Yes, hello. Let's start our CMA Inter Financial Accounting Marathon with your chapter number 1, Accounting Fundamentals. Let's go through all the concepts, then we'll go into all the PYPs, and then we will solve all the model test papers. Clear? First, let's start with concepts. First one is entity concept. What is entity concept? Where the business and business person are two different people. Business and business person are two different entities, two distinct entities. That means if at all you have Shalini and Co as the business and there is Shalini, these are two different people. Even though the business is run by Shalini, it is considered as two different entities. Accrual concept. Accrual concept is what? Transactions are recorded as and when they happen. Okay, not necessarily when the cash is received or when the cash is paid. So imagine a person pays 2 lakhs to one more person, okay, and 1 rupee was also, person was supposed to pay 2 lakhs and 1 rupee also was not paid. Still the salary will be taken as 24 lakhs. Okay, 2 lakhs per month. So 2 lakh into 12, it will be 24 months. 24 lakhs. Even though 1 rupee also salary was not paid in March. This is called as accrual concept. If it is cash concept, what would have happened? March salary is not paid. So 2 into 11, 22 lakhs would have been taken. 22 lakhs. Clear? Periodicity concept. Okay, periodicity concept means what? All transactions related to a particular period will be recorded in that period only. This is the reason why outstanding of that year also is taken in that year only as expense. But if you make a prepaid expense, that means next year's expense you paid today, it is not taken because of periodicity concept. Clear? Next we go into money measurement concept. Money measurement concept is what? In accounts, whatever can be measured in terms of money, those things are recorded. Okay, record all transactions that are measurable in terms of money. Clear? So now imagine you have to pay 5,000 per month to Santosh. That is recorded. Imagine Abdul is telling that I will come and give you one sweet box every day. Every day one sweet box. That is also measurable in terms of money. So any other things which are not measurable in terms of money, those are not recorded in books of accounts. Going concern concept. Okay, there is no indication or intention to shut the business. Indication or intention means what? I don't have plan of shutting down and there is no indication in the market that I will be forced to shut down. Imagine I am selling imagine this person is selling chocolates and the chocolate is going very good in the market, but she decided that she is tired of this business and she wants to stop. This is called as intention. Imagine the chocolate is not being sold only in the market. She can't compete only with anybody. That is called as indication. Clear? Next, matching concept. Now, what is matching concept? Just like you can see, the person is wearing matching goggles and matching shoes. Same way over here, income and expense should be matched with each other. Okay, if income is recorded in a period, expense that is related to earn that income, that also should be recorded in that period only. Next, dual aspect concept. Dual aspect concept is what we are following in books of accounts. That is double entry system of accounting. For every debit, there must be one equivalent credit. Okay, next, realization concept. What is realization concept? Any income must be recorded to the extent it is going to be realized. That means I made a sale and I feel that I will get the money back. I will record the sale even though I didn't get the money today. But imagine I made the sale and next moment only when I called, that person has blocked my number. That means I made the sale. I am not confident of realizing the amount. That amount will not be recorded. So any income must be recorded only to the extent that it can be realized. Cost concept. Cost concept usually tells us that all assets must be recorded at cost when purchased. So when you purchase an asset, it should be recorded at cost itself. Clear? Conventions. Next we go into conventions. Okay, first convention that we have to learn is conservatism. Okay, conservatism, all expected loss should be recorded, but not the expected profits. Now imagine there is Sriram over here. Okay, Sriram, one day he was going home. When he was going home, he saw one astrologer with one parrot. He asked the parrot to pick some chits. In that chit, it came that he is going to win 20 lakh rupees. 20 lakh rupees is going to win. So what he did immediately, he took 20 lakh rupees from his uncle and he went to Goa. Okay, straight away he went to Goa and spent all that 20 lakh rupees. Now after that, when he came back from Goa, he saw the lottery result. He didn't win even 1 rupee. So now he had to ask uncle for 500 rupees more to come back. Okay, even train ticket he didn't have money. So he had to take 500 rupees and he had to come back. So now what happened over here? He did not follow conservatism. Because of that, what happened? He recorded the expected profit and spent money. But when the profit did not come, he was in trouble. But if it is expected loss, imagine this parrot would have told Sriram that when you are going home, there can be an accident in the next 2 weeks. And bike, there can be some repair required for his bike. Okay, so what happens in such case? Expected loss is there. If at all you would have made a provision for this, and if actually the accident happens, he can that time use that money, okay, which he has kept aside. Imagine the accident did not happen. That time no problem. He can take that money and use it for something else. This is a very important concept. In multiple chapters we are going to see this, because wherever provision is created, provision for bad debt, provision for loss, provision for anything, wherever it is created, that is always because of the concept of conservatism. Next, consistency. Consistency is basically like how you need to consistently study till the exams are there, right? So all rules and concepts followed must be applied consistently from one period to another period. Okay, so today you feel that you will use one method of depreciation. After 6 months, you should not change and then again not come back. So consistently, if you follow all the accounting rules, that time it is easy for the person to compare and see also. Next, full disclosure. That means do not hide anything. Whatever is there, completely disclose to the reader so that it will help the reader to also take the decisions. All info required for the reader must be disclosed. Materiality. Now see, this full disclosure is very important, because sometimes what happens, if it's my business, I don't want people to know about the loss. So loss I can hide and I can show fake profits. That should not be done. Whatever info is there as it is, it must be disclosed. Materiality. Now, when there is information, business runs for 365 days, right? 365 days info also, can I tell everything to the reader? Imagine some days, employees went for lunch and came 10 minutes late. Is it important for the reader to know? No. So such information will not be disclosed. But if at all they came late and I'm going to charge penalty from them, that should I tell the reader? Yes, because money measurement concept also comes into picture. Disclose only that information that is needed for the reader. Clear? Which will help the reader to take decisions. Next, we'll go into the next concept, that is capital and revenue expenditure, capital and revenue receipts. Now, this is one concept. Again and again, they're asking questions, 7 mark question to tell whether it is capital or revenue. Now, capital items means usually the things that impact the balance sheet, and revenue item means the things that impact your trading and P&L account. Now, revenue is usually short term and recurring in nature. Short term means it's related to this year and it happens again and again. For example, your rent, you will pay every month rent, correct? And it's related to this year also. And you will not pay rent, let's say you will not pay rent for 5 years. That becomes lease. And that will go to balance sheet. You have lease accounting chapter. It will go to balance sheet because it's a capital transaction. Now, long term. Capital is something that is long term, non-recurring in nature. If you buy one building, you will not buy every year. Okay, it's one time, maybe sometime in 10 years, you will buy 2 buildings. So it's not recurring in nature. And usually capital, the very important point you have to keep in mind is it's giving you extra benefit. If it gives you extra benefit, it will be considered as capital. Clear? Now we'll go into some examples. Now, first example, building purchased is always capital. Okay, by computer dealer. Building purchased by computer dealer, capital. Imagine I tell you, building purchased by building dealer. Okay, that is revenue, because it's his business only is doing this, buying and selling building. So building purchased by a real estate dealer, it would have been revenue. Now building taken on rent. Now I have to pay rent regularly. Okay, revenue. Building purchased by real estate dealer. Yeah, here it is. It is revenue. Computer purchased by computer dealer. Revenue. But the computer, if it was purchased by the real estate dealer, it would have been capital. Now, computer purchased by real estate dealer, capital. Now, repair to building or machinery. Now you have to worry about one thing. If the repair is going to give me extra benefit, if it's giving me extra benefit, it's capital. If it is giving no extra benefit, then it will become revenue. Is this clear? Now, you have plant and machinery over here. Okay, this is your plant and machinery, by the way. Okay, this plant and machinery, if I repair, before it was giving me 5 units per hour, it stopped because of some short circuit or something. It stopped working only. Now, how many units it is giving me? 0 units per hour. Clear? By repairing it, it will again give me 5 units per hour. It's not giving me extra benefit. It is giving the same benefit what it used to give before. Okay, this will be revenue. But imagine by repairing, I put some new part over here. It's going to give me 7 units per hour. That time it becomes capital. 7, Tala for a reason. Yes, plant and machinery purchased. Plant and machinery purchased is capital. Clear? Installation charges of plant and machinery is also capital. This is a very important thing that you have to understand. See, it's like a chain reaction. One capital expenditure comes, related to that, whatever capital expenditures are there, everything will, whatever expenditures are there, everything will be considered as capital. So basically, if you are purchasing one machinery from some other country, till that machinery reaches your location where you can start using it, all the expenses are like a chain reaction expenses. Everything will be capital. Now see over here. Abdul is there, sitting in Chennai. Okay, he has ordered machinery from Russia, and that machinery is put into the boat. Okay, ship, and it is coming. Or whatever you are paying for the ship, that is also capital expenditure. It is also added to the machinery only. And to put to the boat, you have to have some loading and unloading expenditure. That is also capital expenditure. It reaches the port. That is also capital expenditure. In port, you have to pay duties and taxes. That is also capital expenditure. From port, it has to reach his factory. That is also capital expenditure. Once it reaches the factory, we need to install it, unload it, and then install it. That is also capital expenditure. After installing, whatever expenditures are there, those are revenue expenditures. So till that thing reaches its present location and condition, it will be considered as capital expenditure. Now, construction of building, capital expenditure. Preparing the site for construction, that is also capital expenditure. Now imagine our land is looking like this. Okay, now if I have to make that land level, that means preparing the land for construction, that is also capital expenditure. Demolition of old building. One old building is there, I have to demolish that so that I can construct new building. That is also capital expenditure. Now, temporary huts for workers. Workers are going to stay. So workers have to stay overnight, no? So for them, I made some temporary hut or shed. That is also capital expenditure because that is required for constructing the building. Now, temporary huts demolished. Imagine building is ready. Will I still keep the temporary hut over there? I will demolish it. So that is also capital expenditure. Inauguration of new factory. Everything is done. Building is ready, right? Then I call, let's say I call Virat Kohli. Okay, I call Virat Kohli to inaugurate. So when I call Virat Kohli to inaugurate, he'll charge some 2 crore rupees. Now, without calling Virat Kohli, let's say without calling Virat Kohli, local MLA I called and inaugurated. Still you can use that building. So building was already ready. This inauguration is always for marketing purpose, advertisement purpose. So it will be considered as revenue. Advertisement expense, revenue. Clear? Now, let's go into the next part. This is our accounting process. We start with always journal. Okay. Journal alternative is what? What is the alternative for journal? Subsidiary books. If there are too many journal entries related to same type, right? You can put it into subsidiary books. Then from journal, we move into ledger. The things are posted from the journal to the ledger. Then from ledger, we go into trial balance. Trial balance, this is called as unadjusted trial balance. Then there are some adjustment entries. If you pass the adjustment entries, trial balance will become adjusted trial balance. Then from the adjusted trial balance, you can prepare trading P&L account and balance sheet. This is the accounting cycle. Clear? Now, journal and ledger. Let's quickly go into journal and ledger. Journal is called as the primary book and ledger is called as the secondary book. You can get these things even in MCQs. Okay. So now journal, alternative for journal is what? Subsidiary books. Now, instead of passing many journal entries, purchase account debited, purchase account debited, purchase account debited to different parties, what I can do is I can prepare subsidiary books. Clear? Now, all transactions are recorded in primary book. All transactions are posted into the secondary book. Now, journal, okay, always is in chronological order. Chronological order means what? Date wise. Okay. It doesn't matter that after one purchase, one sale came. After sale, one rent entry is there. But still everything is of that date. Everything will be recorded together. In ledger, what happens? Transactions are recorded in analytical order. It's called as analytical order. That means all cash entries, one ledger. All rent entries in rent account. All electricity entries in electricity account. Okay, transferring debit and credit items from journal to ledger is called as posting. Clear? Next, we go into journal. Now, this is absolute basic of journal. Traditional method and modern method are there to pass journal entries. Traditional method classifies everything into what? Real account, personal account, nominal account. In real account, what happens? Real account is usually related to your non-current assets. Real account is usually related to your non-current assets, and then personal account is basically natural persons, artificial persons, and representative persons. Okay, what is representative person? Basically owner. Owner is a representative of the business. So his capital account and drawings account are also called as representative persons. Nominal account. Nominal account, what do you have? Expenses, losses, incomes, gain. Now let's go into the rule of real account. Real account, debit what comes in, credit what goes out. And personal account, debit the receiver, credit the giver. And nominal account, debit all expenses and losses, credit all incomes and gains. Clear? Now, if at all you are not comfortable with traditional approach, or if you are learning journal entries for the first time, best thing to go is with modern approach. Modern approach classifies everything into 4 categories: asset, liability, expense, income. And also the fifth one, which is also liability, it is called as capital and equity. So liability and capital, both same because they are on the same side. Okay, liabilities, we call liabilities for outside liabilities. Capital is also liability, but that is insider's liability. Okay, so if it is asset, asset increase, debit. Asset decrease, credit. Liability increase, credit. Liability decrease, debit. Expense increases, debit. Expense decreases, credit. Incomes increases, credit. Incomes decreases, debit. Capital is same like liability, so the rule must be same as liability. Now simple. Okay, let's simplify this and remember one thing. If it is an expense, okay, it can be 2 types of expense. Either it is revenue, that means it is considered as expense, or it is capital, that means it is considered as asset. So rule for expense and asset is same. If it is income, it can be revenue receipt, which will be considered as income. It can be capital receipt, which will be considered as liability. So can you see liability and income, the rule is same. Clear? Yes. Then we go into outstanding expense, prepaid expense, income accrued and income received in advance. Now, outstanding expense is always liability. Why liability? I have to pay somebody money, so there is a burden or responsibility on my head. Whenever there is burden or responsibility on my head, it's considered as liability. Same way, opposite of outstanding is what? Me doing the things early. That is prepaid expense. If I have done something early, I don't have tension tomorrow. That is considered as asset. For outstanding expense is liability. So liability should be credited. So entry is expense account debited to outstanding expense. Clear? Now here, to remember this, remember, we had discussed that even though you don't pay the money, you still should take it as expense because of periodicity concept. So expense is debited. Can you see we have added it to expense over here? And outstanding expense is liability. That's why outstanding expense is credited over here. Now, prepaid expense. Prepaid expense is asset. Asset should be debited. So prepaid expense is debited. And prepaid expense means what? Next year's expense. That means it is not this year's expense. So we should remove it from expense. So expense is credited. When expense is credited, expense reduces. Clear? Now when we go into the next part, income. Income accrued means what? Income is receivable. It is asset. Income received in advance means what? Liability. Income received in advance means what? Liability. Now you're like, sir. Income received in advance, how is it liability? I got money, no. How is it liability? Somebody gave me money, but I have not done my work. Imagine my building is on rent. That fellow paid next to 12 months rent. So I still have to give the building to him, no, for using. So if income is received in advance, that means I still have a burden. I still have not fulfilled my responsibility. So it becomes liability. I have done my work, but I didn't get the money. That means it is receivable asset. Because it is asset, income accrued is debited. Okay, and remember periodicity concept. Okay, so this year's income should be added so to income account. Income received in advance is not this year's income, it is next year's income because I didn't do the work yet. So income account debited, that means I have to reduce the income to income received in advance. Is this clear? Yes. Let's go further. The next concept that we have to discuss over here is cash book. Now when we are talking about cash book, the name itself suggests, what is it going to record? Cash, but not only cash, all cash and bank transactions. Okay, now if I prepare cash book, again going and preparing cash account doesn't make sense because cash book also is in ledger format only. Again, if I prepare cash account, that also will be in ledger format only. So no cash ledger, no bank ledger. Directly from cash book, the balance will go to trial balance. This cash book is very important because in BRS also they can ask you questions on adjusted cash book. Clear? So now cash book is of three types. One is single column. Single column means which column is there? Either cash column or there is bank column. Imagine you are having only bank transactions. Okay, that time there is no use of cash column. No, that will be a bank column. Now double column cash book. Double column cash book means what? Cash and bank column, or cash and discount column, or bank and discount column. Clear? Triple column cash book. Triple column cash book means what? Cash, bank, discount, everything. Now you're like, sir, this is a cash book. What is discount column doing over here? When I make payment or when I get money, there can always be discount, right? So instead of preparing separate ledger for discount, here only if I have the discount column, I get to know whether discount is allowed or discount is received. Clear? Next, we'll go into discount. Discount can be of two types. Very important. Trade discount. Trade discount means what? For example, you went to shop. Okay, you saw over there it was written 500. Then they put one strike mark like this and they wrote 450. This discount is there, no trade discount. The discount which you got at the time of trade. Trade means buying or selling. Clear? For this you will not pass any entry. Directly you will pass entry for 450 only. But after getting ready to pay 450, later next day when you go to make the payment, right? That time if they give you some cashback offer, they told okay, pay only 420. 420 will be the amount, but the 30, what is the difference? This is called as cash discount. So the discount at the time of buying or selling is trade discount, and the discount at the time of payment or receipt is called as cash discount. For trade discount, there is no entry, just reduce it and directly record the net amount. For cash discount, what will happen? You have to take the discount as discount allowed or discount received. Clear? Now, when I am making payment, I can get a discount. That will be discount received. When I am getting payment, that means I have to give discount. That will be discount allowed. Is it clear? Now, discount allowed means what? I gave discount. For me, it is bad, expense. Discount received means what? For me, it is very good, income. Clear? Discount allowed will be debited because it is expense. And whom did I give discount? I gave discount to somebody who has to give me money. And that person who has to give me money is debtor. Asset reduces. Discount received means what? I got discount. For me, it is income. But who gave me discount? Somebody who I had to pay money. That is creditor. Is this clear? Now, single column cash book. Nothing. It's just like a ledger. Date, receipts, amount. This amount can be cash or bank column. It cannot be discount column because it won't be cash book that time. It will become discount book if I put discount column over here. Two column cash book. Date, receipts. I have written cash and bank. It can be even cash and discount. It can be even bank and discount. Okay, on the other side you have payments. Three column cash book, discount, cash and bank. All three are there. You can even interchange these two columns. Instead of writing cash and bank, you can write bank and cash also, no problem. But always keep discount as the left hand side column. Now, notes. This is a very important note. Check received and deposited. Now, here there can be a confusion. Students usually what they see, when they see that check received, right, you directly write bank account debited. But if it is received and deposited, then only you are supposed to write bank account debited to debtor. Imagine it is received today, but it is deposited tomorrow. Now what will happen? Check received on one day. You will write check in hand account debited to debtor. Okay, check in hand. That means it is not yet gone to the bank. It is there in your hand. Check in hand account debited to debtor. And when you deposit it on that day, some other day, that time check in hand is gone and money comes to the bank account. So bank account debited to check in hand. Clear? This you have to be careful. Petty cash book. There is one company called as Karthik Limited. Now imagine there is Bambani. Bambani is the cashier. Now cashier has too much work. Correct? Too much work. So what Bambani will do? He will call one assistant. And he will call that assistant Geenal. And he will tell Geenal, please look after all the small transactions. That person is called as petty cashier. Now petty cashier, there is a big confusion about petty cashier. Petty cashier will only deal with petty expenses. But even petty incomes will go to whom? Bambani. if Bambani has set the limit of 5,000, no, inside 5,000, all the expenses will be paid by GNL. But any incomes which are there below 5,000, that will go directly to Bambani only. Imagine 50 rupees payment, GNL will do it. 50 rupees receipt will go to Bambani's pocket. Clear? Petty expenses are paid by petty cashier. Now, petty cash, we have two types. One is normal, one is impressed. Normal means every time, every time period, same amount is given. Imagine I give you 500 rupees today, you spent only 5 rupees, till next time again I'll give you 500 rupees. Impress system means amount spent by petty cashier is reimbursed. Imagine I give you 500 rupees today, you spend 200, I will not give you 500 again, I'll give you 200 to make that balance again to 500. Clear? Now, petty cash book as a format, receipts, date, particulars, LF, voucher number, then rupees. This rupees is what for the payments. This rupees is what for the receipts. After that, you can go on adding columns. Whenever there is any item, you go on adding columns. Postage, miscellaneous, this, you go on adding columns. Clear? Next, BRS. BRS you have to be a little thorough because regularly they are asking questions on BRS. Now, BRS is basically bank reconciliation statement. Okay. Statement showing difference between cash book and pass book. Cash book means what? Just now we learned fresh and we came what is cash book. What is cash book? What is cash book? Cash books, that is something as cash transactions, bank transactions. I don't care about cash transactions. In BRS, I don't care about cash transactions. What am I worried about? Only the cash book bank column and pass book. So basically cash book bank column means what? It is maintained in books of accounts and it is our asset. Basically my transactions in the bank recorded by me. Okay. And passbook means what? Maintained by bank. For bank it is liability. That means my transactions maintained by bank is bank passbook. My transactions maintained by me is the cash book. Clear? For me, balance in the bank is good. That is asset. For bank, if at all there is balance, it is bad because they have to give the money back whenever I ask. That is liability. Clear? Now books. Understand? Cash book. Normal means debit balance. Normal means it's also called as favorable balance. It's called as favorable balance, debit balance. Passbook means what? Normal, it is credit balance. Normal means what? Again, favorable. Why debit balance? Because for us it is asset. Why credit balance? Because for them it is liability. Now in books, books means books of accounts. OD. OD means what? Overdraft balance. That means unfavorable balance. That is credit balance because for us it is liability. And if it is OD, bank person will be very, very happy. Why? Because he'll get interest. So for OD, if it is OD in the passbook, that is asset. So bank balance will be debit balance. Now simple, you have to remember if you get confused with this debit balance and credit balance in the exam. No, just remember whenever you make a Google Pay payment to your friend or some tea shop, that when you make the payment, you'll get a message that amount is debited to your account. That means amount is debited means bank is debiting. That means they are reducing their liability. If amount comes into your account, it will write amount is credited to the account. That means for bank it is liability, so they are crediting to your account. But in your books, when amount comes, you will not write credited to your account. You will write debited to your account because for you it is asset. Asset increase debit. For bank it is liability. Liability increase it is credit. Clear? Now, let's understand. Okay. Normal balance, OD balance. This is movement of balance. How the balance moves, because we use the hand movement method. So we have to understand very clearly in which direction the movement happens. Now, if it is money coming in, normal balance, let it be in bank, let it be in cash book. Normal balance, if money is coming in, balance goes up. If money is going out, balance goes down. Okay, not debit credit, just movement of balance. If it is OD balance, already I have to pay money to the bank, right? If money comes in, that time what happens? OD balance goes down. If money goes out, that time OD balance goes up. Clear? Now, right hand will always be your start point. Left hand will always be your end point. Whenever we have BRS, what we will do? We will write no OD balance as per or normal balance as per something. What we write as per, it can be cash book, passbook, anything. Whatever we write over your starting point, take that as your right hand. Okay, whatever you are going to end with, that is going to be your left hand. Clear? Now, simple. Right hand, no. Whatever happens, you can move it. Okay. Imagine right hand went up, you will reduce it. Right hand went down, you will add it. Now left hand, if at all left hand has gone up, then you will not move the left hand, you will move the right hand. Clear? Now entered here, reverse. Whatever is entered here, reverse. Okay. If it is not entered here, then you move the right hand. Clear? Not entered here, then do it. Okay. If it is entered here, do it. Clear? So what we have to understand, what is this entered here, not entered here? If it's entered in the starting point, not entered in the ending point, reverse it. If it's entered in the ending point, not entered in the starting point, then you do it. Then you move the right hand. So all that moves is right hand only. So right hand increases, left hand didn't increase, bring the right hand down. Right hand decreases, left hand didn't decrease, you increase the right hand. Now right hand did not move, left hand increased, then you move the right hand also. Left hand decreased, you decrease the right hand also. Clear? Now, common differences, we'll see some common differences which are caused. Check deposited, not credited. Check deposited means who deposited? We only deposited. So entered in the cash book, but not entered in the passbook. Check issued, not presented. Check issued means what? Entered in the cash book. We have entered it in the cash book, but not entered in the passbook. Okay, simple, no? When I am depositing the check, I will fill all the challan and all in the bank and I will deposit it. And in my book, I will pass the entry. But bank will record it only when the money comes into the account. So there will be a delay. Check issued means what? I gave check to you. When I gave check to you, I wrote your name, signed, and I gave the check to you. So I passed the entry. You kept it in your pocket and forgot to deposit it. Whenever you deposit, that time your bank will ask my bank for the money. That time my bank will remove the money. So there will always be a delay between in check issued and check deposited. Very common ones. Bank charges means what? Bank will charge money. They will not call you and ask whether we can charge the money or not. So entered in the passbook, not entered in the cash book. Cash book we will enter only when we see the passbook. Oh, bank charges were there. We will record it. Now interest and dividend received. Imagine we get interest or dividend. Bank will receive the money, put it in the passbook. They will not call you and tell, no, we received the money. So when you see the passbook only, you will get to know, oh, extra income is there. So that is not entered in the cash book. So entered in the passbook first, later on it will be entered in the cash book. Now difference between cash book and passbook. There are two types of differences. One is called as timing difference. One more is called as error. Timing difference means what? I deposited today, bank will record tomorrow. Or I took the money today, bank will remove the money tomorrow. So there's a timing difference. Check deposited, check issued. These are all timing difference. Errors means what? I put 10 rupees more when passing the journal entry. Or bank has debited 100 rupees more when they did the recording. So errors are not under our control. It's not a timing difference. So in BRS, when we are doing BRS, they can ask two types of BRS. One is without adjusted cash book. Another one is with adjusted cash book. If it is without adjusted cash book, that means enter all the differences in BRS only. If it is with adjusted cash book, adjust the cash book. Adjust the cash book for what? Only things which are under your control. Adjust cash book for items not entered in the cash book and errors in the cash book. Okay, this is very, very important. What to adjust? Things which are under your control. What is under your control? Bank entered, you did not enter. Enter it. It is under your control. Bank made error, you did not make error. So this is not under your control. Bank has to rectify. But if you made error and bank did not make the error, you rectify it. Clear? So adjust the cash book for items not entered in the cash book and errors in the cash book. Not entered, enter it, error, rectify it. Clear? After that you prepare BRS. So your BRS will become little smaller because most of the things you corrected which was under your control. Now you go into TB. Trial balance. Okay, trial balance is basically what? List of all ledger accounts, guys. You know the format, serial number, particulars, LF, debit, credit, put all the ledger accounts. Now if you are confused anytime, just remember asset means debit balance, liability means credit balance. Opposites, income and asset is same. Expense and asset is same. So it will have debit balance. Opposite of expense is what? Incomes, credit balance. Capital and liability are same. So liability will also have credit balance and capital will also have credit balance. What is drawings? Drawings is opposite of capital. Capital means owner giving money to the business. Okay, drawings means owner taking the money from the business. So it will have a opposite of capital balance, that is debit balance. Now let's go into depreciation. Okay, depreciation is decrease in the value of tangible asset. Tangible asset means what? Something that has physical substance. You can see, touch, feel and all that. That is called as tangible asset. Intangible asset, it's not called as depreciation. It's called as amortization. Same thing. Tangible asset decreasing, it's called as depreciation. Intangible asset decreasing, it's called as amortization. Now Akash is there who has a car. Okay, 2 crore rupees car. Akash is sitting here. These are his friends. Okay. Now reasons. What are the reasons for depreciation? Wear and tear. Okay, Akash sees one hump, he does not put the brake at all. He jumps like the Telugu movies. Directly he want to jump over the lorry. Okay, then passage of time. Passage of time is what? He's taking great care of his car. But the thing is, when time passes, automatically the model becomes outdated. So passage of time. Then technological changes. Imagine his car is in great shape. But they said that anymore you can't use petrol cars. You can use petrol cars only one day in the week, remaining every time EV it is. So that time, because of the technological change also, the value of the car can go down. This is called as depreciation. Reasons for depreciation. Now depreciation, you have two things to do. One is computation, other one is accounting. Clear? In computation, what you will do? You will compute the amount of depreciation. Once you compute, then you will do the accounting for the depreciation. You have multiple methods. One is straight line method. Method by method will go. First one is SLM, that is straight line method. Straight line method is also called as what? Original cost method. After we know that it is original cost method, one more word we'll use, that is called as fixed installment method. Clear? With these words, we understand one thing. In straight line method, no, depreciation is same every single year. Every year depreciation will be same. So if you calculate depreciation for first year or fourth year, if the numbers, if at all the values have not changed, it will be same depreciation. Clear? Depreciation is equal to cost minus scrap value divided by useful life. Cost will be given in the question, scrap value will be given in the question, useful life also will be given in the question. Let's take an example over here. Imagine Shalini has a bike, 500cc. This is the bike. Example, cost is 1 lakh, scrap value is 10,000, useful life is 3 years. So what you will do? 1 lakh minus 10,000 divided by 3 years. Clear? 1 lakh divided by 3 years. That time what you got? 30,000 per year is a depreciation. Now next method which we are going to learn is WDV method. WDV method means what? Written down value method. In written down value method, what happens? Depreciation will be calculated on the written down value. Written down value means what? After removing depreciation, whatever is there, that is a written down value. Now, year depreciation is equal to year 1. In year 1, there is no written down value because the year just started. So, cost into depreciation rate. Cost is also given, depreciation rate is also given. But year 2 onwards, what we are doing? WDV into depreciation rate. What is WDV? The written down value. Every method, now understand this, every method will have WDV. Whether you are following SLM, straight line method, depletion method, anything, you will have WDV. WDV is nothing but you will write no, balance carried down. Then next year you will write no, balance brought down. This is called as WDV. Okay, in WDV method, on this balance only we will calculate depreciation. In any other method, we will not use this balance for depreciation computation, but this WDV is there everywhere. So year 2 onwards, WDV into depreciation rate. Clear? Now example you see, if the cost is 10,000 and depreciation rate is 10%. First year what will you do? First year there is no WDV, no. First year directly cost into 10%, you will get depreciation of 1,000. Okay. Sorry, if it is SLM, this will be the depreciation every year. But if it is WDV, cost into depreciation rate 1,000, you will get 9,000. Next year on the WDV, you will calculate 10%. Next year again on the WDV, you will calculate 10% and so on. It will continue. Clear? Now sum of digits method. Now this is a very rarely used method, but if at all they ask the question, it's very easy. Now here depreciation is equal to number of years remaining divided by sum of digits of useful life into cost minus scrap value. What is this number of years remaining? Including the current year. That means if at all 5 years useful life and I am in the first year, I have to calculate even first year. That means 1, 2, 3, 4, 5. If I am in the last year, I have to consider even last year. That means 1 year remaining. Okay, sum of digits of useful life. If at all there is 5 years, no, it is just basically 5 plus 4 plus 3 plus 2 plus 1. This is the sum of digits of useful life. Now useful life is 5 years. What you can do? Shortcut method, n into n plus 1 divided by 2. That means 5 into 5 plus 1 is 6 divided by 2. This will become 15. If you do 5 plus 4 plus 3 plus 2 plus 1 also, you will get 15. Now remember one thing. Denominator is fixed. Multiplier is what? Cost minus scrap value. That is also fixed. Every year what will change? Only number of years remaining. That will change. Now see this example, cost is 10,000, scrap value is 2,000, useful life is 5 years. Now depreciation in year 1, what will you do? If you are in year 1, how many years you have remaining? 5 years. Okay, this is what? 5 into 6 divided by 2. So this is 15. 5 divided by 15 into cost minus scrap value, you get 2667. Second year, what is changing? It becomes 4 by 15. Third year, what is changing? It becomes 3 by 15. Then it will become 2 by 15, 1 by 15. So basically only the numerator is going to change if you are doing sum of digits method. Now, production units method, machine hours method and depletion method are all cousins. Okay. So basically what production units method means what? How much units you produce, that much it will depreciate. So units produced divided by total units into cost minus scrap value. If it is machine hours method, number of hours used divided by total hours into cost minus scrap value. Depletion method is usually used for land and all. Mines, quarry, all that you will use the depletion method. How much quantity you are going to extract. Imagine you are going to remove iron ore or some other natural gas, something you are going to extract. Quantity extracted divided by total quantity into cost minus scrap value. But all are similar methods. Clear? Now we go into accounting. Okay, when we are going into accounting, reduce from the cost of the asset. First method is what? Reduce it from the cost of the asset itself. That means if I purchase the asset, everywhere same entry. What is the asset purchase entry? Asset increases, asset account debited, the money decreases, that means bank account credited. Depreciation will be depreciation account debited to asset account. Depreciation is expense, expense account debited to asset account. Is this clear? Now create provision for depreciation. Method 2 is what? Don't touch the asset account at all. Let the asset be like that only. Now keeping the asset same, still we want to reduce the asset. What can we do? We create a liability. Liability is what? Provision for depreciation. So here what I do, asset account debited to bank and depreciation entry will be depreciation account debited to provision for depreciation account. Depreciation account debited to provision for depreciation account. Is this clear? Now in both methods, depreciation is debited. Can you see here also depreciation debited? Here also depreciation debited in both methods. So in both methods, P&L account debited to depreciation. That means depreciation will always go to P&L. Now see over here. Here depreciation account debited to asset. That means asset reduces. Here depreciation account debited to provision for depreciation. Provision for depreciation is a liability. So in balance sheet, asset I'll keep like that only. But instead of reducing the asset directly, opposite side I'll put liability. Net effect is same. Clear? Now, sale of asset under method 1. Okay, if method 1 is there and if you're selling the asset, simple. Bank account, you got money, so bank account debited to asset account. Put the amount to asset account. Then profit or loss, remove from there and put it to P&L. If it is profit, sale value is greater than WDV on the date of sale. On the date of sale, let's assume your WDV is 400. You sold for 500. That means it is profit. Profit should be credited to P&L. So asset account will be debited. Asset account debited to P&L. Remove the profit from here, put it to P&L. Now, if it is loss, that means sale value is less than the WDV. So P&L account debited for loss to asset account. Is this clear? Now, if at all we are having method 2. Method 2 is what? Creating provision for depreciation account. In method 2, you have to understand one thing. You always will create one account called as asset disposal account. When you get the money, put it to asset disposal account. So bank account debited to asset disposal account. Now take the asset. Asset will be at cost over here. Take the asset and put it to asset disposal account. That means asset disposal account debited to asset account. Then provision for depreciation. Remove the provision for depreciation and put it to asset disposal account. Provision for depreciation is a liability. So when you are removing it, liability is debited. Asset is an asset. So asset, when you are removing it, asset is credited. Can you see everything is transferred to asset disposal account? This is the total provision for depreciation on asset sold. So imagine asset is sold on 1st July. So till 1st July, whatever depreciation is there, that total depreciation will be transferred to asset disposal account. Clear? Now profit on sale. Profit on sale, asset disposal account debited. Now where everything is sitting? The money that is received is sitting in asset disposal account. Cost of the asset is there in asset disposal account. Provision for depreciation is also there in asset disposal account. So from there, asset disposal account, you remove the profit and transfer it to P&L. If it is loss, debit P&L and transfer it to asset disposal account. Clear? So what would have happened in asset account will happen in an account called as asset disposal account. Now, whenever we are solving questions, right, one thing we always struggle, that is new asset, I will calculate depreciation. New asset, what I will do? From the date I purchase the new asset, I'll calculate depreciation. Asset which is sold also no problem. Till the date of sale, I'll calculate depreciation. The problem always confusion or mistakes are made. Depreciation on assets which are unsold. Now what you have to do, take the WDV of all the assets which are there at the starting of the year. Starting of the year, you have some assets. Take entire amount. From that, remove the WDV of the assets sold. WDV of assets sold. You know, right, during the year how much asset is sold. Remove that WDV. That time you'll get the WDV of asset unsold. On this you calculate depreciation. On this you're going to compute the depreciation. Is this clear? Now, adjustment entries. Yes, let's go into adjustment entries. Adjustment entries, these are the entries that are passed at the end of the financial year to record transactions which weren't recorded. Okay, there are a lot of adjustment entries. These adjustment entries will help us also to bridge a gap when we go to final accounts. When we go to final accounts, what we will do is we will not discuss adjustment entries again. All these adjustment entries are going to be asked as additional points in final accounts chapter. Now, first one is closing stock. Okay, simple. Closing stock, what entry usually you pass? You always think that, oh, closing stock, I should put it to trading account and I should show it in the balance sheet. How this putting and showing happens? Closing stock account debited. That's why it becomes asset. Asset goes to balance sheet. To trading account. That's why trading account credit side you find the closing stock. Clear? Now drawings. Drawings means what? Always you have to reduce from capital. But drawings can be of three types. One, drawings in cash. Drawings in cash means drawings account debited to cash account. Drawings is debited because you have to reduce the capital, and cash is credited because cash goes out or cash reduces or asset reduces. Drawings in goods. Goods means what? The goods which you have purchased. So now when I'm giving somebody goods and telling take, use it for your personal purpose. Or I'm not giving somebody, I am using it for my personal purpose. So drawings account debited to purchases account. Okay, so purchases reduces. What I had purchased and thought that I will use it for my business purpose, now I can't use it for business purpose. So I have to reduce my business expense so that I'll create the drawings, and drawings will directly reduce our capital itself. Now in asset, if it is drawings in asset, drawings account debited to asset account. Drawings account debited to asset account. Now, free samples. Okay, free samples. Free samples means what? I gave some free samples to my customer so that if he likes it, he'll come back and buy it. Why am I giving it? Just so that I can promote my product. Advertisement expense account debited to purchases. Now, donation. Donation can again be in cash. If it is in cash, donation account debited to cash. If it is in goods, donation account debited to purchases. Again, because goods reduces, that means purchases. Now, free samples given to employees. Now simple, if I give free sample to employees just for them to enjoy it, then it will not be adjusted with salary. That time it will become advertisement account debited to purchases. If it is adjusted with salary, then salary account debited to purchase. Because instead of giving money, I am giving them goods. So salary account is debited, but goods goes, so purchase account credited. Abnormal loss. We will see this abnormal loss again and again in other chapters also, like consignment and all. Now abnormal loss means abnormal loss account debited to purchases. First you reduce the goods. Either you put it to purchases or directly put it to trading account. Now see, this is my trading account. Either I can put the abnormal loss on the credit side or I can reduce from the purchases on the debit side. Both will give me the same effect. Clear? Then if insurance compensation is receivable, that means insurance company is going to give me money. That time what will happen? Insurance company is a debtor for me now. Insurance company account debited because I have to get the money. Okay, to abnormal loss. If insurance company is not going to give, that means full loss falls on my head only. P&L account debited to abnormal loss. Now this is a very important thing. First what we are doing? Creating the loss. Loss is debited. Okay, then what I will do? Abnormal loss means what? Goods, right? Now goods I have to reduce. So credit the purchases or credit the trading account. Then what I am going to do? Insurance compensation is receivable. So insurance company account debited. So loss is not on my head. So credit it to abnormal loss account. If at all I am not going to get any insurance compensation, that time P&L account debited to abnormal loss. Clear? Loss is debited. Ultimately it's loss. So from trading account we remove because we have to remove the goods. We are not going to trade in those goods. Remove from there. If insurance company is going to give, good. If insurance company is not going to give, put it to P&L account. Is it clear? Next, stationary stock. Imagine you have a stationary stock. Your business is not stationary business, but you have stationary stock. What will you do that time? Stationary account debited to trading account. Why you are putting it to trading account? To record the closing stock. Then goods in transit. Goods in transit means what? Goods have been sent, but I did not get it. So when I get it, it will be my closing stock. When it is still on the way, what will I do? Goods in transit account debited to trading account. Goods in transit account debited to trading account. Is it clear? Now, bad debts. Bad debts. What are we going to do with bad debts? Amount which is not recoverable. This is a very important point. They again and again ask questions. Create provision for bad debt, reserve for bad debt, all this. Now, bad debt is amount which is not recoverable. It's a loss. Who was the reason for this loss? My debtor. Debtor did not pay. Debtor is an asset. When he is not going to pay, what will happen? Asset reduces. So, bad debt account debited to debtor. Bad debt account debited to debtor. Now, provision for bad debt. Provision for bad debt means what? First only I thought that, oh, somebody might not pay. So, I'll keep the money aside. So, P&L account debited to provision for bad debt. P&L account debited to provision for bad debt. Now, bad debts. Okay, the treatment of bad debt. Bad debt is a loss. Loss should go to P&L. Now, simple. Understand this. Okay, if PDD exists, PDD's provision is there, then provision for bad debt account debited to bad debt. That means take the bad debt from the provision itself. If there is no PDD, then P&L account debited to bad debts. Simple. Now understand this. Imagine you're here. Okay, you have some pocket money. This is your pocket money. And you want to go for a movie. So you will create one more fund called as movie fund. This is the movie fund. Now, when you want to go for a movie, what you will do? You will take the money from the movie fund. Rajni. Okay. You will want to take the money from little areas. Yes. You want to take the money from movie fund. So now what will you do? Movie fund, when on the movie day, you will take from movie fund. Imagine movie fund is not there. You will take the money from where? Directly from pocket money. Now your pocket money is your P&L. Movie fund is your PDD. And the movie is your bad debt. So on the date of the movie, okay, so for example, now switch everything from movie to this side. If there is bad debt and you have provision, the bad debt will be taken from the provision itself. If there is bad debt and you don't have provision, then the money will be taken from the P&L. So therefore, if PDD exists, PDD is gone. PDD is a liability. Liability reduces to bad debts. Now if PDD does not exist, P&L account debited to bad debt. That means loss is directly debited to P&L. Now, example, debtors are 1 lakh. Bad debt is 10,000. Now, what will you do? Bad debt account debited to debtors. Direct, because there is no PDD. Now, what will you do? If PDD balance is 12,000, then PDD account debited to 10,000, to bad debts 10,000. Now, PDD balance will be how much? 2,000. Now, bad debt was how much? 10,000. You reduce the debtor, the initial recognition entry you passed. After that, we have to think whether I should transfer this bad debt to P&L or adjust it with my PDD. So now in that case, what happens? PDD account debited 10,000 to bad debts 10,000. That means PDD will reduce, bad debts is adjusted. Now the PDD balance will be what? 12,000. 2,000. 12 minus 10, 2,000. If there was no PDD, what would you do that? What would you do that time? Straight away P&L account debited to bad debts. Straight away P&L account will be debited to bad debts if there is no PDD. Is this clear? Now, what if PDD was only 8,000? Now, I wanted to go to movie, okay? I kept the money aside in movie fund. Now, after going for the movie, in the break, right, in the interval, I saw that ad, all that popcorn popping. So now I'm like, I kept money only for movie. Now I need to buy popcorn. So that time, what is required for the movie, I removed from movie fund. Extra money from where I'll take? I'll take from my pocket money, which is P&L. Correct? So now PDD has only 8,000. My bad debt was how much? 10,000. So PDD account debited 8,000. P&L account debited 2,000. To bad debts 10,000. Clear? Now, how much provision to create? This is a very, very important part. How much provision to create? Now, provision required, which will be given in the question, okay, minus existing provision balance. Now, this existing provision balance, what students make mistake is directly see the trial balance. They will think that this is the existing provision balance. No, This is the provision owed opening balance minus bad debt. Clear? So now if in the trial balance, in my trial balance, okay, I have bad debt also, I have PDD also. This PDD will be adjusted with this bad debt. After that, whatever PDD is remaining, that is the existing provision balance. Is it clear? So, provision for discount on debtors. Provision for discount on debtors. What is this? I know some people are not going to pay me. That is provision for bad debt. I know some people will pay me, but they will ask me discount. That is provision for discount on debtors. So again, same entry, P&L account debited to provision for discount on debtors. Discount allowed. Discount allowed. Discount allowed means what? I gave discount. So discount allowed account debited to debtors. If there is provision, then don't take the discount allowed from P&L. Provision for discount account debited to discount allowed. If there is no provision, then P&L account debited to discount allowed. Same thing what you did for bad debt, you're going to do over here also. Now, bad debts recovered. Now, most common mistake that students make is if bad debt is recovered. Remember this. If bad debt is recovered, bad debt account won't be touched. PDD account won't be touched. Those are different accounts itself. PDD means amount kept aside for bad debt. Bad debt means somebody who is surely not going to pay me. That's a loss. When you get money, those two accounts won't be touched. The entry will be bank account debited to bad debt recovered. Yes. And bad debts whenever it is recovered, right? Yeah, bank account debited to bad debt recovered. Now, bad debt recovered is an income. That income will be transferred to P&L. Bad debt recovered account debited to P&L. So just remember one thing, whenever bad debt is recovered, do not touch the bad debt account, do not touch the PDD account. Now, provision for discount on creditors, which is very, very rare situation. That means I am first only expecting that my creditor will give me discount and create a provision for this. This provision is not a liability, this provision is an asset actually. When somebody is not going to give me money, I keeping money aside, that is called as liability. When I am not going to give money to somebody and I am keeping money aside, that is called as asset. So creation, provision for discount on creditors, account debited to P&L. So here you are putting the money to P&L, there you are taking the money from P&L. When discount is received, creditor account debited to discount received. Now this discount received, if you had provision, adjust it with provision itself. If you didn't have provision, transfer it to P&L. Same thing, but opposite side is happening over here. Now we go into the very small topic called as rectification of errors. Okay. Rectification of errors. Okay. First you should know what are the types of errors. Lot of rectification questions are there which we have to cover. Now rectification of errors. First it is error of omission, error of commission, error of principle. Error of omission means what? You have done something wrong in your accounting process. Okay, it can be partial omission. Sorry, error of omission means what? You missed something in your accounting process. It can be partial omission or complete omission. Partial omission means trial balance will not tally. That means half the entry you missed. Complete omission means you missed both the sides. Remember we were discussing about dual aspect concept. Debit missed, it will not tally. Credit missed, it will not tally. Debit and credit both missed, then the trial balance will still tally. Clear? Error of commission. Error of commission can be one-sided error. One-sided error is only debit wrong. Debit you took 10, credit you took 100. Okay, it will not tally. Two-sided errors. Debit also you made mistake of taking from 100 to 10. Credit also you made the mistake of taking from 100 to 10. Now the trial balance will tally. Is this clear? Now, error of principle means what? You missed the rule itself. Something that was supposed to be taken as asset, you took it as expense. Asset also debit, expense also debit. So basically both are debited, but it is debited, something else is debited. That's why trial balance will still tally. That means instead of taking it as capital expenditure, you're taking it as revenue expenditure. This is one of the common errors which is there under error of principle. Clear? Now, next thing we have to understand is compensating error. Compensating error is what? Your parents told you to study. You did not study, but that day parents did not check. So they also made mistake, you also made mistake, compensated for each other, you didn't get shoutings. Clear? One error adjusts the difference caused by the other error. Trial balance will tally. Okay, you made a mistake of putting wrong debit. Then later on something else you made a mistake of putting wrong credit. Now that wrong credit, wrong debit, same amount, so it got compensated with each other. Similar to dual aspect, yes. But trial balance will tell you. Yes, rectification. When you are doing rectification, you have to remember one thing. First, pass the correct entry. Then pass the wrong entry. Pass the rectification entry. What is this? Pass the correct entry means ignore the error, see the transaction, record the transaction. Wrong entry means see the mistake that they have done and make the same mistake on your own. Rectification entry will be very easy. That time what you will do? You compare correct entry and wrong entry, you will get the rectification entry. Is it clear? So here, ignore error, pass the entry for the transaction. Here, pass the entry for the error itself. Now when you compare the two, you will get the answer. Clear? Now some shortcuts and tips are there which you have to remember. If debit is missing, see in the exam, no, the marks are allotted actually for the rectification entry. There is no mark for the correct entry, wrong entry, rectification entry. So if you can directly pass the rectification entry, that will be best. Okay, because you don't have to waste time. So you can think of the correct entry, wrong entry and rectification entry in your head and directly write the rectification entry. So to help you do that, right, we can take a note of these tips. Debit is missing. Then what you should do? Missing, right? Debit it. Credit is missing. Then what you should do? Credit it. You missed the credit, do the credit. Debit is less. 100 rupees I had to debit. I have debited only 50 rupees. So what I should do? Debit the difference. Credit is less. I had to credit 200 rupees. I have credited only 150 rupees. So what you will do? Credit the difference. Now debit is more. I had to debit 100 rupees. I debited 150 rupees. Now I can't reduce debit. No. To reduce debit, what should I do? I should do the opposite. I will credit it. So whenever debit is more, credit the difference. Do the opposite effect. Whenever credit is more, debit the difference. Do the opposite effect. Now debit is done instead of credit. Instead of 100 debit, imagine I wanted 100 debit. Instead of that, I have put 100 credit. Now what will I do? If there is 100 credit, first I should remove the credit. Yeah, to remove the credit, what I will do? I will put the debit. Now it became 0. Now I will put one more debit. That time it became correct. So debit instead of credit, credit double. Credit instead of debit, debit double. Clear? Now if it is exact amount only, this double logic will work. Now imagine I wanted this effect 80. But by mistake, what I did, I have credited 100. Now double won't work here. Now there won't be double. So first what I should put 100. It became 0. Then I should put 80. That means 180. Is it clear? So same amount instead of debited, if it has become credit, then we can do this double effect. Otherwise we can't do the double effect. First you remove the wrong effect, put the correct effect. Clear? Stage of rectification is very important. Where are we rectifying things? Before preparation of trial balance, after preparation of trial balance, or in the next accounting period. If it is before preparation of trial balance, what is before preparation of trial balance? Maybe when I'm passing journal entries, maybe when I'm preparing ledgers, that time only I identified that there is an error. If it is before preparation of trial balance, there is no suspense account. There cannot be suspense account. How can there be suspense account? What is suspense account? I was preparing trial balance. That time the trial balance did not tally. So I put the difference into suspense account. That is suspense account. If I am rectifying before preparation of trial balance, there cannot be suspense account. So whatever is mistake, correct it directly. Debit means debit, credit means credit. Clear? After preparation of trial balance. If there are two-sided errors, then again pass the entry without suspense account. What is it? Instead of putting it to asset account, I have put it to expense account. So now what I will do? Remove it from expense account and put it to asset account. That means it's a two-sided error. That time you don't need to use suspense account. But if it's a one-sided error, debit missing, credit missing, one of the sides missing, that time pass the entry with suspense account. Now, in the next accounting period, next year I am going to rectify the entry. When I am rectifying in the next year, suspense account rule is same. One-sided suspense account will be there. But next year, what you have to be very careful is, you will use P&L adjustment account. For what? For expenses and incomes. Logic is simple, boss. Last year's expense, you are recording this year. It will affect your this year's profit. So instead of expense, you use P&L adjustment. Last year's income, you are rectifying this year and showing it as income. It will impact your this year's profit. So instead of writing income, you will write P&L adjustment. So simple rule, suspense account rule is same. If debit is there, no credit, suspense account. Credit is there, no debit, suspense account. But when you're going into the next accounting period, next year, if you are rectifying this year's error, that time what you will do? P&L adjustment. P&L adjustment for what? Not assets and liabilities, only for income expense related. So in your rectification entry, if you have income or expenses, that will be taken as P&L adjustment. Is it clear? With that, we are done with all the concepts of chapter number 1. Questions of chapter number 1. After finishing all the examination questions, we'll go into the model test papers which are there. Now, in June 2025, this is June 2025 paper. In June 2025, question number 2B. You can see question number 2B over here. It was asked for 7 marks. 7 marks was asked from chapter number 1. Now, state briefly the difference between purchase day book and purchase account. Purchase day book and purchase account. Purchase day book is a subsidiary book. Purchase account is a ledger. Now, you can see the differences. Purchase day book simply records only credit purchase of goods, whereas both cash and credit purchase of goods are posted in the purchase account. One of the feature of subsidiary book is what? Only credit purchase of goods are recorded. Okay, but in purchase account, everything is recorded. Now, purchase day book is a part of journal, whereas purchase account is a part of general ledger. Alternative for subsidiary book only is the alternative for journal only is the subsidiary book. That's why it is called as part of journal. Purchase account is part of general ledger. Like all other ledger accounts, there is purchase account also. Purchase day book is not divided into debit and credit sides, whereas purchase account is divided into 2 sides. Purchase day book, that is the subsidiary book, does not have debit side or credit side. Subsidiary book just has a subsidiary book format. That is, only amount columns are there. Inner column, outer column. You're going to write calculate over here and put the amount on the outer column. Okay, so purchase day book will have only credit purchase of goods. If I have credit purchase of asset also, it will not be there in purchase day book. Now, next question that they asked over there was rectify the following errors. Credit sales to Barun was recorded as 7,200. Now, you have to identify what is the mistake over here that has happened. Credit sales to Barun. Usually, what is the entry for credit sales? The entry will be Barun account debited to sales. It should have been like that. But recorded as 7,200. You have put extra. So, see the rectification entry. Sales account debited to Barun. You are reversing the entry for 200 rupees. Clear? Instead of recording 7,000, you have recorded 7,200. So the extra 200, what you have done? You have just reversed the entry for 200. Barun account debited to sales should have been the entry 7,000. They have done Barun account debited to sales 7,200. So you will reverse 200. Sales account debited to Barun. Clear? Next, credit purchase from Raman 9,000 was recorded as 9,900. Similar type of error again. Okay, Raman account debited to, purchase account debited to Raman should have been the entry for 9,000. They passed the entry for what? 9,900. See the rectification entry. Raman account debited to purchase 900, 900. Clear? Sorted. Next, goods returned to Chaya 4,000 were recorded as 4040. What is the entry for goods returned to Chaya? Goods returned means it is purchase return. So you will pass the entry Chaya account debited 4,000 to purchase return 4,000. This should have been the entry. Okay, now that is recorded as what? 4040. That extra 40 we have to remove. So purchase return account debited to Chaya. 3 errors, all are similar. Okay, purchase extra, sales extra, purchase return extra. So you have to reverse all the extra amounts. Clear? Goods returned from Paresh 1,000 was recorded as 1,400. You cannot get purchase extra, sales extra, purchase return extra, sales return extra. So what is the entry for this sales return? Sales return account debited 1,000 to Paresh. They have put extra 400. So you will reverse the entry. You will reverse the entry for what? 400. See, Paresh account debited to sales return account. June 2025, you told it was tough. This was the toughness. Okay, so guys, paper was easy only. You should have studied, that's all. Next, let's go further. This was June 2025. With that, I'm closing June 2025. There is no other question asked from June 2025 from chapter number 1. Next, let's go into December 2024. 1 second. December 2024, there are 2 questions. Chapter number 1, there are 2 questions. Okay. 7 marks. Let's see if there is one more question at the end. No, that's it. 7 marks, couple of questions are asked. 14 marks just from chapter number 1. Now, on comparing the cash book of Shivam with the bank passbook for the year ended 31st March 2024, BRS, following discrepancies were noticed. Now, comparing what to what? Cash book and passbook. They didn't tell anything about favorable, unfavorable yet. Okay. Prepare bank reconciliation statement if the balance as per cash book is 182,500. So what you are going to start with now? You are going to start with cash book only because cash book is given. Passbook is not given. So your starting point will be cash book. Your right hand is what? Cash book. Left hand is what? Passbook. Okay. So now if you go and check balance as per cash book, 182,500. Okay. Right hand will be cash book. Now, checks amounting to 85,000 deposited into the bank on 25th March. Checks amounting to 25,000 were collected on 5th April. That means 25,000 went into next month. Remaining everything is collected in this month. So 25,000 is causing the difference. So checks deposited means right hand is cash book. Cash book you have already passed the entry. Cash book balance increased. So now what you should do? Decrease the cash book balance. So minus 25,000. Can you see minus 25,000 here? Yes. Next, checks amounting to 38,000 drawn on 28th of March, of which check for 8,000 was presented on 3rd April. Check drawn means what? Check issued. Check issued but presented on 3rd April. So what is causing the difference over here? This 8,000. Check issued means cash book balance decreases. So what will you do? You will add it back. 8,000. I hope it's clear. Next. A check for 4,000 entered in cash book but omitted to be banked. Entered in the cash book. Okay, but omitted to be banked means what? I put it in the cash book but I forgot to put the check into the bank. So cash book balance has increased. Now you will decrease it. 4,000. Can you see the 4,000 here? Yes. Next. A bills receivable for 18,000 previously discounted. Okay, discount 90 with the bank had been dishonored but advice was received on 3rd April. See, when you discount the bill, you will not get the full amount. But when the bill is dishonored, bank will take the full amount. Now, if the bill is discounted, it was discounted at a discount of 90. That means when you discounted the bill, bank gave you 90 rupees less. But when dishonor happens, bank will take full 18,000 only. So bank without asking you will take 18,000. So bank has taken 18,000. So, but the advice was received on 3rd April. That means the message came to me on 3rd April that amount has been dishonored. So, what happens to the passbook balance now? Passbook balance has reduced. Passbook is left hand, so right hand also has to reduce 18,000. Can you see less 18,000 over here? Yes. Now, a check of 20,000 wrongly credited in the passbook on 29th March was reversed on 2nd April. Wrongly credited in the passbook. That means who made the error? Passbook, there is error. Okay, wrongly credited. That means passbook balance has increased. So cash book also you are going to add. Add the 20,000. Next, amount wrongly debited by bank. Okay. Oh, sorry. Question we didn't read only. Bank has wrongly debited 15,000 in the account and reversed it on 10th April. Similar, first what did bank do? Wrong credit. Now bank is doing wrong debit. That means passbook balance reduced. Passbook is left hand. So right hand also you are going to reduce. Minus. Done. Do plus minus. You will get the answer. 148,500. This was a 7-mark question which was asked in June. Let's go into one more question. 2B. State with reasons whether the following are capital expenditure or revenue expenditure. Okay. Capital or revenue they asked for 7 marks. 7 items, 1 mark each. But just writing capital or revenue will not give you the marks. You have to write the reason also. See, the reason that they are expecting is also like one line only. Just stay to the point. Don't go like too deep into the concept also. Because you will be wasting time, right? Because 7 marks, 1 mark for each question there. Now, expenses incurred in connection with obtaining a license for starting the factory were 10,000. License is for starting the factory. Factory is a capital expenditure. This 10,000 also will be capital expenditure. So you can see over here capital expenditure. It is incurred for acquiring a right to carry on business for a long period. That means it is a recurring nature. So that will also be capital. Now 1,000 paid for removal of stock to the new site. You are just removing the stock to the new site. That is revenue expenditure. You are removing the stock from here, keeping it in the new site. That cannot be capital. No, it is not going to give you any extra benefit. Okay, because it is not enhancing the value of the asset, and it is also required for starting the business on the new site. Okay, so basically what's happening over here, it's not giving you any extra benefit. What benefit the stock was giving over here, same benefit the stock will give over there also. It will not give you any extra benefit. Clear? Next, rings and pistons of an engine were changed at a cost of 5,000 to get fuel efficiency. If that word fuel efficiency was not there, it would have been taken as revenue expenditure. Fuel efficiency means you are getting extra benefit. You change the rings and pistons, mileage is increasing. Okay, so now, sorry, my bad. I read this as fuel efficiency. It's full efficiency. So full efficiency means what you are supposed to get, that only you are getting. So revenue expenditure, because the change of pistons and will restore the efficiency of the engine only, and will not add anything extra to the capacity of the engine. Okay, this is full efficiency, not fuel efficiency. Full efficiency means what? You are using the machine and it was giving you, let's say, 80% of the efficiency. Now by changing rings and pistons, it is coming back to 100% of the efficiency. If you change the rings and pistons, and if it is giving you 120%, that means extra benefit. That would have been capital expenditure. 2,000 spent as lawyers' fees to defend a suit claiming that the firm's factory site belonged to the plaintiff. The suit was not successful. This is going to be revenue expenditure. What is this? Am I going to get any extra benefit? I am fighting a case telling that the land belongs to me. Land is already belonging to me. Okay, now what happened? If I win the case, I won't get any extra land. So it will be considered as revenue expenditure. Next, we have 10,000 were spent on advertising the introduction of a new product in the market, the benefit of which will not be effective during the 4 years. In the concept part, benefit of which will be effective during 4 years. Now see, in the concept part, we had discussed this, right? Creating the factory is capital expenditure, but after that calling Virat Kohli for the inauguration, that is not capital expenditure, that is just advertising. So this will be considered as revenue expenditure. They have even given reference of AS 26 also. We'll study AS 26 as we go further. A factory shed was constructed at a cost of 1 lakh. That is capital expenditure. Sum of 5,000 has been incurred for the construction of the temporary huts. Yesterday we saw this also. So totally 1 lakh 5,000. Both are capital expenditure. Now, next we go into pair of bullocks of 50,000 was killed by lightning. We had bullocks. Okay. What happened? Capital loss. Livestock is a fixed asset. Actually, livestock will not be considered as fixed asset as per AS 10. Okay. But because we lost bullocks, it's a capital loss. We don't call it as capital expenditure. We lost the asset. So it's considered as capital loss. Capital loss, capital expenditure. Both will be debited only ultimately. Yes, that should be it with the 2A question. Yeah, December 2024, 7 marks, done. Next, we'll go into June 2024. June 2024, I think there is 2 questions, right? There is a theory question also. No, I think that is in the model test paper. So here we have one 7 mark question which they have asked, plus I think 7, 14 we can take it. Even depreciation is also there. 7, 14, 2A. Oh, they have just given direct answers, right? Now, on 31st March 2023, in the trial balance of Singhania Brothers, balance of the machinery account appears as 19,80,000. The firm follows rate of depreciation on machinery 15% per annum on written down value method. Which method they are following? WDV method. On scrutiny, it was found that machinery appearing in the books on 1/4/2022 at 4,50,000 was disposed on 30th November in exchange of new machinery costing 3,50,000. So one machinery is disposed and another machinery is received. You are required to calculate total depreciation to be charged in the P&L. Total depreciation, direct question they have asked. Now tell me one thing. How much was the machinery here? 19,80,000. But this balance is on what date? 31st of March 2023. End of the year balance. That is the end of the year balance. So here I have placed 19,80,000 is the WDV on 31st of March 2023. Clear? So now the firm follows rate of dip 15%. On scrutiny, it was found that machinery appearing in the books on 1/4/2022 at 4,50,000 was disposed of on what date? 30th November 2022 in exchange of a new machinery costing 3,50,000. So now what happens? 3,50,000 is the cost of the new machinery. Okay, that is purchased on what date? 30th November. So if I remove that 3,50,000, 19,80,000 minus 3,50,000, you will get 16,30,000. Do you agree? This is all old machine only. Okay, 16,30,000. So now 16,30,000 is there. Here what we have to worry about is what is the depreciation on this old machine. Depreciation rate is how much? 15%. So into 15%, 2,44,500. This is the depreciation. Now what happened to this new machine? New machine was purchased at what value? 3,50,000. New machine was 3,50,000 into 15% into how much? It was purchased on 30th of November, December, January, February, March. So into 4 divided by 12. It is how much? 17,500. So you got totally how much depreciation till now? 2,62,000. But there is one more depreciation. Now what we calculated? Depreciation on the asset which is old. Depreciation on the asset which is new. But what about the depreciation on the asset which is sold? Asset which was 4,50,000 was sold on 30th November, no? So we have to calculate depreciation on asset sold. 4,50,000 into 15% into till November, that means it is 8 divided by 12. 45,000. So if you take this 45,000, actually you should get 3,07,000 as a depreciation. It's not 2,92,000, 3,07,000 as a depreciation. Now profit or loss on machinery. Okay, how much was the machinery value? 4,50,000. Clear? 4,50,000 machinery value. If you remove the depreciation which we calculated just now, 45,000, this will become 4,05,000. But it is exchanged for what? A new machine. New machine is what? 3,50,000. That means 55,000 is the loss. Loss. Can you see profit or loss on the machine? It is loss because 4,05,000 value went and 3,50,000 value came. Now, book value. What is the third thing that they have asked? Book value of the machinery in the balance sheet. How much is the balance sheet value right now? They are telling 19,80,000. So 19,80,000. From that you have to remove the depreciation. Depreciation, not full depreciation. The 2,44,500 and 17,500. 19,80,000 minus 244,500 and 17,500. 17 lakh. See, these are the values you will get. You will not get 16,33,000 and you will not get 2,92,000. Okay, again I'll explain to you this one. See, this was the WDV on 31st of March 2023. Okay, now this one is after sale and after purchase. After sale and after purchase. So now if you remove that 3,50,000, you will get the remaining all old ones, all old machine. On that you calculate 15%. You got 2,44,500 depreciation. Then you calculate depreciation on the new one. New one 3,50,000 into 15% into 4 by 12 because it is purchased on 30th November. So 17,500. These are the two depreciations. And one more depreciation is the asset which is sold. Asset which is sold, 4,50,000 was the starting value into 15% into 8 by 12. So you get 45,000. This, when you total, you'll get total 3,07,000 depreciation. Okay, 3,07,000 is the depreciation. This they're writing it as 2,92,000. Then after that, the loss on sale. Loss on sale, what you're going to do? Subtract the depreciation. You got the WDV on the date of sale. Remove 3,50,000. You will get 55,000 as the depreciation. 55,000 as the loss. Now book value of the machine. Book value of the machine, what mistake you can do is, this is the total book value. From this, you remove the depreciation. From this, you remove the depreciation of old assets. From this, you remove the depreciation of the new asset. Don't remove the depreciation of the sold asset. That sold asset is already gone. It is not there in this book value. So that time you will get the remaining value. Clear? This is your question number 2A. When you go to 2B, there is one question. Trial balance of Rajesh brothers on 31st March 2023 did not agree. In order to close the books, the accountant placed the difference of 26,700 debit to suspense account for necessary adjustment in the next period. What they did the trial balance, they got the difference, they put the difference into suspense account. On 25th April 2023, the following errors arising in 22-23 were detected. It is rectification of errors. Okay, but the error has happened in the previous year. You have to rectify it in the current year. Two things you have to remember. Suspense can be there, and if there is expense or income, you have to use the word P&L adjustment. Now, 4,500 allowed as cash discount to a trade debtor was not debited to the discount account. Cash discount was not debited to the discount account. That means now you have to debit it. Okay, so now you can see the rectification entry over here. You can't write discount account. Instead of discount account, you are going to use the word P&L adjustment account debited to suspense account. Why to suspense? Because only discount is not debited. One-sided error it became. Clear? Now when we go to the next one, credit sale of 6,550 was posted to the credit of the customer's account as 5,650. So customer, we have put little less to the customer's account. Only customer there is a mistake, no problem in the sale. So 6,550 and 5,650, if you see the difference, you will get 900 rupees difference. Correct? This 900 rupees you have to put it to the customer's account. That means customer has to be debited. Customer has to be debited one side. Other side there is nothing, no mistake. So it will go to suspense account. Customer's account debited to. One second. Did they make a mistake? Oh, sorry, my bad. Credit sale was posted to the credit of the customer's account. Okay. Now see over here what has happened. Actual entry should have been customer is debtor, right? Debtor account debited to sales. Instead of debiting the customer for 6,550, they have credited the customer. They have written to debtor 5,650. Instead of debit, credit is done. So now what happens? You have to remove this credit and you have to remove this. You have to create this debit. So 6,550 plus 5,650. That's how 12,200. Customer account debited 12,200 to suspense account. Is this clear? So now see customer's account. It should have been like this. We wanted in customer's account 6,550. But instead of that, I have put 5,650 credit. To remove the credit, what I will do? I will put 5,650. That became 0. Then I will put 6,550. That time total debit, how much I have to do? 12,200 to rectify. Only debtor side mistake. Okay, credit, only debit there is mistake. Credit will go to suspense account because it is one-sided error. Clear? Next. Machine purchased on 1st October 2022 for 50,000 in cash was posted to the purchase account in the ledger. Rate of depreciation applicable was 15%. Now here what has happened is machine is purchased. By mistake we put it to purchase account. Now if you forget to pass the machinery purchase entry, that means you have forgotten the depreciation entry also. So machinery is missed, depreciation is also missed. So machinery we have to bring, and then what we have to do? We have to pass the depreciation entry also. Now machinery is how much? 50,000. 50,000 into 15%, and it is 1st October. That means into 6 divided by 12. 50,000 into 15%. That means 3,750 will be the depreciation. Okay, can you see over here? Machinery account debited to P&L adjustment. Net entry only is directly passed. You can pass two entries also. What will be the two entries? First you will pass the entry machinery account debited. Okay, machinery account debited to purchase account. You are supposed to write purchase, but purchase you can't write because you are in the next year. So it will become, see, I will show both the entries so that you are not confused. See, the first entry should be like this. Machinery account debited 50,000 we should have written 2 purchase because by mistake they put it to purchase. But I can't write 2 purchase because I'm in the next year. I'll write P&L adjustment 50,000. Then I have to pass the depreciation entry. Depreciation I can't write. So instead of depreciation, what I'll write? P&L adjustment because depreciation is an expense. So 3,750 to machinery. So now 3,750. Now what happens? Machinery, debit, credit. Net effect is 46,250. Machinery, debit, credit. Net effect is what? 46,250. So you will write 46,250 over here. Okay, then to what? P&L adjustment 46,250. Is this clear? I hope it's clear. Instead of passing 2 entries, they have just clubbed the entries. You can write 2 entries also in the exam, no problem. That is your rectification entry. Then sales book was overcast by 10,000 in February. Overcast means what? You put extra sales. If you put extra sales, you have to remove. Sales usually has credit balance. To remove sales, what should I do? I should debit the sales. But sales I can't write. I will use the word P&L adjustment account debited to suspense account. One side error, so suspense account. Now whatever suspense is there, P&L adjustment is there. No, here debit and here credit, here debit. Net effect whatever is there, it is transferred to capital account. P&L adjustment, right? P&L adjustment is either profit or loss. So net effect whatever is there, it is transferred to capital account. Okay, so obviously you can see that profit is there, profit is transferred to capital account. Yes, and suspense account, they didn't rectify the errors and asked you to prepare a suspense account also. Now when they ask you suspense account, what you will do? Here there is suspense, right? Put it credit. Here there is suspense, right? By customers. Here there is suspense, right? Put it, and this balance will be carried down. The balance brought down was already given, I think, no, in the question 26,700. Can you see now it is matching? That means you rectified all the errors. Suspense account is closed. There is no balance remaining in suspense account. Okay. Now here you have to be again careful. They have told that difference is 26,700 debited to suspense. So suspense will have 2 balance brought down. Then all the errors credit. That time automatically suspense became 0. Is this clear? This is your June exam, June 2024. With that, we are done with June also. So we are left with December 2023. December 2023. In the end, there is one question. Okay, they have asked you question on what is full disclosure, what is consistency, what is materiality, what is conservatism. In the concepts, we discussed all this. Full disclosure means what? Everything has to be disclosed. Okay, whatever is relevant to the reader. Consistency means what? Whatever accounting policies you have to consistently apply over a period of time. Materiality means what? Whatever is important to the reader, that only you show. Don't give all the information to the reader. Conservatism, all expected losses are recorded and expected profits are not recorded. 5 marks, they have asked this question. Okay, let's see what other question is there. There is one. 2A was asked. Okay, for 7 marks. BRS. 2B is also there where they asked you to prepare the adjusted trial balance. Yes, 7, 14 marks. So 3 out of the 4 exams. 19 marks extra. Extra 5. 19 marks just from chapter number 1. So 3 out of 4 exams which we saw till now, right? There is chapter 1 which is asked for 14 marks. Only one exam, the recent exam, they asked for 7 marks. Yes, let's go into December. On 30th September 2023, Shri Sachin Chatterjee's cash book shows that he had an overdraft balance of 400 on his current account at the bank. On checking the cash book and bank statement, you find the following. Now here they asked, you are required to prepare adjusted cash book and then BRS. So again, let's get a quick briefing. Adjusted cash book, what you have to remember? First of all, OD balance. What you should remember in OD balance? Money comes in, balance goes down. Money goes out, balance increases. That is one thing. Another thing is when you are preparing adjusted cash book, things that are wrong in the cash book, you have to correct it. Things that are not entered in the cash book, that you have to correct. Remaining everything will go to BRS. That means what is under your control? Error in cash book, your control, correct it. Things which are entered in the cash book, entered in the passbook, not entered in the cash book, enter it. 2 things under your control. Things entered in the cash book, not entered in passbook, not under your control, show it in BRS. Error in the passbook, not under your control, show it in BRS. Clear? So now, let's quickly discuss this. Checks issued 1500. Okay, see the starting point. You can see the starting point. Balance as per cash book debit. Right? 182,500. Wait, something else was there, right? December 23 overdraft balance is 400 actually.
So the same question. Which we have solved in the
No. I think we got this thing. Wait, 1 second. We got this is the wrong suggested answer we have taken. Yeah. So we got the right answer paper now. So let's start. Shows that he has an overdraft of 400 in his current account. So first we have to prepare adjusted cash book. Then with the adjusted cash book's balance, then we can prepare BRS. So if it is OD, now here usually students make mistake. They see like Shri Sachin Chatterjee's cash book shows that he has an overdraft of 400 in his current account at the bank. Just because they told at the bank, that doesn't mean passbook. Where is the balance? In Chatterjee's cash book. So cash book has OD balance. OD balance means it is credit balance. Okay, liability. So you can see over here, by balance brought down 400. Clear? Next. Checks issued has been entered in the cash book but not entered in the presented to the bank. Entered in cash book. That means you can't do any changes in the cash book. This will go directly to BRS. Now, dividend amounting to 150 had been directly deposited into the bank. That means they have passed the entry in the bank. Now, this is under our control. We should record it. Not entered in the cash book. So, entry is dividend received. Okay, deposited into bank. Dividend received. So, bank account debited to dividend account. So, you can see over here, to dividend account 150. Clear? Next. Bank had credited interest on bank deposit 170, but the same had been debited in the cash book on 6th October. That means where we have missed? In the cash book. That means we can pass the entry bank account debited to interest account 170. Again, I'm telling whatever we under our control. That means not entered in the cash book, enter it. Mistake in the cash book, rectify it. Then you prepare BRS. Now, bank charges of 50 shown in the bank statement, but the same had not been entered in the cash book. Bank charges is there in the bank statement. It's not entered in the cash book. So now enter it. Bank charges is an expense. Bank charges account debited to bank account. Can you see by bank charges over here? 50 rupees. Clear? Next. A check is issued to NK Chatterjee for 50 was replaced when out of date. It was entered again in the cash book. No other entry being made. Both the checks were included in the total unpresented checks shown above. Now, what is this? Check is issued to whom? 50. But the date was already lapsed. So what we did? We issued one more check. Now, both the checks are included. One check should not be included. So now what will you do? Can you see over here? How much was the amount? 50. Okay, see, can you see over here in the cash book you won't find this at all. Okay, why you will not find it in the cash book? Because both the checks, see, both the checks were included in the total unpresented checks shown above. Can you see over here unpresented checks? Checks issued 1500 had been entered in the cash book but had been presented into the bank only 1000 rupees. So when we do the BRS adjustment, we have to remember this particular point. Directly in this point only we will adjust that. Are you getting this? Actually, they could have done it in the cash book also. Just reverse in the cash book. That time this point, when you go to bank reconciliation statement, you will take the adjusted amount only. But they have not done that. They have directly done it in the BRS itself. Okay, so we'll keep this point pending. It is actually linked with this particular point. Receipt side of cash book has been overcast. Receipt side of cash book is overcast. That means they put more receipts. If they put more receipts, what we should do? We should reverse it. That means we should put one payment. So can you see over here? Receipt side of the cash book has been overcast by 20. By overcasting error, they have to put the payment. Receipt side is this side. This is the payment side. If I put 20 rupees more over here, how can I remove it? By putting 20 rupees on the opposite side. Clear? Next. A check for 20 had been entered as a receipt in the cash book instead of as a payment. Instead of putting it as payment, instead of putting it as payment, they have put it as a receipt. So what we'll do now? First you remove it and do the opposite. So it will create a double effect of 40. Clear? They had put the receipt instead of payment. So they put 20 over here. Now I don't see previous error. What happened was there was 20 extra over here. I just had to remove it. But here instead of 20 being over here, they put 20 over here. So what I should do first, I should remove it by putting 20. Then I should put another 20 so that I can create the 20. That is why there is a 40 over here. Clear? Next. Check drawn for 8 had been incorrectly entered in the cash book as 88. Check drawn. Check, that means what? Check issued has been incorrectly entered as 88. So what we have to do? Payment is put as 88. We want how much? Only 8 over here. So what we will do? We'll put the receipt as 80. Opposite side we are putting 80. Clear? That time we get a balance carried down of 110. So that balance will be the starting point for my BRS. Still it is OD only. Overdraft balance as per amended cash book or adjusted cash book is 110. So now what we have to remember? We have only one point that we have to understand. This check issued and that 50 rupees. Now see over here. Checks issued but not presented 500. Checks issued but not presented 500. Okay. Cancelled check issued 50. Now what is this? We are starting with cash book. Okay. Check issued, that means cash book already the balance has increased. Because OD balance, when you issue the check, balance will increase. Now we have to decrease it. That makes it minus. Clear? And that cancelled check issued. Again, balance has increased. Extra, they told, no, 2 times we have entered it. So 1 we have to remove. 1 is fine. 1 we have to remove. So it is added. Now we are going to subtract it 50. So you are getting this balance as per passbook. Is it clear? That was your December 2023 2A question. Everything was fine. Only this one and this one you have to be careful. And whatever thing. Yes, we could have put it in the cash book only. We would have reversed it there itself. If it have reversed it there, this balance would be different. Ultimately, this 440 will be 440 only. This balance would have been different. That was December 2023, question number 2A. Now we'll go to question number 2B. From the following details, prepare an adjusted trial balance as at 31st March 2023. Now they have asked you to prepare adjusted trial balance. See over here. This is the trial balance. Now what you have to understand is whatever has errors, right, that you have to be a little careful. First, salary and wages due to be paid 2000 and 1000 respectively. That means when salary and wages outstanding, what will happen? You have to add the money to salary and you have to show it as outstanding. So 2000 and 1000 you should find in the trial balance as outstanding salary, outstanding wages, and it should be added to salary as well. If you go and check now, outstanding salary, outstanding wages. Can you see 2000 and 1000? But that is only one side. Whenever you do adjustment, both sides should be adjusted. When you go to salary, this 2000, 1000 should be added. Now, can you check here? What is the salary amount? 10,000. Correct? To that, what I should add? 2000. So if I see over here, salary will be 10,000 plus 2000, salary 12,000. What is the wages amount? 6,000. So if you see over here, wages 6,000 plus 1,000, 7,000. Can you see? The entry is salary account debited to outstanding salary, wages account debited to outstanding wages. That's why it is added and it's also shown as liability in the trial balance. Clear? Next. After that you have insurance was paid to the extent of 300 advance. This is called as prepaid insurance. So you should find this prepaid insurance in the question. See, can you see prepaid insurance 300? And that 300 should be subtracted from the insurance. What is the entry for prepaid insurance? Prepaid insurance account debited to insurance account. Now insurance is having how much? 1500. That means we should remove that 300. That time insurance will become 1200. 1500 minus 300, 1200. Can you see the adjustments happening? This is the adjusted trial balance. Without adjusted trial balance, if I go and prepare final accounts, all these adjustments will happen in trading P&L balance sheet directly. Okay, next. Sum of 500 to be written off as bad debt out of sundry debtors and a provision for 5% to be created out of doubtful debts. Do we have any provision for doubtful debt in the question already? There is no provision for doubtful debt. So 500 will be bad debt. So what I will do, directly I will write bad debt Can you see bad debt? 2,450 they have written. That means there are more things which we have to remember. So 500 is bad debt. I'm making a note of that. Bad debt is 500. And they said 5% provision is going to be created for doubtful debts. Now, how much is my debtor? 40,000. Correct? Yes. So debtor balance 40,000. So PDD has to be 40,000 minus 5,000. Remove 500, the bad debt, into what? 5%. 39,500 into 5% will be 19,975. Now if you go to the question, I think there are more adjustments for bad debts, right? Is it 40,000 only? Debtors. Okay, we'll wait. We'll keep this debtors thing pending. We'll finish everything else. Sundry expense include 2,000 spent for personal purpose of the proprietor. Personal purpose of the proprietor means what? This should be shown as drawings 2,000 and it should be removed from sundry expense. Yeah, it will be removed from capital when we prepare a capital account. Now here it will be taken as C. Now if you see over here, drawings, I'll write 2,000 over here because there might be one more drawings later. So 2,000 plus I have written, and sundry expense, if you go to the question and check, how much is my sundry expenses? 5,000. Now from 5,000 sundry expense, can you see it became 3,000? Because 5,000 minus 2,000. Because that is drawings. And that will be added over here. And if you go to the question and check, do we already have any drawings? No, I don't think there is any drawings. In adjustment only, there will be one more drawing then. So sales for the period include 500 worth of goods, cost price taken by the proprietor for personal consumption. One more drawing has happened. He has also taken goods worth rupees 1,000 for personal consumption, which has not been recorded in the books at all. So now 2,000 plus 500 plus 1,000, our total drawings are 3,500. And one more thing is 500 taken by the proprietor for personal consumption. It has to be reduced from the purchases. This 1,000 also has to be reduced from the purchases. Oh, no, wait. Sales for the period includes 500. So this 500 will be reduced from the sales and this 1,000 will be reduced from the purchases. Now if you go and check, they have not shown any calculation, right? Now if you see your purchases, 65,000. Now where is your purchase? Randomly they have put numbers, right? Yes. We'll keep it pending. Carriage inward is there. Okay, carriage inward directly 1,000. That I'm going to put because it's not going to bother us. Okay, now you have to remember this 500. Then depreciation to be provided as follows: 10% for plant and machinery, 5% for building, 10% for furniture. None of them have any other adjustments. Okay, why that purchase is going down is because here there is a closing stock adjustment. Closing stock will reduce the purchases. That is why that purchase is there over there. Now plant and machinery, if you look at the question, how much is the plant and machinery? Plant and machinery is 10,000. So now it will be 10,000 into 10%. That means 1,000 is my plant and machinery. Correct? If 1,000 is the depreciation on plant and machinery, you can see over here, I guess they have put depreciation also total only. We'll write 1,000 plus. Now plant and machinery should be at 9,000 because it is 10,000 minus 1,000. Clear? Next, after that, building 5%. If you go and check what is the building value, 5,000. So 5,000 into 5%, that will make it 250. Yes, 4,750 in the buildings. 5,000 minus 250, 4,750, and you can add the depreciation 250 over here. One more depreciation is furniture 10%. Now furniture is 3,000. 3,000 into 10%, that is 300. Now what you are going to do? Add the 300 over here, that makes it 1,550, and 3,000 minus 300, this becomes 2,700. Clear? That should be it with the depreciation. Now closing stock adjustment. Closing stock, you should pass the entry closing stock account debited 20,000 to usually trading account. But we are not preparing trading account, so we have to adjust it. Instead of putting on the trading account, what can I do now to adjust it? I will directly write to purchase account. Instead of writing on the credit side, now if I have to adjust the same thing, I'll adjust the purchases. So now my purchase is how much? 65,000. Now if you see over here, 65,000 minus the 20,000 closing stock, and we have 1,500 drawings. Correct? So now you from sale also will remove, from purchase also will remove. Okay, because it should actually be reduced from purchases. Now what they have done, they have included it as sale. Now something that should have been reduced from purchase, okay, they have included it as sale. So we'll remove from purchase also and we'll remove from sale also. Okay, so now 43,500. You will get 43,500 over here for the purchases. Can you see the 43,500 over here? 43,500. Clear? Now all the adjustments are done. One by one we'll go forward. Rent rates and taxes, there was no adjustment. Directly I am putting 1,800. Now if you see the next one, interest paid, there is no adjustment. Directly you will write interest paid. Now sales is 95,000. That 500 we have to remove. This will be 95,000 minus 500. So if you are thinking of the entry, right, the entry actually should have been drawings account debited to purchases 500. Okay, by mistake they have passed the entry drawings account debited 500 to sales 500. So now what I should do? Sales account debited 500. That's why sales is reducing, and to purchases 500 because purchase was not reduced. That is a net effect that is given over here, and this is our sales 94,500. Then we have cash and bank 21,500. Directly you are going to write cash and bank 21,500. The bills payable direct 5,800 bills payable. Then you have sundry creditors 35,000. Again we are going to put directly 35,000 sundry creditors. Next bills receivable 10,000. Direct bills receivable 10,000. Sundry debtors 40,000. But what we are going to do over here, we have one bad debt, right? 500. Provision should be created for 5%. Wait, we'll keep sundry debtors to the end only. Capital will finish 66,000. And then finally we have opening stock 21,000, which is also there 21,000. So only things remaining for us right now is provision for bad debts. Okay, provision for bad debt, and the sundry debtor balance. Now, if you check the question, sundry debtor is how much actually? In the question, sundry debtor is 40,000. Correct?
Yes.
Now, what is the adjustment they have given about sundry debtor? Sum of 500 to be written off as bad out of sundry debtors, and a provision of 5% to be created. So, sundry debtor 500 should be removed because of bad debt. This becomes 39,500. Clear? Then sales for the period includes this 500, right? That means if it is taken as sales, then it is added to debtor also. Are you getting my point? See, we took it that time as drawings account debited, right? Actually, they have passed the entry debtor account debited to sales because they took it as sale only. Are you getting my point? See, drawings account debited 500 to purchase should have been entry. They passed the entry debtor account debited to sales. So now what we are going to do is we have to create multiple reactions over here. Drawings we already added 500. Okay. Purchase we subtracted 500. So that is done. Now sales we removed 500, and debtor also we have to remove 500. So yeah, so the rectification entry will be sales account debited 500 to debtor 500 and drawings account debited 500 to purchases 500. Because of that, from purchase we have minused, drawings 500 we have added, and sales we have minused, and debtor also we'll have to minus. Did you understand this? So what has happened over here is it's a multiple fold error they have created. How did we understand? How should we understand this? Is over here they said sales for the period includes 500 worth of goods taken by the proprietor. What was taken by proprietor? It was taken as sales. If it is taken as sales, they made the mistake of passing the entry debtor account debited to sales. Actually, it was taken by proprietor. Entry should have been drawings account debited to purchases. Clear? So now drawings you have to add 500. Drawings you have to add 500. Can you see we have added 500 to drawings? And purchases we have to minus 500. Can you see 500 we have subtracted from purchases? Our purchase calculation over here. 1500. In this 1500, 500 is also there. 1000 is also there. Clear? Then one more thing is debtor account debited to sales. Sales we have to subtract 500. Can you see from sales we have removed 500? Now from debtor also we have to remove 500. And that time the debtor becomes 39,000. This is bad debt. This is rectification. These are two different things. See? Yes. This 500. The drawings which was taken, which was included in sales, that 500 we are going to subtract. So 39, it becomes that time 39,000 into 5% if you take, you will get 1,950. I think that was the 1,950 which we saw over there. And debtor is showing 39,000. And bad debts. How we are getting bad debt as 2450? 1,950 is the provision that we created. Plus 500 is the bad debt that is already there. 2,450. Actually, when you create provision, P&L should be debited. But here we have not reached P&L yet. So the adjustment is happening in the trial balance itself.
Because the balance was there in the provision.
Balance is there in the provision. So now usually we should pass the entry P&L account debited 1950 to PDD 1950. But P&L we are not prepared. No, we are still in the stage of trial balance itself. Trial balance is getting adjusted. So directly they have written bad debt account debited 1950 to PDD 1950. Basically loss has to be recorded and loss is recorded over here. This is the closing stock which we discussed that time. This is your adjusted trial balance. The major error is over here, this one. This one you have to understand. Sales include 500 worth of goods which was actually taken by the proprietor. Proprietor took 500, that should be drawings actually, but we have considered that as what? Sales. So now what happens? We should remove from sales, we should remove from debtors. Then we should take it as drawings and remove from purchases. So that becomes a double effect error. Yes, that should be your December 2023 paper. Done. Now you have your model test papers. We have to cover all your model test papers also which are there. First model test paper that we are going to start with is December 2023 from beginning. December 2023, there are again two questions there. And one more at the end as well. Yes, this is your December 2023 paper. Model test paper. Okay, let's try to solve this. On comparing the cash book of Saksham with bank passbook for the year ended 31st March 2022, following discrepancies were noticed. Following discrepancies were noticed. Now you have to go to the end of the question and you can see over here, prepare bank reconciliation statement as on 31st March 2022 if the balance as per cash book was 158 to 280. Okay, so right hand will be cash book 158 280. Can you see 158 280 over here? Starting point. So now you start with right hand cash book. Out of 82,000 paid in by checks into the bank, that means deposited. Checks amounting to 30,000 were collected on 5th April. So 30,000, what happens? Cash book increased. Now what we have to do? Decrease the cash book. 30,000 will be minus. Can you see 30,000 minus here? Next, after that, we have out of checks drawn, that means checks issued, a check for 10,000 was presented on 3rd April. When check is issued, what happened to cash book balance? Right hand reduces. So what we should do? Add it back. 10,000, we are going to add it back. Next, a check for 4,000 entered in the cash book but omitted to be banked. entered in the cash book. Same type of question we saw in the exam. Can you see that time December exam only, I think. Same type of question. Okay, check 4,000 entered in the cash book. Cash book balance increased, but you forgot to put it into the bank. So decrease it. Minus 4,000. Clear? Next. A check of 2,400 deposited into the bank but omitted to be recorded in the cash book and was collected by the bank on 29th March. This is ulta. Check is deposited in the bank but you forgot to enter in the cash book. So left hand, cash book, the passbook balance increased. Now you will also increase it 2,400. 2,400 add. Next you have a bills receivable of 2080 previously discounted. Discount is 80. With the bank has been dishonored. You know, when it is dishonored, you can ignore the discount. 2080 will be taken. 2080 was discounted. So now what happens? Bank has taken money. So passbook balance reduces. You will also reduce 2080. Next. You can see over here the next one. Yes, here. Bill for 40,000 was retired, paid by the bank under a rebate of 600. But the full amount of the bill was credited in the bank column of the cash book. Okay, bill was retired, paid by the bank. Okay, paid by the bank, but 40,000, but rebate is 600. That means how much? Only 39,400. So 600 is extra. That 600 we have to remove. Can you see the 600 here? Can you see 600? What did you do? Cash book, you put full 40,000. But actually passbook only 39,400. You put extra 600. You will rebate on bill not entered in the cash book. Okay, 600. No, actually wait. What happened was
rebate should be taken for us.
Paid by the bank.
To us.
Yeah. So paid by the bank. That means cash book balance had to reduce 40,000. But here only 39,400. So what we did? We reduced extra 40,000. Extra 600. So we are adding it back. Now actually rebate, they have not been very clear with the sentence. Two things can happen. I gave bill was already issued, okay, and I am paying early. Another thing is somebody gave me bill and they are paying early. Here they said paid by the bank, so that means we are making the payment. When making the payment, I paid only 39,400, 600 I didn't pay, but still in the cash book when I recorded, full 40,000 I put. Are you getting this? So extra 600 payment I have recorded, that I am adding back. Next, check of 10,000 wrongly credited in the passbook on 29th March was reversed. Wrongly credited means what? Passbook balance increases. So cash book also you are going to add. Add 10,000. Wrongly credited by passbook. Yes, did you get it?
Yes.
Next, bank had wrongly debited 20,000 in the account and reversed. Wrongly debited means bank passbook balance reduces. You will also reduce 20,000. 20,000 over here. Next, after that, a check of 880 drawn on the savings account has been shown as drawn on the current account in the cash book. Now, actually, we are starting with which account? First, they told no cash book of Saksham in the bank passbook. Following discrepancies were noticed, and you can see the end of the question. They said that 1,58,000. Where is that?
Below the page.
1,58,280. Now check of 800 drawn on the savings account, but it has been shown as what? Current account. You can see over here 800. Okay. What has happened over here? We have reduced over here. We have to add it back. We are preparing current account. Actually, it is savings account check. We have reduced from current account and we are adding back that 800.
But it was excluded in the savings account.
Yeah, savings account. Both are bank account only. But because we are doing BRS, it's a natural assumption that we are doing BRS of the business. No, business uses current account. Personal, it is savings account. Now here what happened was, it was 800 drawn on the savings account. Savings account 800 should have reduced. Now by mistake we have put it into current account. So current account reduces. You add it back. Okay, so 800 that should be it, and that time add plus or minus you do, you will get the answer. Okay, that should be the bank passbook. That was the question which was there in the model test paper. There is one more question, that is rectify the following errors. Okay, a credit sale of goods to X for 3,000 was posted as 30,000. So instead of 3,000, you posted 30,000. That means 27,000 extra posting. So now see the rectification. Suspense account debited to X 27,000. Clear? Posted means what? To X, no. X you put extra 30,000. So you will remove 27,000. Actually, the correct entry should have been what? X account debited 3,000 to sales 3,000. What is the mistake here? X account instead of 3,000 debited 30,000. Sales, there is no problem. So X you have to reverse. So reversing, X will be credited for 27,000. Clear? And then see over here, sales account debited to X 27,000. Being credit sale of 3,000 wrongly posted as 30,000, now rectified. They could have passed one entry and closed the things, but they are doing double effect. See, actually what happens? Sales account debited to X, right? Sales account you have to reduce and X account you have to reduce. Wrong posting, now rectified. Or. Actually, they have given two situations over here. Either you pass that or you pass this, because they are only not clear with the language. They didn't tell, they said wrongly posted, no. When they said wrongly posted, they didn't tell whether both the sides wrongly posted or one side wrongly posted. That is why they have given you both alternative answers in the material. Clear? Now, cash sale of goods of 3,000 posted as 30,000. Now what happens? Same thing. They have not told where it is posted. So sales account debited to suspense account 27,000 or sales account debited to cash 27,000. Clear? Next. A credit sale of furniture to Z 3,000 posted as 30,000. Credit sale of furniture to Z. So entry should have been not sale account. It should have been as what? Z account debited to furniture. Furniture gone. Now see, it is posted as 30,000. So furniture account debited to Z 27,000. Clear? Correct entry for this should have been Z account debited 3,000 to furniture account 3,000. Now what is happening? You are going to reverse 27,000 because it is 30,000 that is done. Next. A credit sale of goods of 3,000 to Krishnan entered in the purchase book as 30,000 and posted therefrom to the credit of Krishnan as 3,000. What is the situation? Credit sale of goods to Krishnan. Entry should have been what? Krishnan account debited to sales. Krishnan account debited to sales. But entered in the purchase book. Entered in the purchase book means they have actually written purchase account debited now 30,000 and posted therefrom to the credit of Krishnan as 3,000. 3,000. Can you see the number of errors? First of all, they put into the wrong book. Upon that, from the wrong book, when they posted to Krishnan, they made the wrong amount. So now 3,000. Actually 30,000 was entered in the book. Now you have to remove this purchase. You have to record the sale and make the Krishnan's account proper. Now if you see over here, Krishnan's account debited two times. Why? That credit has to be made as debit. So you can directly write debit 6,000 instead of writing two times. Okay, then sales account 3,000 because sale is 3,000 actually. And purchase account 30,000 and difference everything is suspense. Difference everything is suspense. Is it clear this one? No, right? Now see over here. Actually, the entry should have been like this. Where will I write? Here only I'll write. Actually, the entry should have been Krishnan account debited 3,000 to sales 3,000. This should have been the entry. This is the correct entry. You know what mistake they made? They made the mistake of putting it into the purchase book. When putting into the purchase book, they didn't even put into the purchase book. They put the wrong amount in the purchase book. So it became purchase account debited 30,000. Now, if they put into purchase book, it should have been purchase account debited to Krishnan 30,000. But to Krishnan became 3,000 again. So now to rectify, Krishnan, this debit you have to do. So once debited. This credit you have to remove. So once more debited. One debit you have to put and one credit you have to remove. So debit two times. 3,000, 3,000. Sales, we have to record the sales. We have not recorded two sales. To sales 3,000. Purchase is wrong. We have to remove that purchase. To purchase 30,000. In this entire situation, 27,000 difference is there, one-sided. So suspense account 27,000. Clear? Next. Next. Cash sale of goods of 3,000 to Krishnan, posted to the credit of Krishnan as 30,000. Cash sale. Cash account debited to sales should have been 3,000. Posted to the credit of Krishnan. Unlike the first and second one, they didn't tell. There they kept it open. No. It can be one side missing, two side missing. Here they said posted to the credit of Krishnan as 30,000. So Krishnan only we should remove. So now what happens? Krishnan account, you can see over here.
Similar to the previous adjustment.
Similar to the previous adjustment. Krishnan account debited 30,000. To sales 3,000. To suspense 27,000. Okay, 27,000. Because again, cash sale of goods 3,000 to Krishnan, posted to the credit of Krishnan as 30,000. So what you will do? Remove that extra. Okay, sales you record only 3,000. Are you getting this?
Yes, sir.
Yes. Next, after that, credit purchase of old machinery from Sohan for 17,000 was entered in the purchase book as purchase from Mohan for 71,000. We'll stop over here. 3,000 paid to repair charges, we'll see later. Now, credit purchase of old machinery. Old machinery purchase. What should have been the entry? Machinery account debited 17,000 to Sohan 17,000. Now here what they did, entered in the purchase book as purchase from Mohan. Yes, not only they did purchase wrong 71,000, they put to wrong party Mohan 71,000. Can you see? Asset purchase, they showed it as goods purchase and also from wrong person. So now the entry will be machinery account debited. One second. Oh, they are clubbing the next one also, I think. 3,000 paid to repair charges of this machinery debited to general expenses. Okay, 3,000 paid as machinery, repair charges of machinery. They have debited to general expenses. What should be done? When you purchase one machinery, that time only there is a repair. It should be added to machinery only. Capital and revenue expenditure. So machinery account debited should have been happening, but they have debited general expense. So machinery will be debited and general expense will be credited to remove that. So now here machinery, this 17,000 plus 3,000. Can you see? Machinery 17,000 plus 3,000, 20,000. Clear? And general expense, you have to remove that 3,000 which I told you. And Mohan, can you see? I told Mohan wrongly we have put 71,000. We have to remove Mohan. So Mohan, where is it? Yes, Mohan debited 71,000. Okay, to purchases 71,000 and then Sohan you are correctly putting 17,000. Did you understand all this? Okay, Mohan wrong, remove 71,000. Okay, purchases wrong, remove 71,000. Machinery you have to record. So 17 plus 3, 20,000, record the machinery. And Sohan has to be paid 17,000, record that 17,000. So that is the effect of that correct entry and wrong entry. Okay, now next. A bill drawn on Meenu for 30,000 was passed through bills payable book with 3,000 and posted therefrom to the credit of Meena. Wow. I don't know whether this is typo or actual error. Okay, bill drawn on Meenu 30,000. So what should have been the entry over here? Yes, there is Meena. No problem. Bills receivable account debited to Meenu should have been the entry. Okay, 30,000. This should have been the entry. Bills receivable to Meenu. Now, what they have done? Passed through the bills payable book with 3,000 and posted therefrom to the credit of Meena. So, can you see bills receivable not done? 30,000 done now. Okay, then Meenu not done. 30,000 done now. Correct? Then what they did? They have passed the entry Meena account debited 300 to bills payable 3,000, right? Yeah. Bills payable 3,000, Meena 300. Putting in the wrong book, putting to the wrong person, putting the wrong amount also. Clear? So now Meena account debited. So you have to remove that Meena now.
Yes.
Okay. I think not even debit. They have done one more error there. They have posted to the credit of Meena.
So we have to debit it.
Yes. So can you see over here? It is not even Meena debited to bills payable. It is Meena also credited. Bills payable also credited. So bills payable will now be debited. Meena will now be debited. And then remaining difference, whatever is there, you'll put it to suspense account. So now this is very important. Okay. Bills receivable was the situation to Meenu. They put into bills payable account. Bills payable account, they put bills payable wrong amount. They put it to Meena also wrong amount. Okay, now you have to remove the Meena, and Meena is not debited, Meena is credited. You have to remove Meena from the credit also. So all this leads to this rectification entry. Clear? The last rectification that is there over there is sales included a sale of furniture having book value of 900 for 850 on 31st of March 2022. Instead of sale of furniture, we have recorded it as sale of goods itself. So now the entry will be sales account debited, remove it. Loss on sale of furniture, create it and remove the furniture as 900. Did you understand? Why loss on sale? See over here. Because sales included sale of furniture having book value of 900 for 850. We sold for 850. So 850 only is there in sales. So 850 you will remove from sales. 50 you will show that loss on sale. P&L account should be debited. And then you will remove the full furniture of 900 rupees.
The exam in the rush will not see the loss.
Yeah, exam will not see the loss. We will only see 850 and end the question. Yes, and I think there is one more question. We'll do that as well. So that this model test paper will be done. Yes, that is this one. Company maintains its reserve for bad debts. Reserve for bad debt is provision for bad debt and reserve for discount on debtors at 2%. You are given the following details. Bad debt is given last year, this year. Discount allowed is given last year, this year. Sundry debtors also before providing all bad debts and discounts is given. On 1/1/2021, last year, reserve for bad debts and reserve for discount on debtors was 4550 and 800 respectively. Prepare reserve for bad debt account for 2021 and 2022. Both they have asked. Now if you see provision for bad debt, okay, you start the question over here. Okay, provision for bad debt, you can see that provision for bad debt was 4550. So opening balance is 4550. Okay, and this year we have a bad debt of 800. Yesterday we discussed that movie fund situation. So if there is bad debt, if there is movie fund, that means if there is PDD, you will take the bad debt from PDD only. So you are writing over here provision for bad debt account debited to bad debt, 800 gone. Clear? Next. Okay, then there is discount on debtors. But before that you have to create 2 P&L. 2 P&L is what? 850. I think 5%, right? 60,000. Here it is, sorry. See, what has happened over here is the problem. 60,000 was our debtors. 60,000, from there I will remove my bad debts of 800. Now what happens? When I remove the bad debt of 800, I get 59,800. Okay, then there is 1,200 is discount allowed. Oh, sorry, 59,200. 1,200 is discount allowed. So now I have only 58,000. On 58,000, I have to create 5% provision into 5%. I need 2,900. I need how much actually? 2,900. But I have more. When I have more, what will I do? I'll transfer it to P&L. When I need provision, what will I do? P&L account debited to PDD. When I don't need provision, what will I do? PDD account debited to P&L. Can you see the twist in the table? I have 4,550. From 4,550, if I remove 800, I actually have 3,750. I require how much? 2,900 only. Remove 2,900. 850 is transferred to P&L. And that 2,900 comes to the next year. That 2,900 comes to the next year. So now when we go, they asked only reserve for bad debt. They didn't ask reserve for discount on debtors. Next year what happens? Again there is a bad debt of 1,500. 1,500 is the bad debt next year. So what you will do? 1,500 you are going to remove.
But the first point, why they are getting the 800 from the 4,550?
800 from 4550. Because when there is bad debt and then there is provision, bad debt will be taken from provision only. No? So now this 2900 came and bad debt is removed from provision because provision is sufficient. Which 850? No, not yet, not yet. Now what happens is, see, debtors is how much? 42,000. From 42,000 debtor, if I remove the bad debt, 1,500, I will get 40,500. Then if I remove the discount of 500, my net debtor balance is how much? 40,000. On 40,000, I have to create how much? 5%. So I need how much now? 2,000 is provision for bad debts. So my balance should be 2,000. Now can you see 2,900? When you remove 2,900 minus 1,500, you have only 1,400 remaining. This time you have shortage, so you take from P&L. Last time you had excess, so that's why you put it to P&L. Is it clear? This is what you have to understand about this particular thing. Okay, if they have put it in model test paper, 100% they can ask in the exam as well. Yes, you can. After this, we'll go into the next model test paper. So we'll go to the next model test paper. The next model test paper is June 2024, set 1. And there also there is one question number 2A. Question 2A. On 1/1/2023, machinery was purchased for 80,000. Prepare machinery account for 3 years, they said. 1/1/2021, machinery was purchased for 80,000. So directly you have to go and pass the entry. Machinery account, see, machinery account debited to bank account on 1/1/2021. Okay, then on 1/7/2021, additions were made to the amount of 40,000. 1/7 additions were made. So you will pass the entry on 1/7/2021, 22, 40,000. So first year what happens? Normal depreciation in at what rate? They said depreciation at the rate of 10% per annum on diminishing balance method. They have done the working note. So you can see over here, 1/1/2021, machine 1 was purchased for, I think this is just for sale. Whenever it is sold, they have made the calculation. Let's not go into that. Now, first year, what is the percentage of depreciation? 10%. So 8,000 depreciation. Okay, balance carried down, balance comes over here. Now next, second year, they have purchased one more. So now what happens is, on this 72,000, you will calculate 10% depreciation. Okay, that makes it on this 7,200 depreciation. On this 40,000, you will calculate 10% depreciation, but for 6 months. So 40 means 4,000, 2,000. So total depreciation you can see over here 9,200. And again balance carried down. And that balance is brought down over here. Okay, till here it is all cool. Okay, then the question starts. Over here, you can see on 31st of March 2023, machinery purchased on 1/7/2022, that is this one, costing 12,000 was sold for 11,000. Costing 12,000 was sold for 11,000. It was purchased for 12,000 and sold for 11,000. But when it is purchased for 12,000, are they showing the calculation? Yes, see over here. They have split it up. Why they have split it up is because the one which is costing 12,000 is sold for 11,000. So first year what happens? 10% depreciation into 6/12. 600 gone. 11,400. Then what happens? They are selling on what day? 31st of March 2023. 31st of March 2023. See, 31st of March 2023, they are selling this machine. Okay, which was purchased on 1/7/2022. So first year 6 months depreciation. Then after that 10% into 3/12. Because only 3 months they have used. So 11,400, 10%. So you'll get 285. So now this is the WDV which is there on the date of sale. This is the WDV on date of sale. And it is sold for 11,000. That's why 115 rupees is the loss. Okay, you don't need to make this table. You can just do it normal working note also. In the exam, you'll get the marks. Okay, 115 rupees loss. So first what we should do? 3 months depreciation entry we have to pass. Then we have to record the sale. Then we have to record the loss. So if you go to the machinery account, can you see 3 months depreciation account? Depreciation entry. Buy depreciation for 3 months. Sale for 11,000. bank account debited to machinery account, loss P&L account debited to machinery account. Three things have happened and all the three things are computed. Now, after that you see, and on 36/2023, that means 3 more months later, machinery purchased on 1/1/2021, that was our starting machine, costing 32,000, was sold for 26,700. So starting machine, just understand, 2021 full year depreciation, 2022 full year depreciation, 2023 6 months depreciation, because it is sold on 36. So the costing 32,000, it was costing what? 32,000. See, 32,000, first year full depreciation 3,200 gone. Then second year full depreciation at the rate of 10%, 2,880 gone. Now we have reached this part. Clear? Now this part, this is used only for 6 months. So into 10% into 6 divided by 12. So 25,920. If you see half year depreciation, it is 1,296. 1,296 is the depreciation. That time you will get the WDV on the date of sale. That is sold for what value? They have told in the question that it is sold for 26,700. So now what happens? 26,700 is the sale value. You are selling it at a higher price. So because you are selling at a higher price, it will be profit on sale. Is this calculation clear? See, 6 months because they have sold on 36/2023. No, it's not financial year. They're following calendar year here. It's not financial year. They're following calendar year.
And the previous mission, it should be
No, it's 3 months only. It's from January to March. January year started and the asset was sold on 31st March. So 3 months. Here January year started and asset is sold on 36. So 6 months. So then now here we have first always depreciation till the date of sale. This year's depreciation 1,296. Sold for 26,700 and profit we have to transfer. So now if you see the ledger, 1,296 depreciation account debited to machinery account, bank account debited to machinery account, profit should be credited to P&L. So here machinery account debited to P&L account. Clear? 2,076. Then after that they have told on 1/10/2023, 3 months later, addition was made to the amount of 20,000. New machinery purchase, machinery account debited to bank account. Can you see machinery account debited to bank account over here 20,000? Now for this one, it was purchased on 1/10. For this one, only 3 months depreciation. Depreciation has to be at the rate of 3/12. Okay, but there are some old machines also which are remaining. So you have to be a little careful about the depreciation. That's it actually. Question got over. Now here what happened is, see, machine 1, 80,000 was the cost. 32,000 machine costing, that is sold. So the remaining machine is there. First year's depreciation you remove, you will get the end value. Second year's depreciation you remove, you will get the end value. Now this is used for the entire year. So 3,888, 10% depreciation. In machine 2, 40,000, 12,000 is sold. 28,000 is there. First year half depreciation because it was purchased on 1/7/2022. Then you will get this value. Then full entire year's depreciation. That time you will get 2 depreciations for old machines. Then the new machine which is purchased, it is going to be used for what? It is purchased on 1/10. So only 3 months depreciation, 3/12 into 10% into 3/12, you will get 500. So this plus this and this will be your total depreciation for the year. So machine 1, what part is unsold? Full depreciation. Machine 2, what part is unsold? Full depreciation. Machine 3, purchased only this year. It is used only for 3 months. So 7048 should be your depreciation entry for the remaining assets. So the entry will be depreciation account debited to machinery account. You can see 7048. 7048. After that, there is nothing. Balance carried down, done. Clear? So first year, the reason why they gave first year is just to push the number forward. Second year, there is a purchase which is used only for half year. Okay. Third year, the 2 sales are happening. And sale what? Entire asset is not sold. Part of the asset is sold. So the remaining part still remains. So you'll have to calculate depreciation on that. Clear? This is your machinery question which they had asked. Now let's go into one more question that is there, that from chapter 1. On 1st April 2022, the balance of provision for bad and doubtful debt was 13,000. Now, what did they ask? Pass necessary adjustment entries for bad debts and its provision on 31st of March 2022. Prepare necessary ledger accounts. Then show the relevant items in the P&L and balance sheet. Now, let's try to understand. 1st April, there was a provision of 13,000. The bad debts during the year 21-22 were 9,500. Obviously, now, if the PDD is 13,000, from that only you will remove the bad debt. 9,500. From that only. So now bad debt will be debited from what? PDD itself. So you will be left with 3,500. Clear? Now sundry debtors on 31st March 2022, okay, end of the year, stood at 3,25,000. Out of these debtors, 2,500 are bad and cannot be realized. Further bad debts. This is called as further bad debts. So again 2,500. So from my PDD, again I'll remove 2,500. My PDD will remain at what? 1,000. This is my PDD balance after removing everything. The provision for bad and doubtful debts is to be raised to 5% on sundry debtors. You are required to. Now, try to understand. Journal entries they have asked first. See, bad debt account debited to sundry debtors 2,500. This is the further bad debt. Okay, provision for bad debt account debited to bad debt. How did they get this 12,000? See over here. 9,500 and 2,500. Two bad debts were there. You are taking it from PDD. PDD is a liability. If you are taking PDD, will reduce. So PDD account debited to, where is it? PDD account debited to bad debts 12,000. Clear? 9,500 plus 2,500. 9,500 is already done during the year. 2,500 is further bad debt. Now what will you do? P&L account debited to provision. Now what was my debtor balance? Debtor balance was 3,25,000. Correct? From this, out of these debtors, 2,500 is bad. So remove 2,500. So you will get 3,22,500. Okay, and to be raised to 5%. So calculate 5% of 3,22,500. 16,125. Clear? Remember the number. 16,125 minus 1,000. Why 1,000? Out of my PDD, 1,000 was still remaining over here. See, I did the calculation. 1,000 was still remaining after removing all the bad debts. So therefore, I will create provision for only 15,125. Done. Okay. Then you are just preparing bad debt account. Bad debt account, what? Two bad debts are there. Balance brought down, which was already there. And then new bad debts, further bad debts. Now that is adjusted against provision. Done. Provision for bad debts. There was already balance. Bad debt got removed. It came down to 1,000. Can you see it came down to 1,000? Then I create a provision of 15,125. It becomes 16,125, which was required. That was 5% of our debtors. Sundry debtors, if you see, this was the opening balance of sundry debtors. Further bad debt you remove. This is the balance carried on. That's it. Sundry debtor will not get reduced by the provision. Only in balance sheet it gets reduced. But in ledgers it doesn't get reduced. It's just for information. Now P&L information they are asking you to see. See P&L, further bad debt and bad debt. Anything will not come to P&L because everything is taken from provision, from PDD itself. So PDD you see, what is the situation? 15,125 is debited to P&L. Clear? They are showing, see. 16,125 is what I want. Bad debts and then less provision which was there. So same calculation which we did in a reverse order they have done. 15,125. Balance sheet impact, bad debt. From that you remove further bad debt. What bad debt is already there in the trial balance, that is done. That you don't remove. Remember there is one more. 9,500 is also there. That 9,500 is not subtracted because this is after subtracting that 9,500. Only further bad debt you will remove and then provision you will subtract. You will get the net amount in the balance sheet. That should be it. That is your June 2024 question. Now here what we have to be really careful is this one. See. 1st April 2021, this is the provision, opening balance of provision. Clear? This is the opening balance of provision. Now, bad debts during the year 21-22 is 9,500. That means that is already done. Okay. Sundry debtors on 31st March 2022. That means this is after removing this. But out of this, there are 2,500 bad. That means this is further bad debt. This was not there. Clear? What we can make in error in the exam is we'll subtract both. Yes. That should be it with June. There is, I think, one more question at the end. We'll just check if there is one question at the end. No, here we don't have. That's it. 7, 14 marks. Let's go to the next model test paper. Okay, this is your December 2024. December 2024 model test paper. There is again chapter 1, 2 questions are there. Now, on comparing the cash book of Saksham with the bank passbook for the year ended 31st March 2024, following discrepancies were noticed. Now, give me 1 second. Did we have the same question, Saksham, in some other model test paper? Just find it.
Same question. December 23.
December 23?
Set 1.
Exam or model test paper? Okay. Same as
Set 1 of
December 2023, set 1. So let's not worry about that. Next, prepare rectified entries of the following with suitable narrations. An amount of 50 received from C Sane has been credited to D Sane. I think this is not a repeat question. We have not seen this. Okay, rectification entries they have asked. Now, let's go into this one. See. Okay, rectification entries. Amount of 50 received from C Sane has been credited to D Sane. If you receive money from C Sane, the entry is what? Bank account debited or cash account debited to C Sane. Instead of that, we have put it to D Sane. So now what we will do? Remove from D Sane and put it to C Sane. So D Sane's account debited. D Sane's account debited to C Sane's account. Clear? If you want the correct entry would have been cash account debited 50 to C Sane 50. What they have done? Wrong entry is cash account debited 50 to D Sane. So now what you will do? D Sane, this credit has to be removed and this credit has to be given. So D Sane's account debited to C Sane's account. That was the first one. Next, purchase of furniture for 2,500 has been debited to purchases account. Furniture has been debited to purchase account. Furniture has to be debited to which account? Furniture account. They have put it to purchase. So simple. You are going to just debit furniture and credit purchase. Remove the purchase, debit the correct entry. Next, sale of old machinery for 2,000 has been recorded in sales account. It should have been bank cash account debited to furniture. Okay, machine. Now they have done cash account debited to sales. Remove the sales by debiting and create the furniture. Okay, put the entry into furniture itself. Can you see sales account debited to machinery account? Not furniture, sorry, machinery account. Next, Basu account has been debited for 3,500 for salary paid to him for the like amount. Actually, the entry should have been salary account debited. What did they debit? Basu account debited. So now what you will do? Remove the Basu part and put the salary part. So the entry should be salary account debited to Basu account. All similar entries. Instead of putting to one account, they put to other account. So put it to the correct account, remove that one and do the opposite. Next. Annual whitewashing expense of 800 has been wrongly debited to income tax account. It would have been repair or whitewashing or maintenance, whatever it is. They have debited to income tax account. So what you will do? Put it to the correct account again. Maintenance account debited to income tax account. Next. Income tax paid for 800 has been wrongly debited to income tax account. For a sole proprietor, right? Income tax is not a business expense. It is a personal expense. So you can see over here, drawings account debited to income tax. So remember, there is no expense called as income tax for sole proprietor in books of business. For sole proprietor, income tax will be a personal expense. Firm means it should be partnership, right? ABC. Then it would have given ABC and Co or something like that. They would have given. Yes. Next. Discount received 150 has been recorded as interest received. So discount received is income. It should have been credited. Instead of that, what did they credit? They credited interest received. So remove that and put to the correct account. Interest received account debited to discount received account. Next. Goods purchased for the proprietor amounting to 200 has been debited to purchase account. Purchase for proprietor means what? Drawings. So it should have been drawings account debited. What did they debit? Purchase account debited. So directly you will write drawings account debited to purchases. Drawings account debited to purchase. Clear? Next. wages of 1500 paid for constructing a new building has been debited to wages account. Actually, if you construct a new building, it should have been added to building only. Instead of that, they put into wages. So building account debited, remove the wages. So 2 wages. Building account debited to wages account. This is your set 2 from December 2024. Let's check if there is anything at the end with where they have asked from chapter number 1. Okay, doesn't look like there is anything. That should be it from December 2024. Now we'll go into December 2024 set 1. Here also there are 2 questions. Okay, there are 2 questions which we have to see. Now, first one is obviously this machine was sold, prepare machinery account for 3 years. We had a similar question where they asked you to prepare machinery account for 3 years. On 1st April 2021, SOM Limited purchased a machinery for 66,000. 66,000 and spent 5,000 on shipping and forwarding. 7,000 as import duty, 1,000 as carriage, and 500 as installation, and 500 as brokerage, and 500 as iron pad. So what will you do? Everything is going to be added, right? Machinery account debited to bank account. Machinery account debited to bank account. 2 entries. Why 2 entries? Just take the total of all these things. What they have spent. 5,000. Is it 14,000? Yes. All these things. 5,000, 7,000, 1,000, 500, 500. Everything is added to machine. When you purchase a machine, whatever related expense comes, everything will be added to machine itself. So you can see there 14,000. Clear? Next. It was estimated that the machine will have a scrap value of 5,000 at the end of its useful life, which is 15 years. 15 years useful life it has. Okay, scrap value they are telling is 5,000. On January 2022, okay, this is April 2021. So now January 2022, repairs and renewals of 3,000. They are following calendar year only. They are not following financial year because it is sole proprietor what they are talking about. Now here 66,000 plus 14,000. Totally, what is our cost right now? 80,000. 80,000 minus scrap value is 5,000 divided by 15 years.
5,000.
It will give us 5,000. This is our annual depreciation. But see the depreciation for first year. 31st March. Okay. They are not following consistency. Okay. They don't tell anything. But here they started with 1/4/2001 and 21 and they ended with 31st March 2022. So here they are following financial year itself. In some other question, like the previous model test paper, they followed calendar year itself. Okay, so 5,000 is the depreciation, balance carried down 75,000. Next year, what happens? 1/4/2022. See, it was estimated they on 1st January, repairs and renewals of 3,000 were carried out. Repairs and renewals will not bother the machinery account. It's repair account debited to cash account or bank account. On 1st October 2023, this machinery was sold for 50,000. Simple. Now, let's reach 1st October. In 22-23, there is actually nothing. You take 75,000, depreciation will still be 5,000 because we are not following WD, we are following straight line method. So, the balance carried down will be 70,000. That balance will come over here. Now, you have to understand 70,000, it is sold on what day? 1/10/2023. So, 5,000 is the depreciation for the entire year into into 6/12 because they are following financial year. So the depreciation is only 2,500. Clear? Sold for what? 50,000. Bank account debited to asset account. And then whatever remaining is there, that is loss on sale. Loss on sale. Very simple and easy question they have given. There shouldn't be any problem. Next. The trial balance of a concern has agreed, but the following mistakes were discovered after preparation of final accounts. After preparation of final accounts, they are telling, show the effect of the above errors in the P&L and balance sheet. They didn't ask you to rectify and all. The effect of the above error they want to see in the P&L and balance sheet. Now, they have made 2 columns, P&L, balance sheet. Okay. Only that much. No adjustment entry was passed for an amount of 2,000 relating to outstanding rent. Outstanding rent is not shown. Okay, now outstanding rent, if it is not shown, what will happen to the P&L? Rent will be more. Rent will be less. See, profit was overstated. See, rent entry is this. Rent account debited to outstanding rent. Rent account debited to outstanding rent. They did not pass this entry. Because they didn't pass this entry, this rent is not there. Because this rent is not there, profit is more. Are you getting it? Because the rent is not there, profit is more. And now balance sheet, you see the effect on the balance sheet. Capital was also overstated by 2000. Why? More profit means more capital. And outstanding liability was understated by 2000 because you didn't put the outstanding liability. Clear? Next. Purchase book was overcast by 1000. You put more purchase. That means what will happen? Less profit. Profit will be undercast this time. See, gross profit was understated by 1000 and also the net profit. Purchase book overcast. That means you put more in the purchase account. That means your profit will be less. Clear? And balance sheet, capital was understated. Profit is less, capital will be less. Profit is more, capital will be more. This is the impact on the balance sheet. Next, 4000 depreciation of machinery has been omitted to be recorded in the books. You didn't put the depreciation. You missed one expense. Because you missed one expense, what happened to profit? Profit is more now. Yeah, capital is more and asset also will be showing higher amount. Now, net profit was overstated, machinery was overstated and capital was also overstated. Okay, that's all they're expecting you to write. 600 paid for purchase of stationery has been debited to purchase account. Now, if you, instead of stationery, if you put it to purchase account, purchase sits in the trading account, stationery sits in the P&L account. So now what happens? Your gross profit is less. Your net profit is more. Okay, actually net profit should have been less. Okay, gross profit should have been more. Now see, gross profit and net profit were overstated by 1000. Sorry, this one, no, D, no. DD. No effect on net profit. They didn't tell the gross profit part at all. No effect on net profit because ultimate will be same. But gross profit will be showing wrong amount. Clear? And here they said no effect on balance sheet. Obviously there is no effect. Instead of one expense, you put it into other expense. Next. Sales book was undercast by 1000. You put 1000 rupees less in sales. 1000 rupees less in sales means that much profit is less. If that much profit is less, capital that much will be less. So now if you go and check, gross profit and net profit were overstated by 1000. Oh, sorry, my bad. It's wrong, right? E. 1, 2, 3, 4, 5. Sales book was overcast by 1000. You put extra 1000. Yes, correct. Were overstated. Yes, correct. We read it as undercast. Okay, they put more this thing sales. That's why because of more sales, what happens? Both of them have increased, and capital was overstated by 1000. Next, last one you have 5000 received in respect of book debt has been credited to sales account. 5000 received in respect of book debt, that means debtors, has been credited to sales account. You should have credited to what? Debtors. It should have been to debtors 5000. What did you do? To sales 5000. Now when you put 5000 to sales, your profit will increase. Your profit will increase. Yeah, GP will increase, net profit will increase. Okay, because of that, and this you didn't do, that means in balance sheet, debtor is overstated. Debtor is still more only. And because of this, in balance sheet, capital will be more. Now, see the impact. Gross profit and net profit overstated. Capital and sundry debtors also were overstated by 5000. That is it with this particular one. Let's go and check if there is anything at the end. Not there. That's it. That should be your model test paper. Next one. We come closer to June now. June 2025. White papers. No more yellow. CSK gone. Yes. So now 2A. See, white papers no actually makes more sense. You know what they have done? 2A, below that only answer. Then 2B, below that only answer. Before what they used to do? 2A, 2B, then answer you have to scroll. They got smarter. Yes. Now, prepare machinery account for 3 years. How many times we are seeing this? Again and again. So that means they can just copy paste one of this into the exam itself. Yes. Is it?
Yeah.
Yeah. It is from CA Foundation, right? Yes. On 1st April 2022, SOM Limited purchased a machinery for 66,000 and spent 5,000 on shipping and forwarding. 7,000 is import duty, 1,000 for carriage and installation, 500 brokerage, 500 iron pad. Same question just now we saw.
Or should be added?
Again copy pasted, right?
Yes, sir.
Yes. No, number also is same. Same as, what was it? Just now we finished.
But
I don't think anything is different. This machinery was sold for 50,000. See, we'll open the fifth one.
sir, same amount. Yeah.
Yeah, same question.
But the total value was different. That was around 14,000.
This also will come to 14 only, I feel.
5, 7, and
Yeah, this also is 14,000. Same as, what is that model plate?
useful years is 15 and scrap value is 5,000 and same
Yes.
is 3,000.
What is the year? Same as
This
June, right? No, December.
December 24 or 2 yeah. No, sir.
No, which set? December 24, set 1.
Set 1.
Next, we'll go to 2B. Okay, rectify the following errors assuming that the errors were detected before preparation of trial balance, after preparation of trial balance, after preparation of final account. So all the three stages they have asked you. Now purchase planned for 10,000 was wrongly passed through purchase account. Purchase of plant 10,000 was wrongly passed through purchase account. So actually the entry for that is what? Plant account debited to purchase account. You have to record the plant, remove the purchases. Plant account debited to purchase. Even after preparation of trial balance, same thing. But in the next accounting period, you can't use purchase. You will use the word P&L adjustment. Clear? Sales day book was cash short. So there was, what is that, 1,000 rupees less. You can't use suspense account before preparation of trial balance. So you'll go, sales account will be credited with 1,000. That's it. Only one side you will do it, which was missing. But here you will write suspense account debited to sales. Here you will write suspense account debited to P&L adjustment because you can't use the word sales. Okay, because you're in the next year. Cash paid to Mr. X for 1,000 was posted to his account as 100. So what you will do, 900 rupees less in Mr. X. For cash paid to Mr. X, what should be the entry? Mr. X account debited to cash account. No, cash account. Correct entry. So now here what happened? X will be debited with 900 because 1,000 minus 100. Now after preparation of trial balance, you can't do one side. So X account debited to suspense account. Next accounting period also it will be X account debited to suspense account because we don't have any income or expense. Only when we have income or expense, you'll go to P&L adjustment. Yes. Purchase goods from Mr. T for 3,500 was entered in the purchase day book as 500. Okay, entered in the purchase day book only as 500. That means you entered fully wrong. So now purchase account debited to T 3,000. Why? Out of 3,500, 500 is recorded. So 3,000 will be recorded now. Next, same entry after preparation of trial balance. But when we go to next accounting period, we can't write 3,000, right? What will we do? P&L adjustment account we will write. We can't write purchase, we will write P&L adjustment account 3,000. Paid salary 3,000 wrongly passed through the wages account. Okay. Salary account debited to wages account, remove from wages, put it to salary. Salary account debited to wages account, same entry. But when, see the fun part when we go to the next accounting period, P&L adjustment to P&L adjustment. Both are expenses, you can't use both those words. Is this clear? This was there in June 2025 set 2. Let's see if there is anything at the end. I don't think there's anything at the end. That should be it. So let's go into June 2025 set 1. June 2025 set 1. Now, on 31st January 2024, Sethi's cash book showed a overdraft balance of 2,50,000. On comparing with the passbook, following differences were noted. Now, when you go to the end of the question, you can see prepare amended cash book. So when you're preparing amended cash book, you have to remember one thing. First, we will make all the corrections in the cash book. What can you make changes in cash book? Things that are under your control. That means entered in passbook, not entered in cash book, enter it. Error in cash book, rectify it. Only two things you can do in amended cash book. Now, you start with what? OD balance. OD means what? Liability balance. Correct liability. Can you see buy balance brought down? 2,50,000. Now, one by one. Cash and check amounting to 26,800 were sent to the bank on 27th of January, but checks worth 4,600 were credited on 2nd February. And one check of 900 was returned by them as dishonored on 4th February. Both of this, okay, you have done it. Now, this 4,600 you can't do anything. They have credited later. Check is checks which are sent to bank. Okay, they have check deposited but credited later. But what about the check which is returned by them? See, 900 rupees check is returned by them. Can you enter anything for that? No, because they returned when on 4th February. We are in which month? January itself. Are you getting it? So both of this will go straight to BRS. Will go to BRS. You can't do anything in the cash book. Now, during the month of January, Sethi issued a check for 33,400 to his creditors. Out of these, checks worth rupees 27,400 were presented for payment on 5th. So, checks issued, not presented. You can't do anything in the cash book now. BRS. Because you already entered in the cash book. Now, according to Sethi's standing orders, bank have made the following payments during the month. They made some payments. Okay. Life insurance premium. We have to enter that now. Yes. Life insurance premium account debited to bank account. But life insurance premium is whose? See? Sethi's. And television license fees is whose? Sethi's. Both are drawings. Both are drawings, but entry will be there. Drawings account debited to bank account. Can you see 6240 here? Next. After that, Sethi's bankers have collected 3,000 as dividend. They have collected, we have not entered, so we'll pass the entry bank account debited to dividend account to dividend. Clear? Interest charged by the bank was 2,500. They have charged interest, we have not passed the entry, so let's pass the entry interest account debited to bank account. Next, a bills receivable of 2,000 discounted with the bank in December 2023 was dishonored on 31st January 2024. Bill dishonored. So what should be the entry for this? Debtor account debited, that is drawee account debited to bank, 2,000 rupees. Can you see 2,000 is there? Done, that's it. Now, whatever balance you are getting, 2,57,740, this is the balance with which you are supposed to, as per cash book, this is the balance which you are supposed to start with in your BRS. Can you see BRS here? Balance as per cash book, overdraft 257,740. Clear? Now, there are two things. One, A1, 4,600 and 900. Okay, that is basically checks deposited but not credited. Checks deposited, not credited. What will happen to cash book balance? OD. When check is deposited, balance will go down. OD. So what will you do now? Add back, because you're starting with cash book. So can you see 4,600 and 900 added back 5,500. Now next one is this. Checks issued 27,400 was presented on 5th February. Checks issued. What will happen to cash book balance? Cash book balance will go up because it is OD. Now what will you do? Subtract it, 27,400. Done. BRS. This was the BRS question which was there. Done. Clear? Now let's go further, guys. The next question that we have over here. The books of accounts of A & Co for the year ending 31st of March 2024 were closed with the difference of 510 in books carried forward. The following errors were detected subsequently. Can you understand which stage they are in? Books were closed and they moved forward. That means they're in the next accounting period. No, you cannot use income or expense. You should use the word P&L adjustment. Return outward book was undercast. Return outward means what? Purchase return. Now purchase return undercast. So we should put purchase return. Purchase return is opposite of purchase. So it should be credited. So suspense account debited to purchase return. But we can't use purchase return. So P&L adjustment account. Clear? 1,500 being total of discount column on the credit side of the cash book was not posted. Discount column on the credit side of the cash book is basically discount received. Discount received. Discount received should be credited, not credited. Okay, so only credit. Debit will be suspense. So now credit will be P&L adjustment because discount received is an income. Are you getting this? Yes. 6,000 being the cost of purchase of office furniture was debited to purchase. Furniture was recorded, should have been recorded, but it was debited to purchase. Now what will you do? Furniture account debited. Remove the purchase. So purchase account credited. But because we are in the next accounting period, what we will do? P&L adjustment. Office furniture to P&L adjustment. Are you getting this? Next. A credit sale of 760 was wrongly posted as 670 to the customer account in the sales ledger. Now 760, instead of that you posted what? 670. 760 minus 670, I think it's 90 rupees. So now what will you do? Debtor account debited 90. You put less for the debtor. Debit the debtor to suspense because only one side. Okay. Debtor is asset item. So you will not write P&L adjustment for that. Next. Sales account was undercast by 10,000, being the carryover mistakes in the sales day book. Sales account was undercast. You put less sales. So now you have to put the sale. Sale is an income. So you will write P&L adjustment. Suspense account debited to P&L adjustment. Next, closing stock was overcasted by 10,000, being casting error in the schedule of inventory. Schedule or inventory. Now, closing stock was put more. Closing stock is asset. Asset you have to reduce now. So you will write to closing stock. P&L adjustment account debited to closing stock. Yeah, that is because for the closing stock, the entry is closing stock account debited to trading account. Now when I have to reduce the closing stock, trading account debited to closing stock. Now trading account will affect the profit. So instead of trading account, you are going to use the word P&L adjustment. Any income expense item you cannot record in the books. Instead of that, now trading account it will create profit, no? If I remove from trading account now, it is removed from this year's trading account, but it should have been removed from last year's trading account. That's why P&L adjustment. Yes, that should be it, I think. No other questions are there. Yes. Now we finally move forward to December 2025. For this, we don't have solutions, so we have to solve. We can't just discuss it. We have to solve this. Okay. This is your December 2025, the most recent model test paper. Let's solve this, guys. Illustrate a bank reconciliation statement from the following particulars as on 31st March 2025. So you're going to prepare a BRS. So you'll write BRS for the year ended. No, you'll write the date only. 31st March 2025. Okay. Now, let's see what they have asked. Debit balance as per bank column of cash book. Debit balance means normal balance only. So you will write balance as per cash book. 10,50,000. Now you know in the BRS some things will be added and some things will be deducted. Okay, let's begin. Checks issued to creditors but not yet presented to the bank for payment. Check issued. That means what happened to cash book balance? Reduced. It's not already normal. Checks issued, reduced. So what will you do? Add back. So write check issued.
Now 1,90,000.
What?
Value.
A value. Not presented. 1,90,000. Next. Check deposited into bank was dishonored, but no intimation was received. Check deposited was dishonored. So what happened? In the bank, the entry is passed. So bank balance, no, dishonored. So bank balance reduces. So what will you do? You will also reduce. Check dishonored.
79,900.
Yes. Not entered in cash book. 79,900. Next, you have interest allowed by the bank. Interest allowed means interest is given by the bank. If they tell interest charged, that means interest taken by the bank. So now interest allowed by the bank, passbook balance increases. We have not passed any entry. So add.
If it is interest charged by the bank,
Passbook balance decreases. So reduce. Depends on which hand it is. Interest allowed by bank 2,275. Yes. Checks deposited into bank for collection but not collected by the bank up to this date. Check deposited, not collected. Cash book balance increases. You have to reduce it. Check deposited, not collected. 2,64,900. Next, bank charges not entered in the cash book. Bank charges not entered in the cash book. What you are going to do? Passbook balance reduces. You will also reduce. Bank charges 450. Discount received by the bank but not entered in the cash book. Discount received by the bank. So bank passbook balance increases. Left hand increases. So what you will also add it. Sorry, not discount. Dividend received. Dividend received is 75,000. Next, bank paid house tax on our behalf, but no intimation received from the bank in this connection. Bank has paid the house tax, so bank balance reduces. Cash book nothing, so you will reduce because your starting point is cash book. House tax paid 84,400. Do we have anything else? That should be it. 8,84,000.
87,000.
Positive or negative?
Positive.
So that means it is balance as per passbook. This is your solution. Correct? 887, 625. This is your BRS question which was there in December. Okay, let's go into the next one, guys. Let's go to the next question. Next question B. The trial balance of Mr. Sarvesh Kumar on 31st March 2024 did not tally and the difference was posted to suspense account. On scrutiny of the books, the following errors were detected. Identify the errors in the trial balance of Sarvesh Kumar and pass necessary journal entries. That means we are not in the third stage, we are in the second stage. After preparation of trial balance, not after preparation of final accounts. So we can't use P&L adjustment, but we'll use the word suspense. 2B. Journal entries in the books of Sarvesh Kumar. First one. Now, total of the sales return book for Jan 2024 has been casted short. Sales return book has been casted short. Sales return should be debited. So you will write sales return account debited 1,000. Okay. To suspense account 1,000. Only total there is a mistake. That means only sales return there is a problem. Credit is not there. Credit will be suspense account. Next. Freight paid for installation of machinery 6,500 was posted to the freight account as 5,600. They put it to freight account. First of all, they put it to wrong account and they put the wrong amount also. So now what we have to do? First we have to record the machinery. Machinery we have not put 6,500. So the entry will be machine account debited 6,500. Now then what we have to do? Freight account we have to remove. Freight wrongly posted, that we have to remove. So you will write to freight account 5,600. There is a mismatch now. That will go to suspense account. 900. 3. Next one. Goods of the value of 2,500 returned by a customer were entered in the sales day book and posted therefrom to the credit of his account. Goods returned by customer were first of all entered in sales day book and from there posted to the credit of the customer. Putting it into the wrong account and putting it to the wrong amount also. Now, let me show you the correct entry, wrong entry, rectification entry for this. What is the correct entry? Goods of the value 2,500 returned by the customer. So the entry will be what? Returned by the customer. It should have been sales return account debited to debtor account. Okay, 2,500. Now, understand the wrongness of the entry here. What wrong entry they passed? Entered in the sales book, not in the sales return book, sales book. And posted therefrom to the credit of his account. If you enter in the sales book, you should have written customer account debited to sales. But entered in the sales book, so 2 sales has happened, 2,500, and then you have written 2 debtor. This is compensating error. Putting in the wrong book and then transferring wrongly, that made it correct for us. We wanted credit, we got credit. Even though it went into wrong book, it got credited only. So now sales return is not done. So rectification entry will be sales return account debited because it is not done 2,500. Debtor no problem. Sales is wrongly credited. So we have to remove that sales. Sales account debited 2,500. To what? Suspense account 5,000.
this debit to the sales book?
It is not possible. No, debit to the sales book is not possible because they put it in the sales book. No, if you put in the sales book, sales will be credited only. But if you put in the sales book, customer will be debited. But after putting into sales book, customer instead of debit, they credited the customer.
Yeah.
So that error got nullified. Yeah, it can happen, but not in the sales book. They will tell sales is debited. Then you will reverse the sale. 4. 18,000 paid for purchase of old motorcycle for personal use of Mr. Sarvesh Kumar was debited to conveyance account. Personal use of Sarvesh Kumar means it should have been what? Drawings. So you'll write drawings account debited 18,000. Instead of putting to drawings, what did they do? Debited to conveyance account. So it was debited, so remove it. So 2, not suspense account, conveyance account 18,000. Only when you have a debit, no credit, suspense. Only when you have a credit, no debit, suspense. Here, instead of one account, they put into other account. So remove from the wrong account and put it to the correct account. That's it. Next, purchase of 6,700 had been posted to the creditor's account as 6,000. Purchase of 6,700 posted to the creditor's account as 6,000. Creditor should have been 6,700 only. So now, the rectification is to creditor 700. Only one side rectification. So now the other side will be what? Suspense account debited 700. Then receipt of cash of 5,000 from Mr. Avinash was posted to the debit of his account. Receipt cash from Avinash. It should have been actually cash account debited to Avinash. Now instead of crediting Avinash, you have debited Avinash. So now you have to double it. So the entry will actually be, you have to write to Avinash. To Avinash will be 5,000 plus 5,000. To remove the wrong one and put the correct one, 10,000. Then here you will write suspense account debited 10,000. Yes, that should be it, guys. Set 2 is done. Let's go into set 1 now. Set 1, also you have some questions, 7 marks. Do you have anything at the end as well? Yes. Let's solve this. This is your set 2. December 2025. Set 2. Okay, question number 2A. Question number 2A. See the question that they have asked. Machine is purchased for 7 lakhs. Expense incurred on this cartage and installation is 3 lakhs. That means you will add this too. So your total machine value now became 10 lakhs. Calculate the amount of depreciation at 20% per annum according to straight line method for the first year ending 31st March 2025 if the machine is purchased on 1/4/2024. Oh, what a stupid question. What a stupid question. See, they have just given playing with dates. They are checking your skills. Now here, 1/4/2024 means it is purchased on what day? Starting of the year only. So what will you do? What was the model test paper 1, right? One second. Let me just move this. Yeah. Now see here. 10 lakhs into 20% into 12 by 12. That makes it?
8 lakhs.
No, 2 lakhs.
Oh, okay.
2 lakhs. Then after that, 1st July 2024. 1st July means what? Only 9 months are remaining. 10 lakhs into 20% into 9 divided by 12. 1,50,000. After that, what if it is purchased on 1st October? 1st October means 6 months are remaining. 10 lakhs into 20% into 6 by 12. 1 lakh. Then 1st January. 1st January means only 3 months are remaining. 10 lakhs into 20% into 3 divided by 12. That means it is 50,000. Crazy question. 7 marks it seems. If it comes in the exam, like, just think that all your prayers are heard from childhood. God has heard all your prayers. Now, next, classify the following items as capital and revenue expenditure. This one I'll just solve here itself. An extension of railway track in the factory area. Extension of railway track will give you extra benefit. It is capital expenditure. Wages paid to machine operators. Wages. It is obviously going to be revenue expenditure. But if they would tell over here wages paid to machine operators to install the machine, it would have been capital expenditure. Installation cost of new production machine. There only they have given next line only. Capital expenditure. Material for extension to foreman's office in the factory. Material for what? Extending the factory. Capital expenditure. Rent paid for the factory. Revenue expenditure. Give reasons for your classification. You know the reasons. That's it. Like gift they have given these questions. So with that, we have officially finished chapter number 1 discussion. Fully of chapter number 1, all PYPs, and there is a theory where
Accounting policies. That's a methods and criteria of accounting policies.
analyze methods and criteria for selection and application of accounting policy. No, this is AS1. When we go to standards, we'll discuss AS1, that conservatism, prudence, all those things. Yes, so this should be it, guys. So with that, we are done with chapter number 1. So let's go into next chapter. Same process we'll follow for every chapter. Discuss the concepts and solve all the PYPs first and solve all the model test papers. Yes. Yes. Let's start. Let's begin with our next chapter. That is bills of exchange, consignment, joint venture. All three we will discuss together, and then we'll solve the problems of all these 3 chapters at once. Everything. So first we'll talk about bills of exchange. What is a bill of exchange? Bill of exchange is a negotiable instrument. That means one person, he has to pay money to another person, so that instrument can be negotiated. Clear? Now, seller, for example, you have Sriram over here, okay, who has sold goods to Shalini. Okay, sold goods 50,000. Now, when he sells goods, what will happen? He will always have the tension that will I get the money back or not. So what he will do? He will draw a bill on Shalini for 50,000 for 3 months. Now what Shalini has to do? She has to sign it and accept it and give it back. Once she does that, she becomes the drawee, and Shriram, who draws the bill, who is writing the bill, he becomes the drawer. Clear? One person is the drawer and other person is the drawee. Now, next one you have to understand who has to pay the money. Shalini. So Shalini will also be called as payer and Shalini will also be called as payee. Shriram will be called as payee. Now, we have to understand first about the dates which are there. Now, usually date of bill and tenure is given and due date will be given. Due date you have to compute. Due date plus 3 days grace, you will get your maturity date. Now, 1/1/2024, tenure is given in what? 3 months. If it's given 3 months, add months to the month column, directly it becomes 1/4/2024. Add 3 days, 4/4/2024. Now you have again 1 month, so add month to the month column. Okay, that becomes 1/2/2024. Add 3 days grace, you will get 4/2/2024. Here it's written 30 days. 30 days and 1 month are not the same. So you will add days to the days column, it becomes 31, and add 3 days, it becomes 3rd of February. 1/2/2024, add 30 days. Now 1/2/2024, in 2024 is a leap year. So therefore there are 29 days. 28 days done in February plus 2 days, it will make it 30 days. That time it becomes 2nd of March 2024. 5th of March will be the maturity date. 15th of June 2024, 2 months. If you add, it will become what? 15th of August. But 15th of August is a national holiday. So 14th of August, add 3 days grace, you will get the maturity date. So if it's a national holiday, you will take the previous day. And if it's an emergency holiday, you will take the next day. Clear? Now, bill drawn after date. Bill drawn after date means I drew the bill. Okay, as soon as I send the bill, from today only the time period starts. Tenure starts after the date of bill. Bill drawn after sight. That means I drew the bill, gave it to you, you saw it, accepted it. From the day you accept, that time the tenure starts. Tenure starts on the date of acceptance. Clear? Now here you have a situation. We'll try to cover everything. Drawer, in the books of drawer, in the books of drawee. Okay. Goods sold by Sriram. Goods sold by Sriram. What will be the entry? Here Sriram will pass the entry. Shalini account debited to sales. Shalini will pass the entry. Purchase account debited to Shriram. Oh, SR. I was thinking SR usually I write for sales return. So purchase account debited to Shriram. Clear? So basically debtor account debited to sales, purchase account debited to creditor. Clear? Now bill is drawn for 50,000. Bill drawn is useless. It's just a paper. But bill drawn and accepted, that time only it becomes valid. So bill drawn, no entry. But bill is accepted by Shalini. Now there is an entry. For Shriram, he gets a bill. Bills receivable account debited 50,000. Shalini is gone. So basically Shalini was a debtor. Debtor is gone when debtor gives you the bill. Now bill is the asset. Otherwise debtor is the asset. Debtor gone. Now bills receivable will be the asset. In case the bill becomes dishonored, then Shalini will make a re-entry back again. Clear? Now for Shalini the entry is Shriram account debited. Shriram is gone. There was Shriram over here. Shriram is gone to bills payable. Bills payable is a liability. Bills receivable is an asset. Clear? During the tenure of the bill. During the tenure of the bill, what can happen? Now imagine Shalini, she told she'll pay after 3 months and she signed and gave you the bill. Now can you go and disturb her in these 3 months? No. So that means in these 3 months, whatever happens, Shalini is not going to be affected at all. So here we are going to worry about during the tenure of the bill, holding the bill. Okay. First, Shriram is just going to keep that bill in safe locker and wait for 3 months. For holding the bill, no entry. Clear? Shriram wants urgent money. What he will do? Discount the bill with the bank for 49,000. Go to the bank and give the bill and tell, give me money now, you will get money after 3 months. But bank obviously has to collect their charges also. So they'll give you only 49,000. So bank account debited 49,000. To discounting charges also debited 1,000 because 1,000 is gone to bills receivable. No entry at all for Shalini. Shalini doesn't know anything about discounting, endorsing, nothing. Now bill endorsed to Dinesh. Dinesh is Shriram's creditor. So now Shriram has to pay money to Dinesh. So instead of giving money, what Shriram has done, he has given the bill itself to Dinesh. So Dinesh creditor, creditor goes, creditor liability, liability goes, debit. To bills receivable. Bills receivable which was there in your pocket, which was an asset, that is also gone. Clear? This is the situation for bill endorsed. So if bill is endorsed, this should be the entry. Dinesh account debited to bills receivable. Now on the due date, okay, on the due date, when they tell the due date in the question, it is interchangeable. Due date means maturity date only. Directly take maturity date and pass entries. On the due date or maturity date, two things only can happen. Good thing, bad thing. That is, bill is honored or bill is dishonored. If bill is honored and Shriram kept the bill in his pocket only, now what will happen? Bank account debited because he got the money to bills receivable. Bill is gone. If bill was discounted, bill is sitting in whose pocket? Bank's pocket. So who will make the payment? Shalini. Shalini will make payment directly to bank. No entry for Shriram. If bill was endorsed to Dinesh, bill is sitting in whose pocket? Dinesh's pocket. Who will make the payment? Shalini. Shalini will make directly payment to Dinesh. So no entry. And for Shalini, it doesn't matter to whom she is paying. The drawee, right? In the books of drawee, it doesn't matter to whom they are paying. The entry will always be bills payable account debited to bank. Bill is gone, money is gone. Bill is dishonored. Now I told you that time, if at all they don't pay the money, the drawee will come back. In our example, it was Shalini. Shalini will make a comeback. So if bill is dishonored, just remember, always Shalini account debited, Shalini account debited, Shalini account debited. If bill is dishonored. Now if bill was held, then two bills receivable. If bill was endorsed, to bank account. If bill was discounted, to bank account. If bill was endorsed, to Dinesh account. Because if it was discounted and if it is dishonored, bank will take money. Remember, we saw that in BRS also. Bill dishonored, bank took the money, but we didn't know. So that was causing difference between Cashbook and Passbook also. So if bill was dishonored, in the books of Shalini, bills payable account debited to Shriram. Bills payable account debited to Shriram. So whenever bill is dishonored, in the books of drawer, the debtor comes back. In the books of drawee, the creditor comes back. Because you have to pay money now and there they have to receive money. Clear? Next we have a topic called as noting charges. What is this noting charges? Amount paid to notary public for noting the fact of dishonor. That means someone has to tell, no, you can't go to court directly and tell bill is dishonored. Then court has to do the background check. So they go to a notary public. Notary public is a lawyer. You go to lawyer and tell, boss, this bill is dishonored. Lawyer will tell, get your bank statement. I want to check whether money came or not.
Then he will check everything, and when it is confirmed that it's dishonored, he will note the fact. He will note on the bill telling that it is noted that it is dishonored. Clear? So now, if Sriram is holding the bill, who will pay the noting charges? Sriram only will pay the noting charges. Noting charges account debited to bank. Okay, that noting charges is an expense. Expense usually gets transferred to P&L. But now what we will do? We will not transfer it to P&L. We have to put it on whose head this expense. This expense should fall on whose head? Shalini's head. So Shalini account debited to noting charges. Now Shalini has to pay the bill amount also. Shalini has to pay the noting charges also. In Shalini's books, for her it is expense. Noting charges account debited to Sriram. Has to pay the money to Sriram. Clear? If bill was bill was discounted, then who will pay the noting charges? Bank will pay the noting charges. Bank will take the money from whom? From us. So now we have to ask whom the money? Shalini. So Shalini account debited to bank account. For Shalini again it is same thing. Noting charges account debited to Sriram, and then P&L account debited to noting charges. Fixed entries for Shalini. Bill endorsed. Who will pay the noting charges first? Dinesh. Dinesh will ask us. We will ask Shalini. So Shalini account debited because we have to get money. Dinesh account credited because we have to pay money. Next we go into renewal of bill. Renewal of bill means what? The person is good, time is bad. Person is good, they want to make the payment, but time is bad. They don't have the money. So what they will do? They'll come and request you, can you please give us some more time? So that time what you will do? Cancel the old bill and a new bill drawn and accepted. Old bill should be cancelled and the new bill will be drawn and accepted. First, cancelling the old bill, same entry what we used to do for dishonor. Shalini account debited to bills receivable, bills payable account debited to Sriram. Once that is done, new bill will be drawn and accepted. When new bill is drawn and accepted, you have to understand one thing. Obviously, the person will tell, I am giving you more time, so pay me some interest. So if the interest is going to be paid, two things can happen. Interest will be paid now, or interest will be added to the new bill. Okay, so if interest is paid now, cash or bank account debited to interest. He is getting money, interest is an income. Interest account debited to P&L, income is transferred to P&L. Then new bill will be same as old bill, bills receivable account debited to Shalini. Same amount, new bill will be drawn. And for Shalini, interest account debited to cash or bank, she is making the payment, P&L account debited to interest account. Okay, then Sriram account debited to bills payable. Okay, so basically, first if it is interest is paid now, interest entries you pass. After that, new bill will be same as old bill, draw a new bill, accept the new bill. Now, new bill is with interest. Now, Shalini account debited because Shalini didn't give the interest. Shalini account debited, Shalini becomes the debtor to interest account. Interest is income. Income goes to P&L. And the new bill will be with the interest. So, bills receivable account debited to Shalini. And if you see here, interest account debited to Sriram. Interest is expense, so it is debited. Sriram did not get the money, so we have to pay him, so credited. P&L account debited to interest. Then Sriram account debited to bills payable. New bill will be with interest. Now, next thing is retirement of bill. That means time is good, person is good. Okay, so what the person will do? They'll pay the money early. Bill closed early by drawee. When the bill is closed early by the drawee, right, what we do is we pay something called as rebate. Okay, if at all, we give something called as rebate. See, Shalini was paying late. That time we charged interest. Now Shalini is paying early. So we have to give discount. That discount word is replaced by the word called as rebate. Now, bank account debited 49,500 because Sriram got only 49,500. Discount is always an expense. So rebate account debited 500 to bills receivable. In Shalini's books, bills payable account debited to bank made a payment of only 49,500. Remaining is rebate. So to rebate account. Next we go into a topic called as bills for collection. When you have too many bills, you can't keep track of all the due dates. So what you will do, you will take all those bills and give it to bank. Bank will do the tracking and bank will collect the money and put into your account. For this, bank will charge some charges. Bill sent by drawer to bank for collection. Bank will charge bank charges. No entry in the books of drawee because drawee doesn't matter. Drawee doesn't know what is happening with the bill. On the due date, drawee will come back. That's all. Okay. Bill sent for collection. Your bill went. It will be bills for collection account debited to bills receivable. Bills receivable is gone. New terminology, that is bills for collection. Here, when amount is received, bank account debited to bills for collection. Amount is not received. When amount is not received, always the comeback will be done by whom? Shalini, that is drawee. So drawee account debited to bills for collection. Clear? Accommodation of a bill. This also they can ask. Accommodation of bill. Accommodation of bill means what? Dinesh is there and a person called as Pinky is there. Dinesh and Pinky, they play a smart game. Okay, no transactions between these two. No transactions. But both are in need of money. So Dinesh will be like, listen, I will draw a bill for 50,000 for 3 months. And Pinky will accept the bill and give it back to Dinesh. Clear? Then what Dinesh will do? Dinesh will go to bank and discount the bill for 48,000. And Dinesh will get the amount from the bank and these two people will share the money. When they get the money, these two people will share the amount 24,000, 24,000. Now you have to remember one thing. In what ratio the amount is shared? In the same ratio, the discounting charges also will be shared. Amount is shared in the ratio 1:1. So discounting charges also will be shared in the ratio 1:1. Now on due date. Okay, on due date. Who has to pay the bank? Pinky has to pay the bank because Pinky is the person who accepted the bill. Pinky is supposed to pay the bank. So on due date, what Dinesh will do? He will return his share back to Pinky. So Pinky kept how much money with her? 24,000. And her share of discounting charges is how much? 1,000. So totally 24,000 she had the money. 1,000 she'll put her share of discounting charges. 25,000 she has. What Dinesh has to do now? Give his 24,000 back and add his 1,000 discounting charges. So on due date, Dinesh will return his share to Pinky. Share of each person will always be amount shared plus share of discounting charges. Whatever amount is shared plus discounting charges will be added. So total amount Dinesh has to pay to Pinky is 25,000. Total amount that Dinesh has to pay to Pinky is 25,000. Then Pinky will now have 50,000 with her and she'll pay it to bank. Note, discounting charges to be shared in the same ratio in which amount is shared of the initial bill, first bill. Same ratio. Just remember this. Your institute, right? They might make some lot of different calculations. Don't follow that. Just remember first bill, what ratio is there? Follow that ratio. Done. At the end of the question, prepare ledger of the drawer or drawee to find out the amount payable or receivable. If it's bills for accommodation, draw a ledger. That time you will get to know if it is debit balance, that means you have to get money. If it's credit balance, that means you have to pay money. With that, we are done with the topic of bills of exchange. Next, we'll go into the next topic over there in chapter number 2. That is your consignment. We'll go to consignment. Bills of exchange, consignment and joint venture. All three concepts will finish at once. And then we'll go through all PYPs for these questions. And then all the model test papers also. With that, we'll be done with chapter number 2 in detail. Clear? Now, consignment. There is again Dinesh, who is in Chennai. Okay, there is Bambani, who is in Mumbai. Now, what Dinesh will do? Dinesh is very busy person. He is very busy person. He has too much work in Chennai. But he wants to do his business everywhere. He wants to conduct business everywhere. So what Dinesh will do? He will send his goods to Bambani and tell Bambani, sell it over there. Now Bambani becomes the agent. Dinesh becomes the principal. Dinesh becomes the principal. Dinesh is having business of, by the way, selling coriander leaves. Okay, coriander leaves he is going to sell in Mumbai now. Now, owner of the goods, who is it? Dinesh. Always. Consigner. Goods are sent. Okay. Stock is in consignee's godown. Ownership transfer when goods are sold by consignee. Simple. If Dinesh sends the goods to Bambani also and Bambani receives the goods and it is sitting in his godown also, this will still be taken as whose goods? Dinesh goods. Only when Bambani sells it, that time it will be considered as sale for Dinesh. Clear? Ownership transfers only when goods are sold by consignee. Because consignee is just an agent. He is just holding the goods as a middleman over here. That's all. And for doing this, the consignee will just charge some commission. Now, understand this. Consigner sends goods. Okay, so consigner sends goods and he will, along with the goods, he will send a pro forma invoice. Why is he not sending the invoice? Because invoice is when the sale happens. Invoice is when the ownership transfers. Here ownership is not transferring. Only goods are given telling the take it, sell it. Okay. And consignee every week or every month or every 6 months, what he will send? He will send something called as account statement. He will send something called as account statement. In that account statement, what he will mention? All the details of transactions of consignee. He's like, this much was sold, this much there was some fire, this much something got damaged, this much sales returns, this much amount I received, everything he will mention in that, and that is called as account statement. Clear? Now, invoice given to the seller of goods, that is customer. When will the invoice be given? When consignee sells the goods to customer. Till then, what are we managing with? Only pro forma invoice. You can get this in MCQ. Consignor gives to consignee with the pro forma invoice. Consignee makes the sale with invoice. Now, closing stock on consignment. Closing stock on consignment. Now, this is a very important transaction. Closing stock on consignment and abnormal loss are two transactions which you have to be absolutely careful. Clear? Now, understand this. There is a consignor. Just understand the process. Consignor puts the goods on a truck. That is carriage. After that, he'll put the goods on the ship. That is freight and insurance. After that, it will reach the port. Then you will pay government duty. Okay. Then it will go to one more truck. That is carriage. After that, it will reach the godown of the consignee. In the godown of the consignee, they have rent, electricity, salary. These are not related expense for us. This has nothing to do with the goods going from here till here. Okay, these are unavoidable expenses. That will anyways happen. Now, closing stock on consignment. Understand this. Cost or invoice price of the goods, whichever is given in the question, plus share of non-recurring expenses. See, this happens once, this happens once, this happens once, this happens once, this happens once. All these are non-recurring expenses. Whatever is paid over here, these are all recurring expenses. They have no connection with the goods. So basically, if you have to think, whatever expenses you have spent for the goods to reach till here, all that will be added to the closing stock value. So share of non-recurring expenses will be added. That time you will get your closing stock value. Expense incurred till it reaches the consignee. These non-recurring expense means expense incurred till it reaches the consignee's go down. Now, abnormal loss is something called as avoidable loss. It could have been avoided, maybe damaged in transit or stolen in transit, something. Clear? Now, consignor, two things you have to understand. Goods are in transit or goods are in go down. If goods are in transit, you will add the expenses, everything, all the expenses which are there in transit, you will add when you are calculating abnormal loss. If goods are in go down, till it reaches the go down, whatever is there, you will add all the expenses. Clear? Basically, you have to remember one thing, abnormal loss calculation, when you are adding the expenses, till what point, where it is lost, till that point, everything will be added. Is it clear? Yes. Now, value of stock lost plus share of expenses till the point where goods are lost. If goods are lost in transit, that means the duty and taxes won't be applicable to that, because duty and taxes is only after it reaches the destination. Okay, so what you have to remember, abnormal loss, till it reaches, till that point where it is lost, all the expenses will be added. Proportionate expenses will be added. Now, accounting in the books of consignor. In the books of consignor. Majority of the time they ask in the books of consignor only. But to surprise you, they can also ask in the books of consignee. Now, in the books of consignor, goods are sent on consignment. Now, always one ledger will be prepared. That's called as consignment account. If it's expense, debited. If it's income, credited. Now, goods are sent on consignment at cost. If it is sent at cost, consignment account debited to goods sent on consignment. Consignment account debited to goods sent on consignment. This goods sent on consignment will go where? It will go to the trading account of the consignor. So, goods sent on consignment account debited to trading account. Don't you think for the consignor, this is like sales? He sold the goods. So, that is why it is going to trading account. And consignment, for this consignment transaction, this is a purchase. So, that's why it is debited. Now, if it is sold at invoice price, that means cost plus profit. Consignment account debited to goods sent on consignment, this will be at invoice price. If it is at invoice price, now you have to understand one thing. Immediately, when you record it at invoice price, immediately your hand should move to the other side. You have to reverse. You have to reverse it. Here it becomes remaining loading effect or reversal of profit. Goods sent on consignment account debited to consignment account. Simple. When you send the goods at invoice price, imagine it is sent at 120. You will pass the entry consignment account debited 120 to goods sent on consignment 120. Immediately what will you do? Goods sent on consignment account debited 20 to consignment account 20. Reversal of the profit. Clear? Expenses of consignor. Consignor's expense. Who spent the money? Consignor. Consignment account debited to bank. Expenses of consignee. Who spent the money? Consignee. but it is not consignee's expense. It is consignor's expense only. So consignment account debited to consignee. That means we have to pay money to consignee now. None of the expenses are consignees. Everything is ours. They are just working like agent. Now, cash sales by consignee. Cash sales by consignee. Consignee made the sale, did not give us the money. So consignee has to give us money. Consignee becomes a debtor. Consignee account debited to consignment account. Why consignment account is credited? Because it is income. Credit sales by consignee. Now what happens? Consignee account debited because consignee has to give us money to consignment account. To consignment account because consignment account it is income. Amount sent by consignee to consignor. When consignee sends the money, we get the money. So bank account debited to who gave us money? Consignee account. To consignee account. Is this clear? Now amount sent by consignor to consignee. That time consignee account debited because consignee got the money to bank account. Abnormal loss. How to calculate abnormal loss? We already discussed. Now what is the entry for this abnormal loss? Abnormal loss account debited to consignment account. Consignment value has to reduce. Okay, abnormal loss account debited to consignment account. Then that abnormal loss will be transferred to P&L. So we'll pass P&L account debited to abnormal loss. Closing stock entry. Consignment closing stock account debited. Consignment closing stock because stock is an asset, stock is debited to consignment account. It is credited to consignment account. It can be at invoice price, it can be at cost. Okay, opening stock entry, consignment account debited to consignment opening stock. Now, if stock reserve, you have to understand. Okay, stock reserve is a very, very important concept. You will see it in multiple areas. First time we are seeing it is in consignment. You will see again in branch accounts. You will see it in departmental accounts also. Now, when goods are sent at invoice price and closing stock is there in consignee's godown. So, consignor has sent the goods and it is sitting in consignee's godown and it is at invoice price. That time what you have to do? You have to remove, it is unsold, right? If the goods are unsold, that means profit is unrealized. So what you will do? Consignment account debited. Consignment account is debited to remove the or reduce the profit to stock reserve. To stock reserve. And this stock reserve in the balance sheet, this is the profit portion on the closing stock. If it is on opening stock, what will, by the way, where will this stock reserve go? In the balance sheet from the inventory, it will get subtracted. In the balance sheet, you have that consignment closing stock. No, consignment closing stock will reduce in the balance sheet. It will come down to cost itself. On opening stock, what will you do? Last year's unrealized profit. Last year's unrealized profit is this year's realized profit.
That is reducing profit from the inventory.
Reducing profit from the inventory. To bring it down to cost. So consignment account is debited, okay, to reduce the profit, and stock reserve so that you can reduce the stock. And opening stock is last year's unrealized profit. That means last year it was unrealized. This year it is realized. They made profit this year. So stock reserve account debited, remove the stock reserve and transfer it to consignment account. So this year's unrealized profit means remove from consignment account. So debit. Last year's unrealized profit means this year's realized profit. Put it to consignment account. Credit. Now commission payable to consignee. This can be also a tricky part of consignment. Normal commission. If it is normal commission, then just take the sales amount and multiply the percentage. Bad debt is the loss of the consignor. If it is normal commission, who is going to bear the bad debt loss? Consignor. Del creditor commission. Del creditor commission means bad debt is the loss of consignee. Yeah, it is their loss. We are not going to bother about that. Sales into percentage. Now overriding commission. Overriding commission. Normal sales, normal commission plus excess sales if you make, you will get excess commission. How to calculate that excess commission will be given in the question itself. Okay, now profit on consignment, it will be transferred to what? P&L. So consignment account debited to P&L. Loss on consignment will be debited to P&L. So P&L account debited to consignment account. In the goods of consignee. In the goods of consignee. Now you have to understand one thing in the goods, in the books of consignee. In the books of consignee, what happens? Goods sent to consignee. No entry. We just got the goods, that's it. We'll keep it in the godown, but no entry. Goods returned by consignee, no entry. Expenses paid by consignor, no entry. But if it is paid by consignee, not my expense, but I paid it. So consignor account debited, he has to give me money to bank. Sales, cash sales, bank account debited, I got money, but I have to give this money to somebody, to consignor. Credit sales. Customer account debited to consignor. I have to pay the money to them. Okay, when the amount is received, okay, if amount is received, del creditor commission, no del creditor commission, bank account debited to customer account. If amount is received. Okay, if amount is not received only, there is a problem between del creditor and non-normal commission. But when amount is received, del creditor commission also let it be. No del creditor commission also, you will pass the entry as bank account debited to customer account. You got the money, now you have to give it to this person. Now bad debt. Now you have to be careful. Bad debt, del creditor commission. If there is del creditor commission, whose loss it is? Bad debt is whose loss? Consignee's loss. So bad debt account debited, which will nothing but commission income. Commission income is there, no, of consignee. It will get adjusted with this commission income to customer. Are you getting this? Bad debt account debited actually, but because of del creditor commission, bad debt is falling on whose head? Consignee. So commission income account debited, that means commission income is going to reduce to customer account. If it is not del creditor commission, consignor account debited, because consignor will be debited to customer account. Commission. Consignor has to give commission. So consignor account debited to commission income. See, this commission income only, no. If there is bad debt in del creditor situation, this will reduce. Okay. Amount sent by consignee. Consignor account debited to bank. That's it. Done. Finished. This is your consignment. So let's continue with joint venture now. Joint venture is basically a temporary partnership. Okay. Now imagine Pavan, okay, has IT business and he started, he went and approached Narayan Murthy and told, will you become my partner and make software for me? So software 20 million for Tesla for Indian roads. Okay, is going to enter into a partnership for that. Now this is a temporary partnership. Till this software is ready, they have a temporary partnership. After that, they have no connection with each other. Clear? Now, when the software for Tesla is ready, Pavan and Narayan Murthy have no business relationship. So when you're talking about accounting, it becomes very important to understand the accounting. Simple. You can only have two situations. Separate set of books are maintained. Separate set of books are not maintained. Separate set of books, if it is maintained, then you will have joint bank account, joint venture account and co-venturers account. If separate set of books are not maintained, then two things again, both co-venturers will record all the transactions in their books, or both co-venturers will record only their transactions in the books. Now, if they are recording only their transactions, here one additional thing comes, that is called as memorandum joint venture account. Clear? Now, separate set of books are maintained. Simple. I told you, no, separate set of books are maintained. What are the things? Joint bank account, joint venture account, co-venturers account. So amount contributed by co-venturer. Money comes into joint bank account debited to co-venturers account. Expenses of venture paid from the joint bank. Expense joint venture account debited, because expense is debited, joint venture account debited to joint bank. Expense of the venture paid by co-venturer. So joint venture account debited to co-venturer account. Income of the venture received. Income of the venture received. Joint bank account debited to joint venture account. Joint bank account debited because money comes, and joint venture it is income, so credited. Income of the venture received by co-venturer. So joint co-venturer account debited because they have to give money to us now to joint venture account. Stock taken by co-venturer. If stock is taken by co-venturer has to give money, so co-venturer account debited. For joint venture it is good, it's income, joint venture account credited. Profit will be given to whom? Co-venturers. So joint venture account debited to co-venturers. Transfer the money to co-venturers. Loss, co-venturers account debited to joint venture account. Now whatever balance is there in the bank, it will be distributed to co-venturers, not in any ratio and all, based on the balance in co-venturers account. If whatever balance is there in co-venturers account, check it and make the payment according to that particular balance. When separate set of books are not maintained, first, each co-venturer will record all transactions. Each co-venturer will do what? Recording every single transaction. Now you have joint venture account and co-venturer account. Joint venture account and co-venturer account. So now you have two parties over here. One is Santosh and one more is Nishanti. Now, what will Santosh do? Record every transaction in his books. What is Nishanti going to do? Record every transaction in his book, in her books. Now, goods supplied by Santosh. Goods are given by Santosh to Nishanti. Okay, this is a joint venture. So joint venture account debited because it is expense to purchases because his goods are gone. For Nishanti, it's going to be joint venture account debited. Again, Nishanti also will record this as expense, but to Santosh because Santosh she has to give money. Now, expense paid by Nishanti. So, joint venture account debited because it is expense. But did Santosh pay the money? No, Nishanti paid the money. So, to Nishanti. Here, joint venture account debited because it expense to bank because Nishanti paid the money. Sales made by Santosh and amount received. Who made the sales? Santosh. So, bank account debited. For joint venture, it is income. So, to joint venture account. Here also joint venture account only, but did not receive the money. Who received the money? Santosh. So, Santosh account debited. Now, sales made by Nishanti and amount received. Now, what Santosh will do? Sale has happened. So, income. But who made the sale? Nishanti. So, Nishanti account debited. And for Nishanti, what will it be? Bank account debited because money comes in to joint venture account. Now, stock taken by Santosh. If stock is taken by Santosh, for joint venture it is income and Santosh gets stock. Stock account debited. If stock is taken by Santosh, for joint venture it is income, but in Nishanti's books, Nishanti didn't get the stock, so Santosh account debited. Santosh has to give the money now. Stock taken by Nishanti. In Santosh's books, who took the stock? Nishanti took the stocks. So Nishanti account debited because she has to give money to joint venture account. And here Nishanti got the stock, so stock account debited to joint venture. Now when there is a profit, okay, when there is profit, joint venture account debited, remove the profit, transfer your profit to your P&L and then transfer the other person's profit to Nishanti's account, other co-venturer's account. Here what Nishanti will do, transfer the profit to your P&L and transfer Santosh's profit to Santosh's account. So each co-venturer is keeping joint venture account to record all the transactions and the co-venturer's account to record the transaction with the co-venturer. Now if it's loss, P&L account debited, Nishanti account debited to joint venture. Here P&L account debited, Santosh account debited because Santosh is the party here to joint venture. Amount paid by Santosh to Nishanti. Imagine one person gives the money to the other person. Okay, end of the situation, what happens? Somebody spent more money, somebody spent less money. So one person will have to give the money to the other person and settle it. Now, if amount is paid by Santosh to Nishanti, Nishanti account debited to bank. Nishanti is receiving money, so bank account debited to Santosh. Clear? Now we have separate set of books are not maintained. Each co-venturer keeps record of only their transactions. This becomes very, very critical. They are keeping record of what? Only their transactions. That means the ledger is called as joint venture with co-venturer account. If you are recording only your transactions, is it possible for you to calculate the profit? No. So what will you do that time? To compute profit, you will prepare one more account called as memorandum joint venture account. Memorandum joint venture account is prepared, okay, just to compute profit and all transactions are recorded over there. It's basically like a rough joint venture account you're doing. Because you're roughly doing it, it's called as memorandum joint venture account. Is this clear? Now, Santosh and Bhumika, two people are there. This is the joint venture account. Okay. In the books of Santosh, what will happen? You see, goods supplied by Santosh. Goods supplied by Santosh. Joint venture with Bhumika account debited to purchase account. Goods went. Goods supplied by Bhumika. No entry. Santosh doesn't bother about that because he's going to record only his transactions this time. Expenses incurred by Santosh. Joint venture with Bhumika account debited to bank. Expense incurred by Bhumika. No entry. Then income received by Santosh. Bank account debited to joint venture with Bhumika. If income is received by Bhumika, no entry. Ignore because Bhumika will be passing the entry there. Now stock taken by Santosh. Stock account debited to joint venture. If stock is taken by Bhumika, no entry. Now profit. Only Santosh share. Only Santosh share. Joint venture with Bhumika account debited to P&L account. Loss. P&L account debited to joint venture with Bhumika. Clear? So there are three situations. Separate set of books are maintained. Separate set of books are not maintained, but each co-venturer is recording all the transactions. Separate set of books are not maintained, but each co-venturer is recording only their transactions. Now, amount received by Santosh. Bank account, money comes in. Bank account debited to joint venture with Bhumika. Amount sent by Santosh. Joint venture with Bhumika account debited to bank. Done. That's it. With that, we are done with all the three units of chapter number 2. That is bills of exchange, consignment and joint venture. Now we'll go and follow the same methodology, finish all the PYPs, and then we will go into model test paper. First PYP is June 2025. Let's go into June 2025. We already solved one of the question there. Insurance claim, branch, incomplete records, partnership, consignment. Question number 6. We have only one question from this chapter. I don't think they asked anything else. Yes, question number 6A came for 7 marks in the exam. Question number 6A. Yes. Let's get ready. Always consignment. We have to go to the end of the question and check. Okay. What did they ask you to prepare? Prepare consignment account and sham account in Ram's books. Consignment account and sham account in Ram's books means this co-insurer is keeping record of all the transactions. Now, Ram of Patna consigns goods to Sham of Delhi for sale at invoice price or above. Invoice price or above. Now, look at the solution. If you look at the solution, no. Right. See, in the books of Ram, consignment account is there to Delhi, and then there is Sham's account. Two things are there. That's it. Goods sent on consignment, they did not ask, but still they have prepared. And the workings you need for calculation of stock and other things. Now, let's go further. Terms are like this. Commission to Sham is 5% of invoice price plus 25% of any surplus realized. That means extra sales if you made or you sold at higher value, on that will give you 25%. But normal commission, this is the overriding commission which we are talking about. 25% extra. Ram draws a bill on Sham at 90 days site for 80% of the invoice value as security money. So what Ram will do? Ram, when he is giving the goods, he doesn't have complete confidence. So what he is doing? Whatever invoice value is there, 80% is drawing a bill of exchange. Okay. Now, Sham remits balance proceeds after sales, deducting commission by side draft. They'll come balance amount, whatever is there when sale is made, he is going to make that payment. Anyways, the bill amount will be paid with the bill amount only. Okay. Details. Goods costing 20,900, including freight, invoiced at 28,400. Now, consignment account should be debited. Okay, now see over here. Consignment account debited to goods sent on consignment. But I told you when it is sent at profit, immediately you have to reverse it. So, goods sent on consignment account debited to consignment. Can you see the profit portion is reversed? They said no, 20,900, 28,400. If you see the difference of these two numbers, it is 7,500. So, goods are sent at invoice price. So, I told you, whenever goods are sent at invoice price, you have to immediately reverse the loading effect. Can you see the loading effect is removed? Yes. Now, sales made by Sham, 26,760. Sales are made by Sham. So, what will happen now? Sham has to give us money. So, Sham's account debited to consignment account. Sham's account debited to consignment account. Clear? Next. Unsold goods, invoice price is 6,920. Original cost including freight is 5,220. Unsold goods, closing stock it is. So what happens over here? Stock, closing stock on consignment account debited to consignment account 6,920. But immediately what you will do? You will create stock reserve to stock reserve 1,700. To stock reserve 1,700. So everything is simple. Only commission calculation you have to be careful. Okay, now that's it. Site draft received up to 31st December is 6,820. Others in transit. So they have given a draft telling that 6,280. Others are in transit. That means goods are in transit. Now only calculation you have to do. See over here. 80% of the invoice price you have to raise a bill. Remember they told as soon as goods are there. Now where is it over here? See the terms. Ram draws a bill on Sham for at site for 80% of the invoice as security. How much is the invoice price? 28,400. So 28,400 into 80%. 22,720. This is the amount for which Ram is going to draw a bill. For bill, what is entry? Bills receivable account debited to Sham. Sham is the person over here. Can you see 22,720? Bills receivable account debited to Sham. Is it clear? Now, only other entry that we have to discuss is, see, 6,280. They told that, say, they have sent 6,280. If they are sending a draft, okay, that means what should be the entry? Draft is like check only, like DD. Okay, so draft account debited. Okay, like instead of bank account, they have written draft account debited. Draft account debited to Sham. Sham gave us that much money. And they said remaining is in transit. They sent everything, remaining is in transit. This you will get later as the balancing figure. 902. Only when you put the commission. Okay, when you calculate that. Now see over here. Consignment, goods sent on consignment. There is nothing to worry. Okay, by consignment account, reverse the profit. Remaining everything will go to trading account. Clear? Now this working note you have to be careful. Calculation of commission. Okay, first you have to understand the question. See what they told in the question. They said that 5% on invoice price, 25% on any surplus. Clear? Now if you see over here, invoice value of the goods is what? 28,400. In that, unsold stock is their closing stock. Remove that. That means this is the value that is sold. Okay. But this is the value that is sold. But can you see they have sold at 26,760. They have sold at a higher value. Because they sold at higher value. This much surplus. On surplus, they said 25% you are going to get commission. So you can see on 5280, you are getting 1320 as commission. But on the remaining, that is on invoice value, you will get 5% commission. Again, go back to the question and see. 5% on invoice price. 25% on surplus realized. So can you see the surplus realized? First, what happened? Total invoice price is how much? 28,400. Okay, we sent 28,400 unsold stock. They only gave the unsold stock also. How much is unsold stock? 6,920. So this is at invoice price. This also should be at invoice price when you are subtracting. That means this is the remaining goods at invoice price. And those remaining goods at invoice price were sold at this value. Sold at higher value. So we got surplus. On surplus 25% commission. Invoice price directly 5% commission. Commission, no commission becomes 2394. Commission, what is the entry? Consignment account debited to consignee. So consignment account debited 2394 to consignee 2394. Done. Consignment account closed. This profit is balancing figure. Gets transferred directly to P&L account. Clear? Now, see the remaining one. Sales made by Sham 26,760. Correct? Security money already received. Remember security money we calculated 80% of 6920 is 5536. What is this 6920 they had given, right? Where is it? Unsold goods. Unsold goods are 6920, right? Now see over here. You have to understand this calculation. Little tricky it is. Now, sale is made by Sham this much. So, do you agree that Sham has to give that much money? Okay. Now, security money on closing stock. Closing stock is not sold. But on that also 80% they have already given. Okay. 5536. That makes it 32,296 total amount. Now, less bill already drawn. Bill drawn 22,720. Clear? Commission account. Commission we calculated 2394. Draft received 6,280. That means still 902 is the balance. 902 is the draft balance. Are you getting it?
Yes, sir.
Now, see again if you want I'll explain it. Now, what is the sale made? In the question only they gave 26,760 is the sale. So for 26,760, this amount is receivable. Amount is receivable. So now closing stock, okay, closing stock is not yet sold. It will be sold next year. But out of that closing stock, 80% we already have calculated. 80% we have to get. No? 80% is this one, man. So I'll tell you. See, Ram draws a bill. 80% of the invoice price is security money. Okay. So the security money you see, 80% of that 5536. Now you are like, what about the remaining? Remaining will be paid. Okay, 80% only is there. Closing stock is there, 80% security money is there. So this amount and this amount I have to get. Okay, this full I have to get because it is sold, and this 80% I have to get because it is part of the bill. So this much amount I have to get. For this, what they have given? They have already given me bill. Bill we calculated that time 80% of the invoice price. So they have to give me this amount. Then this amount already I have bill. So I don't have to worry. Clear? This amount I have to give them commission. So that is also gone. Then 6,280 draft they gave. Draft means money only they gave us. So if you compare and see, still 902 is pending. That is what they told. Others are in transit. Others means whatever other draft is there, no, DD or check, that is in transit. That is why if you see in the customer's account, sorry, not customer, consignee's account, can you see by draft in transit 902. When you put that only, you will get the balance carried on. Clear? This is an important calculation that you have to understand. Done. That's it. We don't have anything else in June. Let's go further to December 24. December 24, you have one bills of exchange question 3A. Then it's regular. That's it. Only one question, 7 marks. Bills of exchange 3A. Now, they didn't ask normal. Directly they asked mutual accommodation. I told you, right? Mutual accommodation only they are going to test you on. Now, see over here. First, always in bills of exchange also, you have to go to the end of the question and see whose books we are in. You are required to pass journal entries in the books of Indra. That means entire question you are going to think from whose angle? Indra's angle. Indra drew upon Chandra a bill for 90,000 on 1st April 2024 for 3 months for mutual accommodation. Chandra accepted the same and immediately on receipt. Okay, so Indra drew a bill. For Indra, it is bills receivable. So you will pass the entry 1st April 2024, bills receivable account debited to Chandra 90,000. Done. Next, after that, on 1st April 4th, Indra got it discounted at 6% per annum and remitted 1/3 of the proceeds to Chandra. Let's discount the bill first. So when you are discounting the bill, this will be discounting charges will be 90,000 into 6% into 3 by 12. 1,350 discount. Remaining everything you got, bank account debited. Okay. 2 bills receivable 90,000. Bill is gone. Now you are giving how much money to Chandra? 1/3. If you are giving 1/3 of the money to Chandra, discounting charges also 1/3 should fall on whose head? Chandra's head. So now I told you what ratio you are going to share the money. In the same ratio, the discounting charges also will be shared. So now if you check this, bank account debited. Now 88,650 you got, right? Into 1/3 you are going to make payment. That is 29,550. And discounting charges was 1,350, right? That 1/3 you are going to put on Chandra's head. If you are going to put the discounting charges on Chandra's head, my expense should reduce. So discount on bill account credited 450. Total amount what is going to fall on Chandra's head is 30,000. 90,000 bill, 1/3 should be 30,000 only. Clear? Now, after that, at maturity, Indra was not able to send the required sum and asked Chandra to receive a 2 months promissory note of 6,900, which Chandra did. Now, Indra is supposed to give the money, right? Indra is not able to give the money. So, Chandra made the full payment to bank. So, now, what Indra said, remaining amount I cannot give you. So, please take a promissory note. Remaining amount is actually how much? 60,000, no? 90,000 bill, 30,000 fell on his head. So 60,000 this person has to pay. If 60,000 they have to pay and they are giving promissory note for 60,900, that means 900 rupees is interest expense for us. So now see, interest account debited to Chandra 900 and Chandra account debited to bills payable. If you accepted promissory note also for you, it is a payable amount only. So Chandra account debited to bills payable 60,900. Clear? Be careful with the dates. See, can you see all grace days are added? Now, next. Chandra got the note discounted for 60,000 and met his acceptance. Chandra got that bills note discounted because Chandra had to get money, no? We couldn't give money, so we gave bill to Chandra. Now, Chandra got that bill discounted and he recovered his money. Now, Indra became insolvent just before his promissory note was due for payment. Wow. Okay, Indra became insolvent. So now promissory note also bounced. So you have to reverse the entry. Bills payable account debited to Chandra 60,900, 60,900. Now only 25% was received from his estate. So 60,900, in that only 25% is received. How much? 15 to 25. That means remaining everything we are not going to pay at all. If we are not going to pay, for us what is it? No, for us it is profit. For him it is loss. Yeah, for him it will be considered as bad debt. For us it will be considered as deficiency. So if you see over here, Chandra account debited to bank to deficiency account. Is it clear? Entries to be supported by narration, they are telling. You have to write narration. Wherever you see journal entries, you always have to write narration. Okay. So these are the entries. So one only thing is, remember, for drawer not received will always be bad debt. For drawee not paid will be called as deficiency. And bad debt is a loss, so it will be debited. Deficiency is a gain, so it will be credited. Done. That was your December 2024. Now we'll go into next one. That is June 2024. Third one, yeah. Yes, 3A. This time they asked consignment. 3A they asked consignment. 3A. Now, let's go into this and check directly. You are required to show the consignment account, Jatin's account and loss in transit account in the books of Kush. So directly we are focusing on whom? We are focusing on Kush. So if you see over here in the books of Kush, consignment account, Jatin's account and loss in transit account. Now, one by one. Kush of Kanpur sent to Jatin of Jaipur a consignment of 400 electric sieving machine costing 24,000. Invoice price is 30,000. So now directly consignment account debited to goods sent on consignment 96 lakhs, because it's going to be 400 into no.
Yes, 24 into.
It was sent at cost. Oh, it was sent at cost, so 24,000. So 96 lakhs. It is not sent at invoice price, so directly cost only is recorded. Next, Kush paid freight and insurance of 96,000. Who is Kush? You are only Kush, no?
Yes,
So consignment account debited to bank account 96,000. Clear? Next, Jatin spent 31,200 for clearance and selling expenses were 1,500 per sewing machine as and when the sale was made by Jatin. 31,200 who paid? Jatin paid. So consignment account debited to Jatin. Consignment account debited to Jatin. The selling expense we will see later how much is sold, and on that basis we will also calculate the this thing amount. Clear? 1,500 per machine. Now in transit 10 sewing machines were stolen, for which insurance company paid 1,85,000 in full settlement to Kush. In transit only it is stolen. So now what happens? That is why they told you to prepare this abnormal loss account or loss in transit account. How many machines are stolen? 10 machines. 10 into 24,000. 2,40,000. Clear? But plus we have spent some expense, right? The expense is what? Freight and insurance. Clearing expense won't be there because it is lost in transit only. I told you abnormal loss till it is stolen. Okay, so 96,000 is for 400 machines. So 96,000 into 10 divided by 400. How much you are getting? 2,400. Can you see 2,42,400? Loss account debited. Loss in transit account debited to consignment account. That time I told you the entry as abnormal loss account debited to consignment account. Clear? 2,42,400. Next, after that, Jatin sold 210 sewing machines for 32,000 per sewing machine. So 210 machines, he sold it at 32,000 per sewing machine. That gives us 67,20,000. And 130 sewing machines at 35,000. 130 at 35,000 per sewing machine. That gives us
45 lakh 50,000.
45 lakh
50,000.
That gives you a total of
1 crore 12 lakh 70,000.
1 crore 12 lakh 70,000. Can you see here? Jatin account debited to consignment 1 crore 12 lakh 70,000. This is how you got the sale amount. Clear? Now Jatin was entitled to a commission of 5% on total sale value plus 1/4 of the amount by which gross sales proceeds less total commission thereon exceeded the invoice price. Commission we have to calculate. Okay, the final amount due was settled. Now understand this. Now selling expense we can calculate.
The total 340 machines for the 1,500.
340 machines, right?
340 machines for the 1,500.
Yes, 340 machines into 1,500. 5 lakh 10,000. So consignment account debited to Jatin account. Consignment account debited to Jatin account. Clear? Now after that what you have? Only commission calculation and closing stock calculation. Okay, now if you have to check, if I show the calculation over here, okay, we had totally sent how many machines? 400 machines. Out of that 10 machines are
So
stolen. We have 390 machines. Out of that 340 machines are sold. So we have only 50 machines. 50 into 24,000.
112 lakhs.
50 into 24,000 is
12 lakhs.
12 lakhs. Clear? Now you have to be a little careful. I'll show calculation here. 50 into 24,000 machines. That makes it
12 lakhs.
12 lakhs. Now you have to be careful with the expenses. First expense is what? Freight and insurance. So 96,000 into 50 divided by 400.
12,000.
12,000. Then 31,200 clearing. Now listen. 31,200, you have to be a little careful. 31,200 will be into 50 divided by 390.
Yes.
Because 10 already lost. Clearing will be done only for what they receive, right? That gives us what? 4,000. This totals up to 12 lakh 16,000. So closing stock account debited to consignment account. Everything is sorted except for the commission part. Commission we have to calculate. Huh?
Logically,
Which one?
this point is
Yeah.
for the 390.
390, yes. Only what is received. That's what, no, not only logical thing. I told you, right? Closing stock, when you're calculating, whatever expense is spent, this is not spent only because 10 machines already lost in transit itself. So when that fellow Jatin, when he went to the port, no, he didn't get 400 machines. He got only 390 machines. For 390 machines, he'll pay the duty and he'll release the machine and go.
If we miss the transit, it will be
Now, commission. I don't think they have shown the calculation for commission, right? Directly they put the amount as 690, 125. Shabash. Now, commission we have to understand 5% of the total sales plus 1/4 of the amount by which the gross sales proceeds less the total commission exceeds the invoice price. Okay. See the commission here. They said that 5% of the total sales. Okay, 5% of the total sale value you should get. And our sale value is 1 crore 12 lakh 70,000. On that street commission 5%, 5 lakh 63,500. Done. Then they told 1/4 of the amount by which the sale proceeds exceeds the total commission thereon exceed the invoice price. Sorry, total sale proceeds less total commission exceeds the invoice price. Now, understand this. Our sale proceeds is this 1 crore 12 lakh 70,000. But the invoice price of the 340 machines is 1 crore 2 lakhs. So, extra sales, how much we made? 10 lakh 70,000. From that, remove the commission what we are already paying you. 5 lakh 63,500. Apart from that commission also, still there is some extra amount. On that extra amount, you will get 1/4. See over here. 1/4 of the amount by which sale proceeds less commission exceeds the invoice price. Sale proceeds less commission, if it is exceeding the invoice price, that means you are still making extra profit for us. On that you will get 1/4. So the 1/4 when you see, you get 126, 625. These two numbers if you add, this is your total commission 690, 125. Now you can check the suggested answers. 690, 125. Consignment account debited to Jatin's account. Jatin is the person, right? You have to pay the money. Consignment account debited to Jatin's account. Whatever balancing figure is there over here, this is the profit and loss. It will get to transfer to profit and loss. And here whatever balancing figure is there, Jatin is going to give us money because they said the final amount due was settled. So you will write bank account debited to Jatin's account. Done. Finished. Is it clear? So the commission part is little tricky, that you have to be careful. I think in study middle questions, some of them it is there. Yes. Done. June done. We have one last question paper, that is December 2023. December 2023, you have one question. Yes, question number 3A. Bills of exchange again. December 2023. Small question they have asked. Now, again accommodation. Again, it's accommodation. Give necessary journal entries in the books of H. Journal entries in the books of H. So now, you directly start in the books of H and keep in mind that you are H. On 1st July 2023, G drew a bill for 80,000 for 3 months on H for mutual accommodation. Who is drawing a bill? G drew on H. Who are you? You are H. So for you, somebody is drawing a bill on you and you accept that bill. That means for you it is bills payable. H is us. Somebody drew a bill on H only. So for us it is bills payable. So you will pass the entry G's account debited to bills payable 80,000, 80,000. Is it clear? Next, G had purchased goods worth rupees 81,000 from J on the same day. Doesn't matter. G purchased goods, ignore. G endorsed H's acceptance to J in full settlement. G endorsed the bill to that person. Doesn't matter. You are H. Ignore it. On 1st September, J purchased goods worth rupees 90,000 from H. Somebody is purchasing goods from you. That means for you it is sales. So you'll pass the entry J's account debited to sales 90,000, 90,000. Clear? Then J endorsed the bill of exchange received from G to H and paid 9,000 in full settlement. Remember, our bill went to somebody, that person endorsed to somebody, and that person is endorsing it back to me now. So I am getting that bill, but that bill is of how much? 80,000. I am supposed to get how much? 90,000. How much is paying me? 9,000. That means 1,000 is discount for me. 1,000 is a loss. See over here. Bills receivable account debited 80,000. Bank account debited 9,000. Discount account debited 1,000. To J's account 90,000. Now that bills receivable which I got, no, it's my own bill. So bills receivable and bills payable are cancelled with each other. Can you see this bill which went, no? It took one full circle and it came back to me. So now bills payable and bills receivable are cancelled against each other. Next. On 1st October, H purchased goods. Are you H? Yes. Are you H? Yes. H purchased goods worth rupees 1 lakh from G. So you'll write purchase account debited to G, 1 lakh, 1 lakh. Okay, this is done. Now finally, they said that H paid the amount to G by check. H paid the amount. They didn't tell how much. So you have to prepare a ledger. You have to prepare G's account. I told you, bills for accommodation, always you have to prepare G's account. See the first entry over here. G's account debited. So go and write 80,000 debited to bills payable. After that, here there is no G. Here also there is no G. Again, here also no G. Here G comes back again. Purchase account debited to G, 1 lakh. G is credited for 1 lakh, debited for 80,000. That means we have to pay 20,000 to G. So G's account debited to bank 20,000. Always you have to prepare this ledger as a working note to check it out. Done. That was your December 2023 question. Finished. Now we move into model test papers. Yes, let's go into this particular question, guys. 3A. Question number 3A in the model test paper which was in December 2023. So there is this question. On 1st July, first you have to always look at the end. You are required to prepare consignment account, T. Ramaswamy's account in the books of Datta. Ramaswamy, full. Datta they kept still North Indian person only. Where is it? Here. Books of B. Datta of Kolkata, consignment to Chennai. Then T. Ramaswamy's account, 2 things they have to do. And see, commission calculation they have shown. And also closing stock calculation. Now, first one. B. Datta of Kolkata consigned 250 computers costing 28,000 each to Ramaswamy. Okay. Expenses. Now, first of all, 250 into 28,000. 250 into 28,000 will be 70 lakhs. 1 second. Yeah. So can you see over here, consignment account debited to goods sent on consignment, 70 lakhs, done, sorted. Then after that, expense of 70,000 were met by consigner. Consigner only paid, so consignment account debited to bank account 17,000. Next, after that, Ramaswamy spent 14,500 for clearance on 31st July. Okay, so 14,500. So consignment account debited to Ramaswamy's account. Can you see Ramaswamy's account? You can see 14,500. That means we have to pay money to Ramaswamy 14,500 because he has paid for the expense. And selling expenses 1,500 per computer as and when the computer sale is made. Same adjustment was there just now. Yes. T. Ramaswamy sold on 4th September 150 computers at 40,000 and again 75 computers at 42,500. So 150 into 40,000 and 75 into 42,500. First one is how much? 6 lakhs.
No. That is 60 lakhs. This is 31 lakh 87,500.
31 lakh 87,500. So totally our sale is 91 lakh 87,500. Can you see the entry here?
Yes, sir.
Wait, is it 80 lakhs?
That is, they have given 80 lakhs.
150 computers at 40,000.
But the sales.
31 lakh 87,500 is correct.
Yeah, but they didn't give
Huh.
how much sales he made.
Smart. See here. Here they wrote 80 lakhs, which is actually typo. Here 31 lakh 87,500 is correct. See here. 60 lakhs and 31 lakh 87,500. Okay, they have made mistake in this is a typo here. It should be 60 lakhs. Because debit part they have written correct. Credit part they have made the mistake. Okay, 60 lakhs and 31 lakh 87,500. Then after that you have what? Ramaswamy was entitled to commission. Now you know Ramaswamy sold all these computers, right? 150 plus 75, 225 computers. And per computer, what was the expense? 1,500. So you can show the selling expense here. 1,500 into 225 computers. Are you getting?
3 lakh 37,500.
3,37,500. Okay, this also they are showing separately. If you total these two, it is 3,37,500. Two sales are there, right? So 2 times selling expense they have written and 2 times sales also they have written. So 3,37,500 is there over here also in Ramaswamy's account. Consignment account debited to Ramaswamy. Next, after that, we'll go further. Same adjustment. Was entitled to commission of 1,500 per computer sold direct plus 1/4 of the amount by which the gross sale proceeds less the total commission thereon exceeded a sum calculated at the rate of 35,000 per computer sold. Same invoice adjustment which we had in examination. Basically, see, from model test paper they are directly putting into the examination. Okay, it is there. So now this commission calculation we have to do. See. Yeah, they have given the invoice price. First 225 they sold, right? On that 1,500 commission, normal commission, like how we did over here. And then 60 lakhs plus 31 lakh 87,500 is their sales minus X.
Yes, sir. The invoice price.
Invoice price. No, 35. This is 78 lakh 35,000. If you solve for X, you'll get 5 lakh 32,500. Okay. Basically, you could have done without X and Y also. Directly, you could have calculated. You would have still gotten the number. Okay. Yes, you can see over here. Calculated the rate of 35,000. Sale proceeds 1/4. Again, same thing. 1/4 of the amount.
5,35,000.
Okay, guys. There is a small error here. The commission calculation, it doesn't match actually. I'm showing the calculation over here, commission. Now, we sold 225 computers and on that they said 1,500 commission. That makes it 3 lakh. This is the commission, normal commission. Then, what is the 225 computers? Sorry, the sale value. Sale value is what? 91 lakh 87,500. And what is the invoice price for this? Invoice price, they said 225 computers into 35,000. 78 lakh 75,000. When you subtract this, 13 lakh 12,500. Correct? From that, you would remove the commission, 3 lakh 37,500. Just now we did it in one of the previous question. 9 lakh 75,000. On this, we have to get how much? 1/4. Same adjustment again, 1/4. So when you do 1/4 on that, you actually get 2 lakh 43. 2 lakh 43,750. 2 lakh 43,750 and the 3 lakh 37,500 which is there. We should get 5 lakh 81,250. This should be the commission, but they are showing 5 lakh 32,500. Okay, that is one error. So commission you have to change, which we just did in the examination question. You saw that 5 lakh 81,000. So this commission will change. Five lakh 32,500. No, 5 lakh 81,250. Okay. Then obviously the profit or loss also will change because of the profit loss will be different. That is one thing. Stock on consignment we have to calculate. Stock on consignment, we did not have any abnormal loss. Okay. How many units are sent? 250 are sent. 225 are sold. 25 is remaining. Correct? So 25 computers into 28,000. Was that the cost? Starting we saw that the cost was 28,000. Correct? So into 28,000 you got 7 lakhs. Now 17,000 one expense was there. 17,000 into 25 by 250. 1,700. Then clearing expense also was there. 14,500 into 25 by 250. Now this only had a twist in the exam. In the exam what happened? In between this there was an abnormal loss. Because of that 250 didn't reach there. So there we had to do little less. Because after removing the abnormal loss, what reaches, that only will be calculated. So this was the situation, 7,03,150. Okay, this this closing stock calculation, you know, and closing stock entries, closing stock on consignment account debited to consignment account. Can you see 7,03,150 consignment account? This is the question which was there in our model test paper, guys. Next, we'll go into the next model test paper. This is June 2024. June 2024, I think we have only one question again, 3A, right?
Yes, sir.
3A. After that, did they ask anything at the end?
No, sir.
In the end, we have partnership, NPO, yes. Yes, joint venture, 3A. Now you have to go to the end of the question and you have to see, prepare joint venture account with home account in the books of Hari. Also show the memorandum joint venture account. That means which methodology they are following. This is that situation where separate set of books are not maintained and each co-venturer is keeping record of only their transactions. That is when we'll get memorandum joint venture. So here, memorandum joint venture account will have all the transactions and joint venture with home account will have only our transactions. Clear? Now, in one shot, we should finish both. Hari and Om agreed for purchasing and selling furniture in a joint venture. Their profit sharing ratio is 3:2. Let's remember this later for profit calculation. Hari purchased 10 sofas for 10,000 per sofa. Who purchased? Hari. Who are you? Hari. Who are you? Hari. So what should be the entry here? In joint venture account also it will be there 10,000 to bank account, joint venture account to bank account, and here joint venture account debited to bank account. Our transactions we are going to record. Clear? Now you have to be very careful. In the memorandum joint venture account, you are going to record all the transactions, and in the joint venture with home account, you are going to record only your transactions. Next, he means Hari only, spent on those sofas, he sent those sofas to home for sale after spending 1,000 per sofa for insurance and transportation. Who spent? Hari. So joint venture account debited to bank, 10,000, and here also joint venture account debited to bank because it's our transaction. Now, he drew a bill of 50,000 on home and this bill was discounted at a discount of 5,000 after acceptance. Who drew a bill? Who drew a bill? Hari drew a bill on home. Correct? So can you see over here? Discount of 5,000 is an expense, right? Drawing bill is not going to be an expense. But when you drew the bill, 50,000, what is the entry for drawing the bill? Bills receivable account debited to home. But 5,000 expense is there. This expense is of the joint venture. So joint venture account debited to discount account. And here also joint venture account debited to discount on bill. So both the places we are showing it as expense. Clear? Next, Om incurred further expense of 2000 on these sofas before sale. Om is incurring. In the joint venture account, that will be there. Joint venture account debited to Om account. But in the joint venture with Om account, it won't be there because it is not our expense at all. Are you getting the difference? This memorandum joint venture account will have all transactions. Why all transactions? Because we want to know what is the profit. And the joint venture with Om account will have only our transactions. So that should be the situation. Next. He sold all sofas for 15,000 per sofa, giving 5% commission to the dealer. Who sold? Om sold. So here you will record everything. Om joint venture Om account debited because Om sold to joint venture account. Full sale value is there. But it will not be there in joint venture with Om account because it's not our transaction. Okay, then over here, commission, joint venture account debited to Om account. It will not be there in the other ledger because who paid the commission? Om paid the commission. That's it. Prepare joint venture account. Now if you see, whatever profit is there, it is shared in the ratio of 3:2. Okay. So Hari will get his profit. So you can see Hari will record only that 15,300. Only 15,300. That other one will go to Om. And can you see bills receivable here? That 50,000 bill was drawn. Bill account debited to joint venture with Om account. And finally, balance carried down. They didn't tell that it is settled. Okay. This is what they are expecting for 7 marks. Easy. That's why joint venture is not asked as often as the other things. Okay. This was your model test paper of June. Let's go to the next one. December 2024. I think again question number 3, right? 3A shows consignment. Okay. Now, when we go to consignment, again go to the end, prepare the journal entries in the books of techno traders given that maintains consignment inward account. Consignment inward is an account where they are recording all the stock when it comes into the consignee. So can you see in the books of techno traders? In the books of techno traders will see who they are first of all. RG Cellular of Kolkata consigned 100 mobile sets to Techno Trader. Techno Trader is actually the consignee. They have asked you journal entries in the books of consignee, okay, of Durgapur. Now, cost of each handset was 25,000. So 25,000 into 100, 2,50,000, 25 lakhs. So we are getting the goods. When they are getting the goods, they are passing the entry consignment inward account debited because we got the consignment to RG Cellular. Why RG Cellular is credited? Because we have to make the payment. He is the consignor. Next, after that, consignor paid insurance of 15,000, freight of 8,000. Can you find that entry over here? No, because who paid? Consignor paid. No entry. Yes. An account sale was received from Pluto showing gross sale proceeds of 80 units at 30,000 each. 80 units at 30,000 it is sold. See. Bank account debited to consignment inward. We sold, right? We sold to whom? Somebody called as Pluto. Bank account debited to consignment inward. This is the situation. Now, expense paid and deducted by him were carriage 2,000, establishment expense 10,300, insurance 24,000, commission 85,000. Who has paid the expenses? See, carriage 2,000. 10,300, 24,000. Can you see these expenses paid for consignment?
Establishment payment, consignment.
Yeah, establishment expense is consignee only because see over here, carriage, consignor will pay us. Establishment expense also consignor will pay us. Sorry, I missed it. Yeah, establishment expense also consignor will pay us. What the consignor will not pay is this commission. 85,000 is separate. So 2,000, 10,300, 24,000. Everything will be paid by consignor. See, you have to remember one thing. Expenses are of whom? Expenses are of consignor. But right now we paid it. So we paid it. So we'll pass the entry. The entry will be see consignment inward account debited. The stock has to reduce to bank account. To bank account. 36,300. Now commission they only told 85,000. 85,000 commission we are going to get it. So bank account debited, sorry, they didn't receive it, it's receivable. Consignment inward account debited to commission account. Commission is recorded income and this is receivable. So it is debited.
So if they have received it is bank.
It would have been bank account. Yes. Net amount only they'll receive, I think, last. Handsets lying unsold with Pluto were valued at 5,05,000. Okay. Five lakh 5,000. So you can see over here, RG cellular account debited to consignment inward. Why we are writing RG cellular account debited? Because it's theirs, right? So 5,05,000. Then after that, finally, nothing. That's it. Now, can you see over here, 2,83,700 consignment inward account debited to RG cellular, being balance of consignment inward account transferred to Jupiter account. You are sending it to them. And finally, the net amount, whatever is there, RG cellular account debited to bank. If you do the balancing figure, if you would have prepared ledger, you'd get the balancing figure itself. Now here you will get the balancing figure by doing plus minus for all the debits. Okay, 22,78,700 is there. That amount you are going to pay. Is this clear? From here it starts. Okay, see, RG cellular, if you see, 25 lakhs we got.
Yes, sir.
And after that, 5,05,000 minus. Then 2,83,700 plus. When you see, this is the amount that you are supposed to pay.
22 lakh 8,000.
Yes. This is what they ask in the books of consignee. Usually they ask in the books of consignor. Clear?
Yes.
Done. Next. We'll go to the next one. 3A again. Bills of exchange. What they ask this time? Bills of exchange. Go to the end. Show the journal entries in the books of X and Y both. They want in the books of X also, in the books of Y also. So in the books of X and then in the books of Y. Now, X draws a bill of 1,200 on Y and accepts the same for mutual accommodation in the ratio 4:2. 4:2 is what? They are going to share the money in the ratio 4:2. First, we'll draw the bill. If you see the books of X, right? Bills receivable account debited to X, 1,200, 1,200. In the books of Y, it will be X account debited to bills payable 1,200, 1,200. This is the situation. Now, if you go further, X discounts the bill for 1,100 and remits 1/3 of the sale proceeds to B. How much is going to remit? 1/3 of the sale proceeds to B. See, now you might be confused. Sir, they told 4:2. Now suddenly 1/3 is up. 4:2 is nothing but 2:1. That is, suddenly they switched from 4:2 to 1:3 now. Okay, 4:2 and 2:1 is same. So 1/3 of the proceeds are sent to B. Now first you have to discount the bill. X is discounting the bill. 1,110. Bill is 1,200. So 90 rupees will be your discounting charges. So bank account debited 1,110. Discount on bill account debited 90. Two bills receivable 1,200. Clear? Now same thing. If at all bill is discounted, the other party will not pass any entry because other party is not discounting the bill. Now this fellow will send 1/3 the amount. 1/3 of the amount is going to send. So Y limited account, Y account debited 400, but to bank. Now understand how much was the amount? 1,110 into 1/3. That means 370. And here discount on the discount is how much? 90. I told you that time. Same ratio you should share the amount also. What ratio share the amount? Same ratio you should share the discount also. 90 into 1/3, 30 is the discount. When I'm putting the discount on, that fellow said my discount reduces. That means my expense reduces. That's why expense is credited. Now this entry will be there in other parties' books also. This entry will not be there in other parties' books because it's a discounting entry. It's a transaction between X and bank. So Y is not involved. Here if you go and check, you have to pass the entry, just the opposite entry. Bank account debited, discount on bill debited to X. Can you see just opposite entry is passed over there? Yes. Next, what happens before the due date? Y draws another bill for 1,800 on X in order to provide funds to meet the first bill. So now Y is drawing bill on X. So what will be the entry for that? Y account debited to bills payable. In the books of Y, it will be bills receivable to X. See, bills receivable to X. Because now one person drew a bill, discounted, kept the money, didn't give the money. So now that person is drawing the bill on this person. Okay, now after that, you can go and check. Second bill is discounted for 1,740 by Y and sum of 360 is remitted to X after meeting the first bill. Second bill, who is discounting? Y. So the discounting entry will be in whose books? In Y's books. Bank account debited 1,740, discount on bill 60, to bills receivable 1,800. Then what will Y do? Y will make the payment to the bank. See, bills payable account debited to bank. The first bill. This is the first bill which Y has to make the payment. Then what will Y do? Whatever money he got, 360 he is giving. 360 is nothing but 1000. See, bank account debited 360. But remember, discounting charges is there, no? 60. Discounting charges will be in what ratio? Same ratio. First bill, what amount they shared? In that ratio only, because second bill is a consequence of the first bill. Because first bill was not settled properly, second bill came. How much is the discounting charges? 60. 60 into 2 by 3. Why 2 by 3? 1 by 3 is mine. 2 by 3 is his. That time that fellow was putting on my head. So he put 1 by 3 on my head. Now I am putting on his head. So it will be 2 by 3 on his head. Clear? So 40 is the discount gone. X account is debited for 400. Then if you see, bills payable, already we passed the entry, bills payable to bank. And this fellow is receiving the money. So bank account debited, discount account debited to Y. Done. So after that, we have to see second bill is duly met. Luckily, second bill on the due date they made the payment. So X will pass the entry, bank account debited to Y and bills payable account debited to bank. How is this bank account debited to Y? The net amount, whatever is there in Y's account, being the balance amount of second bill remitted to Y. Everything. Okay, you have to check Y's account. If you do the Y's ledger, I told you, you have to always prepare the ledger for the party. When you prepare Y's account now, when you see Y's account, see from starting. First, what is there? Credit 1200. Then what is there? No Y at all here. Here Y is debited 400. Then what is there? Y is debited 1800. Then what happened over here? Y is credited 400. Here what happened? No Y at all. Now if you check the difference, right? 1800 plus 400 minus 1200 minus 400. How much are you getting? 600 rupees debit balance is there. That means 600 rupees still I have to pay to Y. So bank account, wait, what is debit balance is there? That means Y has to give to me, not Y. I have to pay to Y. See, 600 rupees debit balance is there. So Y will give me money, bank account debited to Y. Did you get it? Mutual accommodation, every time at the end you have to prepare the ledger of the other party. So this person has to give. Now if you see that person, right, he would have passed an entry X account debited to X account debited to bank account. Now bills payable is there, no, the second bill, 1800 ka bill. That 1800 bill, what will happen? Bills payable account debited to bank account, and for that person bank account debited to bills receivable. And it is not there over here. Sorry, it is not there over here because that fellow has already discounted the bill with the bank. No, can you see this? See, first bill, X drew the bill on Y. So for X it is bills receivable, Y it is bills payable. X went and discounted with the bank. So on the due date, Y made the payment to bank. So X will not have any entry. Second bill, Y drew a bill on X. So for Y it is bills receivable, X it is bills payable. But what did Y do? Y went and discounted it with the bank. So on the due date, X is making the payment to bank. Clear? This you have to understand, and that was your set 1 of December 2024. Now we go into June 2025. Couple of questions are there in June 2025 also. I think one question, right? Consignment. That's it. 3A, they have reserved it for chapter number 2. Now 3A. Singania Traders of Surat consign. Now let's go to the end and see. Prepare consignment account in the books of Singania Traders. So consigner in the books of consigner, Singania Traders, consignment account they have asked you to prepare. Now Singania Traders of Surat consigned 5000 liters of edible oil costing 32 each to M Limited. 5000 liters entry is what? Consignment account debited to goods sent on consignment. Can you see 1,60,000 there? Yes, matching. Next, S Limited paid 5,000 as freight and insurance charges. Okay. S Limited is, I think, Singania only. 5,000.
Yes, sir.
So consignment account debited to bank. 5,000 is paid. Expense paid by consigner. Next. During transit, 200 liters were destroyed for which insurance company agreed to pay 5,000 in full settlement. Wow, 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 wow. So now what will happen? How much is lost?
6,400.
200 liters into 32 rupees. That gives us 6,400. Correct?
Yes, sir.
Now see the fun part here. How much expense was there?
5,000.
Freight 5,000. 5,000 into 200 liters divided by 5,000 liters.
200.
200.
5,000.
200 liters lost out of 5,000 liters, and the cost is also 5,000 only. So 200. So 6,600 is your abnormal loss. Can you see? Goods destroyed in transit 6,600. 6,600. They have shown the working note. Okay, we already got the working note. So let's not worry about it. Next. M Limited paid clearing charges of 6,100, go down rent of 300, salesman salary of 900. Who paid? M Limited. That means consignee. So consignment account debited all these expenses. Okay, consignment account debited all these expenses to whom? Consignee. But we are not preparing consignee's ledger. Only consignment is asked. Okay. Next. It was entitled to 6% ordinary commission and 4% del creditor commission on sales. So basically 6 plus 4, 10% commission is going to be paid. On 36, M Limited reported that 4,000 liters were sold at 1,65,000 and 100 liters were lost due to evaporation. Natural loss. That we are not going to do anything. 4,000 liters sold for 1,65,000. So now what will happen? Can you see over here? M Limited has to give us money. M Limited account debited to consignment account 1,65,000. Clear? Next. Customer who brought liquor for 1,500 could pay. What is this? They started with milk. Sorry, edible oil. Now they are ending with the liquor. This is not liquor, guys. It's oil only. Okay. For 1,500 could pay only 40% of his amount. M Limited paid his balance due by a check. Okay. Now you have to be a little careful. Okay. Commission, you see, nothing. I told you, no, 10% you have to take 1,65,000 into 6%, 1,65,000 into 4%. So basically 10% commission, full commission. So consignment account debited to consignee's account. Now, after that, you don't have to worry only about the bad debt, because bad debt is whose loss? Consignee's loss, because del creditor commission is there. Consignee's loss. Now what we have to calculate is only this consignment stock. Consignment stock you have to calculate. Now see over here. Goods lost in transit we already calculated. No, 6,600. We don't have to bother about that. 5,000 liters were sent. 1,60,000. Add the expense. So it becomes 1,65,000 now. For 5,000 liters, our total expense is 1,65,000. Now 200 liters are already gone. So now if you see 1,65,000 into 800 divided by 5,000. Yes, 1,58,400. This is the remaining after you remove the abnormal loss. This is the remaining. Okay, now non-recurring expenses are there incurred by consignee, like clearing charges and all. That you are going to add 6,100. Now 4,800. This became the cost, total cost. Normal loss you remove 100. Only 4,700 are there. 1,64,500. Are you getting this? Now, if I have to show it to you in a different way.
Will that 4% will affect the balance?
What?
4%.
No, it will not affect. Del creditor commission is given because now bad debt is his responsibility. If del creditor commission was not there, normally I would give him 6% commission. If I give 6% commission, bad debt will be my responsibility. Now, because I gave him extra 4%, bad debt is his responsibility. Okay, now the question is about closing stock. Closing stock, what we have to do? Usually, if you are calculating, how many kgs are still there? 5,000 kgs, right?
Yes, sir. 5,000.
Now, 5,000 kgs, out of the 200 kgs went.
Yes, sir.
4,800 kgs. 4 liters. 4,800 liters into 32, right?
Yes, sir. 1,53,600.
1,53,600 into 32. Clear? Then they have spent some money. How much money they have spent? 5,000. 5,000 into 4,800 divided by 5,000. That will be 4,800 only. So now we got plus 4,800, 1,58,400. Now again they spent some more money. How much money they spent? They spent clearing charges and go down rent. Oh, sorry. Only no. Only clearing charges. Go down rent is recurring. Salesman salary is recurring. I told you have to add the expenses only till it reaches there, go down. Till it reaches there, go down. So 6,100 they have spent. And 6,100 is spent for 4,800 only. It is not spent for 5,000. Because 200 already is lost in transit. So now directly 6,100 if you add 1,58,400 plus 6,100, 1,64,500. 1,64,500 is our total expense. But do you have 4,800 remaining? How much is the closing stock that is there?
Sir, that 6,100 is for 4,800, right? Then divided by 5,000.
No 5,000. Because when it reached there, only 4,800 reached there. And for 4,800 they paid 6,100.
Oh, they paid?
Yeah, they paid 6,100. Now here what happened? They paid 5,000.
Why we are not converting it into the 5,000 units? 4,800 units. They have paid it for 6,100.
No. They paid 6,100 for 4,800 units. Here we paid 5,000 for 5,000 units. That's why we calculated how much is it for 4,800 units because 200 already gone. There they paid 6,100 for 4,800 units only directly. Because 200 didn't go there. It was lost. Okay, now 1,64,500 is the situation. Correct? 1,64,500 divided by 4,700 units. Not 4,800. 4,700 because of normal loss. Divided by 4,700. You are getting how much? 35 is the cost per kg or sorry per liter. Now how many liters are remaining with us? If you see the question, okay, we sent how many liters? 5,000 liters. Then what was the sale? 4,000 liters sold. Okay, then after that 100 liters normal loss. 200 liters gone. So I think we are left with only 700 liters. See, 700 liters into 35.
24,500.
Can you get the 24,500? They have done a calculation in a complicated manner. You don't need to do that. You can directly do it like this. Calculate the cost, get the cost per liter, then multiply into the remaining stock. You will get 24,500. And entry, don't forget, closing stock on consignment account debited to consignment account. 24,500. That should be it with that particular question. Let's go into the next one. This is also June 2025, set 1. 3A again. Joint venture.
Same, sir. Same, sir.
Same sum.
Yeah, same. This is like a book sum also. So they are repeating in place the papers.
What?
This is
Book
a
sum.
also.
Hari and Om. Prepare joint venture account with Om in the books of Hari. Also show memorandum joint venture account. Memorandum joint venture account we had prepared. This only was we were getting 3:2 ratio. Same values. Just now we saw it, right?
Yes.
Done. Okay. Now we go into the next one. Okay guys, let's go into December 2025. We have to solve these questions. Okay. Question number 3A. Ram, first we'll go to the end. They are asking in the books of whom? Ram. Consignment account and what? Sham's account. Sham personal account is Sham's account. Correct? So in the books of Ram. In the books of Ram, we require consignment account. And then we also have to prepare Sham's account. Consignment account and Sham's account. Now, when we go further, you can see over here, Ram of Kolkata sent goods costing 1,50,000 to Sham of Mumbai on consignment basis. Yeah. 2 goods sent on consignment account 1,50,000. Next, Ram paid 6,000 on various accounts for sending the goods. Who paid? Ram paid. So consignment account debited to bank account. Ram paid no 6,000. Next, Sham paid 3,600 as railway charges and 1,500 as go down rent. Sham paid. So we are going to write consignment account debited to Sham account. To Sham account, yes, 3,600 and 1,500. 3,600 plus 1,500, it becomes 5,100. Go to Sham's account and write by consignment account 5,100. Okay, next we proceed further. Consignee sent a bank draft for 90,000 as advance against the consignment. Who sent the money? Consignee sent. That is Sham. So bank account debited. We got the money. Bank account debited to Sham. So we are going to write by bank account 90,000. Next, 4/5 of the goods were sold at 1,74,000. Who sold the goods? Sham. So Sham's account debited to consignment account 1,74,000. And we'll go to consignment account and write by Sham account 1,74,000. Next, a customer who purchased goods for 1,000 failed to pay, for which the debt was proved bad. But wait, account sales sent by consignee showed that he charged 10% as ordinary commission and 2.5% as del creditor commission. Because of del creditor commission, you can ignore this. Because the bad debt is whose responsibility now? Sham. So you don't have to worry about that. Okay, you are required to prepare in the books of that's it. Del creditor commission is there 10% and 10% and 2.5%. So directly you can write consignment account debited to Sham account. How much was the sale? 1,74,000 into 12.5%. 21,750. So directly you are going to write by consignment account 21,750. And then what we need to do? You are required to prepare. That's it. No, done. There is no abnormal loss.
No.
There is no abnormal loss. Now you have to calculate only closing stock. This becomes an important working note. Closing stock. Closing stock on consignment. Clear? Now you have to be careful here. Okay, goods costing 1,50,000 was sent. Correct? How much was sold?
1,74,000.
No. 4/5 was sold. So 1,50,000 into 1/5.
30,000.
30,000 is still there.
Yes, sir.
To this you have to add the expenses. Now expenses you can't add everything. What you have to add? First the 6,000 which was spent by Ram. Then in Sham's expense only the railway expense. Go down rent won't be taken because go down rent is recurring expense. So 6,000 plus 3,600.
6,000 is for 1/5.
6,000 is for total. Ram sent everything, right? Yeah. Now you have to calculate. Yeah, 1/5 we have to do. But what I'm doing is 6,000 plus 3,600 into 1/5. 1,920. 31,920 will be a closing stock. Now again, why we are not taking go down rent? Because go down rent is a recurring expense. Only till it reaches there, whatever is spent, that one will be added. 31,920. So you're going to write closing stock on consignment account debited to consignment account. So here by closing stock on consignment account 31,920. Simple question. There was no abnormal loss also. You're getting a balance of 23,070. Where will this 23,070 go? To P&L account. Profit. To P&L account. And they didn't tell anything about the Sham's account. Sham's account you can check 1,74,000 minus 5,100 minus 90,000 minus 21,750. 57,150. By balance carried down. Done, that's it. Set 1 done. Simple question they had asked. This is your solution, guys. Set 2 is done, yes. This is the question that they had asked. Set 2. Let's go into set 1 now. Set 1 is bills of exchange. Again, question number 3A. Question number 3A. Now, here, always go into the end and check. Past the journal entries will be recorded in the books of Mr. X and Mr. Y when the bill was endorsed by Mr. X in favor of his creditor, Miss Z. In books of whom Mr. X and Mr. Y both. So, journal entries in the books of X. Then they also asked you to pass journal entries in the books of Y. This is what they have asked, correct? So now what we are going to bother about is Mr. X sold goods of 15,000 to Mr. Y and immediately drew a bill upon him on 1st January 2025 payable after 3 months. So this everything is happening on what date? 1st January 2025. First we have to sell. Who is selling? Mr. X is selling to Mr. Y. So 1st January 2025 you will write Y account debited to sales account. Y account debited to sales account. How much is that? 15,000. For this person if it is sale, for the other person what is it? Purchase. So 1st January 2025 purchase account debited 15,000 to X account 15,000. So this should be sorted. In both the books at the same time we keep on passing entries. Then immediately drew a bill on him payable after 3 months. Drew a bill. So 1/1/2025 for me X it is bills receivable. So bills receivable account debited 15,000 to Y account 15,000. Now you go into the books of Y. For that person it is bills payable. So that person will pass the entry X account debited 15,000 to bills payable account 15,000. Done, sorted. Now you go further. On maturity, the bill was dishonored and 50 was paid by the holder of the bill as noting charges. On the maturity, bill is dishonored. 50 is paid by the holder as noting charges. And they told specifically, pass in such a way that the bill was past journal entries in the books of X and Y when the bill was endorsed by Mr. X in favor of Miss Z. So first Mr. X has to endorse this bill now. So 1/1/2025 you will pass the endorsing entry in favor of whom? Z, right? Yes, Z account debited 15,000 to bills receivable account 15,000. For endorsing, in the books of Y there is no entry. I endorsed, they are not bothered at all. On the maturity date, what is happening now? Bill bounced. Bill is dishonored. 50 rupees is paid as noting charges. Who paid the noting charges? Z paid. But Z will ask us. And we have to ask whom? Y. So we have to ask whom now? Y. So 4/4/2025. 3 months bill. Add 3 months it becomes April. Add 3 days grace it becomes 4/4/2025. Clear? So now when the bill is dishonored. Okay. Bill which is endorsed and it is dishonored. Whenever the bill is dishonored, you have to bring that old person back. So Y account debited again. Y account debited because I have to get money from Y. But who is asking me money? Z is asking me money. So you'll write 2Z account 15,000 plus 50 rupees 15,050. 15,050. Now what about in the books of Y? 4/4/2025 in the books of Y, bills payable account debited 15,000 gone. Correct? But not only this bills payable now, this person has to pay extra 50 rupees. No, wait. Extra 50 rupees. That is noting charges account debited 50 rupees to X account 15,050. This is the entry. And this is what they have asked. This is your solution for that particular question. With that, we are done with your chapter 2, which contains bills of exchange, consignment, and joint venture, and all the questions of past examinations and also your model test papers. Next, we'll go into your next chapter, that is your final accounts. Yes, let's go into your next chapter, which is final accounts. In this chapter, you will have final accounts, NPO, and incomplete records. All three will be covered in this particular chapter. Clear? Now, if the entity is into trading business or if it's into manufacturing business. If it's into trading business, what they will do? Trading account will be there, P&L account will be there, balance sheet will be there. Why trading account? To find the gross profit. Why P&L account? To find the net profit. Why balance sheet? To know the financial position. Now what you need to know additionally, if it's manufacturing, then you will have a manufacturing account. There what you do? To find cost of goods manufactured. After the goods are manufactured, then what we have to do with that goods? We have to trade only. We have to sell it. So that goes into trading account, same process, then P&L, then balance sheet. Clear? Now we'll see what are the regular items we find in the trading account. In trading account, obviously, to opening stock, purchases less returns. That means if you have purchase returns, we have to subtract it from purchase and show it net over here. Then direct expenses like wages, power, all those things which are directly required, those things will be added over here. Then sales less returns. That means if there is sales return in your trial balance, you will subtract from sales and you will show it over here. And then finally by abnormal loss. If there is abnormal loss, you will subtract it from trading account. That's why it is credited. Closing stock is credited to trading account. If it is gross profit, debited and it is transferred to P&L. If it's gross loss, credited and it is transferred to P&L. Clear? Basically, this will usually be your balancing figure. And you can't have both. You'll either have this or you'll have this. Now, P&L account. P&L account, the gross loss brought down will come here. Gross profit brought down will come here. Then all the other expenses, all indirect expenses will be there over here. All indirect incomes will be there over here. Okay, net profit, if it is there carried forward, it will be carried forward on account called as P&L appropriation account. And loss also will be carried forward on P&L appropriation account. What is this appropriation account? After doing all the outside things, outside expenses and outside incomes. Now, whatever insider related transactions are there, that is distribution of profit, salary, etc. to insider, that will go to P&L appropriation account. Clear? Now, finally, if you have to look at P&L appropriation account, net profit, net loss, which is brought down to dividend. Dividend is nothing but share of profit. From P&L appropriation, you will distribute the dividend. And if you're transferring to general reserve also, it will go from P&L appropriation. Final profit, whatever is there, it will go to capital account. That means it will get added to the not partner here. It will get added to the sole proprietor's capital. Now, balance sheet, you know, assets and liabilities. There is no specific format for the balance sheet over here. What you can do is non-current assets. Keep it on top. That means your asset, fixed assets, investments, everything you keep it on top. Current assets, that is your stock, cash, debtors, bills receivable, everything keep it below. And in liabilities, try to follow this format. First, you keep the capital on top, then non-current liabilities. Non-current liabilities are loan borrowed and all those things. Current liabilities are trade payable, creditors, bills payable, all those things, you write it below. This should be the format you're going to follow. Now, if you're following manufacturing, if you have to create manufacturing account is not created to calculate any profit. It's only created to calculate the cost of the goods manufactured. Now, first you will start with opening WIP. Opening WIP and closing WIP will be there in the manufacturing account. What is WIP, by the way? The goods which are semi-finished. Now, raw material consumed. Not raw material purchased, raw material consumed. Opening stock of raw material plus purchase of raw material minus closing stock of raw material. You will put the net amount over here. This is the amount of raw material we have used. Now, direct wages. Direct wages will be here. Salary will be sitting in P&L. Direct expenses. Okay, whatever you are spending on the manufacture, everything, all other expenses related to manufacture, everything will be put into manufacturing account. Now, closing WIP is there. Now, sometimes when we manufacture, what happens? We will produce one byproduct. That byproduct will be sold. Byproduct is basically a waste product. That waste product will be sold and that gives us some profit. That profit will be reduced from the cost of the main product. All this is the cost of manufacture. Debit side. You put it on the credit side, it will reduce the cost of the manufacture. Clear? Then whatever balancing figure is there, this is your cost of manufacture, which will be transferred to the trading account. It will be transferred to what?
trading account. Is this clear? Now this is the situation. Now there can be confusion that can arise. It can come in MCQs also. The confusion that can arise between, sir, should we put it into manufacturing account or should we put it into trading account? Now, if I have depreciation, it usually goes into not even trading account, it goes into P&L account. Now, if it is on office building, P&L. But if it's on factory building, manufacturing account. If it is on warehouse, also it will go to manufacturing account. What is warehouse? The storage area. Now, depreciation on assets used for manufacturing. Depreciation on machinery. Machinery is used for manufacturing. It will go to manufacturing account. Depreciation on other assets. It will go straight into P&L account. It will go straight into P&L account. Clear? Salary. Salary will go where? P&L account. Now, salary of a supervisor will go where? Manufacturing account. Imagine supervisor is looking after the manufacturer only. So, it will go to manufacturing account. Raw material. Sorry, not raw material. Repairs and maintenance. If it repair and maintenance is of factory building or plant and machinery, manufacturing account. If it is of any other asset, it will go to P&L. This is what you need to know about final accounts. This is the brief introduction of final accounts concepts. Clear? Next, we will go into the concepts of NPO, non-profit organization. Clear? Now, what is non-profit organization? It's an organization which is not running because for the purpose of profit. Just now we saw final accounts of sole proprietor. What was the reason of preparing final accounts? To find the profit only, to find the gross profit, to find the net profit. Now, NPO, why we are doing it? To provide service. NPO usually it is for providing service. Here we have receipt and payment account, income and expenditure account, and we have balance sheet. Now, very, very important thing you have to understand. Receipt and payment account, whenever you're preparing, just remember, this is just like cash book. You're actually preparing cash book. Money comes in, receipts. Money goes out, payments. You're recording only receipts and payments. Income and expenditure account. Income and expenditure account is just like P&L. Just like P&L, but we can't use the word P&L because it is non-profit organization. After telling non-profit organization, we can't tell profit and loss account. So, profit, loss words are not going to be used. What is going to be used is surplus and deficit. Next, balance sheet. Balance sheet is a position statement. But there you cannot write capital. Capital means amount invested into the business. We are not investing anything into the business for the purpose of earning profit. So you will call it as capital fund. What will you call it as? Capital fund. Is it clear? So instead of profit loss, you will call it surplus deficit. Instead of capital, you will call it as capital fund. Next. We have receipt and payment account, cash system, and income and expenditure account, accrual system. Okay, now you have to understand the difference. I told you receipt and payment account is like a cash book. So obviously we cannot use accrual concept over there. And income and expenditure account is like a P&L. So we follow accrual concept over there. Now you have to understand one thing. In receipt and payment account, all receipts are included. All receipts and all payments, whether it is capital or revenue. That means if I purchase stock and pay money, that will also be there in receipt and payment account. If I purchase machinery and pay money, that will also be there in receipt and payment account. Clear? Now, income and expenditure account, all receipts and payments won't be there. Only revenue transactions will be there. That is why we had that topic, no, capital and revenue expenditure. Capital will go to balance sheet, revenue will go to income and expenditure account, which is also called as P&L. Now, any receipt or payment related to any year. Doesn't matter. 10 years ago, salary you paid today, it will still be there in your receipt and payment account. Okay, 10 years ago salary if you paid today, it will not be there in your income and expenditure account, because income and expenditure account, you are going to record transactions only related to current year. Clear? Only related to current year. Is this clear? Depreciation will not be there because it is a non-cash transaction. Here depreciation will be there because there is a P&L. Here we don't care about non-cash and all, whatever transactions, expense will be recorded. Now next, receipts and payment account given in question. If they give receipt and payment account in the question, simple. It's a very, very important part. Understand? If receipt and payment account is given in the question, then you will have to prepare what? Income and expenditure account. Now receipt and payment account is given, you have to prepare income and expenditure account. Now understand this. In receipt and payment account, you will have what is the expense paid. Payment side, you will find what is the expense paid. Now, if expense is paid, understand this. Last year's outstanding. Okay. We are preparing what? Income and expenditure account. If you are preparing income and expenditure account, we want to know only this year's. So, last year's outstanding what will you do with last year's outstanding? Minus. Why? It is last year's expense. This year's outstanding did not pay, but it is this year's expense. Plus. Last year prepaid. Last year already paid, but last year it was prepaid. That means it was related to which year? It was related to this year. Last year prepaid. That means it was related to this year. So it will be added. This year prepaid means what? It is related to next year. That is why it is going to be subtracted. Is it clear? So this is the expense for the current year. Now, imagine we are talking about income. Same thing. Income, if you are starting with receipt and payment account and you have to prepare income and expenditure account, then income received in the year will be there. In this income received, if it is last year's receivable, okay, is last year's income. It might have been received this year, but still it is last year's income minus. This year's receivable did not receive. We are going to receive only in the next year. Plus income received in advance last year. Last year, if it is received in advance, it is related to which year? This year. Plus income received in advance this year. That means related to which year? Next year. Minus. That time you will get the income for the current year. You will get the income for the current year. Is it clear? Now, if income and expenditure account is given in question, okay, now you are going to prepare what? Receipt and payment account. So you should always know what you are going to prepare. Receipt and payment account, income and expenditure account. If you are preparing receipt and payment account, understand this. Expense for the current year is given in income and expenditure account. Now, you have to care about only what is received or paid in this year. You are preparing what? Receipt and payment account. Our focus is, did we get the money? Did we pay the money? Yes. Expense, outstanding expense of previous year. Outstanding of previous year. That means it is paid in which year? This year. Add. Outstanding of current year. That means it will be paid which year? Next year. Minus. Prepaid of previous year. Prepaid of previous year is this year's expense, but already paid in the previous year. Minus. Prepaid of current year. It is paid this year, but it is related to next year. Doesn't matter. You paid, right? Add. So when you are going to receipt and payment account, you have to think only whether it is paid or received. When you are going to income and expenditure account, you have to think whether it is this year's expense or not. That's all. Now, income for the current year is given. Income receivable of previous year. That means it will be received in the current year. Add. Income receivable of current year. That means it will be received in the next year. Minus. Income received in advance previous year. Previous year already it is received in advance. So this year it is not going to be received. Minus. Income received in advance this year. That means it is related to next year, but received this year. Add. Is it clear? This is what you need to know. You can also do it with ledgers. Okay. You can also do it with ledgers. Okay. I would prefer you to do directly only with the format. If you want the ledger, this is there. You can have a look at the ledger. Whichever is comfortable, you can take it. Clear? Now, donation received. There are some specific items which you have to be a little careful. Donation received. Okay. Understand this. If it's a general donation means you can use it for anything. Then income and expenditure account will be shown as income. Donations received. If it is a specific donation means what? They have given money just for the purpose of constructing building. So you have to construct building now. Then it will be shown in the balance sheet as liability. It's a specific donation. Now, entrance fees. Entrance fees is usually in the balance sheet. It is going to be added to capital fund. But unless they mention differently in the question, sometimes in the question they will tell you 30% of the entrance fees is not capitalized. That means it will go to income and expenditure account as income. If it is capitalized, it will go to balance sheet and will get added to capital fund. Renewal fees. Renewal fees means every year they have to pay. So income and expenditure account, income. Honorarium. Somebody came and provided some service. So to honor their service, you are giving them some money. That will go to income and expenditure account as expense. Legacy. Legacy means when some person died, that person has written the entire will. Okay, entire property in the will he has written in the name of our non-profit organization. It will be added to capital fund. Endowment fund. Endowment fund means amount will be received as donation only, but it can't be utilized. It can't be utilized. Okay, return from the amount invested can be utilized. Clear? Now what are they telling? Amount will be given to you, but you can't utilize that amount. So keep that amount separately in the balance sheet as a liability. You do one thing, you go and invest that amount. invest that amount, and then whatever return comes from that you can recognize it, okay, utilize it. So that will be taken as income, okay, when it comes. Now material consumed, you will get this point, material consumed. There will be like sports material, that, this and all they'll give you. Okay, you don't have to worry about the material purchased. You have to worry about material consumed. How will you get the material consumed? Opening stock plus purchases minus closing stock. That will give you the material consumed. Now, if material is consumed, that will be shown as expense in the income and expenditure account. Okay, now material consumed will be shown as expense in income and expenditure account. Material purchased is equal to material consumed if there is no closing stock or opening stock. Imagine I purchased 10 boxes of chocolate and there is no closing stock of chocolate. That means all the 10 boxes are consumed. Are you getting it? So material purchase will be equal to material consumed if you don't have any closing stock or opening stock in the question. If you have opening stock and closing stock, then material consumed will be opening stock plus purchases minus closing stock. Clear? Now club. Imagine we have a club. In case of a club, you will have a restaurant also. You will have other services also. Now, other services are provided that will go straight into income and expenditure account. Now, just for the restaurant, you will prepare trading account because restaurant is actually involved in trading activity now. You will prepare trading account and profit or loss from trading account will be directly transferred to income and expenditure account. Not to P&L, but it will go to income and expenditure account. Clear? Yes, that's it. Now we go into our next unit. Okay, that is accounting from incomplete records. Very, very commonly they are asking this question. Okay, last 3 items they are asking incomplete records only. See, logic is simple. Think from institute angle. If they ask you final accounts, you will have to prepare trading P&L balance sheet. Correct? But trial balance is given by them. If they ask you incomplete records, here also you have to do trading P&L balance sheet, but with little more working. So there, complete records means what? Trial balance is there. You just take and prepare final accounts. Incomplete records means what? Trial balance is also not there. From that position, you have to prepare final accounts. Okay, so obviously, if at all you are thinking from an institute angle, if they give you incomplete records only, they'll be testing you more, no? Because final accounts, whatever is there, it's there in incomplete records. Clear? Now, imagine there is a person called as Pawan with an amazing hairstyle. Okay, now he is manufacturing hair oil. Now, cash is in his pocket. He doesn't have anything. He only knows how to manufacture hair oil. Amazing hair oil he'll manufacture, but he doesn't know anything about books of accounts. So he has not maintained anything. Now, end of the year, bank comes and asks him, boss, you want loan? Pawan says, yes, I want loan. I want to expand my business. So bank tells, give me financial statement. Give me your trading, a P&L account and balance sheet. Pawan has no idea about all that. Now he has to, from zero, without having any information, he has to prepare. Correct? That time, cash is then in his pocket, right? That is his cash balance at the end of the year. Bank, you can go to bank and ask, please, can you give me statement? From the statement, you will get to know all your expenses, incomes and everything. Okay, that time you will get the bank balance at the end of the year. Now, who has to pay him? He knows, right? Who and all has to pay him money? He'll go to him and ask, can you give your ledger? Okay, can you give my ledger in your books? They'll give the ledger. Oh, okay, this much you have to pay me. Done, debtors. Whom he has to pay, that also he knows. He'll go and ask them, how much I have to pay you? Give me your books of accounts. My ledger in your books, creditors. So this is how, when things are actually incomplete, how you can get the information. Clear? Now, capital computation. This might be a little tricky. How to compute the capital? Opening capital, you know. Opening capital. How can capital increase? If there is additional capital. You put more money, capital will increase. Minus drawings. Okay, drawings will reduce the capital. Add the net profit, that will increase the capital. If there is net loss, that will decrease the capital. And that time you should actually get the closing capital. If at all you are not getting, that means some of the number can be missing over here. They can give one number missing and give all the other information. You have to find what is drawings. Or they can give you one number missing, additional capital, and they give all the other information. You have to find the additional capital. This is what they can do for capital computation. Okay, this is to find the credit sales. Now, debtors we are going to prepare to find what? Credit sales. Now, debtors account is very, very common. Debtors account, creditors account are the most two common working notes which are required for incomplete records. Now, debtors account. Debtor is what? Asset or liability? Asset. Debtor is asset. So, what balance the debtor should have? Debit balance.
Debtor is having debit balance. Okay, so therefore you are writing here 2 balance brought down. Then debtor is having credit balance at the end. No, it's just balance carried down. Debtor will not have any credit balance. It's just balance carried down. Clear? Now tell me one thing. If there is a sale, cash sale, what should be the entry? Cash sale, what should be the entry? Is there any entry for cash sale? Yes, cash account debited to sale account. But that will not impact your debtors ledger. What will impact your debtors ledger? Credit sales. That time you will pass the entry debtors account debited to sales account. Clear? Now, after that, if at all goods are returned by the debtor, goods are returned by the debtor, sales return account debited to debtors. If you give discount to the debtor, discount allowed account debited to debtors. If there is bad debt account debited to debtors. If debtor gives you money, cash or bank account debited to debtors. If bill is drawn on debtor, you saw in bills of exchange, bills receivable account debited to debtor. If bill is dishonored, then it has to reverse debtor account debited to bills receivable account. Clear? It can also be debtor account debited to bills receivable, or it can be bank if the bill was discounted, or it can be creditor if the bill was endorsed. Clear? These are the situations that you're going to see in debtors ledger. Now debtors ledger is mainly prepared to find the sales, credit sales. Now total sales is cash sale plus credit sale. When you get the credit sale from the debtors ledger, you will get the total sales if you have information about the cash sales. Clear? Next we have an account called as bills receivable account. Bills receivable account, no, it can directly impact your debtors ledger. So without preparing bills, without closing the bills receivable account, don't go to close the debtors ledger. Now bills receivable account, to balance brought down, opening balance, and by balance carried down, closing balance, because bills receivable is also asset. Now if new bill is drawn, the entry is what? Bills receivable account debited to debtors. Bills receivable account debited to debtors. Now if bill is paid, they made the payment on the date, bank account debited to bills receivable. But if bill is discounted also, you will get bank account debited to bills receivable. But if bill is discounted, you pass the entry bank account debited, discounting charges debited to bills receivable. So discounting charges also is there over here. If bill is endorsed, you are giving the bill to creditor, creditor's account debited to bills receivable. If bill is honored, that means they gave you the money, bank account debited to bills receivable. If bill is dishonored, that means debtor account debited to bills receivable, you will get the closing balance. Literally, this is the structure of your bills receivable account. Anything can go missing in this. When you are preparing income related accounts, anything can go missing. You have to find the missing figure. That is the challenge. Next, creditors account. Why are we preparing creditors account? To find the credit purchase. Creditors are liability. So liabilities will have credit balance to start with. Liabilities will have what balance? Credit balance. Then you will write by balance brought down, and here you are writing by balance carried down. Clear? Now creditors ledger, understand this. If I make credit purchase, what is the entry? Purchase account debited to creditors account. If there are some new, what do you say, if at all I am accepting the bill, let's go in order. Okay, purchase return. If there is purchase return, what happens? Creditor account debited to purchase return account. Creditor account debited to purchase return account. Now if I get a discount from creditor, good for me. Creditor account debited to discount received. And if at all there is a situation of deficiency, what is deficiency? I did not pay the creditor. Bad debt is when I don't get the money. Deficiency is when I don't pay the money. Creditor account debited to deficiency. We saw this in bills of exchange. Now if I pay the amount to creditor, creditor account debited to bank account. Creditor account debited to bank account. If bills are endorsed, we saw over here, right, in debtors ledger. See over here. If bills are endorsed, sorry, not debtors, bills receivable. Can you see bills are endorsed? I wrote over here. Creditor account debited to bills receivable here by creditors. So here what you will write? Creditor account debited to bills receivable. That means creditor reduced and bill also reduced. I gave the bill to creditor, so creditor will not ask me money. So creditor also reduced, bills receivable also reduced. Now if new bills are accepted, that means I am telling, okay, I'll pay you money, but I'll give in the form of bill. So creditor account debited to bills payable. A new liability is born. But this bill, if I don't pay on the time, then this bill will get dishonored. So now what will happen? Bills payable account debited to creditor. Is this clear? Balance carried down, done, finished. Now your bills payable account. Always the debtor account and bills receivable account are linked.
So you have to be very careful. And creditor account and bills payable account are linked. When you're closing the ledgers in incomplete records, first you close the debtors account, first you close the bills receivable account, then you close the debtors account, close the bills payable account, then you close the creditors account. Clear? Next, in bills payable account, what we have? Bills payable is a liability. So liabilities has opening balance. Okay, by balance brought down. And here you are going to write by balance, to balance carried down. Now, if new bills are accepted, what should be the entry? Creditor account debited to bills payable account. If new bills are accepted. If bills are honored, what will you do? If bills are honored, bills are gone. So bills payable account debited to bank. You're making payment. If it is dishonored, bills payable account debited to creditor. So bill is gone, creditor is reborn. So this will be your balance carried down. Now total purchases, again same thing, cash purchase with credit purchase. If you total, that time you'll get your total purchases. Now additional ledgers that you might have to prepare other than this is cash account and bank account. Cash account, bank account, you have to know how to prepare. Okay. Main goal is to prepare trading account and P&L account and balance sheet. Now balance sheet is not called as balance sheet. Most of the times it's called as statement of affairs. So now statement of affairs, you will have to prepare the opening statement of affairs, because you have to prepare opening statement of affairs to find the opening capital. These are the concepts of these three units, that is final accounts, NPO and incomplete records. Clear? Now you have to look at all the questions as usual. First we start with June 2025. Starting with June 2025. We have solved few questions, right? Yes. First we go into question number 4. Only 14 marks. Question number 4, it is asked for 14 marks. The following information relates to the business of ABC Enterprises. Prepare a trading and P&L account for the year ended and a balance sheet on that date. Assets and liabilities are given. And cash transactions are given. Additional information is also given. Now this much information is there. Now in this you have to go in the order. Okay, you should always go in the order. Now first thing what we have to do is usually, now tell me one thing, furniture account is there, but usually debtors, you have to prepare debtors ledger, you have to prepare creditors ledger, and you have to prepare cash and bank ledger. These three working notes are mandatory. You have to prepare, there is no other option. Now, first thing, they asked you to prepare what? Question number 4. Where is it? Trading P&L and balance sheet. Now see, can you see? Capital on 1/4/2024. First thing is opening balance sheet. Second thing is creditors account. Okay, then you will also, okay, they could have quietly prepared debtors account. Okay, debtors account, they have to prepare this. Irrelevant. In trading account only you will get to know. I don't know why they have prepared that. Now, debtors account, and then you can see cash and bank account. So many things are there. Amount of expense debited to P&L, sundry expense. All these ledgers I will explain to you. Bills receivable. Bills receivable is also there. So many ledgers. Okay, now first we'll focus on opening balance sheet. Now how you should prepare is, you should read the question once. And you should complete the entire solution. You can't read the question again and again thinking that first I'll read the question to prepare working note, then I'll read the question to prepare trading account, then I'll read the question to prepare P&L account. You cannot do it. You have to read the question only once and you have to complete the entire question. Now I'll tell you how to do that. First we start with furniture opening balance. Furniture opening balance will go to opening balance sheet as furniture. It will go to opening balance sheet. And then where will it go? Nowhere. You are not preparing furniture account. Then furniture closing balance. It will go where? To closing balance sheet. Can you see furniture? 63,500. Directly it is there. Okay. Closing balance. Now next. Stock opening balance. Where will stock opening balance go? It will go to opening balance sheet. It will go to opening balance sheet as stock. They have written closing inventory because last year it was closing inventory for last year. 80,000. And then stock closing balance will go to what? The closing balance sheet. Can you see 70,000? And both of this opening stock and closing stock will also go into your trading account. Can you see trading account 80,000? And closing stock here also you have put. It will go to opening balance sheet, closing balance sheet, and it will also go to trading account. Next, Sundry debtors, we have only opening balance. Closing balance is not given, that we have to find out. So sundry debtors opening balance will go to opening balance sheet 1,60,000 and you will go and put it to debtors account 1,60,000. You will put it in debtors account, to balance brought down. Clear? Sundry creditors sundry debtors closing balance is not found. We will have to find it when we prepare all our things. Clear? Sundry creditors opening balance will first go to opening balance sheet. Can you see the opening balance sheet 1,10,000? And then you will go and write sundry creditors in the sundry creditors ledger by balance brought down. Clear? Next, sundry creditors closing balance, you will go and write it in the closing balance sheet. Can you see 1,50,000 in the closing balance sheet? Yes. And you will go to sundry creditors account and write to balance carried down. To balance carried down. Is it clear? Next, prepaid expense will be there in the opening balance sheet as well as it will be there in the closing balance sheet. Now prepaid expense in the opening balance sheet is 6,000 and in the closing balance sheet you can see prepaid expenses 7,000. Can you see these numbers? Yes. Now tell me one thing, prepaid expense will also bother you in one more place. Where is that? When you are calculating your expense. When you are calculating your expense in P&L, prepaid expense has to be added and subtracted. That we have to discuss. Outstanding expense will be there in the opening balance sheet. It's a liability. See in the opening balance sheet, you can see 20,000 as outstanding expense. And you'll see the closing balance sheet also outstanding expense of 18,000. You can see 18,000 over here. And this outstanding also will be important when we are calculating our expenses. Just now we studied in NPO, right? What happens to last year's outstanding, this year's outstanding, last year's prepaid, this year's prepaid. That impact we have to give. Cash in hand and bank balance. Cash in hand 12,000. It will go to opening balance sheet 12,000 and it will also go to cash account opening balance. Cash account opening balance because you're preparing. This is the start you're supposed to give before you even go to the transactions. Now, cash account closing balance 26,250. You can see 26,250 in the closing balance sheet and you also have to put it in the cash account closing balance. So what did we do just now? Whatever the table was given ready information, we prepared opening balance sheet, we kept the closing balance sheet also ready, we kept the trading P&L. So you are supposed to do like this: trading and P&L account open, balance sheet open, you're going to prepare debtors account, creditors account and cash and bank account and any other working notes. All those you are going to keep it ready. Now one by one, you found the numbers over here, you transferred it. All these numbers will go to opening balance sheet, all these numbers will go to closing balance sheet. Plus, this will go to the debtors account also, this will go to creditors account and this will go to cash and bank account because you're preparing those ledgers. Clear? Now, cash transactions during the year, one by one. Collection from debtors after allowing discount of 15,000 amounted to 5,85,000. First we will write 5,85,000. What should be the entry? 5,85,000 we have collected from debtors. What should be the entry? Entry should be cash account or bank account debited to debtors account. Correct? Now go and check. This is your cash account. Where is it? Cash account debited 5,85,000 to debtors. Where is my debtors? Debtors 5,85,000. Is this clear? This is how, because it is incomplete, every single transaction what is given, you have to do the accounting. Then only it will get completed. Now here they said after allowing discount of 15,000. There is a discount of 15,000. What is the entry for discount? Discount allowed account debited. Discount allowed account debited to debtors. Now go to your debtors account. Can you see discount allowed? Now discount allowed, do you agree that it is an expense? So straight you have to go to P&L and put this discount allowed. You should go to P&L and you should put, see, to discount allowed from debtors 15,000. Can you see it in the P&L? You have to do it simultaneously, otherwise you will not finish it. If you finish also, you will take a lot of time that you will you could have spent on other questions. Discount allowed account debited to debtors. Debtors you have to credit and discount allowed is an expense. So you have to put it in the P&L. Next, collection from discounting. One second. Collection on discounting bills of exchange after deducting of discount of 1250 by bank total to 61,250. Collection on discounting of bills of exchange. Now understand this. We discounted a bill. When we discounted a bill, what we got? 61,250. Okay, after the discount deducted one discount 1,250. We have learned earlier that what is the entry for discounting of bill? Bank account debited, discounting charges debited, to bills receivable. Now bank account debited, how much money you got? 61,250. So you can see in your bank account, you will find 61,250. Bank account debited 61,250. Discounting charges debited. Okay, 1,000, whatever the number was, 1,250. It will go to what? Bills receivable account. They have prepared one bills receivable account. Can you see over here? By bank 61,250 and by discount 1,250. Now this 1,250 is an expense. Expense will go to what? It will go to P&L. Can you go to your P&L and find this 1,250? Yes. Whatever discount is there, it should go to P&L. Clear? So when you pass the entry, and if it is expense or income, it should go to P&L or trading. Next, creditors of 4 lakhs were paid 3,92,000 in full settlement. Creditors were paid 3,92,000 in full settlement. What should be the entry here? Bank account debited or cash account debited. Sorry, creditors account debited to cash or bank account 392. So you can see over here, creditors account debited 392 to bank account 392. To bank account 392. But actually the creditor was supposed to be paid how much? 4 lakh. How much you are paying? 392. That means how much is the discount? 8,000 is the discount. What is the entry for discount received? Creditors account debited to discount received. Creditors account debited to discount received. 8,000. Creditors account debited to discount received. Now this 8,000, what will happen? 8,000 will straight away go into your P&L as discount received, which is income. Clear? Next. Freight inward. Freight inward is carriage inward. It goes into trading account. But first you have to pass an entry for that to go to trading account. Freight inward entry will be freight inward account debited to bank account. Freight inward account debited to bank account. Can you see over freight inward 30,000 in your bank account? And freight inward is an expense. Expense should go to trading or P&L. Will it go to trading or P&L? Yes, it will go to trading account. Can you see in trading account freight inward 30,000? Next, after this you have drawings 70,000. What is the entry for drawings? Drawings account debited to bank account. Drawings account debited to bank account. You can find this 70,000 in your bank account. Can you see by drawings 70,000. Some other adjustment is there later. We'll see that 70,000, and this 70,000 has to be subtracted from whom? Capital. It has to be subtracted from the capital. You can see over here drawings in this 91,000. 70,000 is also there. One more drawings will come later. Clear? Next, payment for office furniture. Entry should be office furniture account debited to bank account. Office furniture account debited to bank account. Now, if you go to bank account, you will find over here in your office, bank account, see, buy furniture account 10,000. That means this will not go to P&L. This will get added to the furniture in the balance sheet. So now, let me go and check. What was your furniture here? 60,000. So 60,000 plus 10,000 just now I purchased. So right now my furniture is sitting at 70,000. Let's see how it became 63,500 later. Now after that, next, payment for office furniture done. Investment carrying annual interest of 6% were purchased at 95. 200 shares face value of 100 on 1st October 2024 and payment was made. Okay, 200 shares they have purchased at the rate of 95. 200 shares they have purchased at the rate of 95. So 200 into 95 is 98,000 of 19,000 of investment they have purchased. Now investment purchase 19,000. What should be the entry for investment purchase 19,000? Investment account debited to bank account. Investment account debited to bank account. Go to bank account. You can check it out over there. Can you see in your bank account? Yeah. Here, buy investment account 19,000. And why did they tell you when it is purchased? They told you that it is purchased on 1st October 2024 so that you can calculate the interest. Now check out the interest. 200 shares into 100. Interest will always be calculated on face value into 100 into whatever 20,000 you're getting into 6% into 6% into wait into what months. First of all, are they following calendar year or financial year? They are following financial year. So into 6 divided by 12. How much are you getting? Yes, what's the answer? 600. Huh? 600 is the interest. Now, did they pay you that interest? Did you receive that interest? No, you haven't received that interest, but still it has to be recorded because we follow accrual concept. So this interest will be shown as interest outstanding in the balance sheet, and you can see in your P&L also this interest has to be recorded. Can you see in your P&L? Interest on investment 600. Boom. And then in the balance sheet you will show interest accrued 600. Done. Yes. Then after that, let's go further. Expenses including salary paid. Expenses including salary paid. Now expense you have to be really careful. What is your expense? 95,000. Your expense paid is 95,000. Now go and check. Now go and check in your question. Where is it? Yeah. See over here, I told you to keep certain things pending. Prepaid expense. Last year's prepaid 6,000. This year's prepaid 7,000. Last year prepaid means which year's expense it is? This year's expense. So what you will do? Add the 6,000. This year prepaid means which year's expense it is? Next year's expense. So what you will do? Minus the 7,000. Clear? Then outstanding expense. Outstanding last year means which year's expense it is? Last year's expense. So minus the 20,000. And outstanding of this year. Outstanding this year means which year's expense it is? This year's expense. So plus 18,000. 92,000 should be shown as expense. Let's go and check your P&L. Very, very important adjustment. This is to sundry expense 92,000. Can you see 92,000? Yes, the most important adjustment. If you have missed that, gone. Balance sheet will 100% not tally. 92,000. And already outstanding prepaid, everything we have put in the balance sheet. So no, nothing to worry about that. So that is done. Miscellaneous receipts. And expense paid, we have to pass the entry. Expense paid entry is expense account debited to bank account. Now when we go to our bank account, can we see expenses over here 95,000? Yes. Then next, okay, miscellaneous receipts. Entry for miscellaneous receipts is bank account debited to miscellaneous receipts. So we'll go into bank account. Can you see bank account debited to miscellaneous receipt? And this miscellaneous receipt should go to what? Our P&L. Let's go to our P&L and check whether we have this miscellaneous receipts. Yes, miscellaneous receipts in the P&L is 5,000. Clear? Yes. Next, additional information. Bill drawn 1 lakh. Bill drawn 1 lakh. Of this we'll see later. First let's draw the bill. For bill drawing, the entry is bills receivable account debited to debtors. Bills receivable account debited to debtors. Bills receivable, you have prepared the ledger here. Can you see bills receivable account debited to debtors 1 lakh? And this 1 lakh has to go to debtors. And in your debtors ledger, can you see by bills receivable 1 lakh? Every single entry when you do it, that time only it gets completed, and that time only you will be able to get the balance sheet at the end. Clear? Of these, 20,000 are endorsed to creditors. 20,000 endorsed to creditors. If it is endorsed to creditors, the entry is creditor account debited to bills receivable. Creditor account debited to bills receivable. Go to creditor account. Can you see over here to bills receivable? And go to bills receivable account. And can you see over here by creditor? This is what you are supposed to do. Clear? Next. After that you have 4,000 was dishonored. I gave to creditor, it got dishonored. So what should be the entry? Creditor should be back and debtor also should be back. So now the entry will be debtor account debited to creditor account. If it is dishonored, debtor account debited to creditor account. Go to debtors account, debited 4,000 to creditors account 4,000. Next, goods worth rupees 9,000 used as advertising material. Goods used as advertising material. The entry is advertisement account debited to purchases. Advertisement account debited to purchases. Nothing will affect our cash bank, nothing. So straight away you should go and check your P&L. There should be 9,000 of advertisement expense, and that 9,000 should be subtracted from your purchase. Can you see it is subtracted from your purchase over here? Yes. Next, after that, gross profit is always 20% on sales. Now, we didn't get the sales yet, so let's keep this point pending. This point will keep it pending. Okay. Now, cash book difference treated as drawings. If there is any difference in cash book, if cash is more, that means it is taken as additional capital introduced. If cash is less, that means it is taken as drawings. Provide 2% for doubtful debts on closing debtors. On closing debtors, we have to provide 2% on doubtful debts. Now, closing debtor only, I don't know. If you look at the question, I don't even know the closing debtor. Closing debtor, they put a question mark. When I complete that only, I'll get to know the debtor. So now, right now, I don't know closing debtor. Let's keep that pending. Now, can you see in your balance sheet, opening balance sheet that you prepared? Why did you prepare opening balance sheet? To find the opening capital. Capital is how much? 1,88,000. That is a balancing figure. Straight away, you'll take it to closing balance sheet. That will be your starting point. That 1,88,000 will be a starting point of your closing balance sheet. Then after that, you closed your opening balance sheet. See the creditors account. Creditors, everything we have discussed. Only one balancing figure is there. That is your purchases. 4,56,000 is your purchases. So what will you do now? 4,56,000 purchases. Straight away, you will take this purchase to the trading account. Any information about cash purchase was not there. Straight away, you will put 4,56,000 purchase into your trading account. Subtract that advertisement, you will get the net purchases. Clear? With that, creditors also closed. We didn't have bills payable. Now, debtors account. This working note is not required. Directly in trading account, you can do this. Okay, ignore that. Debtors account. Everything we have marked in the debtors account. We need to find the sales. If I find the sale, then only I'll get the closing balance. I don't have closing balance also. I don't have sale also. If I had closing balance, what I would do? I would take the closing balance. Balancing figure will be sale. If I had sale, what I would do? Sale is there. Balancing figure will be closing balance. Both are not there. So we need to find some other methodology to do it. Okay. Now, cash and bank account. Everything is there in cash and bank account. They said, right, difference in cash and bank account will be treated as what? Additional capital, or it will be treated as drawings. Now, here if you see, when you calculate, debit side is less. Okay. Debit side is less. Debit side is more. Credit side is less. Where did the money go? Money can go into only one place, that is drawings. Can you see they took this as balancing figure, drawings. Closing balance is already given for cash and bank. We don't have to worry about that. Okay, this 21,000 is the balancing figure over here, which they found as drawings. If at all credit side was more, debit side was less, you would have taken it as additional capital if it was there, but it's not there. So you're taking it as drawings. Okay, other side. Now this drawings 70 and 21, this drawings only becomes 91,000, and you can see in your closing balance sheet 91,000. There is 91,000 in the closing balance sheet. Clear? Now, after that, next, okay, we closed everything. Creditor is already closed. Debtor is already closed. Debtor is not closed. Bills receivable is there. Now, this expense ledger, without doing that only, you got the 92,000 which you were looking for. So you don't bother about that. Bills receivable. Everything is done with bills receivable. You have to just find the closing balance, and this will be your balancing figure, 17,500. What will you do with this bills receivable? Straight away take this bills receivable and put it into the closing balance sheet, 17,500. 17,500. Now, what you have to do is, you have to find your sale. If you find the sale, then you can put that sale into your debtors ledger. And if I put the debtors ledger, I will get the closing balance. If I get the closing balance, I can find the provision for doubtful debts. Now, go straight into your trading account. Everything you know. Correct? Everything you know. Now, what you don't know? Gross profit. What did they tell about gross profit? They told that gross profit will be 20% on sales. So you have, in costing also you have studied, in other places also you have studied, you have one formula, opening stock plus purchases plus direct expenses minus closing stock will give you cost of goods sold. Cost of goods sold. Now, you know opening stock, which is there over here, 80,000. Take 80,000 in your calculator. Plus, you know the purchases, 4,47,000. Plus, you know the direct expenses, 30,000. Minus closing stock, minus 70,000. 4,87,000 is your cost of goods sold. 4,87,000 is your cost of goods sold. Now 4,87,000 is the cost of goods sold. What is the gross profit percentage? 20% on sales. That means 25% on cost. So 4,87,000 into 25% will give you 1,21,750. This is your gross profit. If you find this gross profit over here, automatically your sales will be your balancing figure. You got your sales. This was your balancing figure. When you get the balancing figure of sales, that is 6,08,750, straight away go and put that sales into your debtors ledger. When you put that sales into your debtors ledger, what is the entry for credit sales? Debtors account debited to sales. When you enter it into the debtors ledger, automatically you will get the balancing figure over here. This is the balancing figure of sundry debtors. If you get the balancing figure of sundry debtors, then only you will be able to calculate this 2% provision. 2% provision on doubtful debts. So into 2%, 750 into 2%, you will get 1455. You will get 1455. 1455 will be your provision for doubtful debts. First, you put this closing balance into the balance sheet and you put this into the our P&L account. If you go to P&L account and check 1455, can you see provision for doubtful debts 1455? Provision for doubtful debts is 1455. Clear? And in debtors, in the balance sheet, what you will show? Show the debtor minus provision, net amount will be on the outer column. Now everything is done, but remember I kept something pending at the starting of the question. At the starting of the question, can you see this furniture here? 60,000 was the furniture, 10,000 was purchased. It should become 70,000. How did that furniture become 63,500? That means it is because of depreciation. If it is sale, they'll give you information. It is about depreciation. 70, if it becomes 63,500, that means 6,500 is the depreciation. So depreciation entry is depreciation account debited to furniture. So you should find that depreciation in your P&L. Furniture closing balance, we already know 63,500. We only wanted to know what is the depreciation. Anything can go missing in the furniture. It can even be purchase. Some other question, they might give you the depreciation itself and missing figure will be purchase. Is it clear? So with that, we are done with everything. After that, it's just cakewalk. What you will do, you have the gross profit. Gross profit will come to P&L account. Then everything else, whatever is marked in red, that means we have discussed all those items. Now you will get the net profit. Net profit will straight away go to balance sheet and will get added to capital. That time you will get the closing capital. And this should lead to your total capital. Balance sheet. Done. Finished. This is what you're supposed to do. This was your June 2025 question for 14 marks only. Done. Let's go into December 2024 question. Once again, we'll just check June once again. There's no more questions? One second, we'll check June. End, do we have anything? NPO, there is, what no?
June 25.
Yeah.
Subscription measure. Income and expenditure account for the
There is one 5-mark question over here, NPO. From the following particulars, compute how subscription item will appear in the income and expenditure account. 5 marks, they are asking this. 5 marks. Okay, it's absolutely nothing. You have to do plus minus, you'll get the answer. See, they are asking what? Income and expenditure account. In income and expenditure account, I am not bothered about whether we received or not. I am only bothered about whether it is related to this year or not. So now, subscription received during the year for 4,000. Received is 4,000. Okay. Subscription outstanding 31st of March 2025. That means this year outstanding. This year outstanding means not received, but still it is this year's income. Add. Clear? Subscription outstanding 1/4/2024. Last year outstanding. That means last year's income, but it is received this year minus. We are only wanting to know what is this year's income. Subscription received in advance 31st of March 2024. Last year already received in advance. But if last year it is received in advance, that means it is related to which year? It is related to this year plus subscription received in advance on 31st of March 2025. This year received in advance, but it's related to which year? It is related to next year minus 4,000 plus 180 minus 400 plus 100 minus 80. You should get 3,800 as the answer. Can you see 3,800 here? 3,800 will be transferred to income and expenditure account. Absolute 5 marks gift by CMA Institute. Yes, 3,800. Done. That's why I checked, because I thought there was one more question. Okay, done. That was it. That's it with June. Now we'll go into December. What have they asked in December? They asked a 14-mark question from again incomplete records. Question number 4. Yeah. Rahul does not maintain a proper books of account. However, he maintains a record of his bank transactions and is also to give the following information, for which you are requested to prepare final accounts for the year ended 31st March 2022. Only this much information is there. Now, debtors, opening balance, credit, all this information is there, and details of bank transaction is there. No cash transaction took place during the year. Goods are sold at cost plus 25%. Cost of goods sold was 2,60,000. That's it. And look at the suggested answer. Only trading and P&L account and balance sheet they've given. That's all. No working note, nothing, whatever. So we'll have to do all those working notes. They have not shown any calculation. Only trading P&L balance sheet they've given. Okay, I'm doing the working for this. Otherwise, we'll not be able to understand only from where the numbers came. This is basically June, right? What? Yes, December. December 2024. Question number 4. December 2024. Question number 4. Okay, only the workings I'm showing. Clear? Now, you can see debtors account here. So, 100% I can tell you that I need to prepare one opening balance sheet. Without opening balance sheet, I can't prepare. So this is your statement of affairs as on 31st of March 2023. And also I require one more thing, that is debtors account. Okay, and I can see in the question that there are creditors also. So I need creditors account. And I can see that there is bank. So I need bank account. None of the working notes are given. So we'll have to prepare it. Bank account. Clear? This is how it's going to work. Whatever impacts trading P&L, immediately we look and mark it. Now debtors, opening balance I know, 1,02,500. So what I'll do, I'll go to the debtors account and I'll write to balance brought down 1,02,500. And I'll go to opening statement of affairs and I'll write debtors 1,02,500. Closing balance is not given. So we have to find that by balance carried down. This is not given. Clear? Next. Creditors opening balance only is not given. So go to the opening balance sheet, write creditors. We don't know the value, and go to creditors account and write by balance brought down. We don't know the value. And creditors closing balance is given. So you'll write to balance carried down 46,000. To balance carried down 46,000. Next, stock, opening stock is there, closing stock is there. Where will we put this stock? Trading account. So directly you can see in trading account 50,000 opening stock, 62,500 closing stock. That is done.
Yes, sir.
Next, bank balance. We don't know the opening balance. So we'll write to balance brought down. We don't know opening balance. Then by balance carried down. We know the closing balance which is given, that is 50,000. 50,000. Now, our fixed assets 7,500, 9,000. We'll put 7,500 into our opening balance sheet. Fixed 7,500, fixed assets 7,500. Closing balance sheet, already it would have been put 9,000. Clear? Now, what numbers we know? We know all these numbers for the closing balance sheet. We'll go and check whether it is put. Can you see first one is creditor? Can you see creditor of 46,000 in the closing balance sheet? Yes. Then can you see 62,500 stock? It should be there in the closing balance sheet. Yes. Can you see 50,000 bank balance? It is there in the closing balance sheet. Yes. Can you see 9,000 fixed assets? Is it there in the closing balance sheet? Yes. All the information what is there we have already put into the balance sheet. They only prepare trading P&L balance sheet. This much information we have done into our put it into our working notes. Now we'll go further, guys. Received from debtor. What is the entry for received from debtor? Bank account debited to debtor's account. How much is that?
3,40,000.
3,40,000. Go and put it into debtors also and write by bank account 3,40,000. Next, additional capital introduced. Additional capital introduced. The entry should be what? Bank account debited to capital account. Bank account debited to capital account 5,000. And we know that this 5,000 should be there in the balance sheet also. Can you see when you go to balance sheet? Can you see add capital introduced 5,000? 5,000 is there. Okay. Next, sale of fixed assets 1,750. So bank account debited to fixed assets. Bank account debited to fixed assets account 1,750. Okay, but then can you see over here the book value is 2,500. That means we sold it at 750 rupees loss. So 750 rupees loss should be there in your P&L. It will not be there anywhere for us. Wait. We are not preparing fixed asset account, so we don't have to worry. 750 rupees loss on sale of fixed assets in your P&L. Ta-da. Yes. Next, paid to creditors. Creditors account debited to bank. That we have to do. Creditors account debited to bank account 2,80,000. Done. It will not impact your trading P&L balance sheet. Next, expense paid.
492.
Yes. What is the entry? Expense account debited to bank account. So you'll write over here by expenses 49,250. But did we have some outstanding? No. Do we have any outstanding? Nothing. So it should go to P&L now. Expenses 49,250. No outstanding, nothing. Straight.
Personal drawings.
What?
Next one.
Next one, yes. Personal drawings 25,000. What should be the entry? Drawings account debited to bank account. So we'll write in the bank account by drawings 25,000. By drawings 25,000. Clear? And this drawing should be there in the balance sheet. Go to the balance sheet of what is already there in the suggested answers. Can you see minus 25,000 over here? Yes. Next, purchase of fixed assets. What should be the entry? Fixed asset account debited to bank account. So we'll write over here by fixed asset account 5,000. We are not preparing fixed asset ledger, so we don't have to worry about that. No cash transaction took place during the year. Goods are sold at cost plus 25%. Cost of the goods sold was 2,60,000. So 2,60,000 plus 25% is 3,25,000. What is this? Cost of goods sold is given. Goods are sold at cost plus 25%. So now this 3,25,000 is what? My sales. Cost of goods sold plus profit will be your sales. So what should be the entry? Debtor account debited to sale account. Debtor account debited to sales account 3,25,000. This is my sales. Now if I go to my trading account, I should find this 3,25,000. Can you see sales of 3,25,000? Yes, that is your sale. Okay, which is given in the adjustments over there. Done. We are done with the question. Now what should we do? In debtor, one by one we should close everything. Now what I don't know creditors account, so I cannot close opening capital. Can you see over here? I know opening balance, I know sales, I know amount paid, amount received. I'll get the closing balance. Directly balancing figure 1,02,500 plus 3,25,000 minus 3,40,000. How much did you get? 87,500 is my debtor, and this 87,500 should go to the closing balance sheet. See the closing balance sheet, 87,500. Is it there 87,500 in the closing balance sheet? Yes, they didn't show the working note. That's why I'm showing the working notes. That's how you got the 87,500 which went into closing balance sheet. Otherwise, you can't tally your closing balance sheet. Because if you see the starting of the question, see, debtors, they put question mark. We had to find it. Okay, next. After that, creditors. Creditors, what do I not know? I don't know purchase only. I don't know purchase only. See, I don't know opening balance, but I need purchase also. Buy purchases. Now, what will you do? Buy purchases. Do we know opening stock? See, we have a formula. Opening stock plus purchases plus direct expense minus closing stock is equal to cost of goods sold. Cost of goods sold was already given in the question as 2,60,000. So directly you will write is equal to 2,60,000. Okay, opening stock was already given in the question. How much is opening stock? 50,000 plus purchases we don't know plus direct expense nothing is there minus closing stock is 62,500. So 260 minus 50 plus 2 lakh
47,
no 2 lakh 72,500. 2 lakh 72,500. Yes, 2,72,500 is your purchase. Now what you can do, you can go and write purchase account debited to creditors. By purchases you have written no 2,72,500. This purchase you should find in your trading account. It should be there in your trading account. Can you see in your trading account 272,500? Done. Now what will you do? You will close your creditors ledger and get the opening balance 280 plus 46,000 minus 272,500. 53,500 you got the balancing figure for creditors. Because you got this 53,500, you'll go and put it into the opening balance sheet 53,500. One number was missing over there. 53,500. Then what else we have to put into the opening balance sheet? Opening balance sheet, other numbers which are missing are bank balance also. So still I cannot do anything because I need bank balance. Otherwise, if I see over here, debtors I know, creditors just now I put it, stock I put it, bank balance is not there, fixed assets. All the other things are there. Okay, so 3 plus 1, 2, 3, 4, 5. Stock also I have not put right into the opening balance sheet. It is there. Stock. How much is the stock? 50,000.
50,000.
So basically I have opening balance sheet it is. Opening balance sheet. Yes, 50,000. So now bank is missing. If I get bank, then I will be able to close the opening balance sheet. So now what I will do, I will go to bank balance. Okay, everything is there in the bank. Now all that I have to do is, now by the way, creditors 46,000. Did we see in our closing balance sheet 46,000? Yes, it is there. Now bank closing balance is there, right? Opening balance we need to find. Bank. Now what we will do, go and close the bank account. Everything is there. 50,000, 49,250 plus 25,000 plus 5,000 minus 1,750 minus 5,000 minus 3,40,000. Are you getting 217,500?
267.
What? 49,250 plus 25,000 plus 5,000 plus 50,000 minus 340 minus 5,000.
2,67,500.
It's 2,17,000. 2,17,500 is your bank balance, right? So when you go and put that 2,17,500 bank balance, 2,17,500 into the opening balance sheet, 2,17,500. Now you should get 7,500 plus 102,500 plus 217,500 plus 50,000 minus 53,500. You should get 3,24,000 as your capital. This was the balancing figure. Now if you go and check, is the opening balance of capital 3,24,000?
Opening balance is 1,69,000.
1,69,000. The purchase, yeah, correct. The purchase 272,500 which we made, okay, that we have not recorded. Wait, we have recorded it. Wait, 1 second. I think it is paid to creditor 280. I didn't write it. Correct. By creditor 2,80,000.
You're getting 6.
Yeah. Okay, guys, see, listen, we had not put this creditors. That's why we are getting a missing figure here. Actually, creditors, when you put, take the calculation 49,250 plus 25,000 plus 5,000 plus 280 plus 50,000 minus 1,750 minus 5,000 minus 3,40,000. How much are you getting? 62,500. 62,500 is the bank balance. Now go and put that 62,500 into the, it is the opening balance of bank. Go and put it into the opening balance sheet, 62,500. That time you'll get the right capital, guys. 7,500 plus 102,500 plus 62,500 plus 50,000. 1,69,000 is your capital. Now you can go and check the capital here, 1,69,000. So, yeah, the additional capital, we already got that. It was there. Okay. Now, only thing that is remaining is, Only thing that is remaining is this fixed assets. Fixed asset was 7,500. Okay, opening balance. What happened over there? Purchase of fixed asset plus 5,000. You have purchased the fixed asset, it is 5,000. After that, we have sale of fixed asset. Sale of fixed asset, how much book value went? Book value that went was 2,500. So 7,500 plus 5,000 minus 2,500 should be 10,000. But it is showing 9,000. That means 1,000 is depreciation. 1,000 is depreciation. So you can go and write, check over there. Can you see 1,000 depreciation? Yes, done. After that, every other number is marked in the trading P&L. This is your balancing figure, gross profit, which will come here. And this is your net profit, which is the balancing figure. And that will go straight into the capital account and your balance sheet should tally. They have not given any working notes. These are the working notes. This is your statement of affairs and debtors ledger, roughly. This is your creditors account and bank account, roughly. And this is your purchase calculation. That should be it. This is your question from December 2024 exams. Yes, let's go into the next one. That is the June 2024 paper. June 2024 paper, question number 4. Question number 4. So one is a small trader and does not maintain his books on double entry system. The detail of his business are available as follows. So 3 back-to-back papers, last 3 papers, every time they have asked incomplete records. And that also not for little, for 14 marks. You are required to ascertain so one's profit or loss for the year ended 31st March 2023. What did they ask you? Only profit or loss. That means even balance sheet is not required. Okay, so June 2024, they only asked profit or loss. Let's go into June 24, question number 4. See the amount of calculation given by IC, the institute, for 14 marks. 14 marks. Look at the amount of calculation that they have given. Okay, only this much. Now let's have a look at it. What do we know? We know capital, we know cash in hand. Okay, 0 they have given, and closing balance is 1,000. So what we will have to do? We'll have to do the calculations. Question number 4, and this is June 2024. Okay, now I am preparing opening balance sheet. That means opening or statement of affairs. Statement of affairs as on 1st April 2022. 1st April 2022. Now you have cash. Cash 0. No cash at all. Okay, then bank balance credit. Bank balance credit means it is bank OD. Bank OD 74,000. Then you have sundry creditor, sundry debtors. So debtors means asset. You will write debtors 5 lakh. 5 lakh 30,000. Then you have sundry creditors
1,50,000.
Sundry creditors 1 lakh 50,000. Then you have stock 1 lakh 70,000. Stock 1 lakh 70,000. Investments 1 lakh 20,000. That is also asset. 1 lakh 20,000 investments.
Plant 2 lakh.
Then you have plant 2 lakh.
Furniture 14,000.
And you have furniture 14,000. These are the informations that we know about the opening statement of affairs. Clear? Now opening statement of affairs, closing statement of affairs, the difference if you can find out, that should be the profit. Only profit they asked. P&L also you don't need to do. Direct like this you can do. Okay, now one more statement of affairs, I'm keeping it ready. Statement of affairs as on
31/3/23.
31/3/23. Now again same thing on the other column. Cash, this time we have 1,000 rupees. Cash 1,000. Then we have bank. This time it is debit. That means normal balance.
Bank 40,000.
Bank 40,000.
And
Sundry debtors 8 lakh 80. Shall write debtors 8 lakh 80,000.
creditors 1,95,000.
Creditors 1 lakh 95,000. Shall write creditors 1 lakh 95,000.
Stock 1,90,000.
Stock 1 lakh 90,000.
Investments
1 lakh 90,000. Investments 1 lakh 35,000. Investments 1,35,000. Plant we have 2 lakhs. And then we have furniture 14,000. Okay. Now these things might get modified also because this is only the bare information that they are given. So on had withdrawn 3 lakhs during the year. So on had withdrawn 3 lakhs during the year. Now capital at the beginning of the year, we have to find capital at the beginning of the year. If you use your calculator and find 2 lakh plus 14,000 plus 1 lakh 20 plus 5 lakh 30 plus 170 minus 74,000 minus 1 lakh 50. How much do you have over here? 8 lakh 10,000. 8 lakh 10,000 is your capital. Okay, this is your balancing figure. 8 lakh 10,000 is your capital. Clear? Now, if I start my calculation, opening capital is 8 lakh 10,000, and they told me in the question that opening capital 8 lakh 10,000, and here they said there is a withdrawal of 3 lakhs. He has withdrawn 3 lakhs. So minus withdrawal, okay, 3 lakhs. Minus withdrawal 3 lakhs. Then they said he introduced fresh capital of 65,000 on 1st October. So plus additional capital 65,000. Then a provision for 5% on sundry debtors is necessary. So sundry debtors, we have to create a provision of 5%. So now what happens? You have debtors over here 8 lakh 80. I'm just modifying that 8 lakh 80 minus 5%. So 8 lakh 80 minus 5, 8 lakh 36,000. Then after that, they said that write off depreciation on plant at the rate of 15% per annum. So plant, what we have to do? Depreciate at the rate of 15% per annum. So my plant will become 2 lakhs minus 15%. 1,70,000. And they told that write off depreciation on furniture at the rate of 10%. So furniture will become 14,000 minus 10%, 12,600. Next, interest on opening capital to be allowed at the rate of 10% per annum. Interest will be at what rate? 10% per annum. So if I write over here only plus interest on capital, okay, to be allowed. So it will be 8 lakh 10,000 was my opening capital. 8 lakh 10,000 into 10%. 81,000 will be my interest. Clear? And the manager is entitled for a commission at the rate of 10% on the net profit after charging such commission. Manager is entitled to a commission on net profits. That we don't know how much is the net profit. Okay, so now this much information we have. Now if you see the calculation what they have done, capital at the end of the year as per statement of affairs, they have not prepared statement of affairs itself. So 1,70,000 plus 12,600 plus 135 plus 190 plus 836 plus 11,89,600. Okay, can you see capital at the end of the year? 11,89,600. Yes, this is your capital balancing figure. 11,89,600. That's your closing balance. Clear? Now, what we need? Okay, if I take closing capital, so till now 8 lakh 10,000 was the opening capital. From that 3 lakh is withdrawn. 6 lakh 56,000. 6 lakh 56,000 is the situation, correct? Now over here closing capital we got 11 lakh 89,600. So therefore 5 lakh 33,600 is what? Profit. But what did they ask actually? What is the profit or loss for the year ended? 5 lakh 33,600 you will get. But that profit is before commission, no? This is the profit before commission, because now they told us that we have to allow some commission. Okay, now what ICMI has done, they have done reverse calculation from closing capital. I am doing from opening capital, which is more simple. Opening capital, what will you do? Drawings minus additional capital, add interest on capital, add, you should get this as the closing capital. But closing capital is how much? 11,89,600. How did the closing capital increase? Because of profit. But this is not the profit, because this profit is before commission. They told that manager is entitled to commission of 10% on net profit after charging such commission. So now what we have to do? Minus commission, okay, 5,33,600 into 10 divided by 110, not 10%, into 10 divided by 110, 48,509. So 533,600 minus 48,509, 4,85,091. This is your profit for the year. Now, if you are thinking, what is this? How did this happen? 10 divided by 110. If they would have told commission on net profit before charging commission, then it would have been 10 divided by 100. They have told commission on net profit after charging commission. That's why it is 10 divided by 110. Is it clear? That is your June 2024 question. And you can see 4,85,091. Only this much calculation they have given in the suggested answer. This much is not enough in the exam. In the exam, you have to do opening statement of affairs, closing statement of affairs, and then do this statement. Then only you will get the answer and you will get the full 14 marks. Yes, with that we are done with June 24. This is your solution if you want to have a quick look at what I have done. Opening statement of affairs, closing statement of affairs, both to find the opening capital and closing capital. And then you have this calculation where we get our profits. June 24 done. Let's have a look at June 24 if there is anything later. Insurance claim AS, chapter 1. Yes, done, finished. Now we go into December 2023. In December 2023 also we have a question for 14 marks. And Raj does not maintain proper books of accounts. For four attempts back to back, they have asked what? Incomplete records. Yes, Raj does not maintain proper books of accounts. From the following particulars, prepare trading and P&L account for the year ended 31st March 2023 and the balance sheet as on that date. This is the information that we have, limited information. Then they told summary of other transaction is as follows. He had 25,000 cash balance in the beginning of the year. Now, what we have to do? Let's see first of all if everything is given so that we can discuss. No, nothing is given. Very good. Look at the amount of suggested answer. The answer that is suggested, only this much. Trading P&L balance sheet. That is what I asked you, that is what I gave you. But working note, nothing. Okay, so we will have to prepare working notes, guys. This is your December 2023 question number 4, which is asked for 14 marks. Now, obviously, I need to prepare statement of affairs. Okay, first thing that I 100% have to prepare is SOA on as on 31st of March 2022. Okay, closing statement of affairs not required. That is balance sheet only, closing balance sheet. After that, if you can see over here, debtor is there, creditor is there. So 100% I will have to prepare debtor's account. And also I will have to prepare creditor's account to explain to you. And these are the working notes that are required. Okay, working notes I am going to prepare. Okay, and the main solution directly will discuss from the suggested answer itself. So creditor's account I require. After that, what is there? Cash will also be there. Right now you can't see, but can you see? He had 25,000 as cash balance in the beginning of the year. Cash account we'll have to prepare. So in cash account, as I prepare only, I'm writing to balance brought down 25,000, and I'll go to the opening balance sheet and write cash 25,000. In the opening balance sheet, 25,000 cash should be there, right? Next, we'll go into this debtors 90,000. What will I do? Go into the opening balance sheet and write debtors 90,000, and also go into debtors account and write to balance brought down 90,000. Next, stock 49,000. Stock I don't have to put anywhere other than opening balance sheet. See, I'll go to opening balance sheet and write stock 49,000 and then go into December 2023, answer and see opening stock in the trading account. Can you see 49,000? 49,000. Solution I'm directly discussing there also. Then furniture 5,000. I'll go to opening balance sheet and write furniture 5,000. Okay, then yes, after that you have creditors 30,000. You'll go and put it to closing balance sheet. Opening balance sheet, creditors 30,000. And then you'll also go to creditors account and write buy balance brought down 30,000. That should be it. Okay, we'll keep it pending. Later we have to find capital. This will be our capital, opening capital, which will be the balancing figure. They have not given any other information, but let's proceed as it is. Okay. Now going into the first thing, collection from debtors. 3,04,000. What should be the entry? Cash account debited to debtors account. Cash account debited to debtors account 3,04,000. Now go into debtors account and write by cash account 3,04,000. Next, cash paid to creditors. What is the entry? Creditors account debited to cash account. Creditors account debited to cash account 2,20,000. And here we will write in cash account by creditors 2,20,000. Next, salaries 60,000. What will be the entry for salaries? Salaries account debited to cash account. So you will write by salaries account 60,000. This salary should be there even in the P&L. Let's go into the P&L. Can you see salary 60,000 over here? Yes. Next, rent 7,500. What should be the entry? Rent account debited to cash account. So we'll write over here by rent account 7,500. Let's go into the P&L and see. Can you see rent over here 7,500? Yes. Next, office expenses 9,000. Entry for this is office expense account debited to cash account. So you'll write by office expenses account 9,000. And you should find this 9,000 in the P&L also. 9,000. Next, drawings 15,000. What should be the entry? Drawings 15,000. Drawings, right? Yes, drawings 15,000. So the entry will be drawings account debited to cash account. So we'll write over here by drawings. By drawings account 15,000. Now just keep this. Later we will need it for our capital calculation. Closing capital calculation, we will need this drawings. Then additional capital introduced. Additional capital introduced. What should be the entry? Cash account debited to capital account 10,000. This also we will require for the future. Cash sales. What should be the entry for cash sales? Cash account debited to sales account 7,500. So when I'm calculating my total sales, we know that cash sales is 7,500. Credit sales I need to find out. Cash purchases. Cash purchases, what is the entry? Purchase account debited to cash account. So we'll write over here by purchase account 25,000. So now when I find my total purchases, I will add the cash purchase of 25,000. I have to find the credit purchase later. Now, discount received. What should be the entry for discount received? Creditor account debited to discount received. Creditor account debited to discount received account 3,500. Now this discount received will also go to what? It will go to P&L. In P&L you can see 3,500 as discount received. Next, after that, discount allowed. Discount allowed entry is discount allowed account debited to debtors account. So we'll write by discount allowed
1,500.
Account 1,500, and this 1,500 you will put it into P&L also. Can you see 1,500 here? Yes. Next, after that, returns inward. Returns inward is what? Returns inward, that is sales return. So what should be the entry for that? Sales return account debited to debtors. So we'll write over here by sales return By sales return account 5,000. By sales return account 5,000. But this sales return later on you have to subtract it from sales. Okay, you have to subtract it from sales. Now returns outward. Returns outward, what should be the purchase return? So creditors account debited to purchase return account. How much?
4,000.
4,000. This later you have to subtract from purchases. Bad debts. What should be the entry for bad debt? 1,000. Bad debt account debited to debtors. So we'll write over here by bad debts account 1,000. By bad debts account 1,000. This should be the situation. So literally whatever is there we have done. Now if you close the debtors account, how will you close the debtors account? See, debtors, you need the closing balance. Wait. You need the closing balance. Closing balance of debtor is 1,25,000. So you'll go and write by balance carried down 1,25,000. And this 1,25,000 debtor should be there in the balance sheet also. Can you see in the balance sheet debtor is 1,25,000? Yes. Now if you balance the debtors account, 3,04,000 plus 1,500 plus 5,000 plus 1,000 plus 1,25,000 minus 90,000, 3,46,500. 3,46,500 is your sales. So you'll write debtors account debited to sales. This is your credit sales, 3,46,500. So when you go and write 3,46,500 plus 7,500, 3,54,000 will be your total sales. 3,54,000 will be your total sales. That's why we prepare debtors account to find the credit sales so that we can find the total sales. Next we go into creditors. Creditors, you have to write the to balance carried down. What is the creditors balance carried down? You can 22,500. Yes, so you can write 22,500, and this 22,500 should be there in the closing balance sheet. Can you see 20? 1 second. That we should reach there. Wait. Yeah, sales return is there, no? Okay, but here creditors is 22,500, no? Okay, they have written here as 25,000 creditors. Balance sheet creditors 25,000 they have written. It should have been actually 22,500. So if change it in the question itself, because if 25,000 you make it, if you make it as 22,500, your purchase will be different than what is there in the solution. So 25,000 is the closing balance, not 22,500. 22,500, I'm taking it as 25,000 just for the sake. Okay, so this will be 25,000. Now 25,000 is the closing balance of creditors. 2,20,000 plus 3,500 plus 4,000 plus 25,000 minus 30,000. 2,22,000. 2,22,500 will be your purchase. So you'll write by purchases. This is your credit purchase, which is your balancing figure, 2,22,500. So 222,500 when you add, you will get 25,000. So 247,500. $247,500. I think, wait, they have messed it up. Okay, in the solution, they have written it as 25,000 here. Just add it, 183,500 plus 25,000, 2,08,500. You're getting that right? But if you see the purchases, if you see your purchase creditors account, 2,20,000 plus 3,500 plus 4,000 plus 25,000 if you do, and minus 30,000, you get 222,500. Okay, we'll go with the original question only, guys. We'll go with the original question only, 22,500. What is printed, that only we'll go with, 22,500. So this balance, closing balance will be 22,500. 2,20,000 plus 3,500 plus 4,000 plus 22,500 minus 30,000. How much is it? 2,20,000. 2,20,000 will be purchased according to the question printed. Okay, according to the question printed, purchase will be 2,20,000. So that makes it 2,20,000 plus 25, 2,45,000. 2,45,000 will be your total purchase. Now, debtors, creditors done. Okay, debtors, creditors done. Now, cash. What will you do with cash? Take 25,000 plus 3,04,000 plus 10,000 plus 7,500 minus all the payments. 10,000. Can you see 10,000 is the cash balance? And here you're getting buy balance carried down 10,000, and this 10,000 has gone into your balance sheet also. Clear? Now, after this, let's look into the other things that are there one by one in the question. Here, stock. This stock will be what? Closing stock. It will go to trading account as closing stock, and it will go to balance sheet as closing stock. Next, after that, what do you have? Furniture. Furniture, what will happen? Furniture will go into your balance sheet as closing balance of furniture. 7,500. 7,500. They had already told that we had purchased something, right? Yeah, so office furniture is there. Now, when you are calculating 7,000, office furniture is not there, right? Okay. Furniture has gone from 5,000 to 7,500. Actually, furniture has gone from 5,000 to 7,500. That means there should be a purchase of furniture. Purchase of furniture. For that, what we'll have to do? We'll have to pass entry. Okay, furniture account debited. Furniture account debited to cash account. Or wait, 1 second. They didn't tell anything, right? That furniture is purchased for cash. So furniture is 100% purchased. Because furniture has gone from 5,000 to 7,500. So furniture is 100% purchased. But we didn't make payment. Because we didn't make payment, that is why that closing balance of creditor was 22,500 plus 2,500, 25,000. Are you getting this?
Yes, sir.
22,500 is the closing balance of creditor given in the question. And this 2,500 is closing balance of creditor for purchase for furniture. Creditor for furniture. That's how you're getting the 25,000. Okay, that should be sorted now. That is not a typo. Next, after that, we don't have anything else. We have only to worry about this one. Sales. This is our total sales, 3,54,000. But in the question, we have sales written 5,000. So, if you go to the solution, 3,54,000 minus 5,000, you'll get 3,49,000 as your sales. And if you check the purchase calculation which we did, 2,45,000. Okay, 2,45,000, and if you go and check what was the returns, that is 4,000. So 2,45,000 minus 4,000, you will get 2,41,000. Done, sorted, that's it. Whatever balancing figure is there, that is your gross profit. Gross profit will be over here. Then bad debts we have already entered 1,000, and this will be your net profit, finished. And net profit will be coming to balance sheet. Now I have to show you the capital calculation. Capital. What was the opening capital? Let's go to our opening statement of affairs. Let's find the opening capital. 5,000 plus 25,000 plus 90,000 plus 49,000 minus 30. Is it 1,39,000 opening capital? $1,39,000 is my opening capital. So opening capital 1,39,000 plus we have some additional capital in the question. Additional capital is 10,000 plus additional capital 10,000 minus drawings. How much is the drawings? Drawings is 15,000. Drawings 15,000 plus net profit. What is the net profit? 49,500. 1,83,500 you'll get when you do all this. This is your solution, and these are the workings that you have to do to reach that solution. You can't reach it directly like how they have done. Okay, you will have to do all these calculations. This is it. This is it. And this is your calculation. With that, we are done with December 2023. You can have a look at the capital computation over here. Yes, done. Now we go into the model test papers, guys. Model test papers. December 23 onwards. From December 23 onwards, we'll go into question number 4. Yeah, there only one we are going to see now. That's similar. Question number 4. Question number 4. Can you see they have asked NPO? Furnishes you the resident payment account and you are supposed to obviously prepare the income and expenditure account for the year ended 31st March 2022 and balance sheet of the club on 31st of March 2022. NPO question is asked. Let's quickly go through this NPO question. Now, let's see the adjustments first. Subscription in arrears for 21-22 and subscription in advance for 22-23. This will be important when we are doing our subscription calculation. Next, 400 was insurance premium outstanding as on 31st March 2022. 31st March 2022 is this year end. This when we are doing insurance premium, we have to remember miscellaneous expense prepaid. This also we have to remember when we are doing miscellaneous expense. 50% of the donation is to be capitalized. If 50% of the donation is to be capitalized, the other 50% will go to your income and expenditure account. Entrance fees is to be treated as revenue. That means entrance fees will not be capitalized. It will go to your income and expenditure account. 8% interest has accrued on investment for 5 months. This we have to keep in mind. Then billiards table and other sports equipment costing 3 lakh were purchased in the financial year 2021 and of which 80,000 was not paid on 31st of March 2021. That means billiards table was purchased. There is no charge for depreciation to be considered. Billiards table purchase, since still some amount is pending related to billiards table. Prepare income and expenditure account and balance sheet. That's it. Income and expenditure account and balance sheet they have asked you to prepare. Now, first thing always we have to prepare question number 4. Sorry, here only, right? Income and expenditure is there. Balance sheet is prepared. Now, balance sheet, opening balance sheet. We always need the opening balance sheet. Why? To find the opening capital fund. We need the opening balance sheet to find opening capital fund. Then we go and prepare income and expenditure account and closing balance sheet. Now, to prepare opening balance sheet, first thing you have to see over here. Can you see in your receipt and payment account, cash in hand, cash at bank? All these are opening balances. It should go to what? Opening balance sheet. If you go to opening balance sheet and put, see, cash in hand 40,000, cash at bank 1 lakh. Clear? Now, after that, they told us that billiards table over here, billiards table was purchased. 3 lakh was purchased in the financial year 2021. Last year they purchased. That means it is still there in the balance sheet. And they told of which 80,000 was not paid on 31st of March 2021. So now if you go and check, no, you will find billiards table sitting at 3 lakhs and billiards table outstanding sitting at 80,000. That means they didn't pay. Other than this, they didn't give us any information about last year. So this will be your capital fund balancing figure. This opening balance of capital fund will be the starting point for your closing capital fund. Can you see 3,60,000? Yes, 3,60,000 will come to your closing balance sheet as opening capital fund. From there you will carry on. Now, if you see other things, one by one we have to do. Donation. What did they tell about donation, which we just discussed? 50% of the donation is to be capitalized. That means 50% of the donation will go to income and expenditure account. If you see our income and expenditure account, can you see donation over here? 25,000 is sitting over here. And the other 25,000 should be added to the capital fund. Can you see 25,000 is added to the capital fund? Because of that point. Otherwise, we would have put full donation into the income and expenditure account itself. Next, after donation, next thing, subscription, 1,20,000. Here there is an adjustment. 1,20,000 is our subscription. Okay, now you have to be a little careful. Here they told subscription in arrears. That means we have to add this year's receivable. Subscription received in advance for next year. That means we have to subtract 3,500. 1,20,000 plus 6,000. 1,25,500. This should be a subscription. This year's subscription is receivable. Add next year's subscription already received in advance, that we have to subtract. 125,500 you will find in your income and expenditure account. Can you see 125,500 over here? Yes. And receivable is asset. It should be shown on the balance sheet asset side. Subscription arrears 9,000 and received in advance is a liability. That should be shown on the liability side 3,500. Immediately that point only you should put and finish it off. Next, after that, what do we have? Entrance fees. What did they tell about entrance fees? Entrance fees, they said it should be treated as revenue. If it is to be treated as revenue, it will go to income and expenditure account. It will go to income and expenditure account 10,000. Entrance fees directly into income and expenditure account. Can you see 10,000 there? If they would tell it is treated as capital, it would have been added to capital fund. Clear? Here they told it as revenue. Next, after that, interest on investment. 1,000 is there, interest on investment. Clear? But they told one point over here, 8% interest has accrued on investment for 5,000. Now, investment for 5,000. Now we have to understand, if you look at the other side, can you see investment here? 60,000. Can you see on the other side investment is there 60,000? So 60,000 into 8% into 5 divided by 12. How much is it?
2,000.
So 2,000 interest has accrued. Accrued means interest is receivable. So now 1,000 is already there. So 1,000 plus 2,000 in your income and expenditure account you have to put 3,000. If you see your income and expenditure account, can you see interest on investment 3,000 sitting over here? Yes. And out of this 3,000, how much is received? Only 1,000 is received. 2,000 is receivable. So you will go and put it in the balance sheet. 2,000 interest receivable. Can you see they have added it to investment itself? Interest receivable 2,000. Clear? Next. After that, let's go further. Interest from banks. Interest from banks. Here they have not told any adjustment. Okay, directly 4,000 will go to income and expenditure account. Interest from banks, bank interest, receipt, or sorry, income. Then next item, sale of old newspaper. Nothing, no adjustment, nothing. Straight away go and put sale of old newspaper. 1,500. Done. Then sale of drama tickets. Whenever you have something like this, now go to the other side and see what is there. Can you see one drama expense over here? 5,000. So drama ticket and drama expense. Net we can show. So it will be 5,500. Okay, they have not done that. They have shown sale of drama ticket 10,500 over here and drama expense 5,000 over here. You can even net it off and show, but they have shown separately, no issues. Okay, let's go further, guys. So this drama expense also done. Now you are going into the other side. Subscription, everything is done. Now, salary. Do you have any adjustment for salary? No. Directly you are going to put 20,000 in your income and expenditure account. Salary 20,000. Done. Next. Repair expense. No adjustment for repair expense. Straight away repair expense in your income and expenditure account. Expense done. 5,000. Yes. Furniture is not income and expenditure. Furniture is a balance sheet item. So directly you have to put furniture into the balance sheet only. Nothing has been spoken about any depreciation or anything like that. So directly in the balance sheet you should find furniture. Where is furniture? 60,000. If they would have told depreciation rate, we would have calculated and subtracted and written. But they have not told anything. 60,000. Next, after that you have miscellaneous expense 5,000. But miscellaneous expense I can't write directly because they said miscellaneous expense prepaid was 900. Prepaid 900 means 5,000 minus 900. I should show only 4,100 and 900 will go to balance sheet as prepaid. Now if you go and check, right, miscellaneous expense 4,100 and 900 will be there in the balance sheet as prepaid expense. Clear? Yes. Next, after that, insurance premium also I can't put directly because insurance premium there was 400 of insurance premium outstanding. So 2,000 plus 400, it will become 2,400 and this 400 will be shown in the balance sheet as insurance premium outstanding liability side. So you can see over here insurance premium 2,400 and in balance sheet you can see insurance premium outstanding. Clear? Next. After that you have billiards table and other sports item. Remember last year 80,000 was pending, they paid that, so it became 0. So in your balance sheet this time you will not find any billiards table outstanding or something, 0. So you can see in the balance sheet there is no billiards table. Can you see in the liability side, no billiards table? This 80,000 was there, no?
The opening balance.
Yeah, this became 0. This became 0. Clear? Now, next, after that, you have stationery expense. No adjustment at all for stationery expense. Directly go and put it 1,500 stationery expense finished. After that, you have cash, drama expense, we already put it. Okay, cash in hand, cash at bank. Both of them will go to closing balance sheet, 26,500 and 72,000. You can see 26,500 and 72,000 in your closing balance sheet. Investment, we had already seen 60,000. That we add 62,000, it becomes because of interest outstanding or interest receivable for us. Billiards table is still there, only payment is made. So billiards table still there, 3 lakh, which was there last year also. Okay, then after that, we don't have anything else to be done. That's it. Everything is marked, can you see? And you will get excess of income or expenditure. This is called as surplus. This surplus straight away you will put it to balance sheet, 1,41,500. That time you will get your closing balance, and then that's it. It will tally. This is your 14 mark question, guys.
The exam we can write it as two surplus.
You can write 2 surplus, no issues. Okay, that should be it. 5th is partnership, branch, insurance claim, AS chapter 1. That's it. We don't have anything from. Yeah. So the 14 mark question is always like pakka 14 mark question from this particular topic. Next, we'll go into the next model test paper. This is the set 1 of June 2024, which I am discussing right now. Set 1 of June 2024. Question number 4. Okay, guys, we'll go into the next question. This is from your June 2024 set 1. June 24 set 1. Okay, the following trial balance has been prepared from the books of Mr. Saxena. Temporarily, they make you excited in the exam hall, but come back to the exam. As on 31st of March 2024, after making necessary adjustments for depreciation on fixed assets, outstanding and accrued items and differences under suspense account. 14 mark question. What did it tell? After making necessary adjustments for depreciation, that is a regular adjustment, and outstanding and accrued items, that is also there, and any difference under suspense account. Okay. Now they have given us one trial balance. Now this trial balance is there. We'll go outside the trial balance and see what all adjustments were there. Because you have to remember these adjustments when you are preparing your trading P&L balance sheet. They have given you the trading account, they have given you the P&L account, and they have given you balance sheet also. Some notes also are there that we will not go to see. We will do the calculation on our own. Now, on the subsequent scrutiny, the following mistakes were noticed. Very good. Can you see in our question, there is one suspense account over here, 39,400.
Yes.
And now they are telling, following mistakes were noticed. A new machinery was purchased for 50,000, but the amount was wrongly posted to the furniture account as 5,000. New machinery was 50,000. They have wrongly posted to the furniture account as 5,000. That means furniture, there is a mistake. So what will happen now? Here you will have to add it to furniture. That means furniture will be 45,000. 45,000 we have to add. 45,000 we have to add. Okay. And then for only one side. So what will happen? Suspense account will be credited for 45,000. Suspense account will be credited for 45,000. Have they shown any calculations? See, 45,000. Suspense account is eliminated by the item. 45,000 is the item over here. One more you will find. Some other error is there. Now, okay, next they said cash received from debtors 5,600 was omitted to be posted in the ledger. Cash received omitted to be posted. That means what should be the entry? Cash account debited to debtors account. Cash account debited to debtors account. Wait. Omitted to be posted in the ledger, they said, no. Which ledger, what, which side, nothing. They have left it to your imagination only in the exam. Okay, now see over here. By 5,600. Yeah, they've shown in the workings. So basically it should have been cash account debited 5,600 to debtors.
5,600. But they forgot to post it. Okay, now they forgot to post it means what? 45,000 was the situation, right? 45,000 minus 5,600. So debit was missing. Cash received, they spoke only about cash received. So cash is not debited. So 5,600. Sorry. Debtor is not posted. So 5,600. So what will be the mistake over here? Suspense account will be credited. I'll give you the notes for all these things. Otherwise, it will be like full imagination you'll have to do. Question number, June, right? June 24, set 1.
No, sir.
Only one set is there, yes. Question number 4. Now, rectification entries, I'll tell you. So that it helps you. Okay, now here, new machinery was purchased for 50,000, was wrongly posted to the furniture account as we actually got it wrong, guys. That time. It's a new machinery purchased for 50,000, was wrongly posted to the furniture account as 5,000. So now, actually, if you see, no, do we have machinery in the balance sheet? 170. If you go to balance sheet and check, no, machinery. What on earth is this? 50,002. 2,50,000.
One is typo.
That's typo, yeah. 1 is typo, 2 is also typo. 170 is the machinery, right? So many errors if they make. It's all our imagination to think what to do, what not to do. See, new machinery purchase is 50. Here machinery account is showing 170. When we go to balance sheet, machinery is showing 250. Even 170 plus 50 if you do,
220.
become only 220. I'm not sure if there is one more error anywhere. Full year's depreciation is provided on addition. Okay. Closing stock on physical verification. No, is there any other machine? No, right?
No.
Only one machine, 170. This kind of typos they should not make. Yes, guys, it's solvable, this one. But thing is, don't completely see the solutions. We will solve it on our own. Now, first we will sort this one. New machinery was purchased for 50,000, but the amount was wrongly posted to the furniture account as 5,000. So what should be the entry actually? Machinery account debited 50,000 to bank account or cash account, whatever it is, 50,000. What have they done? Furniture account debited 5,000 to bank account 50,000. Bank is correctly done. So now the rectification entry, machinery we have to do. So machinery account debited 50,000. Machinery account debited 50,000. Okay. And we have to remove that wrong furniture. Wrong furniture which is debited we have to remove. So to furniture 5,000. And difference will put to suspense account. To suspense 45,000. To suspense it will become 45,000. Clear? This is one error. Error number 1. This one. Next, cash received from debtors 5,600 was omitted to be posted in the ledger. Cash is received. So the correct entry is cash account debited 5,600 to debtors 5,600. This should have been the entry. What have they done? Omitted to be posted to the ledger. That means cash account debited 5,600 is done. We didn't put it to debtors. So now the rectification entry will be 2 debtors we have to do. 2 debtors 5,600. Okay, now debit will be what? The only credit is there. So debit will be suspense account debited 5,600. Suspense account debited 5,600. This is our rectification of errors.
This is not this chapter. But now suspense account in our trial balance was showing 39,400. So now what happens? 39,400 if I have suspense account 39,400, and you can see over here, if 39,400 is there in our suspense account, what has happened over here? Suspense account got credited by 45,000. So credit 45,000, and suspense account got debited by 5,600. This is how suspense account has to close. Without doing the rectification, we will not be able to close the suspense account. Now later what we have to remember is, I am marking it in red. What we have to remember is, machinery I have to add 50,000 when I prepare my final accounts, and furniture, sorry, I'll show it here only in the rectification entry. Machinery I have to add 50,000, furniture I have to subtract 5,000, and in my next rectification, debtors I have to minus 5,600. Then only I will be able to close the final accounts over there. These are the three rectifications, and this is why suspense account will become zero. So anymore, I don't have to bother about this suspense account. That is done. Clear? Very, very important. This is okay. Very important question. Only thing is they have not presented it correctly for us to understand, but otherwise the twists and turns of the question are good. So first we have to rectify the machine. They have treated it as machinery. It should have been machinery account debited to bank. They have passed the entry furniture account debited, but bank is still 50,000 only. Rule of rectification. What is not told is correct. So machinery account debited, which is not done. Furniture account you have to remove. Then suspense account, difference will go to suspense account. That you know, one-sided errors. Cash account debited to debtor is the entry. Okay, what they have done, cash is done, not posted to the ledger. So now rectification entry will be suspense account debited to debtor. So all these rectifications you have to remember. So now next one, first and second one done, sorted. Goods withdrawn by the proprietor for personal use, but no entry has been passed. Goods withdrawn by proprietor, no entry passed means what should we do? What should we do? We should show it as drawings, and it should be subtracted from purchases. We should show it as drawings and we should subtract it from purchases. Next, sales included 30,000 as goods sold for cash on behalf of Mr. Thakurlal, who allowed 15% commission on such sales, for which effect is to be given. Very important. This is another very important adjustment. Sales included 30,000 as goods sold for cash on behalf of Mr. Thakurlal. I have sold on behalf of whom? Mr. Thakurlal. Okay, and for that he has given me commission. This one we have to discuss. Again, important adjustment. You are further told that closing stock on physical verification is 47,500. Closing stock, we don't have to worry. Put it in trading account and then put it in balance sheet also. Depreciation, machinery and furniture has been provided. Already they have done 15% and 10% respectively on reducing balance in system. Okay. Full year's depreciation is provided on addition. These are the adjustments which we have to keep in mind when we are going further. Clear? Now, first, machinery. I am starting only with machinery. Machinery 170. What did I learn from my rectification? 50,000 I have to add to machinery. So 170 plus 50,000. This will become what? 2,20,000. It will become 2,20,000. Correct? Now, on the existing machinery, you can see that they have already done the depreciation on existing machinery. They didn't tell depreciation is to be provided. They said depreciation has been provided. They said depreciation has been provided. They didn't tell to be provided. They give, when we see percentage in the exam, okay, this immediately will be like, we'll write. Okay, but they told it has been provided. That means this machinery depreciation they have already done. If you see also, okay, now it is 170, right? Before depreciation, it would have been 2 lakhs. If you add the depreciation back 30,000, it would have been 2 lakh. On 2 lakh, you see 15% is 30,000 only. Okay, now this is our 2,20,000 which is there. Now they have provided on the machinery which is there. The machinery which is not there, the depreciation which we provided, on that obviously they didn't provide, no. So now what happens? On 50,000, I have to calculate 15% depreciation. That makes it 7,500 depreciation. So 220 minus 7,500, you will get 2,12,500 your machinery value. Calculation is not shown, but that is the situation, right? So now see over here, Machinery 2 lakh, 2 lakh, 2 lakh, 2 lakh, 12,500. 2 lakh 12,500. They have shown some calculations here. Machinery as per trial balance 170. Add the depreciation, you got 2 lakh. Add the addition, you got 250. From that, you will remove depreciation. That time you will get the value. Is it clear? Yes, it's an important question, guys. Do not skip this question. It's an important question. Twist with this twist, if it is given, if you have not seen it and gone to the exam, 100% you will not recall only. You will see the percentage directly. You will do 15%. Okay, so that is how you got your machinery as 2,12,500 in our solutions. 2,12,500. Now what we will do? Depreciation we already know that 30,000 is there. 30,000 depreciation on machinery. Just now I added another 7,500 to that. So total depreciation is 37,500. See in the what is say our P&L 37,500 is the depreciation. 30 was already there. Extra the rectification depreciation I did just now. Next. Furniture 49,500. What should I do now? Rectification in this 49,500, right? In this 49,500, 5,000 was included by mistake. So this is only 44,500. 44,500. Depreciation on furniture is how much? Depreciation on furniture percentage they gave is 10%. So now, if I by mistake included furniture, by mistake depreciation also would be calculated. So now 5,000 into 10% will be 500. That 500 I have to add back. Depreciation, see what happened on the left hand side and see what happened on the right hand side. Left hand side, machinery was not taken. So we forgot the depreciation also. So we took the depreciation of 7,500. On the right hand side, furniture was wrongly taken. Furniture was wrongly taken. So wrongly depreciation also is calculated. So we have to add back the depreciation now.
If we have taken wrong, we have taken that, then why wouldn't we have?
No, wrongly we have taken the asset. Wrongly we have taken the asset. So now we will remove the asset. That time the depreciation we will add back. That is the benefit for us. So now 500 I am going to add back. That time it becomes, furniture will become 45,000. Furniture should be 45,000. We'll go to balance sheet. It should be 45,000. Can you see 45,000? Yes. Next. After that, sundry debtors. Sundry debtors also has surplus. What is the surplus on sundry debtors? They told that, what is that? Not posted. 5,600 not posted. Provision and all, they have not asked us to provide. Is there any provision for sundry debtors? No. See the sundry debtor now. In the balance sheet, sundry debtor 38,000 minus 5,600. See our working note. We told that it should be subtracted from debtors. Yes, minus 5,600. This will be our sundry debtors. Net balance 32,400. I hope you are understanding each item. Next, when we reach the model test paper of December 2025 exam, okay, we will solve both. Both the questions we will solve. Drawings 28,000. Drawings, what should happen? Did we have any adjustment for drawings? Yes, one more drawing was there. Goods taken by proprietor 5,000. No entry passed. So this 28,000 plus 5,000. One more drawing is there plus 5,000. That becomes 33,000 drawings totally. So you go and check drawings in the balance sheet. Can you see 28 plus 5? 33,000 drawings. Okay, 28 was there in the trial balance. 5,000 is outside the trial balance, which is not even recorded. 33,000 trial drawings. Next. Traveling expenses 6,500. No adjustment, nothing. Directly into P&L. 6,500 traveling expenses in the P&L. Done. Clear? Next. Insurance. We didn't hear anything about insurance. 1,500 directly into the P&L account. 1,500 insurance 1,500. Yes. Next. After that, audit fees. No adjustment we heard about audit fees. Directly 1,000. It should be there in the P&L. 1,000 audit fees. Next. Salaries 49,000. We didn't have any adjustment for salaries. Outstanding, prepaid, nothing was there. Directly 49,000. Salaries directly 49,000. Next, after that, rent 5,000. Directly rent in the P&L you should find 2 rent 5,000. Next, after that, cash in hand. Cash in hand directly will go to balance sheet. Cash at bank also will go to
balance sheet. So in the balance sheet, you should see both cash in hand and cash at bank, exact amounts. Okay. 90% of the question will be fill in the blanks. Remaining adjustments, you have to be careful. Now, stock in trade 1/4/2023. That means which stock is this? Opening stock. It should be there in the trading account. Can you see opening stock 80,000? Done. Prepaid insurance. Prepaid insurance is what? Asset. It's there in the trial balance. So no need to do any adjustment. Directly 250, put it in the balance sheet asset side. Prepaid 250. Next. Miscellaneous expense. We don't have any adjustment. Directly into the P&L 21,200. 21,200. Then next. Discounts. Directly into P&L 1,200. Discount allowed. Printing and stationery is also there. 1,500. Next. Directly 1,500. Printing and stationery. Next. After that. Purchase less returns. Directly. Where will it go? It will go straight into trading account. But. Remember this working note, what we have to remember. Drawings. Goods withdrawn by proprietor. We have to subtract it from purchase also. 4,60,000 minus, how much did he withdraw? Proprietor 5,000. 4,60,000 minus 5,000. This should be 4,55,000 in your trading account. Check trading account. 460 minus 5, 455. Done. Drawings. What is the entry for drawings? Drawings account debited to purchases. So drawings already we added 5,000 that time. Next, after that we have depreciation on furniture and all done. Already we have taken the net amount there. Furniture. Depreciation on furniture, we have to directly put into P&L, 5,000 in the P&L. Can you see 5,000? Sorry, 5,500 is there over here. How it became 5,000? Because we added back that, no, depreciation 5,500 minus 500, which was not required. That becomes 42,500, done, depreciation. After that, we don't have anything else. We have to go to the credit side. Sundry creditors 82,000 directly into the balance sheet. Sundry creditors 82,000. Can you see here? 82,000 sundry creditors. Done. Next, after that, we have capital account 245,750. That will be your starting point of your capital. You can see capital 245,750 capital. Next, after that, you have your salaries outstanding. Outstanding salary, where should it go? Directly in the balance sheet. It's there in the trial balance itself. It's there in the trial balance. Directly into balance sheet 1,500. Outstanding salary. Then you have outstanding printing, outstanding audit fees. Both of them will go to balance sheet because it's in the trial balance. Directly to balance sheet. Both of these items. Then next, after that, you have bank interest 1,200. Bank interest is an income. Income should go to P&L. P&L you will find 1,200 by bank interest 1,200. Done. Finished. Okay. Next, discounts. Discount is discount received. It's on the credit side. Discount received 1,800. Discount received. Next, after that you have sales less returns. We didn't have any adjustment for sales. Directly sales we'll put it into trading account 6 lakh. Oh, wait. Did we have some adjustment for sales? Yeah, this one. Thakurlal we kept pending, no? Thakurlal, see, this is a very important adjustment. Sales included 30,000 as goods sold. Okay, goods sold for cash on behalf of Thakurlal. Goods sold for cash on behalf of Thakurlal. Now, we sold not our goods, we sold Thakurlal's goods. On behalf of Thakurlal, no, we sold 30,000 goods. Now, if I have sold 30,000 goods on behalf of Thakurlal, don't you think I am supposed to give him that money? So, it is not my sale, no. Imagine I am selling my calculator and you tell me, okay, keep this product also. Along with your products, you sell my product also. When you get money, you give me money. So, same way, Thakurlal has told that 30,000 goods are sold for cash, okay, on behalf of Mr. Thakurlal. So, now it is not my sale, it is Thakurlal's sale. But I sold, I got money. Now I am supposed to give 30,000 to Thakurlal. For doing this, no, Thakurlal told he'll give me 15% commission on the sale. So 30,000 into 15%, 4,500 is going to give me commission. 4,500 is supposed to give me commission. Now, did he give me that commission? No. Did he give me that commission? No. Is he supposed to give me that commission? Yes. Did I sell goods for him? Yes. Did I sell goods for him and did I get the cash? Yes. It sold for cash. Did I get the cash? Yes. Did I give him that money? No. I have to give him 30,000. He has to give me 4,500. That means net how much I should get? 25,500.
Oh, he had given the cash.
No, he has not given cash. I have to give him 30,000 cash and he has to give me 4,500 commission. Okay, 30,000 I sold goods on behalf of him. So 30,000 I have to give him money.
Yes.
And because of me selling his goods, he told he'll give me 15% commission. So he has to give me money. So 30,000 I have to give him money. 4,500 he has to give me money. Net amount 25,500 I have to give him. So in the balance sheet you should find Thakur Lal. Can you see Thakur Lal? 30,000 minus 4,500, 25,500. And 30,000 is not my sale. So I'll remove that from the sale. Can you see 30,000 is removed from the sale and you have 6,50,000 and that commission is my income. Commission is my income. Can I see 4,500? Clear? 30,000 you have removed from sale, not my sale. And I have to pay him money. 4,500 my income. I did not get it. But income I put into P&L. But I did not get it. So receivable. So payable 30, receivable 4,500, net will take 25,500. Clear? Yes, that should be the situation. After that, we have only one thing. Okay, new machinery adjustment done, cash received done, goods withdrawn done, sales Thakur Lal also done. Only closing stock is there, 47,500. Closing stock will go to trading account 47,500 and it will also go into the balance sheet 47,500. Balance sheet 47,500. Clear? Now, if you see everything is done, all things are marked, you will get gross profit. Gross profit will go to P&L. Okay, from P&L everything is marked. You will get net profit. Net profit will go to balance sheet. When you add the net profit and subtract the drawings which we already discussed, okay, you will get the capital and other things in the balance sheet we already discussed. So balance sheet obviously has to tally. That should be it. We'll see if any other question is there on chapter number 2, final accounts and all. Yes. NPO. Demonstrate the features of non-profit organization, they said. 8B for 5 marks. See, features of non-profit organization. This organization governed by elected body, trustee. Obviously, it's NPO, so we'll have trustees. Its operation is not driven by profit motive. That's why it's called as non-profit organization. Main purpose of organization is to provide social service. That is one of the features. Main source of their income comes from donation and membership subscription because they're not selling any goods. They have to get donation only. The funds are utilized maximum for the benefit of the society. It is supposed to be utilized for the benefit of the society only. It's a non-profit organization. Membership process for this concern is a non-transferable. That means if I become member, I cannot transfer the membership to you. The method of accounting that is followed is entity concept. Entity concept. Obviously, we follow entity concept everywhere. That is it, guys. Okay, 5 marks, easy 5 marks they've given. That's all. Yes, let's go into the next model test paper. That is your December 2024 set 2. December 2024 set 2. You have your question number 4, which is NPO. Income and expenditure account of an association for the year ended 31st March 2022 is as under. Now they have given income and expenditure. That means we have to prepare the receipt and payment account. Okay, let's go further. You can see over here. Aforesaid income and expenditure account has been prepared after the following. Prepare receipt and payment account of the association and the balance sheet as at that date. Now, this is what they have asked. First, let's go into the solution. See, receipt and payment is there, balance sheet is there. They have prepared multiple ledgers also. Without ledger also we can do the calculation, but majorly I wanted this one, opening balance sheet. Because opening balance sheet is always required to prepare the opening capital fund. Okay, to get the opening capital fund. Now, let's begin over here. We have 4 adjustments for subscriptions, and then salary 2 adjustments, audit fees also there are some adjustments. Building owned by the association cost 1,90,000 since 2004 they are telling. We are in which year now? We are in 2022. So this building, straight away I can put it into opening balance sheet. It should go to opening balance sheet building 1,90,000. You can see in the opening balance sheet building is 1,90,000. In closing balance sheet also building is 1,90,000. No depreciation they have given for building. So building is 1,90,000. Clear? Closing balance sheet as well as opening balance sheet. Now after that we have equipments 31st of March 2022. That means last year. 31st of March 2022 means this year.
Okay, this year 52,000. That means this 52,000 should be found in our closing balance sheet. Sorry, where are we? Sorry, 31st of March 2022 means opening balance sheet. It should be there 52,000 in the opening balance sheet. Can you see 52,000? Yes. Then they are given some adjustment. They are told that at the end of the year, after depreciation, equipment amounted to 63,000. That means closing balance of equipment they gave. This should be there in the closing balance sheet. Equipment 63,000. But after depreciation of 7,000, they said. Now see, 52,000. Okay. 52,000. If you remove 7,000 depreciation, you will get 45,000. But the closing balance is 63,000. That means how did it increase to 63,000? 18,000 is purchase of equipment. If you purchase equipment in your receipt and payment account, it is payment. Correct? So you should find equipment. Can you see equipment 18,000? Payment. Okay, this is the working that we have to understand. Next. Depreciation 7,000 will go where? It will not go to receipt and payment account because it's a non-cash item. In income and expenditure account, 7,000 will be the depreciation. If you go to income and expenditure account, can you see 7,000 depreciation? But this will not go to receipt and payment account because it's a non-cash item. Clear? Next. After that, you have in 21-22, that is last year, association raised a bank loan of which is still not paid. That means this loan is there last year also. This loan will be there this year also. 30,000. Can you see in the closing balance sheet there is loan of 30,000, and in the opening balance sheet also there is a loan of 30,000. There is a loan of 30,000. Is this clear? Yes. Now, after that, there is cash in hand. This is at the end of the year, 28,500 closing. So 28,500 closing, you should put it to the closing balance sheet, and it will also be the closing balance of receipt and payment account. Receipt and payment is like a cash book. So can you see the closing balance of receipt and payment account by balance carried on 28,500, and it's there in the balance sheet also 28,500. Then they have told cash in hand and cash in hand last year. Can you see 13,600? Okay, 13,600 last year. So what will you do? In the receipt and payment account, it will be two balance brought down, and in the balance sheet, opening balance sheet, you will find 13,600. 13,600. Is it clear? Then they have told capital fund on 31st of March 2022, 2,20,600. So directly you'll go and put it to opening balance sheet 2,2600. It's given. That is one thing. And that should be the starting point of your closing balance sheet. Closing balance sheet 2,2600 is the starting point. Clear? To that you will add the surplus when we find the surplus. Now, apart from that, we discussed all these things in the additional information. Now, subscription and other things we will discuss as and when required. Clear? Now, two salaries. Salary is there. Salary should go to what? No. It should go. It is already there in P&L. P&L is income and expenditure account here. It should go to receipt and payment account. So it will be a payment. It will be a payment. But we have some information about salary. Salary outstanding is there. 1,20,000 was a salary. Correct? Outstanding of last year will be paid this year. So add 6,000. Outstanding of this year will be paid next year. So minus 8,000. So you will get 1,18,000. 1,18,000 will be your salary paid. So you will find this 1,18,000 in the payment side. Can you see 1,18,000? Yes. And you have to be a little careful. This salary outstanding of last year should be there in last year's balance sheet. And salary outstanding of this year should be there in this year's balance sheet. So 8,000 you will find in this year's balance sheet. Salary outstanding. Can you see creditors salary? 8,000. And 6,000 you should find in last year's balance sheet. 6,000. Is it clear? Next, after that, then printing and stationery. I think for printing and stationery there is no adjustment. Directly you will put it as payment 6,000. Then after that, telephone. For telephone also you don't have any adjustment. Directly you will put it into the payment side 1,500. Then after that you can see postage also no adjustment. Directly you will put 500. So be it with general expense also 12,000. Directly you will put into the payment side 12,000. Clear? Next one is audit or interest and bank charges. I think this one also does not have any adjustment. Directly 5,500. You can see interest here 5,500. Next you have audit fees, 2,500. That has adjustment. Can you see over here? 2,500. Audit fees paid during, audit fees for 2021 paid during 22-23. So they have paid some previous year's audit fees. So what will happen to previous year's audit fees if it is paid? Whichever years it is paid this year, no. So you will add the 2,000. You will add the 2,000 and audit fees for 22-23 is not paid. So you will minus the 2,500. What? 2,000. So 2,000 should be your audit fees in the payment side. Resident payment account. Can you see? Audit fees 2,000. And you have to be careful. This one, 2,000 will be there in opening balance sheet as outstanding audit fees. And this 2,500 should be there in the closing balance sheet as outstanding audit fees. See, in our closing balance sheet, you have outstanding audit fees 2,500 and opening balance sheet, you have outstanding audit fees 2,000. Then we go further. And annual dinner expenses. Directly we will put 25,000. Annual dinner expense 25,000. Done. All the payments are done. Clear. Now when we go into receipts. First one is subscription. Subscription is a very important adjustment. 1,70,000. Clear. Now understand this. Subscription outstanding as on 31st March 2022. Last year it was outstanding. That means this year it is received plus 16,000. Then subscription outstanding on 31st March 2023. That means subscription outstanding this year. That means minus 18,000. Not yet received. Then subscription received in advance 31st March 2022. Last year received in advance. That means last year already received. So minus 13,000. And subscription received in advance 31st March 2023. That means this year received in advance. Okay, but it is next year's, but still you will add it plus 8,400. 1,63,400. 1,63,400 you will find as subscription. Where is it? Over here. Yes, 1,63,400. Now you have to be careful about last year's outstanding 16,000 and this year's outstanding 18,000. It should be that outstanding is subscription is an income. So receivable. So you will find 16,000, 18,000 in this year's balance sheet and 16,000 you will find in last year's balance sheet. Clear. Then subscription received in advance 13,000 and 8,400. So received in advance of last year is a liability. You will find it in the last year's balance sheet received in advance and this year's balance sheet 8,400. Clear. Sorted. So can you see last year's balance sheet, all the items are matching? Yes. That is why they gave the capital fund already balancing figure. They only had given it in the question. Now after that, you have entrance fees. Entrance fees, if they don't tell you anything, what do you usually do with entrance fees? You should put it to capital fund. But can you see where is the entrance fee sitting? It is there in the income and expenditure account. For us what? We are preparing cash book. So 4,000 entrance fees received. Annual dinner contribution straight away received 36,000. Done. So our resident payment account is done. Closing balance was already given in the question itself. Otherwise we have to find the closing balance. And balance sheet, what you will do? The surplus which is there. Where are you getting the surplus from? No, income and expenditure account which is already there, 30,000. You will add it over here, 30,000. You will get the balance. Done, finished. This is it. Additional capital is there. We'll add. But this is this thing, NPO. Okay, so fifth one is partnership. Sixth, non-profit organization. Final accounts. We have one final accounts question over here. B. From the following particulars presented by Mr. Shankar for the year ended 31st March 2023, prepare P&L account after taking into consideration the given details. Gross profit 1 lakh. From this, they are asking you to prepare P&L. Gross profit 1 lakh. You know the gross profit will be the starting point. C. By gross profit brought down or by trading account 1 lakh. Then after that you have rent 22,000. Do you have any adjustment for rent here? Outstanding salary. Rent paid for 11 months. Rent paid for 11 months. 22,000. So 22,000 is the rent for 11 months. 22,000 divided by 11. That means 2,000 is the rent per month. Okay, that means 12 months rent will be 2,000 into 12 is equal to 24,000. So 24,000 should be the rent. 2,000 rent should be outstanding rent, but still it should be shown in P&L. So you will see rent over here 22,000 plus 2,000 outstanding 24,000. Next we are going into salary 1,10,000. They told that outstanding salary is 4,000. That also has to be added. So sorry, not 1,10,000, 10,000. So salary will add 10,000 plus 4,000. 14,000 will be the salary. Basic question they have asked. Now commission 12,000. Anything about commission adjustment? Commission received in advance amounted to 2,000. Commission received in advance. So 12,000 minus 2,000. So you will show commission of only 10,000. So you go to the credit side and you will write commission. Can you see 10,000 received in advance is next year. So you are not going to show in P&L. Next, after that, insurance is 8,000. Do we have any insurance adjustment? Yes, prepaid insurance. So 8,000 minus 2,000, 6,000 should be the insurance value. You can see the P&L. Can you see insurance 6,000? Yes. Next, after that, interest. Interest credit 6,000. Interest due but not yet received. Not received the amount. That means 6,000 due, not yet received, but still accrual concept. You have to add that 2,000. So you will get 8,000. Interest will be 8,000 in the P&L. Next, after that, bad debts 2,000. Okay, provision for bad debts 4,000. So bad debt is 2,000. Provision for bad debt is 4,000. So bad debt will not go to P&L because directly you will remove from provision itself. So from your provision 4,000, you will remove 2,000. You will be left with only 2,000 in the provision. Sundry debtors are 40,000. They don't come to our P&L. Okay, discount received 2,000. Discount received 2,000. That will do. Discount received 2,000. That is how much? 2,000 directly income. And then plant and machinery 10,000. So 80,000. So plant and machinery they told depreciate by 10%. So directly 8,000 depreciation you will find in the P&L. 8,000 is the depreciation. Clear? Next, after that, you have a situation further bad debt amounted to 2,000. So when the further bad debt happened, our provision became 0. Okay, and our debtors, we have done this in chapter number 1. Debtors were 40,000. When you remove the further bad debt, 38,000. And make a provision for bad debt at the rate of 5%. On this 5% you will create provision 1,900. So 1,900 should be there in the P&L. 1,900.
There's a new provision 1,900.
Where is it?
Right in the provision for bad debts and less new provision. You have given
Okay. What they have done is, this is wrong. Okay, don't do it like this. Net effect will get the same. They have put all the bad debt over here, and then they have put the provision reversal over here, 2,100. This 4,000 and 2,100 difference is what? 1,900. Directly you have to put provision over here itself. This is what is taught in chapter number 1. Now here they can't go and do ulta. Okay, so this 4,000 don't do like this. Just write 2 PDD 1,900. Here with their result also you are getting the same. 4,000 debit, 2,100 credit is 1,900 only debit. But don't do that. Write 2 PDD 1,900. You will get profit after that. You will go to capital. Done. 5-mark question was asked. That should be it. That is your set 2 of December 2024. We'll go into set 1 of December 2024. This is your set 1 of December 2024. Let's go into question number 4. X, a sole proprietor, furnishes you with the following bank summary for the year ended 31st March 2023. The bank summary is given. Okay, then from that, X informs you he had following assets and liabilities at the starting. 23, 22, they have given assets and liabilities. He also informs you that extra information. X asks you to show his capital account and prepare receipt and payment account for the year ended, trading and P&L account for the year ended, and balance sheet. So basically, this is incomplete records again. So receipt and payment account is nothing but cash book. He asked you to prepare his cash book. Clear? Now, one by one, let's begin. We'll go in the order of the question. Balance on 31st December 2022. That is his opening balance in his bank passbook. Okay, so if you go and check the receipt and payment account, that is there 11,000 bank. 2 balance brought down, 11,000 bank. Cash will not be there in the passbook. Cash we have to find out. Okay, 11,000 bank. Then after that, you can see over here, add deposits. Add deposits. So he has deposited some money, 1,25,000. Can you see for that? There is no entry at all. Why? So many things are there. Okay, this time first time they have given all the calculations. Okay, deposits are not required to be shown because for deposit the entry is bank account debited to cash account. Now in our cash book, receipt and payment account, contra entry it is, so you can ignore this. Okay, cash out of cash sales. So cash account debited to sales account. Cash account debited to sales account. Can you see 3,50,000 over here? Wait, is it 5 lakhs?
3 lakh.
3,50,000 cash out of cash sales. Collection from credit customers 36,000. But here you can see collection from, okay, there is an alignment issue.
3 lakh 50 and
See,
36
cash sales is this, okay,
collection.
and collection from customer is this 36,000. We'll see what that 3,50,000 will keep. 5 lakh we'll see what is that later. 36,000. Okay, cash sales and collection from customer. Income from personal investment. Income from personal investment is what? It is capital introduced. It is a personal item. So what will happen? It will go to balance sheet. Directly in the balance sheet, you have to add it. Okay. Yeah, see. The presentation has gone for a toss. Income from personal investment is written over here, but the amounts are not matching. Wait. What has happened? 36,000. Okay, see over here. They have given additional information. He uses 75% cash sale proceeds for making cash purchases, the remaining balance being deposited in bank. They are telling whenever they get cash, no, 75% they are using for making cash purchases, remaining only they deposited in bank. So that 5 lakh makes sense. Yeah, so over here 1 lakh 25,000 is there, no, deposits out of cash sale. This is the amount. 1,25,000. Alignment issue has happened over here also. See, add deposits. Under deposits, they have written 3 items. 1, 2, 3. So 1,25,000 is the amount. Okay. 3,50,000, yes. 1,25,000 is the amount. 1,25,000. See, 75% of the cash proceeds they are using. So 1,25,000 is 25%. How much is 100%? So that makes it 5 lakhs. 5 lakh is the cash sale actually. So that's why you can see over here receipt and payment account. You can see here 2 cash sales 5 lakh. Here there is no alignment issue. Actually in the question there is alignment issue. Okay, 5 lakhs. And then it's correct. Now it's correct. See, collection from customer 3,50,000. So cash account debited to customer account 3,50,000. Next, after that, collection from credit customer. Income from personal investment. Personal investment, cash account debited to income from personal investment, but personal investment should get added to capital itself. Now it's correct. Now you can see in the balance sheet 36,000 income from personal investment. Okay, 36,000 should be added. Maybe some other calculation is there. We will keep that pending. But 36,000 you are finding in the cash book. I'm just putting a star mark here. Yes, cash withdrawn from personal drawings 20,000. So you will find in the cash book. Okay, 20,000 receipt and payment account. You will find drawings 20,000 over here. Some more drawings you will find as we go further. 20,000 is there, and then one more. What we are seeing over here, shop expense 40,000. So you can see in the receipt and payment account, shop expenses. No, but shop expense is not drawings, no. Shop expense 40,000 is there over here. Payment for services 40,000. And that 40,000 should go into P&L account, shop expenses. P&L account also they have given all working note and all. They have not done one by one. Okay guys, we'll do one thing. It's an important question. I'll solve it. Forget about it. They made a complete mess out of everything. So we'll solve. We want what? Receipt and payment account, right? Yes, I'll do it. December 2024. You'll get totally confused if you look at their calculations. Somewhere one working note, then bringing total amount over here. I'll do it on my own. Then you can see. Set 1. Question number 4. First thing that we require is receipt and payment account. Receipt and payment account. Next thing, what did they ask us? Trading and P&L account, and then balance sheet. Next thing is our trading and P&L account. And then finally, balance sheet. As of 31st March 2023. Then from here onwards, everything will be our working notes. Okay, so we'll start. Let's just go through the question quickly once so that all alignments and all we can calculate. See, balance on 31st December 2022 is 11,000. Okay, deposits, add deposits, cash out of cash sales, and collection from credit customers, income from personal investment. Now, deduct cash withdrawn from personal drawings and shop expenses, checks issued to suppliers of goods, services, checks issued for personal purpose, and bank charges. Yeah, it is personal expenses. This is the balance, closing balance. X informs you that he had the following assets and liabilities in addition to the bank balance described on December 31st, the extract of which are as under. This is the assets and liabilities which they have given. With this, what we can do, we have to prepare even opening balance sheet because we'll need the capital, right? We don't know the capital. So as a working note, the first thing we have to do is opening balance sheet. Okay, opening balance sheet. Now opening balance sheet, whatever information we have to input it. Then he also informs you that he uses 75% of cash sale proceeds for making cash purchases, remaining balance being deposited to bank. This is an important point. Then he has allowed cash discount of 5,000 to his credit customers for prompt payment. He was allowed cash discount 7,000 for prompt payment. This is discount. We will discuss this. Collection from credit customers and payments to suppliers of goods are invariable by cross check. Okay, doesn't matter. They paid to check only, they are telling. Now we'll start from here one by one. Cash balance. Where should I put this opening cash balance? Receipt and payment account. I'll write to balance brought down. To balance brought down. Under that I will write cash 7,000. And also it will go to my opening balance sheet. Okay, on the asset side I'll write cash 7,000. Next, amount due from customer. Amount due from customer means nothing but debtors. Debtors, I will write debtors 37,000. 37,000, and obviously we have to prepare the debtors ledger also to find the sales. Debtors, I'll write to balance brought down 37,000. Next, unsold inventory at cost. Unsold inventory is what? Opening stock basically. Unsold inventory. So in opening balance sheet you will have stock. How much is the unsold inventory? 13,000. Then you will go to trading account and you will write two opening stock 13,000. Two opening stock 13,000. Then you have prepaid expenses. Prepaid expenses you will put into the opening balance sheet as asset side. Prepaid expense 3,000. And whenever you have to prepare your P&L, right, in that when you write expenses, last year's prepaid will be added. Whenever we do the expenses part, last year's prepaid will be added 3,000. Next, creditor for goods, creditor for services. So in the balance sheet, you will have creditor for goods. Opening balance sheet, you will have creditors for goods and creditors for services. How much is the creditor for goods? 23,000 and 2,500. These are the two things that we have done. So opening balance sheet items, everything we have covered. Correct? So now going into the remaining things. Closing balance sheet. Let's say cash balance. Where will this closing cash balance go? It will go to recipient payment account, and you will write over here by balance carried down. Under that cash, how much is that? 4,000. Next, and you will also put it to, don't forget, put it to closing balance sheet as cash 4,000. Everything you should do at once when you read. Amount due from customer, it will go to closing balance sheet as debtors 27,500, and go and put it to the debtors by balance carried down 27,500. Unsold inventory 10,000. Closing stock, go and put it to the balance sheet as stock 10,000, and then go and put it to your closing stock by closing stock 10,000. Next, prepaid expense. Remember in P&L we have to subtract the prepaid expense of 2,000, and in balance sheet we have to show it as asset, prepaid expense of 2,000. Next, after that we have creditors for goods, creditors for service. Both should go into the balance sheet. Creditors for goods 28,000. For services 1,500. Then after that, we can cover this point here itself. He had allowed cash discount of 5,000 to his credit customers. Allowed cash discount. So go to P&L and write to discount allowed. Discount allowed 5,000. And remember, in your debtors account you will write debtors account by discount allowed 5,000. And it is better to even make a ledger for creditors. Creditors we need, because purchase we have to find. By balance brought down, to balance carried down, and creditors information is given over here. Creditors for goods only you take 23,000 and 28,000. 23,000 is the opening balance and 28,000 is the closing balance. And what they have told over here, he was allowed cash discount. That means he got cash discount. For cash discount, what is the entry? Creditor account debited to discount received. Creditor account debited to discount received account. How much? 7,000. Now go and write over there in the P&L. By discount received in the P&L 7,000. By discount received in the P&L 7,000. So now what happens? This point is done. This point is pending. This point is done. Clear? Now let's go further. Here you have to understand he uses 75% of the sale proceeds of cash purchase, and remaining he will put it into into bank. Yeah.
So that is 25% is bringing to the bank and 70% is releasing.
70% is using for paying for cash purchases.
That is fine.
Yeah.
No.
No, that is 3 lakhs. So cash out of cash sale So now we'll start from here. Opening balance of bank is what? 11,000. So that opening balance of bank, we'll go to receipt and payment account opening balance as bank 11,000. And then what will you do? You'll put that 11,000 in the opening balance sheet also as bank 11,000. Then after that, add cash purchases. Sorry, cash sales. So you'll write bank account debited to sales account. 1,25,000 is 25%. How much is 100%?
5.
That is 5 lakhs. And what did they tell? They told that whatever is not deposited, he has used for cash purchases. So you'll write over here by purchases, purchase account debited to cash account, by purchases 5 lakhs into 75% of the cash purchase, cash sales, right? So it is 3 lakh 75,000. And remember, both of this should go into our P&L, a trading account. So you'll write two purchases
3 lakhs.
in bracket 3,75,000 and by sales in bracket 5 lakhs, because this is only cash sales. There is cash credit sales also. So then after that, go to the next one. Collection from credit customer 3,50,000. Collection from credit customer. What should be the entry for that? Bank account debited to debtors account 3,50,000. Then go and write that in the debtors as well by bank account 3,50,000. Next, income from personal investment. Income from personal investment. Income from personal investment means what? Bank account debited to capital account. Bank account debited to capital account 36,000. This has to be added to the capital account. In balance sheet, we will write capital. Okay, we don't know the opening balance, but plus personal investment 36,000. Then cash withdrawn from personal drawings. Personal drawings. What will happen now? Deduct cash withdrawn from personal drawings. So you'll write by drawings account in your trading and receipt and payment account. You'll write by drawings account 20,000 plus one more drawings is there over here. That is checks issued for personal purpose 55,000. So 20,000 plus 55,000, 75,000. This is basically he withdrew money for personal purpose and he gave check to somebody for personal purpose. Both are drawings only. So minus drawings 75,000 minus drawings 75,000. Next, after that, what do we have? Shop expenses. What is the entry for shop expenses? Receipt, shop expenses account debited to bank account. So we'll write over here by shop expenses 40,000, and this shop expense has to go to even P&L. So you will go and write two shop expenses 40,000 plus 3,000 last year's prepaid minus 2,000 this year's prepaid. So this becomes 41,000. 41,000. Then after that you have checks issued to supplier of goods. Checks issued to supplier of goods. What will you write? By creditor for goods. How much is the creditor for goods? How much did they pay? 3,50,000. Okay, go to creditors account and write. You have prepared the creditors account. So you'll write to bank account 3,50,000. Then after that, checks issued for supply of services. So you'll write by creditors for services. How much is that? 55,000. No, 40,000. Then we have bank charges. Bank charges account debited to bank account. So you'll write by bank charges 500 rupees, and bank charges should go to P&L also. So go and write two bank charges 500. Then you can see here closing balance 16,500. Where will you put this closing balance? In recipient payment account, you'll write by balance carried down 16,500. And where will you put this 16,500? To the closing balance sheet as bank 16,500. 16,500. Clear? Now, if you see opening balance sheet, you will get your opening capital 11,000 plus 7,000 plus 37,000 plus 13,000 plus 3,000, 71,000 minus 23,000 minus 2,500, 45,500 is the capital. Balancing figure. Now that capital you will put it to opening balance sheet 45,500 plus 36,000.
6,500.
Wait, we didn't find profit only. 45,500. No, wait, what profit are you finding? Wait, we didn't find sales here. Debtors account.
The credit is
Yeah, to sales account. Balancing figure. So that will be 3,50,000 plus 5,000 plus 27,500 minus 37,000. 3,45,500 will be your sales. 3,45,500. Go and put it in your trading account. 3,45,500 plus 5 lakhs will get 8,45,500. Then go into your purchases of goods. Creditors 7,000 plus 350 plus 28,000 minus 23,000. 3,62,000 will be your purchases. So we'll write over here by purchases balancing figure 3,62,000. We'll add it to trading account 3,62,000 plus 3,75,000. That makes it 7,37,000. 7,37,000. Clear? Then we have one more thing, that is services. There are creditors for services also. Creditors for services will be the one more ledger that you will have to prepare. Creditors for goods we prepared, now creditors for services. By balance brought down. Creditors for services 1,000, 2,500 is wait. This is 22, this is 23, right? So opening balance is actually 28,000 in creditors. Opening balance is 28,000. Closing balance is 23,000. See the column?
yeah.
Yeah. Opening balance is 28, closing balance is 23. 20, so 7,000 plus 23,000 plus 3,50,000 minus 28,000. So purchase is actually 3,52,000. First we'll change this. Plus 3,75,000. 7,27,000 is your purchase. And if you go to debtors, let's check debtors also. Debtors, what is the opening balance of debtors? 37,000. Closing balance of debtors is 27,000. Debtors is correct. Debtors is correctly done. Now creditors for service we have to do. 1,500 is the opening creditors for service. To balance carried down. 2,500 is the creditors for service, closing balance. And for services they have told checks issued. See, check issued for payment of services 40,000. So you will write over here to bank account, that is already there in the bank account 40,000. Now if you see 40,000 plus 2,500 minus 1,500, 41,000 will be your by extra services that is taken, services consumed 41,000. So now you'll go and put this 41,000 into trading account. To direct expenses or services 41,000. Clear? So with that we are done with the creditors what we opened, and the debtors what we opened, creditors for services, debtors, opening balance, we already got the opening capital. Now we have to close the receipt payment account. Receipt payment account, the closing balance of bank is given, no? You have tried that bank. What is the closing balance of bank? 16,500. So we wrote here in the trading and P&L account, balance current, 16,500. So now what happens? 7,000 plus 11,000 plus 5 lakhs plus 3 lakh 50 plus 36,000 minus 3 lakh 75,000 minus 75,000 minus 40 minus 3 lakh 50 minus 40 minus 500 minus 4,000, 19,500. But it's showing 16,500. So minus by, do we have any 3,000 rupees? Maybe it is purchases. Cash purchases we didn't know, no? 3,000 balancing figure. I'm just taking it as 3,000. Now purchases you will add another 3,000 plus 3,000, so that makes it 7 lakh 30,000. Now you can find your profits. 2 gross profit. 8 lakh 45,500 plus 10,000 minus 13,000 minus 730 minus how much? 71,500. By gross profit brought down 71,500 plus add the things minus 5,000 minus 500 minus 32,000 is your net profit. 2. Net profit carried forward to balance sheet. Add the 32,000 plus net profit. So you have 45,500 plus 36,000 minus 75,000. 38,500. 38,500 will be your closing capital plus 28,000 plus 1,500. And here we have 2,000 plus 4,000 plus 2,000. Yes, there is some small mistake here. The columns only were missed, correct? So cash balance 7,000 is closing balance, correct? So cash balance, this should be 7,000 closing balance, and that 7,000 should be cash in the closing balance sheet. And then amount from due from customer, this is the closing balance. So the debtor should show 37,000 in the closing balance sheet, and debtor's balance carried on should be 37,000 in the closing balance sheet. Then we have closing stock. Stock 13,000 should be there in the closing balance sheet. Stock should be 13,000. Where is it? Stock, yeah. Closing balance sheet should be 13,000 and it should go to trading account. And in trading account, closing stock should be 13,000. The columns got swapped. Prepaid expense should be 3,000. That is this year's prepaid. So this should be 3,000 minus, and this 2,000 should be plus. And in our prepaid expense, we should show 3,000. Then liability creditors for goods. Creditors for goods should be 23,000 in the balance sheet, closing balance sheet. And in our creditors account, it is correct, 23,000 only. And 2,500 should be creditors for services. That is correct, 2,500. Sorry, 2,500 should be creditors for services. And that is 2,500 only in the creditors ledger also. Then the opening balance sheet side. It all got swapped, right? Cash balance should be 4,000 opening balance. 4,000 cash is opening balance. This cash, and that 4,000 should be there in the opening balance sheet as cash. 4,000. Then 27,500 is debtors opening balance. Debtors opening balance 27,500 500, and that should be there in the opening balance sheet as debtors 27,500. And then we have unsold stock, that is closing stock, should be 10,000 in the opening balance sheet, and it should be 10,000 in the closing stock trading account. Prepaid expense 2,000 should be closing it is 13,000. Sorry. Opening stock should be 10,000, and then prepaid expenses 2,000. It should be 2,000 in the opening balance sheet, which is showing 3,000 because we swapped the columns. And prepaid expense. Here we have already added 2,000. Last year's prepaid added, this year's prepaid subtracted. Creditors 28,000. I think in the opening balance sheet is also wrong. We should take this as 28,000, and creditors opening balance is correct. And services 1,500, and services is correct. 1,500 only is the opening balance. Now we'll recalculate the opening capital. 11,000 plus 4,000 plus 27,500 plus 10,000 plus 2,000 minus 28,000 minus 1,500. 25,000 will be the capital. That will go here, 25,000. Many other things will change. Debtors will change because we have changed the balances. 27,500 plus 5,000 plus 3,50,000 plus 37,000 minus 27,500. What is the sales now? 3,64,500. 3,64,500. You will put it to trading account. 3,64,500. 8,64,500. This purchase won't be there, no? So creditors account, we have to check what is the purchases. That is correct. 7,000 plus 350 plus 23 minus 28. 3,52,000. That's correct. 3,52,000. Yes. And services, if you check creditors, it is 1,500. No, 40,000 plus 2,500 minus 1,000. 41,000. That's correct. 41,000. Now we have to check the receipt and payment account. I think now we should not have the difference. The difference 3,000 which we had. 4,000 plus 11,000 plus 5 lakhs plus 350 plus 36,000 minus 3,75,000 minus 75,000 minus 40 minus 3,50 minus 40 minus 500 minus 16,500 minus 7,000. Is it telling now? Guys, just have a look at this. 37,000 expense. Randomly they have taken this as balancing figure. Balancing figure 37,000 expense. If 37,000 expense you are taking it as this thing, balancing figure, then why did you give in the question that the shop expense is 40,000 and payment to supplier is 40,000? That is why we are getting 3,000 difference in the receipt and payment account. You can see here 3,000 difference we were getting, right? Because randomly this 40, one of these 40,000s which are there, the 40,000s, they have just taken it as balancing figure 37,000. We should not get difference, no 3,000. So they just took it as 37,000. If you take 37,000, it will tally. Are you getting this? So randomly they have taken it as 37,000. Shop expense or payment to supplier, one of them. Okay, this 37,000. Okay, I'm stopping it here only. Okay, there's no point continuing. Okay, so randomly they have just taken this as 37,000 balancing figure. That's why we're getting 3,000 difference over there. Okay, 3,000 difference. So shop expense 40,000, or this 40,000 you can take it as 37,000. Creditors for services. What a mess. Okay, I hope you understood most of the concepts. Okay, which are supposed to be taken. I hope in the exam they don't ask a question like this. If they ask also, I hope the balancing figure makes sense. Okay, so let's go into the next one, guys. We have wasted a lot of time on this. Next. There is one, no? Fifth.
No, for the December 24 set 1, that is
December 24, 8th one, huh? NPO. On 31st March 2023, a club had a subscription in arrears of 28,000 and advance of 4,000. That is 31st March 2023. During the year ended 31st March 2024, the club received a subscription of 2,08,000, of which 12,500 was related to 24-25. On 31st March 2023, there were 5 members who had not paid the subscription for 24,000 for 2024 at 1,600 per person. Prepare the subscription account, they asked, for 23-24. Subscription account. Now, on 31st March 2023, club had subscription in arrears. That means last year receivable, this year it will be received 28,000. You can see the subscription account 28,000. Balance arrears. Okay. Next. And in advance of 4,000 in advance, liability, opening balance of liability, credit balance. Next, during the year ended 31st March 2024, club received subscription of 2,08,000, of which 12,500 was related to 2024-25. That means next year. Next year, 2,08,000 they have received, so 2,08,000, and this will be the balance carried on, which will go to next year, 12,500. And then they said on 31st March, there were 5 members who had not paid the subscription of 2024. That will be the balance carried on of subscription receivable. So 1,600 into 5, 8,000. Whatever balancing figure is there, that is your subscription for the year, which will go to income and expenditure account, which they asked for 5 months. Yes, I hope you got it. This is your opening balance of your receivable. This is your opening balance of received in advance. This is the received amount. This is the received amount. Bank account debited to subscription account. And this is the closing balance of received in advance, which is going to next year. And this is the closing balance of receivable, which will go to next year. So this is asset, this is liability. Liability carried down and asset carried down to next year. This is the payment which we received. And balancing figure, whatever is there, it will go to income and expenditure. That is the income for the year. Yes, that should be it in that one. Let's go further. What happened? Okay, guys, let's go further to June 2025 syllabus. June 2025 syllabus, June 2025 mock test paper. That is set 2. Set 2, they have asked one nice small 14-mark question this time. Okay, let's go to the end and check what they have asked actually. Calculate profit earned during the year ended 31st March 2024. So to calculate profit, we should compare 2 years balance sheet. So first we'll check the opening balances. Opening balance, cash at bank. We'll go to opening balance sheet. Opening balance sheet 20,000. Then sundry debtors asset 17,000. Stock asset 40,000. Furniture 29,000. Then creditors 32,000. Can you see creditors here 32,000? Yes. 10% loan from Sashi. So that will also be here 30,000. Okay. With that, you will get the opening balance. You will get the opening balance sheets balance. Clear? Now, then after that, P&L and all they are prepared. Okay. Now, after that, you can see closing balances. Cash at bank 21,000. Okay. Sundry debtors 25,000, 60,000, and 29,000 furniture. Then you have creditors 22,000 and loan from Shashi 30,000. That time you will get the closing balance. So the opening and closing based on the existing figures we got. Now Shashi withdrew 5,000 from his business every month for meeting household expenses. So now 44,000 was there, correct? Opening balance was 44,000. He withdrew 5,000 per month every month. So minus drawings 5,000 into 12. That means 60,000 he has withdrawn. Okay. Then during the year, she sold investments held by her privately for 35,000 and invested the amount into business. Private investment she sold and she invested into business. That means it is additional capital of 35,000 she put into business. And at the end of the year 23-24, it was found that full year's interest on loan from Mrs. Shashi had not been paid. Full year's interest on loan is not paid. 10% loan, no 30,000. So what will happen? Interest on loan will get added. So plus interest on loan 3,000. Next, Depreciation 10% per annum was to be provided on furniture for the full year. Depreciation has to be provided. So now that means furniture will not be 29,000. It has to be what? Full year 29,000. So 29,000. Okay, let's not worry about that right now. See, they have prepared closing balance sheets. 29,000 minus 2,900. Okay, I don't know why that first calculation was done if you are preparing closing balance sheet anyways. Okay, we'll keep that. Depreciation will not bother us. Shop assistant was to be given a share of 5% of the profits ascertained before charging such share. I think we saw one of these questions. Before charging commission. So now it becomes 44,000 minus 60 plus 35 plus 3, 22,000. 22,000 is showing over here. 22,000. Now, if you see over here, all these balances, okay, all these opening balances, cash and bank, same thing. In the closing balance sheet, 21,000. Debtors, 25,000. That will also go to the closing balance sheet. Stock also 60,000 is there in the closing balance sheet. Only thing that changes is furniture will change because furniture from 29,000 is becoming 26,100. Okay, then loan from Shashi is same, 30,000. Interest on loan is 3,000 and creditors 22,000. Now if you check, right? Okay, now if you check, just see they have prepared P and L and all unnecessarily. 21,000 plus 25,000 plus 60,000 plus 26,100 minus 30,000 minus 3,000 minus 22,000. How much are you getting? 77,100. How much did you get? Oh wait, this interest on loan, we have kept it added separate, right? 1 second. 21,000 plus 25,000 plus 60,000 plus 2,600 minus 30,000 minus 22,000. Are you getting 80,100? These circle numbers. Closing capital should be, closing capital is 80,100 minus 22,000. So 58,100 should be our profit. Okay, can you see 58,100 profit over here?
So they have taken 5800 in last so last they have taken 5500.
Yeah, that's because commission is there. No? There is commission of 5%. So 5800 is the profit. See, this is how we have calculated. Okay, this is the opening capital which we found out. Okay, minus the drawings plus the additional capital plus the interest on loan. 22,000 should be there. Okay, then the other things in the closing balance sheet, other things, cash at bank, debtors, stock, all from the question. Furniture after depreciation, 2,600. Then creditors. Ignore all this calculation. Creditors and loan from Shashi. If you remove all these things, okay, that time you will get 80,100. If you see the difference between these two numbers, it is 5,800. 5,800 is actually your profit. 5,800 is the profit, but this is the profit before commission. So on that 5 divided by 105 into 5 divided by 105, you will get, it's before, huh? 5%, 5%, 5% on before charging. Okay, so 58,500 directly into 5%, you will get 2,925 or 905. 59, yeah, 2,000, 55,195. This is the profit. Okay, this statement of P&L is not required because they wrote statement of P&L, but in the statement of P&L, what is put is opening capital, further capital, closing capital, drawings in P&L. Are you getting this? You can't have that in P&L, so that you don't go to do. What we did in an earlier question, earlier in our videos, we did in one of the earlier questions, calculate opening capital, calculate closing capital, find the difference. When you find the difference, you will get the profit. Profit is 58,100 and directly do 5 divided by 100 because they said before charging. So that time we will get the 2,905 as the commission. Okay, 58,100 minus 2,905 if you do 55,195 you should get. Okay, just bear with the presentations that they have done. Follow one single presentation and go to the exam. Okay, we'll see if we have one more in this paper. NPO. Again, subscription. Okay, club had subscription in arrears of 28,000. Arrears, that means asset balance brought down. Subscription in advance, that means liability balance brought down. During the year ended, club received a subscription of 2,08,000, of which 12,500 was related to previous year. I think same question, previous, we saw the same question, right? 1,600 per person, everything. Same question, copy paste. It was there in the previous December 24, set 1. Same as December 24. Yes, that should be it. Okay, you should get the answers, guys. Okay, so we have still June 25 set 1 and then December 2 sets. Yes, let's go into the next model test paper. Model test paper, June 2025 set 1, that is. There is a final accounts question for 14 marks as always. So Mr. Arvind has a small business enterprise. Yeah, we'll go into this question June 2025, 5. Yes, 31st March 2024, they have given us the trial balance. Always when you get a trial balance like this, you always look at the adjustments. Okay, have a look at the adjustments because then you will get a better picture of how to solve. First, stock as on 31st March 2024 was valued at 60,000. This is closing stock. So what will be the treatment for closing stock? 1, trading account, you're going to put it to trading account. And then you'll show it in the balance sheet as asset. Write off further 6,000 as bad debt. Further bad debt. That means already some bad debt will be there in the trial balance. Extra bad debt. So this one you will show it in the P&L. Okay. And also you will subtract it from debtors. You will subtract it from debtors. Now this P&L is contingent. We don't know. We have to look whether there is PDD in the question. If there is PDD, it will get subtracted from PDD only. Otherwise, it will go directly to P&L. And maintain a provision of 5% for doubtful debts. These are the adjustments which you see in chapter 1 usually. We'll have to do a working for that. Goods costing 10,000 were sent on approval basis to a customer for 12,000 on 30th March 2024. This was recorded as actual sales. Now, on 30th March they sent it. This is recorded as actual sales. 31st March our year only is closing. That means they have not accepted, not rejected till today. If they have not accepted, so we'll have to reverse it from sales and add it to closing stock. Reverse from sales and just add it to closing stock. Then 2,400 paid as rent for office was debited to landlord's account that was included in debtors. So this point, fourth point, will also impact the second point where you're calculating provision for doubtful debts. So what has happened over here? 2,400 rent for office debited to landlord's account and was included in debtors. So now actually for this, the entry should have been rent account debited to bank account. Now here they have passed the entry landlord account debited to bank account because they have debited landlord account. Now landlord is sitting in the debtors. So now when you rectify this, you will pass the entry rent account debited to landlord. When you do this to landlord situation, this will reduce your debtors, and the reduced debtors later on that you have to create provision for doubtful debts. Are you getting this? So this rectification will modify the debtors, and after that you have to create provision for doubtful debt. Landlord is basically a person, right? Person, when it is debited personal account, he'll go and sit in the debtors account. Yes. General manager is to be given a commission of 10% on net profit after charging commission. This will be the last adjustment in the P&L. Once your P&L is done after charging commission. So remember, this will be basically 10 divided by 110. If it was before charging, it would have been 10 divided by 100. Works manager is to be given a commission of 12% of net profit before charging general manager's commission and his own. So before general manager's commission, work manager is going to get a commission, and this will be 12 divided by 100 and not 12 divided by 112, because they said before charging general manager's commission and his own commission. Okay, so before charging commission, both the adjustments they have tested in one question itself. Okay, so that should be prepare final accounts, Mr. Arvind Kumar, and also balance sheet. Now, you know what the adjustments are. So when you see the trial balance item, you should be able to recollect what are the connected items. Okay, first we start with Arvind Kumar's capital, 1 lakh. Okay, directly go to closing balance sheet and write the opening balance. Okay, 1 lakh. Starting point is 1 lakh. Then after that, machinery 36,000. They have not spoken anything about machinery. Did they tell depreciate machinery by 10%, 15%, anything? Nothing. So directly machinery should go to balance sheet. See, in the balance sheet you have machinery of 36,000. Done. Next, depreciation on machinery. It's sitting in the trial balance. Because it is sitting in the trial balance, entry is already passed. You don't have to reduce it again from the machinery. Directly put it to P&L. In P&L you should find depreciation on machinery 4,000. Next, after that you have repairs to machinery. There was no adjustment for this. This also direct fill in the blanks. 5,200 into P&L. Next, see, half of the final accounts question, right, will be fill in the blanks. Not even half. 80% will be fill in the blanks. Take from trial balance, put it into the right place. 20% will make you like test your concepts. Wages 54,000. No adjustment, no outstanding, nothing. Directly into trading account. 54,000 wages. Next, after that you have salaries. No adjustment, no outstanding, nothing. Directly into P&L. 21,000 salaries. Next, income tax of Mr. Arvind Kumar. That is drawings. In sole proprietor, income tax will be taken as drawings. Go to balance sheet and subtract it. See, minus drawings, income tax 1,000. Done. Next, after that you have cash in hand. Directly balance sheet. Okay, it should be shown on the asset side. Cash, cash, cash. Yes, here it is. 4,000. Next, after that you have land and building. Again, no adjustments were there outside. So direct fill in the blanks. 1,49,000 land and building. Next line only there is depreciation. Again, depreciation when it is in the trial balance, it is to be directly shown. Now, just a testing question. What if this was sitting this side? Instead of on the debit side, it's on the credit side. Now what would happen? What would happen? It is provision for depreciation. If it's on the credit side, it's provision for depreciation. And if it's provision for depreciation, directly you will take it to balance sheet and from the asset you will subtract it. Clear? Yes. So 5,000 depreciation you should find it. Okay, it's straight away. Then after that you have purchases. Did you have any adjustment related to purchases? Nothing. No rectification, nothing was there related to purchase. Purchase will go directly and here only you can see purchase return is there, which will get subtracted in the trading account. 250 minus 3, 247. Done. Next, after that sales 498. Okay, I don't see any sales. No, sales written. Yeah, approval is there, but there is no sales written sitting here. So sales 498. From that sales on approval basis should be there. See 498 minus 12,000. But be very careful. See this 12,000. 10,000 is the cost. So from sales you will remove 12,000. To stock you will add 10,000. Clear? So can you see minus 12,000 and can you see here only 10,000 is added to the finished goods. Okay, so this is your adjustment for that. See, then you have next CC bank. See, bank is correct, very good, but just don't see bank and directly go and put its credit balance there. Credit balance means it is OD. OD will go directly into balance sheet liability side. Liability side, CC. Yes, C, OD. They didn't use the word OD. If they would have used the word OD, right, it would have triggered it in your mind that it's a liability. They just told bank and they put it on the credit side. Yes. After that, you have next thing, that is accrued income. Accrued income is what? Asset. If it was given outside the trial balance, what I would do? I would add it to income and then show in the balance sheet. So directly will show in the balance sheet as asset 3,000 accrued income. Last item here. Next. Let's go further, guys. Salary outstanding. Now, why didn't we add it to salary? Because already it's there in the trial balance. Directly in the balance sheet liability side, you'll show it. Salary outstanding. Outstanding salary 4,000. Yes. Next, you have bills receivable. Asset, no adjustments. Directly in the balance sheet, 30,000. You will show bills receivable. Done. 30,000. Next, see, 90% we have finished the trial balance, right? It was just fill in the blanks. So, and provision for doubtful debt. Now you know that bad debt, further bad debt, you have to be careful when provision for doubtful debt. So all debtor related items, I'll do it at once. I'll keep it pending. Okay, next. After that, you have bills payable. This doesn't have any adjustment. Directly in the balance sheet, 16,000 you will show as liability. Then after that, you have bad debt. We'll keep bad debt also pending. Then discount on purchases. Discount on purchases, discount received. So you'll go to P&L 7080, you'll show discount received. Then after that, debtors, that I'll keep it pending. Creditors 62,520. 62,520, what will you do? Directly into balance sheet, no adjustment, nothing. 62,520. Then the last item there is opening stock. Okay, opening stock, nothing. Directly put it to trading account. That is your opening stock, finished. Clear? This much we have finished. Is that right? Now, the major adjustment is debtors. Now, see the debtor over here, 70,000. But from this 70,000, there were a couple of things that we have to worry about. One, this one, further bad debt will get subtracted. One more, the landlord amount which is there, how much is that rent amount? 2,400 will get subtracted. Clear? So, 2,400 will get subtracted. Okay. And then that 2,400 paid as rent for office was debited to landlord's account. That should be shown as rent. Now, if you see this, debtors, our question debtor is how much? 70,000. So, if you see the situation here, sundry debtors, they have started with 70,000. Clear? And goods on approval. Goods sent on approval. Can you see 12,000 subtracted? Correct? Because you reverse the sale, obviously the debtors will get reversed. The sale entry is what? Debtor account debited to sale account. Now sale you remove, debtor also you have to remove. Then bad debts. Which bad debt is this? 6,000. Which bad debt is this? There was a bad debt in the trial balance. Do you remember? See, the bad debt in the trial balance was 2,000. This was not subtracted because this is already in the trial balance. The further bad debt is 6,000. This is subtracted. So further bad debt you are going to subtract 6,000. Then that rent of landlord is also subtracted 2,400. After this is just creating provision now. Now this rent will have an alternative effect. Can you see? You should show that rent in the P&L as rent. It was not shown as rent. It was shown as landlord. So it is sitting in the debtor. Now you remove from debtor. Now you have to show that rent as rent in the P&L. So done. Now finally what you have to do? The bad debt which is there in the trial balance, that should come to P&L. 2,000 bad debt. Further bad debt which is there outside, it should come to P&L also. It should be subtracted also. Subtracted, it is done. 6,000. Now provision. It's just basically whatever net figure you have over here. 70,000. 49,600. On that 5%, is it 2,480? Yes. 49,600 into 5%. 2,480. And entry for provision for bad debts is P&L account debited to provision for bad debts, not debtors. P&L account debited to provision for bad debt. Provision for bad debt is actually a liability, but for better presentation, we bring it to the asset side and we are subtracting it from the asset. 2,480 is subtracted here and it should be there in the P&L also, 2,480. Clear? Then what they have done? They have done this adjustment with the existing provision only. So now you can show it in a better way. You have a provision, right? Existing provision, 10,000 is there. In the trial balance, there was some bad debt. So that went from the provision. Now the provision is 8,000. Then after that, further bad debt was there. That also went. Now in your provision, there is only 2,000. Correct? You just calculated that you require a provision of 2,480. You have 2,000 already. So 480 you are going to create. 480 you are going to create. Differential you will create. Clear? Then after that, I think if you look, everything is done. Closing stock. See, bad debt adjustment done. Goods costing done. Then 2,400 situation done. Only the manager's commission, though 2 commissions are there. And this closing stock you have to take. This 60,000 will go to trading account, 60,000. That 70,000 which is total, that will go to balance sheet, 70,000 done. Okay, everything is sorted. Now commission payable is nothing but the worksman commission and the other commission which we have to calculate. Now whatever you do see, trading account, everything we have discussed. This is your gross profit. Gross profit will come to P&L. This is your gross profit which will continue. Now if you just check, no, they have not shown the calculation. Just use your calculator. 181,000 plus 7080 minus 21,000 minus 5,200 minus 4,000 minus 5,000 minus 2,400 minus 480. Are you getting 1,50,000 round figure? 1,50,000 round figure. Now You have to check first which manager will be paid. First works manager will be paid because they said works manager is before general manager and before his own commission. So 1,50,000 into direct 12%. So this will be 1,50,000 into 12%, 18,000. Can you see this 18,000 here? Now after giving him that 18,000, you will be left with only 1,32,000. And general manager is going to be given 10%, but 10% after charging. So into 10 divided by 110, are you getting 12,000? Now both these commissions are payable. It is not paid. It is payable. So both of them are liability. It should be shown as commission payable in the balance sheet, 30,000. Done. After that, you'll just get a balancing figure, 120. This 120 will go to capital also and get the balance of capital. Done. That's it. It should tally. Finished. This was asked for 14 marks. Okay, they've shown the calculation also of commission. No problem. We'll see at the end if there is anything. One more question asked. NPO. The very regular subscription question of NPO. Okay. The City Club of, first of all, let's go to the end and see what they are asking. Calculate the amount of subscription that will appear in the income and expenditure account for the year ended 31st March 2024. Now, City Sports Club of Surat had received 50,000 towards subscription. What did they get? 50,000. Can you see 50,000 over here? Is there in the book? How? Oh, it's illustration questions only. It's not all, but because some of them were mostly. So basically, they're not putting any extra effort. Very good. Yes. Guys, yesterday only I was talking to your law faculty. Okay, and he was telling that whatever is there in model test papers and last 5 exams, if you see, so many questions, word by word, they are repeating. Huh? Values also, yeah. So just ensure that you just look at all those questions. Yes, 50,000 is the subscription value. Subscription for 22-23 unpaid on 1/4/2023, 5,000. Subscription unpaid. When is it? 22-23. Last year unpaid. That means it is last year's subscription. So minus 5,000 will be subtracted. Can you see over here? We are going from receipt and payment to income and expenditure account. When we are going from receipt and payment to income and expenditure account, just remember one thing. Whatever is related to this year, we will take it. Whatever is related to some other year, we'll ignore it. Clear? Now, subscription paid in advance. 31st paid in advance. Which year's subscription you paid? Next year's minus again 1,250. Wait. Sorry. My bad. The date is 31st of March 2023. Last year paid in advance. That means it is this year's subscription. Add 1,250. And the same on 31st of March 2023 is 1,000. That means this year we paid in advance. This year we paid advance for next year. Minus 1,000. And then finally subscription for 23-24 not paid. Not paid, but still they are this year's subscription only 2,250. Add. Done. This they are asking for. Only 5 marks. Done. That should be it, guys. This is your model test paper done, dusted, finished. Let's go into December 2025. This will solve in class. Okay, this model test paper will solve in class. Question number 4A. Yeah, they have done it into 2 parts, right? 4A, 4B. It will be like a practice for us. December 2025. Question number 4A. 7 marks. Which set is this? First one? Set 2. This also is there in the study material. You think so? Yes. So let's begin. Yeah, 4A. The following information were obtained from the books of Chennai Club on 31st March 2025. At the end of the first year of the club, you are required to prepare receipt and payment for the year ended 31st March 2025. What are you supposed to prepare? Receipt and payment. Straight away keep receipt and payment open. Correct? Receipt and payment account you need for the year ended 31/3/25. Now, next. Donations received for building room. 1 lakh. Donations received. Still receipt and payment, right? We received it. So what we are going to do? Leave the first line because we need to put the opening balance. So we'll just write 2 donations. 1 lakh. Next, after that, you have other revenue receipts. Entrance fees you received. All the things are given, actual payments and all that. Donation to the, let's go to the end. Donation to the extent of 12,500 were utilized for purchase of library books. No problem. Utilization we'll see later. Balance was still unutilized. No problem. For us, only receipt and payment account. We are not going to prepare anything else. In order to keep it safe, 9% government bonds of 80,000 were purchased. No problem. We'll do the purchase later. Remaining amount was put into bank account under the term deposit. Okay. Now, first, we'll start with this. Revenue receipts, entrance fees. What should be the entry? You got entrance fees, correct? Bank account debited to entrance fees 8,500. Next, subscription. Did they tell you anything about subscription receivable, subscription received in advance and all? Nothing. They told you actual receipt only. They didn't tell you the actual amount. They told you actual receipt. So directly you'll write to subscription 9,500. Then locker rent, to locker rent 300. Then you have sundry income, so to sundry income 530. Next, refreshment account, to refreshment 8,000. Next, other actual payments also they have given. Land cost 5,000. So what will you write? Land account debited to bank account. So buy land 5,000. Next, furniture costs 73,000. Cost 73,000. But actual payment 65,000. If I prepared balance sheet, my land will show 73,000 and on the liability side I'll show liability for land 8,000. But doesn't matter, I'm preparing receipt and payment account. So you'll write over here buy furniture 65,000. What I paid, that's all I'm going to record. Then salary 2,400. By salaries 2,400. Next, maintenance for playground. By maintenance 500. Next, rent 4,000. By rent 4,000. Refreshment account. By refreshment 4,000. Done, finished till here. Donations to the extent of 12,500 were utilized for purchase of library books. So what will you do? You already passed the entry, bank account debited to donation. Now what entry will you pass? Library book account debited to bank. So you'll write over here buy library book 12,000. How much was it? 12,500. Next, you have balance was still unutilized. In order to keep it safe, 9% government bonds of 80,000 were purchased on 31st of March 2025. Because it's on 31st of March, obviously this year you're not going to get any interest on this. So you'll write buy government bonds 80,000 and the balance amount was put into term deposit. So when you're writing buy balance carried down, under that you're going to write deposit of 7,500. How did we get the 7,500? 92,500 is the total amount. 1 lakh is the total donation which we received. 7,500 is sitting in deposits. Okay, next, that's it. Have they given you anywhere the opening balance? You are required to prepare at the end of the first year. No information about opening balance is there, right? That's all. Use your calculator, find the closing balance. 1 lakh plus 8,500 plus 9,500 plus 300. How much? 54. What are you talking? Are you sure? $54,070, but it's two balance brought down. Closing balance, nothing is there. Okay, if you check now, you'll get a negative figure in your calculator. So that means it is two balance. Opening balance is a balancing figure. Are you getting it? Now, there is a conflict here. They have not given any information. So either you can take it as two balance brought down, or you can write it as to balance carried down. 54,070. It's up to. Opening will be 0. We don't know. So they didn't give us information, right? So you are going to assume that opening we had money and that we spent and we have only 7,500 now. Or opening we didn't have money, we spend more. So we are sitting with an OD balance right now. Anything can be done because of lack of information. This or this. Clear? And just give a note to tell that this is the situation. Assume that it is opening balance or assume that it is closing OD balance. If you are assuming it is opening balance, it is normal balance. If you are assuming it is closing balance, it is OD balance. Clear? Yes. 4B. Yeah, if you have not written, quickly write it. Done. Yes, let's go into 4B, guys. 4B, they have asked incomplete records for 7 marks. Calculate profit received by Rahul during the year ended. Prepare statement of affairs on 31st March 2024 and 31st March 2025. If they don't tell also, we have to prepare. How else will you calculate profit? You will have to prepare for both the years anyways. Okay, so they have given 31st March 2024, 31st March 2025. So 4B. Statement of affairs as on 31st of March 2024. Statement of affairs as on 31st of March 2025. Okay, just for our understanding, let's look at the things that are given outside. Rahul decided to provide depreciation 2.5%, furniture 10%. Mr. Rahul purchased jewelry of 12,000 for his daughter in December 2024. He sold his car on 31st March 2025 and the amount of 20,000 is retained in the business. Very good. Now, first we'll look at the opening balances. Now, just for understanding, right? So, I'm not going to do in detail. Furniture, building, both are assets only, 75,000. Okay, fixed assets, I'm just writing. Fixed assets, 75,000. Next, stock. Stock is 50,000. Next, you have sundry debtors. Debtors 30,000. Next, you have cash in hand, cash at bank. Cash and bank 35,600. I'm just totaling both of them. Liabilities, you have loan 45,000 and you have a creditor 25,000. Whatever extra information is given, it's given everything related to this particular year only. So just use your calculator, total, this is, you're going to get your capital, balancing figure. And whatever capital you get, that will be used for us to calculate profit later. 1,20,000. 1,20,600. Next, after that, what we are going to do next? Stock. Why did they not give you information about furniture and building and all? Because they said furniture depreciation at the rate of 10%. So what will I do? Directly I'll write furniture 20 to 500. Remove 10%. Then after that, the next thing is building 2.5%. So building, I think 48,750. 2.5%. 48,750. After that, what do we have? We have stock. This and all we have to write. Stock 1,25,000. Debtors 55,000. Cash 6,600. Bank 37,500. Then we move into liabilities. Loan 35,000. Creditors 40,000. Done. And outside they had given us information about Rahul purchased 12,000 jewelry for his daughter, that is drawings basically, and he sold his car and put the money into business. That is additional capital. Let's ignore that for now. Find the balancing figure first. Cap 165. This is your capital. 165,350. Now what will you do? Start with your opening capital. Your opening capital was 120,600. 120,600 plus additional capital. Additional capital was 20,000 minus drawings was 12,000. Drawings was 12,000. Okay. Then you should get a figure 128. Yes, 128,600. This is the value. But what is the actual closing capital? 165,350. That means 36. This is your profit. Done. Is this there in the material? Huh? Not there. One model test paper of this thing, chapter 3. Then we'll go to chapter 4. Yeah, that should be it with that. And then we'll go into the last model test paper, which is there. 2, 3, 4. Final accounts. Damn silly. 7. Oh, again they have started this pattern of giving 7 marks. 7 marks, 7 marks, 7 marks. What did they ask you to prepare? From the following 12 months, prepare trading account and P&L account. Only trading account and P&L account, no balance sheet asked. Okay, so directly we'll do only trading account and P&L account. This is what? Set 2. Set 1. Set 1 now. Set 1, December 2025. 4A. Okay, whenever the strategy in these kind of questions is keeping trading and P&L open. If at all balance sheet is asked, balance sheet also open. Okay, you have to read the question once and finish it off. So, this is your trading and P&L. Okay, next. First, we'll see all the adjustments. Closing stock, 92,000. So, you can directly write by closing stock. 92,000 in the trading account. Then wages and salary outstanding. Okay. When you go to wages and salary, remember it. Depreciate plant and furniture. Okay. Remember that. Depreciate value of land and building. Depreciated value of land and building has come to 5,85,000. So this will help us to calculate the depreciation later. Provision for doubtful debts as on this date, that is 31st of March 2025, was 6,000. Okay. We'll start now. Drawings. Ignore. You're not preparing anything, right? Plant. Ignore plant, but you have to calculate depreciation. Depreciation, what did they tell for plant? 15%. So we'll write 2 depreciation. 50,000 into 15%. 4,500. It's not 50,000? Oh, sorry, my bad. 3 lakh. 3 lakh and 15% is 45%. Yes, 45,000. Depreciation, 1 depreciation. Then other one, debtors. Debtors will keep it pending. We'll do it at the end. Returns. What return is this? If it is there on the debit side, what return it is? It is sales return. So now, whenever you write sales, you'll write by sales. It will always be sales less return. So here only I'm writing minus 20,000. Okay, discount. It is discount allowed. So you'll write 2 discount 10,000. Then commission, it is commission expense. So you'll write 2 commission 16,000. Interest on bank loan. Okay, now this side there is bank loan. Wait, this side there is bank loan 9 lakh. Are you sure it's 9 lakh 60? I think there is some alignment issue, right? This. Yeah, this is 4 lakh 40,000. So 4 lakh 40,000 into 10% is 44,000. So it's correct. If it is not correct, then there would have been outstanding. If it was this side, if you would have seen a number called 40,000, then 4,000 you only have to add. So directly you will write 44,000 now. To interest, 44,000. Then furniture. Okay, we don't need furniture, but we need depreciation. Depreciation on furniture is again 15%. So depreciation. How much is furniture value? 68,000.
15%, 10,200.
10,000. 200. Next, wages. Wages you can't write directly. You'll write here 2 wages. 96,000. There is outstanding wages, which we saw in adjustments. How much is the outstanding wages?
10,000.
10,000 for wages. At 10,000. 1 lakh. 6,000. Next, after that you have salaries. Again, outstanding is there. 8,000. So you'll write 2 salaries. 1,28,000. Next, advertisement 54,000. No adjustments and all. So to write 2 advertisement 54,000. Next, purchases. Now, purchases 4,80,000. I'm just going and writing 2 purchases 4,80,000 and writing it in the bracket and leaving. Later when I find returns, I'll minus it. Next, then stock 31st of March 2024. That means it is last year, right? So you'll go and write 1 line left for that only to opening stock. How much is the opening stock? 1 lakh. Next, you have carriage inward. Carriage inward will go to trading account. It's a direct expense. So you'll write 2 carriage. How much is that? 24,000. Next, land and building. Land and building also had depreciation. They said depreciated value 585. Here it's showing 6 lakhs. That means how much is the depreciation? 15,000. So directly to depreciation on land and building 15,000. Next, after that you have cash and bank, not required. It's a balance sheet item. Capital, not required. Creditors, not required. Returns. What return is this? Purchase return, right? Minus 24,000. 4,56,000. Next, discount. This is discount received, right? By discount 8,000. It's on the credit side, so it is discount received. Provision for doubtful debts, will keep that pending. Bank loan doesn't matter to us. Sorry, this is not bank loan. This is sales. Sales is 9,60,000. So 9,60,000 right over there. 9,40,000. Then we have only item that is provision for doubtful debts. Provision for doubtful debts 24,000. And this side what we had? Debtors 1,80,000. And outside they said that provision for doubtful debts as on this date, that is 6,000. So from 24,000, if it has come down to 6,000, that means what? It is bad debt. But are you going to put it to P&L? Are you going to put it to P&L? Are you getting this? See. Opening balance of provision for bad debts is 24,000. Closing balance of provision for bad debt is 6,000. That means provision has reduced by 18,000. This 18,000 reduction is because of what? Bad debt. Now, if it is because of bad debt, that bad debt should have been there in the trial balance. It is not there in the trial balance. Because it is not there in the trial balance, what does it mean? Either you're taking it as further bad debt. If you're taking it as further bad debt, you will pass the entry bad debt account debited 18,000 to debtors 18,000. And then you will pass the entry PDD debited 18,000 to bad debt 18,000. But outside the trial balance, they had already given the PDD balance is 6,000 outside the trial balance. That means it is further bad debt. Or the alternative assumption that you can take is PDD has reduced. You're like, we don't need PDD. If you treat it like we don't need PDD, it's a reversal of PDD, and reversal of PDD will be PDD account debited 18,000 to P&L 18,000. Are you getting this? We have no idea about whether there is bad debt or not. So either you're going to take it as further bad debt. Further bad debt will not impact P&L at all. If you're taking it like this, okay, PDD reversal, that means we don't require this much PDD. So you're removing the PDD. So PDD creation, what is the entry? P&L account debited to PDD. Now you're reversing PDD. What should be the entry? PDD account debited to P&L. Clear? That also can be an alternative assumption. This can also be done, or this can be done. If you do this, it will have no impact on your P&L. If you do this, you will have to put 18,000 to the credit of the P&L. Are you getting this? Okay, there is no, what is say, proper clarity in the question, right? They just told provision for bad debt on this date, 6,000. How did it reduce? We don't know. It is not because of bad debt already recorded. If it is because of bad debt already recorded, that bad debt should be there in the trial balance. Now, debtor is there in the trial balance. Clear? It doesn't matter. If it is outside the trial balance bad debt, that is further bad debt, it will not impact the P&L at all. But if it is just reducing the provision, then you will put that 18,000. Okay, right now I am ignoring that 18,000 in the P&L. Okay, if at all you are taking it, then it will be shown as 18,000 over here. You will write by PDD 18,000. Okay. Yes, this is it. I'm not even calculating. Okay, these are the items. Gross profit you will calculate. That is balancing figure. Bring it down here by gross profit brought down. You calculated 346. Huh? Okay, net profit. $31,800. This is your trading and P&L. Yeah, done. That's it. Let's go into the next one, guys. Calculations are correct, no? Yes. Next, incomplete records again. They've asked for what? 7 marks. And what did they ask you? From the given information, calculate total sales and total purchases. So for that, one you will have to prepare 4B. One you will have to prepare debtors account. One more you will have to prepare creditors account. Without looking at the question, this much we know. Maybe we'll have to prepare bills receivable account and bills payable account also. We don't know. Next, we start with debtors as on 1st April, opening balance. So you'll go to debtors and write to balance brought down 80,000. Then creditors opening balance. You'll go to creditors and write by balance brought down 91,000. Then you will go and write bills receivable received during the year. See, now you are forced to open a bills receivable account. Bills receivable received during the year. So I am going to open a bills receivable account. Okay, tell me what should be the entry for bills receivable received during the year? Bills receivable account debited to debtors account. How much is that? 47,000. Go to bills receivable. Go to debtors and write by bills receivable 47,000. Next, bills payable issued during the year. So it's going to be one more ledger requirement. Bills payable account you will have to open. And the entry for this is creditor account debited to bills payable account. What is the amount? 53,000. So in bills payable you will write by creditor 53,000. Then you have cash received from customer. Cash received from customer, what entry are you going to write? Cash account debited to debtors. So by cash, how much is that? 1 lakh? Next, cash paid to suppliers. So you're going to write suppliers, that is creditor. Creditor account debited to cash. How much is that?
1,72,000.
Next, bad debts recovered. Ignore. Completely ignore. Bad debts recovered entries, cash account debited to bad debts recovered account. It will not impact any of our 4 ledgers. Bills receivable endorsed to creditors. Endorsed to creditors, what should be the entry? Creditor account debited to bills receivable account. So creditor account debited to bills receivable. What is the amount?
27,000.
27,000. Go to your bills receivable and write by 27,000. Next, bills receivable dishonored by customer. What should be the entry? Debtor account debited to bills receivable account 5,000. And here by debtors 5,000. Next, going to the other side, we have discount allowed by supplier. So what should be the entry? Creditor account debited to
discount received account 7,000. After that you have discount allowed to customer. That means discount allowed account debited to debtors. So by discount allowed, how much is that? 9,000. Next, endorsed bills receivable dishonored. Endorsed bills receivable dishonored, the entry will be debtor account debited to no bills, creditors. Debtor account debited to creditor account 3,000 by debtor 3,000. Already bill went, no? When you have endorsed the bill, bill is already out of your books. So now, next. Sales return. What should be the entry? Sales return account debited to debtors. So we'll write by sales return 11,000. Next. Bills receivable discounted 8,000. Okay. They have not given the discounting charges and all. So I'm assuming 8,000 only. So bills receivable discounted. What should be the entry? Cash account debited to bills receivable. So by cash, directly I'm writing 8,000. You know there will be also discounting charges. For that you would have written by discounting charges also the amount, whatever it is. Okay, next. Discounted bills receivable dishonored. So what will be the entry? Discounted bills receivable. Debtor account debited to no cash. Debtors account debited to cash account 2,000. Guys, whenever bill is dishonored always debtor is debited. Debtor is debited. If the bill was with you, 2 bills receivable. If the bill was discounted, 2 bank or cash. If the bill was endorsed, 2 creditor. So debit is constant. Credit keeps changing because of the situation. Okay, next. Cash sales. What should be the entry? No entry for us in these ledgers. But we are supposed to find total sales, right? So total sales. Cash sales we already know. It is 1,68,500. And credit sales we will find. And then cash purchases. So we need total purchases 1,97,800. We'll find the credit purchases that and we will add it over here. Next we have debtors closing balance 82,000. Go to debtors ledger and write by balance carried down 82,000. And then they have given the creditors closing balance 95,000. Go to creditors account and write to balance carried down 95,000. Done, that's it. So now what will you do? Moral, always before closing debtors account, always close bills receivable account. Bills receivable, we don't know opening balance. We know that new bill was received 47,000 and this is creditor dishonored and this is something else dishonored again. Okay, and then this 8,000 is received. So what are you going to do? By balance carried down. All dishonors are told, right? So this will be the balance carried down 47,000. Now what about bills payable? Only one item is there. Bills payable. Either you are going to assume that this is paid or you are going to assume that it will be paid in future. Whatever you assume, it doesn't matter to us because it's not going to impact my creditor account or debtor account. Okay, so you are going to just write balance carried down. Done. Now debtor you close. 2 sales. What 2,15,000? 2 lakh? 2 sales, right? 2,15,000. So this is the sales amount. So 2,15,000 plus 168. 3,83,500 is your total sales, and this is what they asked. Now go and do the same thing in creditors account also. We need the purchases. By purchases, find the balancing figure. $2,60,000 is your purchase. So go and add that 2,60,000. Done. This is your purchase. Finished. Okay. This also they have asked for. This is not there in the material. That means the recent exam model test paper, nothing is there in the material.
Okay. So with that, we are done with the chapter 3. Done with chapter 3, we'll go into the next chapter, partnership. Okay. Let's start with the small, sweet and simple topic called as partnership. Okay. Nothing is there in this. Simple. 3 people will join together, start a business. Somebody will knock the door and want to enter, admission. Somebody want to get out, retirement. Somebody what to do, God, okay, God's role play. He has taken somebody away, death. Then after that, we close the partnership firm, dissolution, 2 partnership firms joining together, amalgamation, 1 partnership firm converting into company. That also can happen. Clear? Yes. Now, what is partnership? 2 or more persons join together for conducting business with an intention to earn profits. Clear? Now, when we're talking about partnership, this is what we were talking. Basics we need to know. Absolutely. Okay. Basics are very, very important. Basics means I'm talking even about goodwill. Because if you miss goodwill calculation, right, it will impact this everywhere. It will become a huge chain reaction. So basics, then admission, retirement, death, dissolution, amalgamation, sale or conversion into company. Okay. Now we'll start with basics. Oh, you're only there in this example. Ram and Anu. Okay. Partnership agreement, partnership deed. Can you tell me what is the difference between partnership agreement and partnership deed? Both are rules only, but this agreement, when it is registered, getting the partnership agreement registered, it becomes partnership deed. Okay, just so that it gets more legal validity. Clear? Now, if not mentioned in the partnership deed, there are certain things that you have to remember. Okay, 1, profit sharing ratio is equal. No salary or remuneration to partners. No interest on capital. No interest on drawings. Interest on loan, maximum 6%. Interest on loan of only partners it is. Now there is one more thing that you have to understand. If there is inadequate profit, that means the profit is not sufficient. Now what will you do? Whatever profit is available, you will distribute it to partners, but you will distribute it to partners in capital ratio. It will not be in profit sharing ratio, it will be in capital ratio. Correct? That is one thing. And one more thing that you have to remember is, imagine you have to give interest on capital. To give interest on capital, you don't have enough funds. This interest on capital also will be distributed in capital ratio. Clear? Yes. Now, what is the difference between drawings and capital withdrawn? Drawings means money taken by the partner in anticipation of profit. They're like, okay, future profit will be there at the end of the year, but I can't wait till end of the year. I have my monthly expenses. So what I will do, I will take the profit today. That is amount related to the firm taken in anticipation of profit. What is capital withdrawn? I have put money, that money only I am going to take out. That is amount introduced is withdrawn by partners. Clear? Now, on drawings, there is always going to be interest on drawings that is going to be charged. If it is going to be charged for the firm, it is a income, and for the partner, it is a expense. Clear? On capital withdrawn, there is no interest. There cannot be interest also. My own money, I am taking it out. There is no interest going to be charged on that. Now, interest on capital. Interest on capital, simple. Take the capital into interest rate into months divided by 12. Now, if you have lack of information in the question, always whatever opening capital is there in the question, right, on that you apply the interest rate and calculate. Done, finished. Okay, because closing capital will be after all the adjustments that you have done. So opening capital, whatever is there in the question, take that and multiply the interest rate and give the interest. Now imagine there is a capital of 2 lakhs and 1 lakh. Interest on capital is 10%. What will you do? Capital introduced on 1/7, 50,000. Capital withdrawn on 1/1, 30,000. So when you're calculating interest, this 2 lakhs, full 12 by 12 interest you will give. And the capital which is introduced on 1/7, if I'm following financial year, that means 9 more months are there in this year. So 9 by 12, this will be the interest. And here if capital is withdrawn, that means I should not give interest for 3 months. So no interest for 3 months, minus. This will be your interest on capital. For the other person, directly you will calculate, okay, interest. Interest on drawings. Okay, interest on drawings, let's say 10%. Pawan and Divya, 2 partners are there. Okay, drawings. 1/6, they have taken 20,000. 1/2, they have taken 15,000. This is first scenario. First scenario is what? There is drawings. There is no particular pattern. There is no pattern. Different dates, different amounts. Clear? So what will you do? 1/6 means 10 divided by 12. That means only April, May done. 10 months are remaining. Okay, into 10 divided by 12. 1/2 means only February, March, 2 divided by 12, and this will give you the interest. This is scenario number 1, that is different dates, different amounts. Clear? Now, what if the drawings is 1000 per month on first? So same amount at the starting of the month. So what will you do? Take the total drawings, that is 1000 into 12, 12,000 into rate into 6.5 divided by 12. You can derive and do every month calculation, but why? 6.5 divided by 12. This is if the drawings is same amount every month. If you miss even 1 month, you can't do this. You can't use this formula. Okay, 6.5 divided by 12. What if the drawings is on 15? That means it is at the middle of the month. Then what you will do? Same formula into 6 divided by 12. If it is at the end of each month, same formula, it will be 5.5 divided by 12. Now this is the situation we saw. Situation number 1. Drawings on different dates, different amount. Individually you have to calculate, no other option. Then situation number 2. Drawing same amount every month at the starting. 6.5 divided by 12. Now the mistake you can do is, when you are calculating, not 1000 into 10% into whatever fraction. 1000 into 12. Total drawings. Total drawings into whatever rate into 6.5 divided by 12. If it's at the middle of the month, then 6 divided by 12. If it is at the end of the month, 5.5 divided by 12. Now these are 4 scenarios. Now the fifth scenario is, there is no date given. They just tell total drawings. Total drawings. See, total drawings 6,000. They just tell this. Now it's a natural assumption that drawings are evenly drawn during the year. That means you have to do 6 by 12. Just because they gave total drawings, I cannot do 6,000 into 10%. If I do 6,000 into 10%, I'll get 600. It means that he has taken the full 6,000 on the first day of the year. If he takes first day of the year only, full year's interest will be applicable. So if I directly do into 10% and get 600, that means I'm assuming that he has taken the money at the beginning of the year. Clear? If they tell you total drawings, you have to naturally assume and you have to do 6 by 12. Clear? Now, goodwill. Okay, what is goodwill? It is the reputation of the business. Correct? Let's say what are the factors that are affecting goodwill. What is the example? Yes, factors affecting goodwill. Now there is a college. Let's assume there is a college and there are 2 people who are selling that heart-shaped balloon. Okay, you know this one person was there, heart-shaped balloon he was selling. First factor that is affecting goodwill is the location. Now imagine this fellow is selling heart-shaped balloon next to the college. One more person is selling heart-shaped balloon somewhere far away. Now obviously same balloon, same price, everything same effect. But this fellow will obviously get more sales. He's right next to the college. Now imagine this fellow also comes next to the college now. Okay, now because he has come next to the college, what happens now? It got neutralized. That locational advantage got neutralized. Now next thing is customer satisfaction. This fellow, whenever people give him money, okay, he is giving the heart-shaped balloon with a smile. The other person, he is always grumpy. 20 rupees, if someone gives a note and asks for change also, no, he's grumpy. So now what happens? Obviously this fellow will have the sale. So now this fellow also started smiling. Both started smiling. So that also got neutralized. Now the next thing is reputation of owner. Now imagine Akash, okay, he just gets Joe Biden. Now Joe Biden has no reputation. Okay, I think when we took this batch, Joe Biden was still the president. That's why Joe Biden is there in this example. Now where is Joe Biden? Maybe he's, I don't know, where and all he fell, we don't know. Okay, so Joe Biden is having some reputation. So now let's assume Joe Biden we brought. Just because we know that Biden is one of the owner, automatically the customer will go to this person. Now sometimes we go to some hotels and all, just because it is run by some celebrity. Correct? Just because food might be normal only, ordinary only. Okay, so now this fellow also gets Trump. Now what happens? It got neutralized. So the reputation of owner is not there. Next, technological advantage. Now imagine this fellow got some technology. Okay, he gives the balloon. As soon as he gives balloon to the girl, right, that releases some chemical gas. Because of that, you know, the girl starts feeling good in her head. And then she tells yes to this person. just because of the balloon. Okay, technological advantage. Because of that, can you see? This will also be a goodwill. Okay, factor affecting goodwill. Okay, so these are some factors that are affecting goodwill. Excuse me. Yeah, factor affecting goodwill means goodwill is a reputation. Now, when this admission, retirement, that this and all happens, right? We need to know the reputation what is earned by the existing partners. So that new partner coming in has to bring money. If a partner is going out, we have to pay money. All this will happen. Now, computation of goodwill. In goodwill, no, there are two parts. One, find the amount. Second, the found amount, what is there? Do the accounting. Okay. Some questions, they might directly give the goodwill amount. Now, finding the goodwill, first thing you have to understand is simple average method, simple average profit method. What will you do? Goodwill is equal to average profit into number of years of purchase. What is this number of years of purchase? That means how many more years you are expecting the reputation, existing reputation to continue. Clear? So average profit, what will you do? Total profit divided by number of years. Now, if you take this example, 80, 60 and 110 was the profit. You just take the total of that divided by 3 and then you will multiply into number of years of purchase 5. You will get the goodwill. This is simple average profit method. You can also have weighted average profit method. Same question, if I am doing weighted average profit method, I will assign weights. So that time the weighted average profit will be total product divided by total weights. Product is nothing but profit into weight will give you the product. Now when you're doing this, 1, 2, 3 is assigned. Let's say instead of 60, 80 and 110, it's increasing, right? Instead of 60, 80 and 110, I write 110, 60 and 80. Now what happens? Will the weightage be 1, 2, 3 only? Yes, it will be 1, 2, 3 only. It will not be 3, 2, 1. The weightage is not assigned because of profit is increasing or profit is decreasing. Weightage is assigned highest weightage for the most recent year. Which is the most recent year? 2024. So 1, 2, 3. Highest weightage for the most recent year. That means the logic behind weighted average profit method is what happened in the most recent year, the chances of that repeating is high. You studied yesterday. The chances of you studying today is high. Okay. You studied 5 days back. After that you didn't study. The chances of you studying today is low. Are you getting my point? The recent year performance, the chance of that repeating is higher. That's why highest weightage is given for the most recent year. So then what you will do? Multiply, multiply, multiply. You will get the total product, total weightage. You will get the weighted average profit. Once you get the weighted average profit, you will multiply into number of years of purchase. You will get the goodwill. Clear? Next, highest weightage for most recent year. Next one is super profit method. Super profit method is more logical than simple average and weighted average. Super profit method tells us goodwill is equal to super profit into number of years of purchase. What is a super profit? Now imagine you're doing business. You're having business. You are having reputation. Right in front of your business, I will start the same business. Okay. It doesn't mean I will make zero profit. It doesn't mean that means it doesn't mean that whatever profit you were earning, it was just because of your reputation. Clear? So now you're having business. 10 lakh is your capital. You're getting 5 lakh as profit. I will put 10 lakh as capital. Will I also get 5 lakh as profit? No. Let me say I will get at least 1 lakh as profit. So that means the extra 4 lakh that you are earning with the same capital, that is called as super profit. That is called as super profit. How many more years you are expecting that super profit to continue? That is goodwill. So super profit into number of years of purchase. Super profit is average profit. That is what you are earning minus normal profit. Normal profit is what you are supposed to earn. So now what happens? Capital employed into NRR. NRR also will be given in the question. Capital employed is also given in the question. Multiply. This is the normal profit. Are you earning more? If you are earning more than the normal profit, that means it is your super profit. Super profit into number of years of purchase will give you your goodwill. Now see the profits over here. 60, 80, 110. Same. Okay. This is your capital employed. 60, 80, 110. Now what will you do? If you see this, okay, sorry, this is not a capital employed. This is your profit. Okay, you just have to take your profit. Take the average. You will get the average profit. Okay, normal profit. Capital is 5 lakh into that 10%. 50,000 is your normal profit. So now average profit already we had calculated 83,333. So minus normal profit, that means 33,333 is your super profit. Into 5, you will get your goodwill. Clear? Next is annuity method. What is annuity method? Now you're like, sir, you're getting super profit, right? Super profit I'm getting after 1 year, after second year, after third year, after fourth year, after fifth year. That means all the super profits I'm going to get in the future. And I am doing the calculation today. So take the present value of all these super profits. Super profit 33, 33, 33, 33, 33, all in the future. Take present value factor at the rate of 10%. 10% is because it's given in the question. It can be 12, 15, anything. Okay, multiply into the present value factors, you'll get the goodwill. How to get this? 1 divided by 1.1. Press is equal to, you'll get the answer. Okay, then multiply, you'll get the answer. The meaning of this present value factor is 1 rupee that you're going to get after 1 year. What is the value of that 1 rupee today? It's only 90 paise. 1 rupee which you're getting after second year, at the end of 2 years. 2 years later, you'll get 1 rupee. Value of that is only 82 paise. That means the value of money keeps depreciating every year. That is why we are calculating present value. Can you see in the previous question, we got goodwill as 166,665. Now you're getting goodwill, same numbers, you're getting goodwill of 126,332. Because now what you did, you took present value of that goodwill which you're going to get in future. That means the 166,665, which you'll get over a period of 5 years, the value of that 166 is only 126 today. This is your annuity method. They can ask you that also. Capitalization method. Capitalization method, goodwill is equal to normal value of business minus actual capital employed. Actual capital employed, we already know, it's given in the question. Okay, normal value of business, it's basically the reverse situation of super profit. In super profit, what I did, I told you put 10 lakhs and you're getting this profit. I put 10 lakh, I'm getting only this much profit. That means extra profit that you're getting is because of your reputation. That is super profit method. Capitalization method is you're getting that profit. I am getting this profit. So for getting that profit, how much capital you should have? This much. But do you have that much capital? No. By having lesser capital also, you are still getting the same profit what you are supposed to get. Difference in the capital is called as goodwill. Clear? Now see over here. Normal value of business minus actual capital employed. Average profit divided by NRR into 100. We had our average profit already 83,333. So we are telling normally the rate of return in the market is 10%. So 10% if I am getting and 10% is 83,333. That means what is 100%? What should have been the capital? It should have been 8,33,330. But do you have 8,33,330? No, you have invested only 5 lakh. By putting 5 lakh, you are getting the return of 8,33,000. That means 3,33,330 is your goodwill. This is the logic behind capitalization method. Is it clear? Done. Now, goodwill share to be given by. This is like a golden rule for goodwill. Don't think that it is admission. Don't think that it is retirement. Don't think it is death. Nothing. In admission, naturally we'll feel that, oh, new partner will give us. Not necessary. Sometimes one of the old partner also has to give. So goodwill always will be to be given by gaining partner to sacrificing partner. It will always be given by whom? Gaining partner to sacrificing partner. And we will use only one ratio. We don't know what is gain ratio only. Only sacrificing ratio we'll use. Old ratio minus new ratio. Because if you switch and if you have two ratios with you, I think in the material you will have gain ratio also, you will have sacrificing ratio also. Now the problem is, now you don't know where to use which one. Where I should use gain ratio, where I should use sacrificing ratio. So eliminate everything. You have only one ratio, that is old profit sharing ratio minus new profit sharing ratio. In this, if you get a positive result, that means it is sacrificing because you are calculating sacrificing ratio only. If you get a negative result, that means it is gain. Simple. So if you get a positive result, that means that partner is sacrificing. If you get a negative result, that means that partner is gaining. So the gaining partner has to give the money to sacrificing partner. Is it clear? Next example. There are two partners with a ratio of 2:1. Okay, partners, 3 partners are there now. New partner Ram got admitted 4:3:2. So now what will you do? How will you calculate old ratio? Old ratio is 2:1. So 2/3, 1/3, 0. Because new partner was not even there that time. New ratio is 4:3:2. So 4/9, 3/9, 2/9. I hope you know how to calculate over here. What you have to do, you have to take LCM. Let's assume in the exam pressure, you are not able to understand what is LCM. You forgot. What is LCM itself, you forgot. Okay, people forget roll number. What is there in forgetting LCM? Correct? You forgot what is LCM. So now what you do, simple. I tell you simple. If you forget LCM, multiply these two numbers. take 27 and calculate. If you don't know LCM, right, just multiply these two numbers. Doesn't matter if it is not lowest common multiple. Just take it. Later when you get the ratio, simplify it, you'll get the answer. Are you getting this? If you're not able to, now 3 and 9, obviously you know it's 9. Okay. If you're not able to identify, just multiply the two numbers, write 27 over here. Based on 27, you calculate everything. Later you'll get a higher ratio. Simplify it, you'll get the same number. Clear? Now see, 3 and 9, 9 is the LCM. So what you'll do? 3 3s are 9. So 2 3s are 6. 9 1s are 9. 4 1s are 4. So 6 minus 4, you'll get 2 by 9. Okay, here it became 3 3s are 9. 1 3s are 3. 9 1s are 9. 3 1s are 3. So 3 minus 3, 0. 0 means what? No sacrifice, no gain. So new partner was 0. 0 minus 2 by 9 has to be minus 2 by 9. Can you see minus 2 by 9? That means this partner is gaining. This partner is sacrificing. Obviously, if somebody is sacrificing, equivalently, somebody has to gain. That is one thing. If you don't get the sacrifice and gain to match, right, that means you have done some numerical error. Okay, if 3 people are there, one fellow is sacrificing. That means 2 have to gain. 2 people are sacrificing. 1 has to gain. All 3 cannot sacrifice. Is it clear? Yes. So now, who is sacrificing over here? Pawan. Who is gaining over here? Ram. So gaining partner has to give, I told. So gaining partner's capital account debited. Because gaining partner is giving to sacrificing partner's capital account. Gaining partner's capital account debited to sacrificing partner's capital account. Clear? Now, next we move into admission of partner. This goodwill distribution rule will be same. Admission, retirement, death, wherever we are. Clear? Now, admission of a partner, there are certain things that you have to understand. One is NPSR, new profit sharing ratio. Either it will be given in the question. If it's not given in the question, we have to compute. Okay, they'll tell this much share is taken from this partner. Okay, that means other partner we are not touching at all. So we'll take directly from this partner itself. So if they don't give, we have to calculate NPSR. Now, next is sacrificing ratio. That is old profit sharing ratio minus new profit sharing ratio. Clear? Next, goodwill computation. Goodwill computation we already learned. Some or the other method we have to use and find the goodwill. Okay, then we have to do revaluation of assets and liabilities. This is the main important thing. Now, revaluation of asset and liability means what? Either asset will increase or asset will decrease. Why? Why? Why are we doing revaluation? Why are we doing revaluation? Online students, why are we doing revaluation? Why? Sorry? I didn't hear. Just repeat what you told. Blindly did no? Revaluation? Revaluation. Okay, here we will put here, you will put here, over done. We got profit, we'll put to partners capital. Loss, this side we will put. See, revaluation, understand this. A and B other. 2 partners. They have done business from some time. In their balance sheet, let's assume there is one land. Okay, land is showing 1 lakh in their balance sheet. Okay, 1 lakh in the balance sheet. Okay, now land is 1 lakh in the balance sheet. It's at cost. Land doesn't depreciate. So it will be at cost only. Value in the market is 1 crore. Value in the market is 1 crore. Somebody is knocking the door. Admission. Correct, we are waiting. Now let's say we admitted that person. In the balance sheet, what is the land value? 1 lakh. In the balance sheet, what is the land value? 1 lakh. Now that person came. Next day we fight and we dissolve. When we dissolve, we'll close everything. We'll sell the assets. When we sell, what we will get? 1 crore. When we sell, what we will get? 1 crore. In the land, in the books, what was it? 1 lakh. How much profit we made? 99 lakhs. How much profit we made? 99 lakhs. This 99 lakh profit will be shared between A, B, C. Even new partner just came yesterday, got the share. But when did this land value go from 1 lakh to 1 crore? When new partner was not even there. Are you getting it? So, new partner is waiting at the door. Old partners will not even open the door. First, they will increase this land value. Now, when they increase this land value from 1 lakh to 99 lakhs, 99 lakh profit. Okay, this 99 lakh profit will go to whom? Old partners in old profit sharing ratio. It already went and sat in the capital account now. Now, what is the new balance sheet? Showing 1 crore as the land. If he comes in and fights that moment only and we dissolve, what happens? When we sell, we'll get 1 crore only. Done. No profit, no loss. Already the profit is distributed between old partners only. Clear? If at all, after 1 month we fight and we sell it at 1 crore 5 lakhs. Now 5 lakhs profit even new partner will get. He should get no. When he came, it was 1 crore. It went to 1 crore 5 lakhs after he came. Are you getting this? This is one thing. If the asset value, if it is favorable, no, we will not even open the door. Now imagine it's unfavorable. My plant and machinery is sitting at 80,000 in the balance sheet. But I know in the market it's only 30,000. Now I don't want to reduce it. If I reduce it, I only have to bear the loss. I will open the door and tell come. All will share the loss. But that fellow will not be ready to enter only, no. Are you getting it? It's not a one-sided thing. If it's increase, I will not change. I will not let him because I want to change and bear the, get the profit. If it's decrease, if it's a loss, he will not agree, no. He will also do his calculation. No, why is it showing 80,000? Tomorrow only if you sell, it will become 50,000 loss. That 50,000 loss will fall on my head also. Are you getting it? So revaluation is to show the real value of assets and liabilities, or basically the previously increased values or decreased values. That means previous profits, previous loss, whatever is there, that has to be enjoyed by the old partners only, or it has to be borne by the old partners only. That is why we are doing revaluation. Now, asset increases. Asset increases means asset should be debited. Asset account debited to revaluation account. Asset decreases. That means asset should be credited. Modern approach. So, revaluation account debited to asset account. Liability increases. Liability should increase. So, liability account credited, revaluation account debited. Liability decreases. Liability debited to revaluation account. This, if you are thinking of modern approach and doing, this is the situation. Okay, otherwise you just think logic. Asset increases, good for us, profit, credited. Asset decreases, bad for us, loss, debited. Liability increases, bad for us, loss, debited. Liability decreases, good for us, profit, credited. Now the profit or loss, whichever is there, it should go to old partners. In what ratio? Old profit sharing ratio. Profit will be credited to partners capital account. They should get money. Loss will be debited to partners capital account. They have to give money. Clear with this? Now, sometimes in the question, no, they will only tell you directly, prepare memorandum revaluation account. Okay. Or they will tell full 5 points they will give about revaluation. 6th point they will tell after admission, the assets and liabilities are to be shown at old values. Then why did you tell me to do revaluation? Are you getting my point? 5 points. Depreciated, increased, decreased, everything they will tell. After that, they'll tell, after admission, assets and liabilities are to be taken at their book value in their books. So that means what? First, you will do the revaluation. Old partners will share the profit or loss. Then in the memorandum revaluation, you will reverse the revaluation. Then the profit or loss. Now, first when you did the revaluation, either if it is profit. Okay, next time when you do reversing of revaluation, it should be loss. If it is loss, it will be borne by all partners. Clear? Now you are like, why new partner is also agreeing for this? New partner agreed because they want to show the book value for income tax purpose or for bank purpose, for any other legal purpose. They want to show their old values only. So first it will increase, profit will be shared by all partners. Then if it is decreasing, loss will be shared by, profit will be shared by old partners. And when it is decreasing, loss will be shared by all partners. Is it clear? Now, memorandum revaluation account, when after admission of partners agree to show the assets and liabilities at original values. That means value before revaluation. First, what will you do? Revalue assets and liabilities. Share the profit or loss between old partners in old profit sharing ratio. Then reverse the assets and liabilities. That profit or loss share among all partners. All partners means including new partner in new profit sharing ratio. Is it clear? So if at all there is a situation like this, maybe in your revaluation you'll have little work. But when you go to balance sheet, right, it's full maja. In balance sheet, what you'll do? You look at the question, copy paste, done. Copy paste, because it increased, decreased, everything reversed, right? You'll take the same values and put it into the balance sheet. Capital obviously will change. Okay, now reserves. What is reserves? In the past, they made profit and they preserved that profit. Now we don't want new person to come in and enjoy that profit. So the reserves, what we will do? Share among old partners. So reserves account debited, reserve is going. So reserves account debited to old partners capital account in old profit sharing ratio. Clear? Now admission. Admission means what? New partner will bring money. Okay, new partner will bring money. If new partner is going to bring money, what should be the entry? Capital introduced. Amount brought by new partner. Bank account debited to partners capital account. Bank account debited to what? Partners capital account. Now there are two situations that can happen over here. New partner will bring money with goodwill, or new partner will bring only capital. Only two. You cannot have a third situation that, sir, what if new partner doesn't bring capital also? Then he's not partner only. Then he's not partner only, no. So new partner brings money with goodwill, a new partner brings money without goodwill. Clear? Now, if he brings with goodwill, still we will take from his capital account and distribute. If he brings without goodwill, whatever he bought, imagine 80,000 capital, 20,000 is goodwill share. If he brings 1 lakh, good. Okay, this 20,000 will remove and will distribute to the other sacrificing partners. If he brings only 80,000, nothing bad for us, bad for him. We'll still remove that 20,000 and his balance will go to 60,000. We will still distribute that goodwill share to the other sacrificing partners. Is it clear? Okay, now, so goodwill distribution, gaining partners capital account debited to sacrificing partners capital account. Don't automatically come to the conclusion that new partners capital account debited to old partners. You have to do that calculation, gain ratio or sacrificing ratio which we did, we have to do that. Okay. Now existing goodwill in the balance sheet. Already in the balance sheet there is a goodwill. What do you have to do? Write off. Write off that goodwill. That is the old reputation. Write off. So goodwill will be written off. Goodwill is an asset. Asset written off means what will happen? Asset value will go down. So old partners capital account debited to goodwill. Instead of doing this, you can also write revaluation account debited to goodwill. Same effect. From revaluation, that loss will go to partners only. Or you can directly write old partners capital account debited to goodwill. Clear? Yes. Making capital proportionate. You usually see this. Capital should be made proportionate, keeping Z's capital as base. These kind of words you see. Correct? So if it is making capital proportionate, imagine one partner is there. They have told keep that partner's capital as the base. So see that partner's capital. See that person's ratio. Profit sharing ratio. So for 1 lakh capital, if his ratio is 1/3, that means what should be the total capital? 3 lakhs. Then distribute that capital to all the partners. Then you see how much capital is there right now. If at all they have requirement of this much capital and in his capital account there is more. So what do you have to do? You have to give him money. We require this much capital and in his capital account there is less. Then what to do? He will bring extra money, he will bring. Clear? So making capital proportionate also can be a part which can be asked. Retirement of partner. That much we have discussed about admission, guys. We'll go into retirement now. Most of the things will be common when we go to retirement. Now, retirement of partner leaving the partnership firm voluntarily. Clear? First, NPSR. We need the NPSR for whom? Remaining partners after retirement. Now, in admission, NPSR is usually asked to be computed in a particular way and all that. Clear? Admission. Imagine, admission, I don't even tell what I'm going to give him. I told new partner admitted. What will I assume? Only assumption I can do is, no, nothing agreement, equal. Correct? Imagine retirement. I tell that X, Y and Z are there. 3:2:1 is the ratio. And I tell that Z retired. So just remove Z, remove 1. New ratio will be 3:2. New ratio will be 3:2. If you have a situation like this, no need to calculate sacrificing ratio also. It will be 3:2. It will be 3:2 only. It's a shortcut. Clear? Now, understand this. NPSR, ratio among the remaining partners after retirement. Sacrificing ratio. Still I am using the word sacrificing ratio only. I am not using the word gain ratio. Old ratio minus new ratio. If answer is positive, sacrifice. If answer is negative, gain. Clear? Goodwill computation. We know already 4 or 5 methods are there. Goodwill distribution. Gaining partner will give to sacrificing partner. The journal entry will be gaining partner's capital account debited to sacrificing partner's capital account. Clear? Revaluation of assets and liabilities. Same as before. Not even going to discuss. Same as before. What we did. Asset increase, decrease, everything. But profit or loss shared between all partners including the retiring partner. Including retiring partner. Reserves. 1 second, guys. Okay. Reserves. Reserves what we'll do? Share between all partners including the retiring partner. Because even retiring partner has a share in this. Now, goodwill existing in balance sheet. Write-off. Same write-off entry. But all partners capital account debited including the retiring partner. Now the new concept over here is JLP or SLP. What is this JLP or SLP? Joint life policy, separate life policy. Joint life policy means life insurance policy taken by the firm on the life of all partners, taken by the firm. Taken by the firm means the premium is paid by the firm. So if money comes, it goes to the firm. Then the firm will distribute it. So don't come to a conclusion that A retired. Okay, so the money whatever comes should go to A. No, it will go to ABC only. Separate life policy means life insurance policy taken by the firm on the life of an individual partner. We felt that one individual partner is more important. So we take a separate life insurance policy on that partner's life. But still it is taken by the firm. Here also taken by the firm. So premium is paid by the firm. If expense is paid by the firm, that means expense fell on every single partner's head. So when money comes in, it should go into every single partner's pocket. Clear? Now, any amount received will be shared by all partners. Any amount received. If partner dies, policy amount received. If partner retires, surrender value is received. Now, obviously, the policy amount is called as joint life policy, not joint retirement policy. Correct? So, if partner dies, you will get the policy amount. Let's say they told policy amount is 1 lakh. If partner dies, you will get 1 lakh rupees. Okay, but that 1 lakh will not go to that partner. It will go to firm. Firm will distribute it to all partners in their profit sharing ratio. Now, if partner retires, you'll surrender the policy. Why will you surrender the policy? Let's say there is X, Y, and Z, and the policy amount is 1 lakh. Now, if Z is retiring also, we'll go and close the policy. When we close the policy, we'll not get 1 lakh. We'll get some surrender value, some normal value. You'll get no profit in that. You'll get some value just for closing. All these years you paid premium, some reduced value you'll get. Why we are closing? If we don't close, policies on the life of XYZ. Tomorrow if Z goes out and if Z dies, now the amount will come and amount again Z will also have a share in that. So Z is going out. So we'll surrender the policy. Then we'll take a new policy on the life of X and Y. Clear? Now, settle the retiring partner. What is it? Settle the retiring partner. Now, pay it immediately or treat it as loan. If they tell nothing in the question, the natural assumption that we are going to do is it is treated as loan. So now, if it is treated as loan, retiring partner's capital account debited to retiring partner's loan account. Later, when we prepare balance sheet, this loan should be there in the balance sheet. Clear? Pay it immediately. If it is paid immediately, retiring partner's capital account debited to cash or bank account. Money went. Now, Section 37 of Partnership Act. You have to understand. Okay, Section 37 of Partnership Act tells us that if at all a partner retires or if the partner dies, it is applicable in both cases. Now, if you don't pay the money, then you have two options. You means who? The partner has two options. Interest at the rate of 6% per annum. Imagine 1,20,000 was there in the capital account, did not get settled. On that 1,20,000, 6% interest. Or share in profit. But to give share in profit, this retiring partner doesn't have a profit sharing ratio. Retiring partner is already gone. Now the profit sharing ratio is only between the remaining partners. So now in that case, what you will do is profit into retiring partner's share divided by capital of other partners plus the loan amount. So basically, let's say A, B, C. A is having a capital of 1 lakh. B is having a capital of 2 lakhs. C is gone. And when C was gone, his balance was 1,20,000. His balance was 1,20,000. It will, because it is not settled, it will be treated as the capital of the company. So now what you will do? Profit is 50,000 into 1,20,000 divided by 1 lakh plus 2 lakhs plus 1,20,000. In this ratio, you will distribute that. Is it clear? Are you following this? This is section 37. Clear? Now, death of a partner. Partner leaving the firm due to death. That means this is not voluntary. Clear? Now, amount payable to partner by the firm to be payable to executor. Executor is nothing but legal heirs. Family. Clear? Now,
payable to executor. You have to understand what and all will be payable to executor. Capital account balance. Don't you think we have to pay that? Yes, that is payable. Current account balance, payable. But why did I write positive as well as negative? If current account has credit balance, payable. If current account has debit balance, receivable. Are you getting this? Current account has credit balance, that means it's payable, so I'm adding over here. But if current account has debit balance, that means it is receivable, so I'm subtracting over here. Interest on capital, pending. Let's say the partner has died somewhere during the year. So till the date of death, interest is pending. That is added. Drawings, he had taken money. That is subtracted. Interest on drawings, that is subtracted. Revaluation, profit or loss. If it is profit, added. If it is loss, subtracted. Share in reserves, added. Goodwill write-off. Which is this goodwill write-off? The goodwill which is there in the balance sheet, that is to be written off. Minus goodwill share given by gaining partner. Goodwill share given by gaining partner. Add. Gaining partners means remaining partners will be the ones gaining. The partner who died will be the partner who is sacrificing. That will be given. Now, JLP or SLP share which is there, that will be added. Profit share till the date of death also will be added. This much is the amount that is supposed to be payable to the retiring partner. Done. Clear? Now understand one thing. All these amounts were there for retiring partner also. But what is this profit share till the date of death? Why it is not there for retiring partner? Retiring partner voluntary. If he is leaving in the middle of the year, he could have waited till the end of the year, taken his profit and gone. Death is involuntary, not under the control. So if a person has died during the year, till that date, he has put effort, right? So profit share till the date of death has to be given. But on that day to give profit, are you preparing P&L? Are you preparing P&L appropriation? No. So you'll create one suspense account. P&L suspense account debited to deceased partner's capital account. Is it clear? This is the amount. Amount payable to executor. Amount payable to executor. Okay. Pay it immediately or transfer to loan account. Pay it immediately or transfer to loan account. So if it is paid immediately, nothing. From the deceased partner's capital account, it will be transferred to executor's account. Then from executor's account, it is paid. So it will be to bank or cash account. If it is going to be paid later, same rules what we saw. That is section 37 of the Partnership Act. Share in profit or interest at the rate of 6%. This is not at the option of the company, or sorry, at the option of the partnership firm. It is at the option of the partner. Here it is the option of the executor. So what executor will do? He will check both options. Where is getting more amount, he'll tell I want this option. Clear? Now, joint life policy accounting. This is also a small unit, right, in your textbook. Joint life policy accounting. Now, joint life policy, I told you, premium is paid by whom? Firm. When premium is paid by firm, there are two situations. Either it is treated as expense or it is treated as asset. If it is treated as expense, you will pass the entry joint life policy premium account debited to bank account. If it is treated as asset, you will pass the entry joint life policy account debited to bank account. Bank account. This will be treated as asset. Is it clear? Joint life policy premium account debited to bank account. Joint life policy account debited to bank account. This is asset. Here this is expense. If it is expense, expense has to go to P&L. P&L account debited to joint life policy premium account. Is it clear? Done. Now, here you understand at the end of the year, no? At the end of the year, you have some extra adjustments to be done. At the end of each year, joint life policy account must be adjusted to the surrender value. Imagine I paid 3,000 premium, but end of the year, the surrender value is 500 rupees. So what I will do? I have to show the asset at the surrender value only. Remove 2,500 and transfer it to P&L. Remove 2,500, transfer it to P&L. So P&L account debited to joint life policy account. This cannot happen in the other case because there I am showing it as expense. Now, if amount is received,
bank account debited to JLP, and that amount will be transferred to partners capital in old profit sharing ratio. Here if amount is received, here also bank account debited to JLP, but already asset, it is shown as asset in the balance sheet. So imagine JLP in the balance sheet is already showing 50,000, and if you receive 50,000, there is no profit or loss. But if you receive 60,000, then there is a profit of 10,000. So see over here, JLP account debited to partners capital only, but balance in JLP is shared. So basically you can take it as JLP balance. Okay, and this is the amount received. If at all you receive more, then you will distribute the difference. If you receive same amount, nothing to be distributed. Clear? Then we move into dissolution of partnership. So we finish admission, retirement, death. Now we'll go into dissolution of partnership. What is dissolution of partnership? Just closing the partnership firm, right? Just closing the partnership firm, shutting the partnership firm. Accounting is for closing the books. Basically, when balance sheet is given, I have to empty that balance sheet now because business only is not there. So first step, transfer assets and liabilities to realization account at book value. Transfer assets and liabilities to realization account at book value. Basically, you're taking from the book and just dumping it into one place called as realization account. Okay, except cash and bank. Why? Some more money you will receive, some more money you will have to pay. That finally you will transfer that cash or bank. Okay, so asset is going. So asset has to be credited. Realization account debited. Liability is going. So liability has to be debited. Realization account credited. Is it clear? Next, asset taken over by partner. Partner is taking over the asset. So if partner is taking over the asset, what will happen? Partner has to give us money. Partner has to give us money. Partner's capital account debited to realization account, not at book value, at the agreed value. What value partner is taking over the asset, at that value it will be adjusted. Liability settled by partner. If liability is settled by partner, partner paid the liability. That means we have to pay money to partner. So realization account debited to partner's capital account at what value? Settled value. Now, sale of assets. If it is sale of asset, what will happen if it is sale of asset? You will get money. Bank account debited to what? Where are all the assets sitting? In realization account. To realization account at sale value. Not at book value, at sale value. Now, liability settled. If liability settled, what will happen? Realization account debited to bank account. At what value? Settled value. So basically, the purpose of doing this was, I transfer all assets and liabilities to one place. So when money comes also, I'll put it there. When money goes also, I'll enter it over there itself. Clear? Now, close realization account. When you're closing realization account, either you'll get a profit or you'll get a loss. If it's a profit, realization account debited to partners capital account in their profit sharing ratio. If it is a loss, partners capital account debited to realization account in the profit sharing ratio. Clear? Now, close the books. Close the books. Okay. If partner has credit balance, that means partner has to get money. So partner's capital account debited to bank account. If partner has debit balance, that means partner has to give money. So bank account debited to partner's capital account. And here you have a very important thing called as Garner versus Murray. Garner versus Murray rule. When will this be applicable? If a partner is insolvent. If a partner is insolvent and his capital account has debit balance. If his capital account has debit balance means what? That partner has to give us money. And he is insolvent. He is insolvent. Partnership main feature is what? Unlimited liability. That means who will bear this loss? Other partners. Other which partners? Other solvent partners. In which ratio? Capital ratio. This was the judgment of Garner versus Murray case. So remember this, if a partner is insolvent, okay, the loss, the debit balance in his capital account will be borne by whom? Other solvent partners. In what ratio? In capital ratio. Note, if all partners are insolvent, then what? Creditor will lose money, that's all. If nobody in the partnership firm has money, here nobody will lose money. Who will lose the money? Outsider. Creditor will lose money. When all partners are insolvent, creditor's account debited, creditor is gone, no, creditor's account debited to bank. How much we can pay, that much we'll pay. Whatever we can't pay, very, very good for us, bad for the creditor. So to deficiency account. To what? Deficiency account. And this deficiency will be adjusted in what? Partner's capital account. So basically, can you see, creditor is losing money. So we are calling it as gain. And that gain, who is benefiting from that gain? Partner. So can you see it is going to partner's capital account? So basically, whatever amount creditor loses, that is the amount partner is not able to bring money. I have to bring 20 rupees to pay the creditor. I don't bring it. That means I am not able to bring 20 rupees. Creditor loses 20 rupees. Clear? Now, amount to be compensated to partner who was admitted, who had given amount towards goodwill on admission. What is this? Very small point, but it's there in your study material. Very small point. See, amount to be compensated to whom? Partner who was admitted, who had given amount towards goodwill on admission. Just now I came, I told you guys have reputation and I gave money for your reputation. Next day you're telling we are dissolving the firm. It's loss for me, right? So now old partner's capital account debited. Remove from their capital account and give it to new partner's capital account on dissolution. Clear? That means transfer that extra money that he had paid, transfer that to his capital account. Clear? Now, non-applicability of Garner versus Murray. When is it not applicable? Dissolution due to death of partner. If a partner has died, then there is no concept of Garner versus Murray. That means we are being kind. Clear? Dissolution due to fraud of new partner. Fraud of new partner. New partner has made a fraud that because of that we are in trouble here. So no Garner versus Murray. Sorry. My bad. This is not non-applicability of Garner versus Murray. Non-applicability of this situation. Okay, that is giving the goodwill back. Giving the goodwill share back. Now, non-applicability, dissolution due to death of partner. Partner died. That's why he is going to leave. Okay, dissolution due to fraud of new partner. Fraud here. He was involved in fraud. Why I should give the reputation amount back to him? Agreement was there for no refund. That means when he joined only we told in case we go into dissolution, we are not going to give this goodwill amount back. Non-refundable situation. Now piecemeal distribution. What is this piecemeal distribution? See, when a dissolution happens, no, you'll pass accounting entries and all, they will tell 1-4 and you'll pass everything on 1-4 only. Do you think practically everything will happen on 1-4? No, right? Part by part, one by one asset they'll go on selling. Whenever they get money, what they will do? They'll give that money to whom? Whenever they get money, they'll give it to the partners. But first they'll pay the outsiders or everything settled. After that, what they will do? They'll give it to partners. So, distribution of cash to partners in parts. Now, there are two methods here. Maximum loss method, higher relative capital method. Now, order of payment you understand. First, you have to pay the realization expense. Then you have to pay the outsiders liability like creditors, bank OD, bills payable and all. Then you have to pay insiders liability, partners loan. Then finally you will pay the partners capital in piecemeal distribution. So you can't tell the outsider, no, I am doing maximum loss method, so I'll pay you later. I have to pay this guy now. They don't know about that. They're like, you have money, just pay it. That's all, finished. So whatever piecemeal distribution we are talking about, that is applicable only when we are paying money to the partners, not to outsiders. Now, maximum loss method. Every installment to be treated as last installment. You got money? We are like very negative person. We got money, we are thinking this is the last installment. Now, step 1. You are going to compute maximum loss. How to compute maximum loss? Amount payable to partner. See the balance. In that big table which we prepare, no, distribution of cash, see the balance of the partners. Whatever amount is payable to partner minus amount available. That means that is maximum loss. Whatever maximum loss is there, it should be distributed to all the partners in their profit sharing ratio. Distribute maximum loss to partners in profit sharing ratio. Then step 3, deduct maximum loss amount from the amount payable to partner. You have distributed the maximum loss. You are like, I have to pay you so much. This is your share of loss. So remaining amount I'll pay you. But when you're doing remaining amount, if somebody has gone into negative, then apply Garner versus Murray. So if any partner goes into negative, adjust in capital ratio because of Garner versus Murray. After adjusting, somebody will be there with positive. That means that person has to get money. Balance amount is amount paid. This is your table. Every time you get money, you have to follow these 5 steps. Step 1, what you're doing? Compute maximum loss. Amount payable to partner minus amount available. You got maximum loss. Distribute to partners in profit sharing ratio. From their balance, reduce the loss. When you reduce the loss, you'll get some amount. If somebody went into negative, distribute that negative to the others in capital ratio. Then whatever is there, that is the amount paid. Higher relative capital method. Higher relative capital method. That means partner who has higher capital is to be paid first. Here what we are going to do? First we are going to calculate the higher relative capital. Once we get the higher relative capital, right, take the amount, just distribute to partners in that rate, that amount only. Now, first divide the partners capital by profit sharing ratio. Now, if at all partners capital is 10,000, 5,000 and 2,000, and if their profit sharing ratio is 3:2:1, divide means just do 10,000 divided by 3,000. You'll get 3,333, and 5,000 divided by 2,000. You'll get 2,500, and you'll get 2,000. This is step 1. Just dividing the number, not in the ratio, just dividing the number. Now, next step is seeing which partner got the least number. C got the least number, right? So, keeping the partner's capital as base, who has the least resultant amount? The resultant amount, who got least? C. Keep his capital as base, not the resultant amount. Keep the capital as base and compute the required capital. You got the total capital now. Now, distribute that required capital in profit sharing ratio. That time you will know if somebody has higher capital. Higher capital is actual capital minus required capital. You'll get the higher relative capital. Now, step 5 is repeat the steps till one of the partner has higher relative capital. You got higher relative capital. Now, two people are having higher relative capital. So, what will you do? Repeat entire steps again till you see who is that one partner who has higher relative capital. Clear? Next, amalgamation of partnership firms. Okay, now you have partnership firms over here. Okay, it can be like this also. There is a partnership firm. There is a sole proprietorship firm. It got amalgamated and became a new partnership firm. Or you have one partnership firm and you have one more partnership firm. It got amalgamated and became a new partnership firm. Clear? Now, first what you have to do, you have to close the books of the existing partnership firm. Close the books of existing partnership firm. So, transfer assets and liabilities to realization account. Realization account to asset, just now what we did in dissolution. Then liabilities account debited to realization, same thing. Asset taken over by partner, same entry which we passed in the dissolution. Liability taken over by partner, same entry which we passed in dissolution. Now, assets not taken over by new firm. Asset is not taken over by new firm. New firm is telling your furniture is very old. You leave that and come. So what will you do? You will sell that furniture. So bank account debited to realization account at sale value. You got money. Liability is not taken over by new firm. That means that liability has to be settled by the old firm only. Realization account debited to bank. Settled. Finished. Now, realization expenses. What is realization expense? When you're closing the firm, you have to contact one lawyer, you have to contact one agent, you have to pay some money to that person. So, realization account debited to bank account. Okay. PC, purchase consideration. That means new firm has to give us money, but they're not going to give us money and all. So, what will happen? New firm account debited to realization account. New firm account debited to realization account. Now, PC is basically asset taken over by the new firm minus liability taken over by the new firm. This is not at book value. This is at agreed value. This is not, now you think new firm is mad. He saw in your books some value. He is ready to take at that value only. He'll be like, no, we have to reduce little. Or you will tell, no, you have to increase little. So at agreed value. So whatever assets are taken over minus liabilities taken over, you'll get a value. This is your PC, and for that you'll pass this particular entry. And is he going to give us money? No. What is going to happen? For this value, all the partners who are there over here will become the partners over there. So partners capital account debited over here to new firm account. When new firm is opening, no, this partners capital will be the opening capital over there. Clear? Now see opening entries in new firm. They got assets, asset account debited. They got liabilities, liabilities account credited. Okay, new partners are coming with some balance, partners capital account. Now if they have paid more, if they have agreed for more, that means it is goodwill. They are paying extra. If they have agreed for less, that means it is good for them. That means it will go to capital reserve. Understand this. PC is greater than asset minus liability. Asset taken over, liability taken over. If PC is greater than asset minus liability, it is goodwill. If PC is less than asset minus liability, it is capital reserve. Simple logic. I have agreed to give more. I am paying for your reputation, goodwill. I have agreed to give less. That means it's good for me. But this good profit doesn't happen on a day-to-day basis. So it goes to capital reserve. Done. That's it, guys. That is your concepts of partnership, which we discussed. Okay. We'll start with the discussion of all the partnership questions, which we have to discuss. Okay. First one is our June 2025 question paper, the most recent one. Now, we'll keep the answers also ready. Directly we'll discuss. Only the last two model test papers we'll solve. 5. Now, A and B are partners in a firm sharing profits and losses in the ratio of 3:2. This is your old profit sharing ratio. Their financial position as on 31st March 2025 was as follows. You have sundry creditors, A's capital, B's capital, then cash in hand, sundry debtors minus provision, stock in trade, fixtures, P&L. P&L is sitting this side. If P&L is sitting this side, that means it is debit balance. If it is debit balance, that means this is loss. Okay. Now, on 1st April 2025, C is admitted under the following terms. New profit sharing ratio given 5:3:2. Now, what was the old profit sharing ratio? 3:2. It was 3:2. Goodwill is valued at 16,000. C brings in cash for goodwill. Okay, C brings in cash for goodwill. Half retained in the business. That means other half is withdrawn by the partners. Other half is withdrawn by the partners. Now you have to understand very, very important thing. Here you need sacrificing ratio first of all. Let's see if they have done the sacrificing ratio. We can discuss from there. Okay. They've shown over here. Old ratio 3:2, new ratio 5:3:2. Therefore, the sacrificing ratio is 1:1. They've done the calculation. You know the calculation, right? So it will be 3/5 and 2/5. Okay, and 0 for the last person. And the new partners, it is 5/10, 3/10, and 2/10. Correct. So 10 it is 6 minus 5, 1/10. 10 it is, so 4 minus 3, 1/10. Can you see they got 1/10? So 1:1. Okay. So 1:1. So anymore, if sacrificing ratio is already calculated, I am not going to do it. I hope you know how to do the sacrificing ratio, right? 1:1 is the ratio. Now you go back to the question. See over here. What was the goodwill valued at? 16,000. Goodwill is valued at 16,000. Not goodwill. That fellow will bring 16,000. What is that fellow's ratio? 2/10. 2/10 is nothing but 1/5. So 16,000 into 1/5. What is the ratio of that person? 3,200. This 3,200 that guy is going to bring. Is he going to bring? Goodwill is valued. C is going to bring in cash for goodwill. That means he will bring for capital also. He will bring for goodwill also. So now the 3,200, you know, that has to be shared by the partners. So C's capital account debited to A's capital to B's capital. Now if you go and check. See here. C's capital account. No, not done. Okay. ICMI. Random stuff. Whenever they feel like, whatever they feel like. See, directly, cash account. Directly, here only they have put 1,600, 1,600. Actually, what happens? Full 3,200 comes to C. C's capital account. Okay, I'll just show the actual. But result is given. 3,200 comes over here. Okay, along with capital. Then the 3,200 is debited over here. Then the 1,600 and 1,600 is given to them. So that what they have done suddenly, randomly, directly cash account debited to A and B only. Actually, cash account debited to C's capital. Then C's capital debited to A's capital to B's capital. Clear? I hope you got what they have done, but don't do it in the exam. Next, after that, then goodwill part is sorted. We'll go further. 4,000 bad debts are to be written off. That means we start with revaluation now. Revaluation, if you're starting directly, revaluation account. Bad debt written off means for us loss and debtor has to reduce. So revaluation account debited to sundry debtors. Clear? Then provision for bad debts to be raised to 10%. Now what is it? Debtor is 46,000 here. 46,000. From that, just now I removed 4,000. That means now it is 42,000. 42,000 into 10%. That makes it 4,200. We already have a provision of 2,000. That means I have to increase how much? 2,200. This is the final accounts point which is put over here. I hope you know this. Okay, 2,200. So now if you go and check, to provision for doubtful debts, 2,200. I hope you got the calculation. Yes. Next. Stock is revalued at 28. Right now stock is what? 21,500. That means we are increasing the stock by 6,500. So you'll write over here by stock 6,500. Stock account debited to revaluation profit. Next. Fixtures and fittings are reduced to 300. Reduced to 300. That means what is the fixtures right now? 500. That means loss is not 300. Loss is 200. So revaluation account debited to fixtures 200. Done. After that, C is to bring cash to make his capital equal to 1/5 of the combined adjusted capitals of A and B. This is the nice bamboo that is kept over there at the end of the question. Clear? Otherwise, usual admission questions they tell no, C will bring this much capital. They didn't tell. C is to bring cash to make his capital equal to 1/5. Okay, now we'll see that. But before that, we'll close the revaluation account. When you close revaluation account, can you see they are getting profit? Profit is distributed between A and B. A and B, their ratio was 3:2. So it's going 60 and 40, 100. And this 60-40 should come to partners capital account. And the existing partners, already they have balance of 24,000 and 60,000. Can you see balance brought down 24,000 and 60,000? Is it clear? And if there was reserves, what I would do, I would just distribute to partners, right? Same way, there is a loss here. This loss will be distributed to existing partners in their profit sharing ratio of 3:2. So can you see 8,000 is distributed in the ratio of 3:2, 4,800 and 3,200. Clear? Done. After that, now you have to check. They said you have to make the capital proportionate. Let's see if they've already done the calculation. Okay, see. Combined adjusted capital of A and B is 2060 and 57,640. Now, how did they get this balancing figure? Balancing figure. Is it the balancing figure, guys? Yes. Now you're thinking, what is this 800, 800? You know what is this 800, 800? Goodwill, whatever is brought in, half only is retained in the business. That means half is withdrawn. So you will do capital account debited to bank. Done. Gone. So now combined capital. Okay. 20,060. This is the balancing figure what you got. This is the balancing figure. And 57,640. This is also the balancing figure. Clear of two partners. These two partners, they will not bring extra money, no. New partner has to bring extra money. So now the two partners' capital came to 77,700. Now they are telling C's capital contribution will be 1/5. See the language that is used. C is to bring in cash to make his capital equal to 1/5 of the combined capital of the other two. Combined adjusted capital, that means after all this revaluation and all those things, combined capital of those two people. Therefore, the combined capital of those two people is 77,700. C will bring 1/5 of that, 15,540. Can you see 15,540 is the bank account debited to capital account? 15,540. And that 15,540 will be the balance. These capitals will come to the balance sheet. Sundry creditor, we didn't do any adjustment. That means whatever is there in the question, same thing we put it over here as capital sundry creditor. And what about furniture and fittings? It is revalued to 300. So 300 is the new value. And stock in trade, they have increased it to 28,000. That means 28,000 is the value. Now sundry debtors, we know it is 42,000. How it became 42,000? From 46,000 after bad debt, it became 42,000. Clear? And the new provision that you created, 4,200. Now you are thinking, sir, in revaluation account, I put 2,200. No, that was 2,200. That is required to be increased. Already 2,000 was there. So total provision is what? 4,200. Subtract, you will get the answer. None of these points are partnership related points. These are all final accounts related points. Clear? Now cash. Cash, how you will get? This is one thing you will always have to calculate. Okay. How much is the cash here? 30,000. 30,000 plus, did the new partner bring 15,540 for capital? Did the new partner bring 3,200 for the share of goodwill? And did the old partners, was it 3,200? Yeah, 3,200. And did the old partners take 800, 800? Just do this calculation and see if you're getting the math. Is it matching? 30,000 plus 15,540 plus 1,600. 47,140. Yes, it's matching, right? Yes, this is your cash calculation that you always have to do. Done. That's it. 14 marks. It wasn't tough. It wasn't tough, guys. 14 marks. Okay. Cash account they have done just to calculate the cash. You can do it as a just calculation also. Done. I don't think there is any other question on partnership that was asked in that. It's there, huh? Oh. That means 14 plus 4, 18 marks. A and B were partners
sharing profits and losses in the ratio of 5:3 on 1st April 2023, the firm was dissolved. Assets other than cash and liabilities were transferred to realization account. Information. You are required to pass journal entries in the books of the firm. Now, let's go to the last one in your suggested answers. Okay. Information. Creditor for 1,80,000 accepted debtor of 1,50,000 at 4% discount. Balance paid by check. Wow, wow. This 4-mark question has more things than the 14-mark question which was there. Now, see over here. One by one. Realization account debited to bank account. You know why? Because all the assets and liabilities, if they are transferred to realization account, and if one liability person takes one asset, no, the entry for that is realization account debited to realization account. You don't have to pass any entry. Are you getting this? See over here. Assets and liabilities were there in the balance sheet. You transferred the asset to realization account. Now asset is sitting over here. In my realization account, asset is sitting over here and liability is sitting over here. So now what happens? If liability is settled with the asset, it's just a mutual cancellation over here only. So now when they told you creditor of 180 accepted debtor of 150, so that for that 150 ignore. Okay, but 150 at 4% discount. Balance paid by check. Now understand this. 180 minus 1,50,000 minus 4%. So 1,50,000 minus 4% will give you how much? 144,000. That means 144,000. That means for 1,80,000 I paid only 144. That means 36,000 I have to pay. Realization account debited to bank. Realization account debited to bank because everything is in realization now. Then next. Another creditor of 1,20,000 took over stock at 40,000 and investment at 76,000. What to do? No entry required. See note itself. No entry required because debtor taken. Okay, that is for this one. Sorry. Okay, now again adjustment will be done only for what? Now see, creditor is how much? 180. Sorry. Creditor is 120. Took over stock at book value. Book value 40. They took at 40. No problem. 40 plus 76 is how much? 1,26,000. Can you see 1,26,000? Now see this. Is it 1,16,000? Now, are we going to pass any entry for this? No. Liability gone, asset gone. That's all. Loss will automatically be calculated in realization account when they finish it. When they close the realization account, automatically loss will be there, no? Because you put asset on the debit side, you put liability on the credit side. These two got adjusted with each other. Are you getting it? Okay. Just remember, in dissolution, if liability is settled by giving asset, liability and asset both are in realization account, no entry. Next, only for extra what you're paying, like over here you paid cash, for that entry is there. Now, another creditor of 3 lakh accepted land and building of 5 lakh and paid the balance to the firm by check. So for the 3 lakh, no adjustment, but they gave balance to us. So bank account debited to realization account. Bank account debited to realization account. Clear? Now this situation you just see. Loss on dissolution they only gave us. Because for 4 marks we can't sit and prepare the full realization account and calculate the loss, no? So loss they only gave us. So now what will be the situation? B's capital account, A's capital account debited to realization account done. 4 marks, 4 entries. 1 was no entry. Is it clear? Done. Okay, that should be it with June, guys. I'm getting rid of June. Yes, let's go into December. Again, question number 5. Partnership. See what they asked. Pass necessary journal entries to record the acquisition of the business in the books of the company and prepare post-acquisition balance sheet of Raylink. That means what they have done. This is not admission retirement and all. This is like an amalgamation situation over here. Now, Raylink agreed to purchase the business of a firm consisting of 2 brothers, A. Ray and S. Ray on 31st of March 2024. Balance sheet of the firm on that day was as follows. Clear? Now, you can see over here capital account of A. Ray, S. Ray, general reserve creditors, leasehold premises, plant and machinery, furniture, stock, debtors, cash. Clear? This is your balance sheet. Somebody is taking over this balance sheet. Now it's taken over by Raylink Limited. That means this is
partnership taken over by company. Company agreed to take over the liabilities and all the assets with the exception of cash. And cash, the agreed purchase price being 4,50,000 to be satisfied as 1/4 in cash and 3/4 by issue of fully paid equity shares of 10 each at an agreed value of 12.5. This is your PC and this is your PC settlement. PC is what? Purchase consideration. For taking over this partnership firm, they are going to give 4,50,000 and they are going to give 4,50,000 by doing what? 1/4 in cash and remaining the new partners will get shares in our company. Okay, now company made the following revaluation of assets taken over, bringing them to books. When bringing them to books, all the values they are going to change. You are required to pass journal entries to record the acquisition in the books of the company. So don't have to worry about closing the books of the partnership. You are taking, right? Now, first, what did I tell you for taking over? Every single asset has to be brought into books. Now, see over here. Journal entries in the books of Raylink Limited. Leasehold premises is coming in. Leasehold premises, let it be anything in the book value, but I will take this value. I don't care about the book value. Book value is how much? 117,500. That is for that fellow to close. For me, I am taking it at 155. So leasehold premises at 155. And then next one, plant and machinery 62,500. Next one, furniture and fixtures 12,500. Next one, stock in trade 1,45,000. Next one, debtors 1,25,000. Now see over here, this all are taken over. Cash you ignore. They told cash is not taken over. Okay. Now 2, business purchase account. Okay, 2, business purchase account. They could have made it simple by passing one entry first called as business purchase account debited to partners. But directly they have created one account called as business purchase. How did I get all these assets? How did I get all these assets? By purchasing a business. So it went into an account called as business purchase account. Clear? Now we are also getting liabilities, not only assets. So creditor is also taken over. So now business purchase account debited to creditor. Think like this. Assets came good, so credited. Liabilities came bad, so debited. Now what are we giving them? Now if you see 5 lakh minus 1 lakh, I am actually getting what from them? 4 lakh. I am getting 4 lakh. But what did I promise to give them? 4 lakh 50,000. That means extra 50,000 if I am paying. That is for their reputation, goodwill. So now can you see business purchase debited 4 lakhs. Business purchase gone. Goodwill debited 5 lakhs. I mean 50,000 to A Ray and S Ray. I have to give this money to whom? A Ray and S Ray. And this A Ray and S Ray, how am I giving this money? How am I giving this money? 1/4 in cash. So can you see A Ray S Ray debited? 1/4 is going to bank account and remaining I'm going to give in shares. Now this is the clarity part you need to get. 4,50,000 into 3/4. Can you give me the value? 337,500. 95% of the questions where students have reached till here, they would have quietly written 2 equity share capital. They would have written 2 equity share capital. 337,500 is not equity share capital because the equity shares are issued at 12.5 of 10 rupees issued at 12.5. So you will do 337,500 divided by 12.5. How much you are getting? 27,000 shares. 27,000 shares. 27,000 shares into 10 only will go to share capital. 27,000 shares into 2.5 will go to securities premium. Now share issue is not there in financial accounting, but still they are expecting you to know it. Share issue is not there. It's in corporate accounting. Correct? But they're expecting you to know it. Okay, this is the situation. Do not just write 2 equity share capital. Now balance sheet. What will you prepare balance sheet? Just now you did one 5 entries you passed. From those 5 entries you have to prepare balance sheet. But the bamboo is balance sheet is as per Companies Act. Balance sheet is as per Companies Act. But this is not the balance sheet as per Companies Act. Okay. Unfortunately, suggested answer, it is wrong. It is not the balance sheet as per Companies Act. Shareholders funds, fine. Share capital reserves and surplus, fine. Non-current liabilities, fine. Current liabilities, fine. Okay, this is Non-current asset, there is no word called as fixed asset. It is called as property, plant and equipment. Clear? There is no word called as tangible asset. It's property, plant and equipment. Intangible asset, fine, goodwill. So from the journal entry only, everything is coming and sitting over here. Okay, current assets, inventory correct, trade receivable correct. They have prepared notes also. That's it. 14 mark question asked. Now let's see if there is another partnership question at the end. There is. Give entries for the following. Again, they're testing it. Realization expense 8,000 were paid by Rana, a partner. What should be the entry? Realization account debited to Rana. Okay. Realization account debited to Rana's capital account. Next, realization expense 10,000 paid by the firm on behalf of Dana, a partner. He has to bear the realization expense. So you have to make Dana responsible for this. Dana account debited to bank. Why? Realization account is realization expense is paid by the firm. Money went from the firm, but Dana had told that he'll pay it. So Dana's account debited. Next, realization expense 20,000. Out of this, 60% to be borne by Mana and remaining by the firm. So 60% you put to Mana, 40% you put it into realization account. So can you see realization account debited 40%, Mana's capital. Oh, Mana became Mona. Okay. Mona's capital account 60% to bank. Gender change. Realization expense account debited 10,000 to be borne by Kana, a partner, but paid by Dana, another partner. So now what will you do? Kana has to pay, right? Kana's account debited, right? Dana paid, right? We have to give to Dana, right? Kana has to Dana's. Done. Finished. 4 marks, huh? 4 marks. Easy. Yes, with that we are done with December, guys. Next we have to go into June. I think this is retirement. Yeah, we'll go into June 2024. Okay, question number 5. XYZ were partners sharing profits and losses in the ratio of 3:2:1. This is their old profit sharing ratio. The firm's balance sheet on 31st March 2023 was as follows. You have creditor, bills payable, general reserve, capital XYZ, cash in hand, cash at bank, debtors, less provision for bad debt, bills receivable, stock in trade, investment, market value is given, furniture and building. All things which will be required for revaluation maybe. Y retired on 1st April 2023, first day of the year only, and it was agreed that he should be paid all his dues in full on that date. So whatever balance will be there after all our adjustments, it will be paid fully to him. For this purpose, goodwill was to be calculated on the basis of 4 years purchase of super profit method. So you have to compute goodwill here. Other information are given below. Average capital employed is given 26,10,000. Net trading profits, okay, of 3 years they are given. 4 years purchase of, on the basis of 4 years purchase of the super profit method, but the profits are given for how many years? 3 years. Just take the average of that. 6,30,000, 5,40,000, 6,75,000 divided by 3. Are you getting 6,15,000 as the average profit? Rate of interest expected from capital having regard to the risk involved, NRR, is 10%. Okay, what is the NRR? 10%. So this becomes 61,500. Fair remuneration to partners for their services, 1,20,000 per annum. So even remuneration has to be subtracted. Then you should calculate the average. Okay, you take the average, then then subtract the remuneration, then only you will get it. Okay, so this much is all about goodwill calculation. Let's see if they have done the calculation. Yes, they have done the valuation. Oh. I don't think they have random calculations, right? Straight away values are. Okay, we'll see. No issues. What is the first thing they asked? Calculate the value of goodwill and show its treatment. Here, value of goodwill, 9,36,000. Straight away. Okay, and its treatment they have given. Now, how will you calculate the goodwill here? 1,20,000 per annum. Fair remuneration to the partners, 1,20,000 per annum. So, 6,15,000 minus 1,20,000. Yeah, from the average. Net trading profit for the firm they have given. Trading profit 630 plus 540 plus 675 divided by 3. Are you getting 6,15,000 minus 1,20,000? 4,95,000 is your final average profit. Correct? Average capital employed is how much? 26,10,000. 26,10,000 into 10%. 2,61,000. So it should be I don't know where to show the calculation to you guys. Let me show it here. So what is the average profit that we got? 6,15,000 minus remuneration of partner 1,20,000. What do you get? 4,95,000 is your average profit. Okay, average profit minus normal profit. Normal profit is 26 lakh. Capital is 26 lakh 10,000. 26 lakh 10,000 into 10%, that is 2 lakh 61,000. This will be your super profit. 2 lakh 34,000 into number of years of purchase 4. 9 lakh 36,000 goodwill. 9 lakh 36,000 goodwill. They also asked you show its treatment. So to show its treatment, no, you need to know what is the profit sharing ratio between X and Y. 5:3. What is the profit sharing ratio before? 3:2:1. So 3/6, 2/6, 1/6. Now X, Y, Z, right? Who is the partner who retired? Y retired. So 5:3 means this will become 5/8 and this will become 3/8. This fellow 0. So this will be 2/6. That means this person is sacrificing. Can you see whatever we got? 9,36,000. 9,36,000 into 2/6 is 3,12,000. Yes. So now what? X and Y. Calculate 8 and 6. LCM is 24. So 6 fours are 12. 12 minus 15 minus 3/24. Minus 3/24. And here, so 8/24. Is it 5/24? It will be minus 5/24. Okay, minus 5/24. 3:8. Just check. 3,12,000 into 3/8. Yes, 1,17,000 and 1,95,000. 3:8 ratio. Okay, sorry, 3:5 ratio. You will get when you do this. Minus 5/24 will come here. Minus 3/24 will come here, and that should be the answer. Okay. What happened? Didn't get. Auto. Okay, just that this 2/6 becomes 8/24. Then you have to bring it into same terms. So this is the first question that they asked. Then after that, the second question that they asked was calculate the profit or loss on revaluation of assets and liabilities and show its adjustment among partners. So till now, whatever was printed, this much, that was only for goodwill. Now we'll go into revaluation. Stock and furniture to be depreciated by 10%. So go and check what is the stock, 3,15,000. So 10% loss. They're not even showing that. Profit on revaluation directly, 1,65,000. Yo. What is this exam? June? Okay, I'm just putting numbers, okay. So, stock is how much? Stock and furniture depreciated by 10%. So, stock is 3,15,000. Stock is 3,15,000. 31,500 loss. Then, furniture is 4,20,000. 42,000 loss. Then after that they said that a provision of 5% on debtors to be created for doubtful debts and provision for liability of 18,000 is to be created against bill discounted. Provision to be created on liability, that means 18,000 is loss, and provision for doubtful debts at the rate of 5% on the debtors. Let's go and check what is the debtor value. Debtor value is 8,70,000, not 8,40,000, 8,70,000 into 5%. What is 8,70,000 into 5%? 43,500. Out of that we already have 30,000. So we have to create a provision of 13,500. Clear? Then after that, what do we have? Value of land and building is appreciated by 2,35,000. Appreciated by 2,35,000. So no, nothing to worry. Directly go and put 2,35,000 as profit. Then after that, they said that investment should be taken at its market value. Can you see the investment was market value was 410. Here it was 375. 375, 410 means 35,000 profit. Directly you will put 35,000 profit over here. Then after that, due to revaluation, the value of assets and liabilities are not to be altered. Very good. Okay, that means memorandum revaluation account. Okay, so now let's just check first once what is the profit. 2,35,000 plus 35,000 minus 31,500 minus 42,000 minus 18,000 minus 13,500. 1,65,000. Yes, 1,65,000 is the profit. Let's go into the solution. 1,65,000 profit on revaluation. What happens now? Not to be altered means what happens? First, all the partners will share the profit. Then remaining partners will share the loss. Because when you reverse it, it will become a loss. Now 1,65,000, can you see X, Y, Z? Profit is shared between all the partners. Then later when you reverse everything, why are we reversing? Here they said that due to revaluation, the value of assets and liabilities are not to be altered. This was the topic, that memorandum revaluation which we had discussed. Now all the partners will share the profit. When you reverse, obviously profit will become loss. So loss will be borne only by X and Z in the ratio 5:3. 5:3 was their new profit sharing ratio. Can you see it's gone into X, it's gone into Z. Ratio, obviously you know how to do it. Now, profit was 82,500. Loss is 103,125. That means X has to bear a loss. So debit X account. Profit is 55,000. No loss for that fellow. So we have to give profit. Credit his account. Profit is 27,500. Loss is 61,875. That means that fellow has to bear a loss. Debit his account. These two people will be debited and this partner will be credited. You can see the total it will total up to 55,000 only. 2625 and 34,375. 55,000. Yes, that should be it with that particular question. Show the balance of partner's capital account after Y's retirement. Now, X and Z are there. Partner's capital account after Y's retirement. Direct number. Okay, suggested answer gave you the direct number from up, it fell into your head directly. Okay, now what to do? We have to do it now. Let me just roughly do the partner's capital account. Okay, only for X and Z I'll do, because I require only for X and Z. Okay, go to the question. They had their existing capital. Existing capital was 970 and 380. So I'll write 970 and 380. Next, we saw that general reserve is there 5,10,000. 5,10,000 into 3 by 6. So 2,55,000 for X and 5,10,000 divided by 6. 85,000 for Z. Only X and Z. The middle column I'm ignoring, right? We don't want it. Okay. 1 second. What if they ask next question? Prepare balance. Okay. Imagine we ignored Y and we did that. And next question they are asking, what is the amount payable to Y? Then we have to do again Y's column for that. That's why I checked. Now this is done. This is done. And then revaluation profit. Okay. Remember the net situation we had written, right? See the net situation. X has to be debited 20,625 and Z has to be debited 34,375. Clear? Apart from that, what is there which will go to X and Z? Goodwill. Goodwill also we had written, right? The journal entry was there. We had discussed that journal entry. X is debited, Z is debited. 1,17,000 debited to X. 1,95,000 debited to Z. Right? Yeah. That should be it. Now we'll just check 9,70,000 plus 2,55,000 minus 2,625 minus 1,17,000. 7,375. 10,18,3. Wait 1 second. Did we make some error? 625 they are getting, right? Let's check for Z also. 380 plus 85,000 minus 34375 minus 1,95,000.
235 625. 235 625. Random numbers. Very good. Wait, let me see if I made an error. Z's capital is what? 380, right?
380
Yes,
and 97.
970. And reserves
510.
3:2:1. So reserve was 510. 510 into 1 by 6. And 510 into 3 by 6. 3:2:1, right? There's no error, guys. 2625 also we have taken from the solution only. 2625 debit. 34,375 debit. 1,17,000 and 1,95,000 also from the solution only. 1,17,000 debit. 1,95,000 debit. That means 970 plus 2,55,000 minus 2625 minus 1,17,000 minus, it should be correct, 1087,375 and 235,625. Okay, this is 1087,375. 375. How did the balance sheet tally? One second, let's just check once. What is the balance we got? 235, 625, right? Okay, I think the situation is this. How much do we have in the bank account? No calculations are shown. Do we have money in the bank account? 248 and all. Now, how much we have to pay to Z? Sorry, not Z, Y. Y is having 740. Correct? We have to give Y 740 plus we have to give him a share of. We have to give him a share of goodwill. How much was the share of goodwill? 3,12,000. Yeah. 3,12,000. His share of goodwill. And then we have to give him his share of revaluation also. That is 55,000. Is it 55,000? Yes. And we have to give him his share of reserves. What is the share of reserves? 5,10,000 into 2 by 6. 5,10,000 into 2 by 6. That makes it 1,70,000. What is it totaling to? 12,77,000. This is the problem. The problem is we have to give him 12,77,000. But how much do we have in bank account? 2,48,000. We have how much? 2,48,000 in the bank account. And see the fun part. See the fun part, okay? Random bank balance. 41,000 and 17,000. So the partners have to bring money. Both the partners have to bring money to give him. Are you getting this? Both the partners have to bring money to give him. So what I'll do is, I'll prepare the proper capital account only. So that you know what is the solution. X, Y, Z, X, Y, Z. Okay, by balance brought down. From the question, it is 970, 740 and 380. 9,70,000, 7,40,000, 3,80,000. Now, reserves. You will write by reserves. Reserves are 5,10,000. So, divided by
5,10,000 into 3 by 6 or 255. 170.
85. Yes. This is your reserves. After you are done with reserves, what is the next thing? Next thing is the goodwill. Correct? We had passed one entry for goodwill, right? So goodwill, these two partners capital account is debited. So you will write to Y's capital account and write under Z. Under the respective partners, you will write 117 and 195, 1,17,000 and 1,95,000.
Then here you'll write by X capital account 1,17,000, and here you'll write by Z's capital account 1,95,000. Clear? Then the only adjustment that we had to do was for that revaluation up and down. So now what we are going to do, X and Y again will be debited, and X and Z will be debited to Y. So we'll write to Y's capital account, and again you are going to write 2625 and 34,375, and here you will write by X capital 2625 by Z's capital 34,375. Actually this is it. Okay, if you look at the question, we don't have anything else that will bother us over here. Now what they told was that person has to be paid on the same day, right? That person has to be paid on the same day. So here you'll write to bank account. You'll write to bank account and settle by 240. Yeah. We got that number that time. 12,77,000. Remember we did that short calculation here, 12,77,000. So you'll write to bank 12,77,000. Now if I open bank account, clear, in bank I already had some balance. How much was the balance? 2,48,000. That was my opening balance, 2,48,000. Apart from that, we have not sold anything, nothing. Okay, so directly by Y's capital 12,77,000. Now if you check, okay, 5:3 is the new ratio. 1118. Wait 1 second. Okay. There is no making capital proportionate. I was just checking if the institute made the capital proportionate randomly. They didn't make it. So now the question is, in the bank, we have shortage, right? Can you see we have shortage? Who will bring? The partners only have to bring, right? Who will bring? Which partner will bring? X and Z only has to bring. In what ratio they'll bring? 5:3. Their new ratio only they have to bring it. So, to X capital to Z's capital. 1 second. 10,29,000 into 5 by 643 125 385 875. This is the amount. Okay, so you'll write by bank 643 125 and 385 875. Okay, after doing all this, just check what is the balance carried down. Four lakh. Are you sure? What balance are you giving? 17,30,500. $621. This should be the balances, guys. This should be the balance, no? And the bank balance should become 0, right? Are you getting it? Okay. A lot of missing things are there in suggested answers. They have not given anything. Clarity is not given. Okay. Now see, the problem is why he has to be given all this money. His balance, his reserve share, his goodwill share, his revaluation profit share. All this has to be given to Y. And to give to Y, we don't have money. 12,77,000 we have to give. Now if you check, any asset is sold? No. So from anywhere JLP is there? No. From where money can come? Nowhere. Bank balance in the question was how much? 2,48,000. Assuming that cash we are not going to touch only. Let the cash be like that only. Anyways, it's only 17,000. It won't make much difference to us. So 2,48,000. So 2,48,000 if there is a bank balance and you are going to pay 12,77,000 from somewhere, somebody has to bring money, no? Who is that somebody? X and Z only has to bring in the ratio. Clear? Yes, guys, that's it. So the numbers won't match, but you'll have to solve it this way. Clear? They have just given direct answers. Think whatever you want, do whatever you want. Yes. Is this there in the study material? No, right? Exam questions you won't find in study material. You will find in other study materials. If you know, you know. You'll find it in other study materials. Randomly, they'll pick from anywhere. Yes. So June done. We'll look at the end and see if there is any other question. Branch, insurance, yes. Nothing. Done. June is done, guys. Let's go into December. December 23, question number 5 again, partnership. Let's go to the end and see what they have asked. Huh? What? Is it? So now, let's go into this. A and B were carrying on business as equal partners. Okay, 1:1 ratio. The firm's balance sheet, okay, as on 31st December 2022 was as follows. Capital account is given, bank loan is given, current liabilities, sundry creditors, bills payable, fixed assets, you have building, machinery, furniture, current assets, all these assets are there, done. Now, the business was carried on till 30th June 2023. Where did we start? 31st December 2022, and business was carried on till 30th June 2023. For 6 months, they carried on the business. Partners withdrew in equal amount half the amount of profit made during the period of 6 months from January to June, after charging depreciation and all like this. So, whatever profit they made for 6 months, right? Half the profit they withdrew. Okay, half the profit. Okay, during the period, whatever they made. Now, we don't know their profit yet. All these depreciations were done. Meanwhile, sundry creditors were reduced by 15,000, bills payable by 2,500 and bank loan by 20,000. On 30th June, stock was valued at 7,09,000. Book debts were 75,000. Cash at bank 2,500. On 30th June, the firm sold the business to limited company for 4 lakhs, payable in equity shares of 10 each. So 6 months they did the business. After that, they have sold. The partners decided to take shares in the profit sharing ratio. Any difference to be settled in cash. You are required to prepare statement of net assets on 30th June. So we need the net asset of the partnership firm. So now, let's see how much they have sold. They have sold a lot. Net assets 9,70,000. They have sold a lot. Net asset 9,70,000 on 30th June. Very good. Now, what is the leasehold building? 80,000, right? Leasehold building, what they told? Leasehold building, they told the 10% depreciation. Okay, so 80,000 minus 5%, not 10%, 5%, 76,000, because half, no. The plant and machinery, they told 180. 180 minus 5%, 1,71,000. Furniture, they told 10%, so we'll take it 5%. That means 19,000. Okay, stock. Did they tell us what was the closing stock? On 30th June, stock was valued at 7,09,000. So 7,09,000 is the stock. Anything did they tell about book debts? Book debts were 75,000. Okay, book debts were 75,000. Anything about cash at bank? Cash at bank, they said 2,500. So cash at bank 2,500. Then what did they tell? Creditors were reduced by 15,000. That means creditor is showing 70 here. We'll make it 55,000. Bills payable by 2,500. 10,000. We'll make it 7,500. What else they have told in that sentence? Nothing. So now you just check 760, 171, 19,000 plus 709 plus 75,000 plus 25,000 minus 55,000 minus
7,500. 7,65,000.
So that is 2,500.
Oh, 2,500. I took it at 25. Huh? 7. 940. Which 940? This is 940. How? 760 and 171 there only first. Oh, that is my bad. I'm taking it as 70. It is 76,000, right? I'm taking from that time as 760. 76,000, 171,000, 19,000 plus 7,09,000 plus 75,000 plus 2,500 minus 55,000 minus 7,500. 9,90,000. Is there a bank loan? Oh, bank loan 40,000. So let's assume that this is like this only. 40,000. Are you sure? Oh, bank loan became 20,000. Okay, bank loan became 20,000. So just check now. Is it matching with the 970? I think it should match with 970 now. 990 it was. So if you remove 20, it will become 970. No? What? Yes, 970 is your net assets. Net assets on that particular day. And then they said statement of profit earned during the 6 months. Net profit earned during the 6 months is 13,60,000. Yes. Direct. Okay. How? We don't know. This is supposed to be suggested answers actually. We don't have any suggestions. Okay. So 9,70,000 is a net asset. Correct. Now, what was the net asset at the starting of the year? What was the net asset at the starting of the year? 4,10,000 was the asset minus 80,000 minus 40,000. What was it? 2,90,000. So now, opening capital was 2,90,000. Closing capital was 7,70,000. Are you getting this? So 770 minus 2,30,000. One second. 138 plus 1. 2,90,000. Sorry. Minus closing capital of 770. Now, you have to do some in-depth calculations, guys. See over here. Partners withdrew in equal amounts half the amount of profit made during the year. Okay, from January to June after charging depreciation. Now they have asked you statement of profit earned during the period 6 months. Now they are giving you a profit of 13,60,000 net profit earned during the period. Now this is the net assets 9,70,000. That means this is the value of their partners capital. Okay, this should be the partners capital. No. How did this become 9,70,000? Only if they make profit. Are you getting this? See, all these adjustments which we did, building value going down will cause a loss of 4,000. Plant and machinery going down also will cause a loss 9,000. Furniture going down will also cause a loss of 1,000. Stock going from 60 to 7,09,000. You know, when there is closing stock increase, that's going to cause a profit. So that is going to cause a profit of 6,49,000 profit. All these are loss. Clear? Book debts have increased. That means they have made some credit sales maybe. 7,000 profit. Are you getting this? Cash at bank increase 500. Okay. And here bank loan decrease will create a 20,000 negative situation. Okay. Sundry creditors decrease 15,000. Only this way you can do it. The profit calculation. Okay. Now again I'll write it instead of that. What are we expected to learn from suggested answers? Nothing. Okay. Now stock.
60 became 7,09,000. Okay. Now, if I compare just the net asset, right? Now, net asset here gave me what? 7,70,000. Whatever the new net asset, we got 7,70,000. And the old net asset, if you see, it is 2,90,000. Okay. Now, with that, 2,90,000 and 770, if I just see the difference, I'll not be able to calculate 290. I'll get 4,80,000. 4,80,000 is the situation. Correct. This is the difference. Now, this is the difference of what? This is the difference remaining in the partner's capital account. This is the difference remaining in the partner's capital account. And here they told partners withdrew in equal amounts half the amount of profit made during the period of 6 months. If half is withdrawn, that means other half is remaining. So can I just take into 2? I'll get 9,60,000. I'll get 9,60,000 as a profit. Half is withdrawn, no. So half is there in the partner's capital account. Half is not there in the partner's capital account. So this should be your profit, 9,60,000. But they have decided to put 13,60,000 random. Are you getting this? There's no other way. If you calculate item by item also, you should get 9,60,000 only. There's no other 4 lakhs, no. What? Did you get it? No, not 1360. 960 did you get it? The 1360, God only has to help us to get 1360 there. Okay, now see, again I'm explaining. Closing capital. See, asset minus liability is equal to capital. So asset minus liability at the end was 770 and this was also told by them also to be 770. Now asset minus liability is equal to capital and asset minus liability at the opening was 2,90,000. That is from the question which is given. Now if you see the difference, increase in capital is coming to 4,80,000. How can capital increase? How can capital increase? Because of profit. Obviously they have not put additional capital because of profit. Now what profit is there in the capital account is only half the profit, because whatever profit they made, they have withdrawn that. So this, if it is half the profit, what is the full profit? 9,60,000. Is it clear? Yes. Now, what else did they ask? Realization account. Realization account, what will you do? You will just transfer everything. Book values. Whatever is there in that balance sheet, you just transfer over here. You will get the book value. So basically, finally, loss on realization 1:1. No? Yeah, equal ratio, right? Now, understand this. Company has agreed to pay them some amount. How much? 4 lakhs. Now, just explaining to you from there only. If you want, see, assets 80,000. Transfer to realization account. So after revaluation, they're transferring. They're revaluation, right? That means I can't look at that balance sheet. I have to look at this balance sheet. I have to look at the side balance sheet because it is done on 30th June. So 76,000, 1,71,000, 19,000. Stock 7,09,000, sundry debtor 7,000, 75,000 and 2,500, whatever revalued figures. Bank loan 20,000, sundry creditors and bills payable, all the new figures which we had taken. Correct? And now, whenever a new company is taking over and they are going to give us money, that is a PC entry. PC entry, new company is going to give us money. New company has agreed that they will give us 4 lakhs and 4 lakhs will be credited to realization account. So here we are getting a loss. Loss is transferred to partners' capital equally. 1:1 ratio. Are you getting this? Any doubt with this? Yes, what's the doubt? Yeah, but that is not profit, no. That is what they made the mistake. See, they said statement of profit earned during the 6 months. After 6 months got over, then the company was taken over. So 9,60,000 plus 4 lakh, if you add, you will get 13 lakh. But this is not profit, no. This is the amount paid by them to purchase our company itself. Are you getting it? So they have added it and shown 13,60,000. But is it profit? The 6 months period ended on 30th June. after the period ended, then our company was taken over by somebody else. Are you getting it? Okay, so let's keep that as 9,60,000 only. And here you're getting loss. This, I don't think there is a problem. Capital account of partners. Capital account of partners. This is balance brought down from where we are getting it from the question itself. 138 and 152. Then random numbers. Okay, fine. See, 680, 680. They have put that capital. Actually, this will be 9,60,000 into 1 by 2. 4,80,000, and the remaining 2 lakh is the purchase consideration which you are going to get from the new company. New company is going to give us 2 lakh purchase consideration, 2 lakh, 2 lakh. Clear? Loss on realization from realization account only. Drawings is that half amount they are going to withdraw, and then to equity share capital is they are going to get 2 lakh, 2 lakh in the new company. There is going to be a difference. Obviously, one person, if there is an imbalance, one person has to give money, one person has to get money. Okay, but nobody does plus 7,000, minus 7,000 there only in the partner's capital account, but they have done it. Okay, it should be actually what? Whoever is minus 7,000, it should be on the debit side. Credit side, we should put 7,000. Clear? Okay, but anyways, this is just for understanding. But obviously, you will not do add less like this in the capital account in the exam. Okay, just do whoever is giving that partner's capital account debited, whoever is getting that partner's capital account credited. Clear? That should be it. Then do we have one more question? Partnership. 8A. And this was asked for 4 marks. On the basis of above information, answer the following. How much interest should be allowed to on A's loan of the firm? Is it a charge or appropriation of profit? Okay. Now A and B were partners in a firm and their capitals was 5 lakh and 3 lakh respectively on 1st April 2022. Profit for the year ending 31st March 2023 amounted to 2,10,000. This is the profit. Drawings of partners were 1 lakh and 60,000 respectively. It was observed that the following errors were committed while distributing the profit. If errors are committed, obviously we have to take the profit back. Now, manager's commission of 10% on the profit before charging such commission was omitted. 555, 5555. What are we even expecting? Answers. Very good. MCQ questions, they have given the answers. Yes, let's go further. Now, closing inventory was valued at 70,000, whereas its net realizable value was 50,000. Okay. NRV. We should have taken it at NRV actually. Outstanding salary of employees 40,000 was not recorded. A had given loan of 1,50,000 to the firm on 1st December. Interest was omitted to be recorded. Loan was given to B. They are asking what how much interest should be allowed on A's loan, right? So 1,50,000. Can you find a percentage for that 1,50,000? Into 6% into 4 divided by 12. Because they did not find a percentage, they did not give a percentage. Interest on loan is always adjusted at 6%, right? And 1st December was the loan into 4 divided by 12. So you will get 3,000 as the interest. That was your first question. And they said whether it is an appropriation or charge. Okay, that they have answered. It is to be treated as a charge against profit and debited to P&L. It's a charge against profit because it's a loan. Okay, when profit distribution happens, that is appropriation of profit. Okay, now next. What is the amount of net profit? That means correct net profit we have to take, right? So, what is the wrong net profit? Profit for the year amounted to 2,10,000. So, I'm just putting 2,10,000 on the credit side. Then, drawings of the partners will not bother the profit. Manage is entitled to 10% on the profit before charging such commission. That should be the last item now. Now, I can't take that, right? So, now 2,10,000 was the profit for the year. Was omitted. So, we didn't give it at all. So, nothing to be worried about. Closing inventory was valued at 70, whereas its realizable value is 50. If at all closing inventory goes down, that means 20,000 loss. Clear? A had given a loan of 1,50,000. Just now we calculated that interest. Interest is 3,000. Then loan was given to B on 1st July, amounting to 1 lakh, bearing interest of 8%. Interest was omitted to be charged by the firm. So calculate 1 lakh into 8% into what? 9 divided by 12. Why 7? 9 divided by 12, right? 6,000. Put that 6,000. Okay, I'm showing the calculation if you want. 1,50,000 into 8% into 9 divided by 12 because the loan was given on 1st July. Then after that, you have interest on capital at the rate of 6% per annum was not allowed, and interest on drawings was not charged at the rate of 10%. Interest on capital and interest on drawings, does it go to P&L? No, it goes to P&L appropriation. So that should not be bothering us actually. Interest on capital and interest on drawings is after the commission. No, it's not before the commission. So now, right now, what should be the correct profit? How much? 193. Yeah. Net profit. Random. Okay. 193. I am having a strong feeling that interest on capital and all they put into P&L itself. Okay. Here we are getting 193, right? As the profit. Okay. Profit. And what is the commission? Commission is 10% on profit before charging commission. So on that 10%, if I take 19,300, so 1,73,700. This should be the profit. This should actually be the profit. Let's try to check what they have done. Okay, we are sitting at 193. Let's say we are sitting at 193. Okay, interest on capital. Interest on capital 6% per annum was not allowed. Okay, capital is how much? 5 lakh and 3 lakh, so 8 lakh. 8 lakh into 6%, 48,000. 48,000. Then drawings, how much was the drawings? 1,60,000. On that they said 10%. 16,000. But we'll take 8,000. 1,60,000 into 10% into 6 divided by 12. We'll take 8,000. Clear? I'm just trying to match the answer, okay? The correct answer is not going to be the one, even if it is matched. Minus 48,153. I just want to check what they did wrong. Minus 19,300. Wow. Still I'm not able to match. It's 133,700 it's coming. Are you getting it? See, first of all, rule number 1. You cannot put interest on capital and interest on drawings to P&L. It goes to P&L appropriation account. Okay. Rule number 2. Commission is always before this interest on capital and interest on drawings. Imagine you are telling this person, what is that? The whoever agent, manager who is there. You can't tell the manager, no, I'll take my interest on capital. After that remaining amount, I'll give you commission. He has done work to generate the one which was there before that. So your actual interest on capital, your interest on capital should happen later. 173,700 should have been there. 173,700. If at all they do a mess up also, it should be 133,700. Okay, but it's showing 137,700. Okay, very good. Divisible profit. Divisible profit is what? Finally, what should be remaining? Now, what should be remaining after all this is one. Let me put that 19,300 here. 193 plus 8,000 minus 48,000 minus 19,300. Yes. 133,700. Clear? This is the divisible profit, right? Okay. Then after that, the last thing is, what is each partner's profit share? That you just divide. Okay, that you just divide. Obviously, we can't match that answer with the suggested answer because they are in the wrong, they are in the wrong situation altogether. And they have not given the profit sharing ratio. Have they given the profit sharing ratio? No. So it should be equal. Have they at least taken that equal? This they have taken equal. 1/2. Yes. Okay. Let's hope that such errors are not there even in the model test paper, and it will take us more time to finish this. Let's go for the guess. December done. Yeah. So we are in this December 2023 set 1. December 23 set 1. P, Q, R and T have been carrying on business in partnership, sharing profits and losses in the ratios of 4:1:2. Set 2, yeah. 4:1:2:3. The following is their balance sheet as on 31st March 2022. Okay, capital, all this, and they have said that they are going to dissolve the partnership on 1st April 2022 on the basis of the following points agreed upon. Now, realization account, bank and cash account, capital account of partners. Now, first we have realization account, bank and cash account, partners, capital account. Now, we'll try to do one by one. First, what can we see over here? Premises. Okay, premises should be transferred to realization account. Can you see premises here? 2,80,000. Okay, one by one. First, all the assets and liabilities should be transferred at book value. So next thing is furniture should be transferred to realization account, 30,000. Next thing is stock in trade transferred, 2 lakhs. Next thing is trade debtors, 3,50,000. 3,50,000, and provision is 50,000. Provision will be on the opposite side. Provision 50,000. Clear? Next, after that you have cash at bank. Cash at bank you will not transfer to realization account. In your bank account, that will be your opening balance, 1,40,000. 1,40,000. Next you have capital account. See, two partners capital account is sitting on this side. That means they have debit balance. So you will find here 2 balance brought down. 2 lakh, 1,50,000. Clear? Then after that, after that we'll go into the other side. You can see 2 partners are, I think this question is in study material, right? 7 lakh and 3 lakh. Okay, 7 lakh, 3 lakh. You can see 7 lakh and 3 lakh over here. Okay. Then after that we go further, and trade creditors showing 3 lakhs. Transfer to realization account, 3 lakhs. Now at this point of time, if you notice, your balance sheet empty. Your balance sheet is empty. After that, whatever you are going to discuss, right, it should be between realization account, partners capital account and bank account. Anything after this should be between these 3 ledgers. Now, first, P is to take over the trade debtors at 80% of book value, 3,50,000. So 3,50,000 into 80%, 2,80,000. P is going to take over. So P has to give us money. So P's capital account debited to realization account. So in realization account, you are finding 2,80,000, and P's capital account, you will find 2,80,000. Clear? Yes. Next adjustment, T is to take over the stock in trade at 95% of the value. What is the stock? 2 lakhs. 95% will make it 1,90,000. Okay, he's going to take over. So T has to give us money now. So T's capital account debited to realization account. T's capital account debited to realization account. Clear? Sorted? Next, after that, R is to discharge trade creditors. R will pay the trade creditors. We just saw the trade creditor was 3 lakh. So realization account debited to R's capital account. R is paying the money. So we have to pay money to R. Okay, so to R's capital account 3 lakhs, and here you can find 3 lakhs. Okay, sorted. Next, realization. The realization is premises got us 2,75,000 and furniture got us 25,000. So we sold these 2 things and we got money. So bank account debited to realization account, 275 and 25 should become 3 lakhs. Assets realized 275, 25, 3 lakhs. And in the bank you should get 3 lakh money. Then next, expense of realization is 3,000. So realization account debited to bank account, realization account debited, and here to bank account. Done. Now Q is found insolvent and 21,900 is realized from his estate. Okay, so we remember that Q is insolvent. The loss arising out of capital deficiency may be distributed following the decision of Ghana versus Murray. Everything is fine. First we have to close the realization account now to do anything. So when we close the realization account, you are getting loss. Can you see loss will be distributed to everybody? PQRT, and it's in the ratio which they have told 4:1:2:3. So you can see 4, 1, 2, 3, all multiples of 7. Okay, so you got this value. This will go to partners capital account. Can you see partners capital account? You are getting transferring it over here. Now this is the rule of this thing. Okay, dissolution. Whenever there is a realization loss, immediately the partners will bring money for that realization loss. But which partners will bring money? Only the solvent partners. Now you are like, sir, solvent partner only P and T, don't look at the balance and decide. Q and R didn't have balance, but in that who is insolvent? Only Q is insolvent. R had debit balance, no problem. Somebody has to pay money, but he's solvent, right? Just because somebody has to pay money, we will not always consider that that partner is insolvent. So now, as soon as you get realization loss, what you should do is the solvent partners, Q is not solvent. So the others will bring money immediately. Realization loss means what? To pay my liabilities, the assets that brought money was not enough. The assets that brought money was not enough. So that is realization loss. So immediately what we will do? 28 came this side also, 14 came this side also, 21 came this side also. They are bringing money. And you can see that they are bringing money. Bank account debited 28, 14, 21. 28, 14 and 21. That Q's amount I'll discuss that. Okay, 28, 14 and 21. Now, then they told in the question that Q is able to give 21,900. So again, what is entry? Bank account debited to Q's capital account. So that is why you have this bank account debited 21,900 and Q's capital account 21,900. Now you have to understand one thing. Okay, Ghana versus Murray, what does it say? What does Ghana versus Murray say? What does it say? Insolvent partners balance loss has to be borne by solvent partners in capital ratio. Now see the fun part. Okay, solvent partners are P, R and T in capital ratio, but capital is there only in P and T. Capital is there in only P and T. So it will be in the ratio of 7:3. Okay, now if you see capital, just check Q. What is the situation? 2 lakh plus 7,000 minus 21,900. I think it is 1,85,100. Can you see into 7 by 10 you will get 129,570. Into 3 by 10 you will get 55,530. Are you getting these numbers? So can you see this is actually shared in the ratio of 7:3 because of their capital. Now what will happen? This partner is gone, no? Remaining partner, what they will do? Will they share the profits? Will they share the money in the bank account in profit sharing ratio? No. You have to check each partner's capital account. If they have credit balance, they will take money. If they have debit balance, they will bring money. If you see Q over here, for Q, right, there is lot of money on the credit side. Debit side, it's only this much. That means Q will take money. Q will take money. So this is the balancing figure. You will write, not Q, P. P will take money. P's capital account debited to bank account. R also, if you see, credit side is more, debit side is less. R's capital account debited to bank account. T also, actually, if you see, credit side is more, debit side is less. T's capital account debited to bank account. Done. Do not distribute the bank balance in profit sharing ratio. Then your capital will still have balance. You have to check each partner's capital account. Credit balance, that means we have to give money. Capital account debited to bank account. Debit balance, that means he has to give money. Bank account debited to partner's capital account. Is it clear? Yes, that is the one question which was there for 14 marks. Is there any other question in that particular model test paper? Done. This is your June set 1. Okay, revaluation account, partner's capital account, partner's current account, C's loan account, bank account, balance sheet. Anything else? Anything else? Tell everything. Okay, in one question only. Now, let's go into this one. A, B, C are in partnership sharing profits and losses in the ratio of 3:2:1, respectively. The balance sheet of the partnership firm on 31st March 2024 is given. This is their balance sheet. Capital account, current account. Okay, one current account is missing. That means no balance in that partner's current account. When current account comes usually? When there is fixed capital. It's called as fixed capital. Okay. Now, loan from C. Creditors, bank holding, premises, plant, vehicles, fixtures, current account. Current account. I think this is the value. Stock, debtors, cash in hand. Clear? Now, C decides to retire from the business as on the above date and D is admitted as a partner on that day. That means one partner is retiring and one more partner is being admitted. The following matters agreed. Assets revalued as follows. Okay. The first thing that they asked is revaluation account. So let's close that. Premises becomes 240. How much is premises right now? 180. That means 60,000 increase in the premises. So you will find 60,000 in the revaluation account. Clear? One by one we'll try to do it. Plant 70,000. What is the plant value here? 74. That means 4,000 reduction. 4,000 loss. Then next, after that, stock 108358. 108358. That means 124,758 minus 108358. You're getting 16,400 loss. Debit. Provision of 6,000 is created against debtors. There is no provision in the existing question. So directly 6,000 loss. Done. After that, goodwill is to be recorded and all they have spoken about. So revaluation only this much. So whatever revaluation profit is there, it will go to partner's current account. Why partner's current account? Because they have maintained fixed capitals. So this will go to A, B, C in their respective profit sharing ratio. Okay. So directly into partner's current account. These amounts I am putting into partner's current account. Clear? Discussed? Next, let's go further. Goodwill is to be recorded in the books on the day C retires at 84,000. Partners in the new firm do not wish to maintain goodwill account. So that amount is to be written off against the new partner's capital account. So basically what? Goodwill will never come into books, right? So goodwill is just to see who is giving or who is losing and who is gaining. Now, A and B are to share profits in the same ratio as before. D is to have the same share as profit of C. A, B, C. Correct? Who is going? C is going. So now we have A, B, D. We have A, B, D. Yes. So A, B, C, the ratio was 3:2:1. ABD, the ratio is 3:2:1. Correct. So basically, if you notice, A and B will share same profit sharing ratio as before. And D is to have the same share as C. So C is going. So basically, whatever C is sacrificing, D is gaining. D is gaining. So take this goodwill of 84,000 and do 84,000 into 1 divided by 6. You will get 14,000. So 14,000 that new partner should give to old partner. So 14,000. See, all this circus is not required. Okay. Buy goodwill, to goodwill, circus is not required. Okay. It's not necessary. Just 14,000 you give it to C and 14,000 you take from D. If you see the net result of this, okay, buy goodwill, simply created goodwill. Now tell me one thing, what is the logic of doing this when A and B are not sacrificing? Are you following this? A and B are not sacrificing only, no. How can you write 42,000 here and 36,000 here? 28,000 here and 24,000 here. And D, 24,000 for D, okay. And random number again, 14,000 here. Are you getting this? Is it the same thing in the study material also? Okay. Now, see this. I'll tell you why it is wrong. Here, A and B are to have same profit sharing ratio. And goodwill distribution is always going to be done in sacrificing ratio. A and B are not sacrificing, guys. A and B are not sacrificing. If you do this, no, you know what will happen? A will get 6,000. A will get 6,000. A is not sacrificing. A is not gaining. He is getting the same amount as before. And here B will get 4,000. Actually for this, the entry is D's capital account debited to C's capital account 14,000. How did I get this 14,000? That goodwill. What was the goodwill? 84,000. Huh? Are you sure? 84,000 into 1 by 6. Yes, 84,000 into 1 by 6. 84,000 into 1 by 6. 14,000 is to be given by the sacrificing partner, gaining partner to the sacrificing partner. So 14 should have been quietly coming into D's account, and it should be going into, see, this fellow is getting 14. Now unnecessarily this fellow is giving 24. Why will he give 24? Why will he give 24 when his share of goodwill is only 14? Can you see this? This is the 24 extra 10 going over here. Okay, I hope you got it, guys. Okay, next. C is to take a car at its book value of 7,800 in part payment, and the balance of all he is owed by the firm in cash except 40,000 which he will be willing to leave as loan. C will take what? Car at a value of book value of 7,800. So see over here, C's capital account. Where is the car? Car is driven away. Okay, they have prepared separate loan account only for C. C has one loan, right? In the books you saw the loan. Can you see there is a loan in C's books? Can you see loan of C? 56,000. Now 56,000 is loan. Clear? Now they adjusted the vehicle with the loan. Fine. They can adjust it with capital also. They adjusted with loan. So 7,800 adjusted. Clear? And in C's current account, go and check the question. How much is there in C's current account? Whatever balance is there in C's current account. Okay, this is the balance. This when you total, you'll get this balance. This balance straight away goes to C's loan account. Goes to C's loan account because you have to pay the money, right? C's loan account, and then C's capital account. Whatever balance is there in C's capital account, 84,000. That also straight away goes to C's loan account. So this is the total now. Okay, now when that is the total, they told 40,000 to be retained. Can you see they said that except 40,000 pay everything. So therefore, you will have 40,000 over here, balance carried down in his loan account. Remaining everything has to be paid. So 1,07,156. Are you getting this? Basically, C already has a loan. Car, he is taking car. So loan account will reduce. Current account, there is a credit balance. That means he has to get money, transfer to loan. Capital account, there is a credit balance, transfer it to loan. Now they said pay everything except 40,000. 40,000 will remain as loan. So this 40,000 which is remaining as loan, later on if they are going to prepare balance sheet, you will see that 40,000 as loan. C's loan will still be there in the balance sheet. Clear? Now after that, see the bank account. There is still more work to be done. Partners in the new firm are to start on an equal footing so far as capital and current account are concerned. D is to contribute cash to bring his capital and current account to the same amount as the original partner from the old firm who has lower investment in the business. Original partner in the old firm who has higher investment will draw out cash so that his capital and current account balances are equal to those of new partners. What are they trying to tell? Unnecessary language, but what are they trying to tell? They are telling that we'll make capital proportionate. Whoever has more money will take it. Whoever has less money will bring money. That's all. See this. Original partner in the old firm who has higher investment will draw out cash. Whoever has more money will take money. Whoever has less money will bring money. Clear? Now, revaluation profit or loss to be adjusted in partner's current account, that we have already adjusted. Now, we have discussed revaluation account. We have discussed most of the things over here. Now, bringing money and making capital proportionate. Okay. Understand this? Can you see over here? They said every partner should have equal capital. They said we'll start on equal footing. Equal footing means what? All partners should have equal capital. Now, equal capital, how are they going to do that? See, equal footing so far as capital, and D is contributing cash to bring his capital and current account same as the amount of original partner. Who was the original partner from the old firm? Original partner from old firm was C. Correct? Now, can you see, because of that, 134, 134, 134. 134, 134, 134 is the capital. They are all going to start with equal capital. If you see earlier their capitals were not equal. Their capital was what? 370 in different ratios, right? 370 in different ratios. Now here, if you check C's capital account, okay, C is bringing money. Now this number also will change. When you change the solution, right, this number also will change. Why? Because C, this fellow D, no, poor guy, he doesn't have to pay 24,000. He has to pay how much? Only 14,000 he has to pay. So they made all the capitals proportionate. Then what did they do? Whatever is there in current account, what will be there in the current account? This also has to be equal. Are you getting my point? Capital account and current account, both the balances have to be equal. So when to make it equal, what will you do? If somebody has shortage, they'll bring money. See over here, by bank account. Somebody has shortage, they'll bring money. Somebody has excess, like A, he will take money. Here also in capital account, D has to bring money. But can you see, okay, nobody is having a shortage. So no one is taking money. Yeah? Everything is matched. Okay, now bank account, same thing, whatever we discussed in the partners capital account and partners current account, wherever people are bringing money, wherever people are taking money, everything will impact the bank account. I'm not going to discuss that. And balance sheet, we already know the revalued figures. We have done the revaluation of premises, plant, whatever they have told. Can you see provision for bad debt also? Everything will be the revalued figures. Only thing that you have to remember is this bank is the balancing figure which came from bank account or cash account. And other than that, capital and current account is what we created. We wanted it to be equal. We created, and C's loan account is 40,000 which we kept. Everything else is done. That's it. This is your balance sheet, guys. Okay. Let's ensure that they don't make the same mistakes when they give in the suggested answers. Do we have any other question in this? Yep. They have a partnership question here. Now see here. S and N are partners sharing profits and loss in the ratio 5:3. They admit J into the partnership for 3/10 in the profits, in which J acquired 1/5 from S and 1/10 from N respectively. Calculate the new profit sharing ratio for 4 marks. NPSR for 4 marks. So 8C. Okay. So now see, who is the partner here again? SN. Okay, new partner is whom? J. SN are already there, J comes. And J is going to get what ratio? J is admitted for 3/10 share, but they said that 3/10 is there. No, 1/5 he'll take from S and 1/10 he'll take from N. Now, S share 1/5 goes away and N share 1/10 goes away. So you have to find the LCM and all that things, and you have to find the value. 17/40, 11/40. But this fellow was 3/10. Now to take 3/10 to same terminology, what will you do? Into 4. Into 4. So this fellow will become 12/40. So 17:11:12. New profit sharing ratio. I hope it's clear. For 4 marks, it's too much. Okay, so that should be it. That was the 7th. We have still 6 more model test papers to do. Okay, we'll do it after the lunch break.